Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So in this session, we are going to get started with a brand new chapter called as Cost of Capital, right? So guys, this is one of the most important chapters in your entire syllabus. And what you learn here is also applicable in your CA Final Advanced Financial Management. And at your intermediate level, every single attempt, your exam paper will never get printed without this particular chapter. One of the most important chapters in your syllabus. Is that clear? And this chapter will have an impact in some of the remaining chapters in the syllabus also. Such is the importance of this particular chapter, guys. Right? Shall we begin? Yes, fine. Now, guys, before we get started, so you guys like stories? Okay, so I would like to share a small story. So before we start every chapter, maybe I'll just give you guys a small motivation. I'll just narrate a story to you all, and then we will quickly get started. Shall we, guys? Yes. So this story is about a guy called Elon Musk. So how many of us know this guy? Elon Musk? All of us, right? Fine. So what is this guy known for? So predominantly Tesla. Okay. Now let me tell you the life story of this guy is something that all of us need to learn from this particular guy. And by the way, this guy is the world's most richest person as on date. Now this guy was born and raised in a small village in South Africa. And growing up in his childhood, he felt that he wanted to make it big in his life. Hence, he wanted to go to the US. Right? He felt that's the most happening place in the entire world. That's where you can grow easily and make it big and achieve your dreams. So what this guy did was, so once he completed his schooling and all, so he went there to the US. So he did certain things, like he did some academics there, and he started off his own startup. He started his own company. Initially, there were a lot of struggles he couldn't get through and all these things. And finally, he started one company. It was a fintech startup, means your finance technology related, right? Back then, in the late 1990s, right? So 1995, 1996, around that time, 1995 to 2000, around that time, internet was booming. He came up with a revolutionary idea with respect to a fintech space. So today we all use this, right? So something like PhonePe, GPay and all, not exactly like that. But you guys have seen Razorpay? Yes, that's a payment gateway intermediary. Similar to that, this guy founded one company, and it was a very, very valuable company. So some investors, they felt it was extremely valuable. They paid him so much of money and bought this company from him. Now, at a very young age, he became a super rich guy. And for those who do not know, the company he founded was actually called PayPal, right? Today, it's actually called PayPal. This was ideally founded by Elon Musk, right? He has nothing to do with the company anymore, but he sold it off. Now, at a very young age, so he made a lot of money. Now, any ordinary human being, what would we all do if we get that much amount of money? Settle, buy one big island in Panama and settle, right? So put some money in your, markets or FDs or whatever it is, and settle down for the rest of your life. But this guy, being extremely unique, you know what he did? He split this money into two. One part of the money, he invested it in a company called Tesla Motors. By the way, for those who do not know, Tesla was not founded by him. It was founded by Nikola Tesla. So it was a running company which he took over. And there was another company which he started up. This company was called SpaceX, right? This company was called SpaceX. Now, Tesla for another day. Now, this story that I'm going to share about is with respect to SpaceX. For those who do not know, he founded this company called SpaceX. The mission of this company is to transport human beings to Mars. Such a crazy idea. And this guy, Elon Musk, his role model was Neil Armstrong. You guys know Neil Armstrong? Who is he? The first person to set his foot on moon. That's what the history says. We don't know what happened, but whatever. That's another controversial thing. So this guy's role model was Neil Armstrong. But you know what? This guy started up this company with an intention of doing the impossible, that is transporting human beings to Mars. This was heavily criticized by so many scientists, including his own role model, Mr. Neil Armstrong. He said this is next to impossible. This is not at all possible. This will not happen. At least we are completely outdated with the space technology as on date. We need so many more hundreds of years to even for this to come up and all these things. But here, guys, the basic issue was with respect to, if you if you want to transport human beings to Mars, it's basically like Mars is extremely far away from Earth, right? For you to do that, the first thing which we need to invent was something called as reusable rockets, right? So if you see a rocket, a rocket is built with all this, the space technology that they use, rocket science as they call it. Rocket science, and we see when something is extremely difficult, no? So they have to use all the space technology. When in case of a rocket, when they are building it, the rocket has to be as light as possible, because more the weight means, it's difficult to carry. There are a lot of physics and so many things that goes beyond it. So honestly, I don't know beyond that. But one thing I know for sure, now for you to make a rocket to go to Mars and come back, right? Now there is no rocket that can carry so much fuel, which means the rocket can go and there it will just burst off. That's about it. Now obviously, how can we come back? So the first thing here is, forget Mars. Let us invent something called as a reusable rocket that goes to space and comes back. Now this itself was a very big task, not done, that was not done at the time when this guy started his company. He said, I will build reusable rockets. Many people once again criticized. They said this is definitely not possible. How can you build reusable rockets? It's like, let's say I'm starting from Chennai and going to Hyderabad. Now I go in a car. There I will just drop the car, buy another car and come back, is it? No, I'll use the same car, right? Now, in space technology, this particular thing was not there. So you cannot do it. That's the reason why, they launch satellites without human beings in it and all. Because only one way you can take the fuel. So there the rocket gets burst off. That's about it. They will destroy the rocket once it's, once it's launches a satellite there and all. It's not possible. This guy said, I will do it. Now, for you to build one rocket, I'm sure you guys must be aware, it takes years of efforts, billions of money, and which is equal to so much amount of some countries' government itself can run with the budget to build one rocket, right? That is the amount of money, time and efforts involved. Now this guy, he said, I will do it. Despite all these things, he pulled in the money, resources, he started this company, SpaceX, he did that. Years of research went by, and on the day of launch, they have a countdown, right? So 3, 2, 1. Now what happened in this particular launching pad? The rocket was there, and in the launching pad itself, it just got blasted into flames, and his first attempt was a biggest failure. Now people lost even more hope. They were saying it's not possible. We told you and all. Why do you do it? Now he said, no, I will try one more time. Now even those little people who were actually hanging on to him, those people also lost the hope. Anyways, first time you failed, what can you do? Once again, years of efforts, somehow he pulled a lot more money, and once again on the day of launch, after multiple years, right, the second attempt of launching. Now what happened on the day of launch? Now 3, 2, 1, and the rocket beautifully took off. But before it could move out of the Earth's atmosphere level, it just blasted off in the atmosphere, stratosphere, or whatever it is, the layer of atmosphere. It blasted off, and the second attempt was also a massive failure. Now this time, many others, his own team members, so many people, even they lost some hope and all. So they felt, no, this is not going to happen. Maybe we are working under the wrong direction and all these things. Now this guy said, I will try for one last time. And if this time, if it doesn't happen well, now I will repay all my debts and I will quit this entire thing and I will go away. Now guys, remember, with his own money, he cannot do everything. He would have borrowed investors, everyone. Now it's not an easy task, but he said, I will do it. Please just have the hopes in me and let me try this for one last time. One last time you give me. If I don't, succeed in this attempt, now I will give up everything. I will maybe sell my personal assets and I will just, he pledged everything. Said, I will give off. Even after paying, he will become a pauper only. Right? He said, I will do it. Now, once again, years of efforts went by. Once again, on the day of launch, money is invested, huge amount. On the day of launch, guys. Now what happened? This rocket beautifully took off. Now it went outside to the space and it launched that particular satellite, and it came back and it beautifully stood on. I mean, it stood in a place from where it was supposed to actually stand, and that was the time when history was created. And this man invented reusable rockets for the first time, which is a first step towards sending human beings to Mars. The first step. Till date, human beings can't be sent to Mars, right? But this was the first step, and this was when the history was created, right? And what happened after this? NASA called him, and they collaborated with him for $1 million deal. I mean, $1 million or $1 billion deal. They said yes. Now we are appreciative of your efforts, and we are, let's do a particular, project together, and all these things, guys. For your information, this man Elon Musk has nothing to do with space technology. He has no background there. When in an interview he was asked, how do you know so much about space technology? He said, I just read a few books and I hired some good scientists. This is what he did. But look at the level of determination he had. And the fun fact is, now I told you this guy Elon Musk, he had another company called Tesla Motors. Tesla is in the business of manufacturing electronic supercars, right? Electronic supercars, a very revolutionary idea there as well. He's built very good electronic supercars. Now what he did in this particular rocket, right? So along with that, in this rocket, he sent one Tesla car with a human being, kind of an astronaut sitting on it, not a real one. It's like an idle kind of thing, where in that it was written in the car, made in Earth by humans, right? So he did this so that, I mean, maybe if some alien sees this, maybe they must they can kind of figure out that there's some planet, and in that, some other species are living, that is us only. So maybe for that, but how they can read English, that we don't know. But whatever it is, some crazy idea, guys. The reason why I'm sharing this story with you all is that look at the determination the man had. Now, when he had the entire money with him, he could have happily and peacefully settled down for a very, very easy life. But he chose something. He came out of his comfort zone, and that's when he went on to create a history, and it's no doubt is world's #1 richest guy to date, right? The moral of the story here is, now this guy had a never say die attitude. No matter what, I will keep giving my level best, and let's see, it will only come out with flying colors. That's the attitude he had, and that is the reason he is where he is today. Of course, that guy is also doing a lot of crazy things. Now, everyone has both sides to them, but let's take good from everyone. Let's take good things from everyone. And this man, the kind of determination he had when every single thing in his life was at stake, his entire life savings is gone, right? At the third attempt, had he failed, now he would have become, poorer than a beggar, because a beggar has zero net worth. This guy has negative net worth. He has borrowed money, correct? To that level, he would have gone when he had everything in stake. Still, he went on to do it. Now, guys, just let's reflect on ourselves. Now, for us, CA exams, now, there, when we are writing an exam, do we have anything to lose? At the most, what will happen? Pass or fail. That's all, no? That's all, no? So what? So what? Worst case, if you fail also, so what? Next attempt. That's about it. I'm not asking you to have that mindset throughout so that not prepare. No, many students, they actually prepare well, and just before the exam they give up with the fear. No, guys, no. Now look at this. At most, what will happen? Just look at these people who have worked in extreme pressure when they had everything to lose, and still they didn't give up, and they just went on to create a history. Now, for you to grow up in your life, you definitely need to come out of your comfort zone. Now, if you stay in your comfort zone and being pampered throughout your life, that is a dead end for you, because you can never grow in life. The most important thing is come out of your comfort zone, and just keep working towards your goals. One fine day you will reach there. If not immediately, you will definitely reach at some point of time, and that's something that we all should learn from this guy Elon Musk, and that's the reason why I shared the story with you. Right, guys? Fine. So on that note, shall we get started with this beautiful chapter called Cost of Capital? Everyone? Yes? Right, guys, let's get started. Now guys, our subject, financial management, has how many objectives? Come on, everyone. 3 objectives. What are the 3 objectives of our subject? Financing decisions, investment decisions, dividend decisions. Now, financing decisions means what? Decisions taken with respect to fundraising activity. Correct? Yes. Now, fundraising activity means what? That is your sources of finance, right? So in this case, this particular chapter, cost of capital, squarely fits into the category of financing decisions. So what is the objective of this particular chapter? Financing decisions, which means this chapter deals with what? Your fundraising activity. Is that clear, guys? Is that clear? Everybody, are you guys clear with this? Perfect. Now, guys, let us say this is the balance sheet of a company. Let us say this is a balance sheet of a company. Now, the company raises money from multiple sources. Correct, right? The company raises money from different sources. Let us say from equity share capital, from preference share capital, maybe from debentures, right? From 3 different sources, they have raised money. Is that clear? Let us say they raised 30 crore rupees from equity route, 20 crore from preference, and 50 crores from debentures. Is that clear? Right? Overall, they raised how much? 100 crore rupees is the total capital raised. And once again, remember, when I say capital, I mean money, fund, total amount. Capital does not mean owners. No. Shareholders. No. Capital means money, funds. Is that clear? Now, you guys tell me, the company is raising money from different sources. Am I right? Now, whenever I'm raising money from each source, will it come free of cost or it will come with a cost? Tell me, guys, answer. It comes with or without cost? It comes with the cost, guys. Correct? Now, the cost, there could be some cost associated with my equity share capital, right? There could be some cost associated with what? Preference share capital. There could be some cost associated with debentures, guys. Correct? Right? Now, for every single source of finance, there will be a cost associated to it, guys. Correct? Now, let us say, for example, the cost incurred in respect of equity share capital, let us say example, right, is 18 or 12%. Let us say it is 12%. 12% is the cost. Remember, in our chapter, this cost, when I say the cost of capital, it is always expressed as a percentage. Are you all able to understand? Cost in this particular chapter is expressed as what? A percentage, and this is nothing but the discount rate which we actually studied in time value of money chapter. In time value of money chapter, R we calculated rate, right? So cost is always expressed as a percentage. Is that clear? For every 100 rupees raised, what is the cost? That percentage means what? By 100 only, no? Guys, are you all able to understand? So here, cost, you remember, is always expressed as what? Percentage, or this is nothing but, cost of capital is nothing but the discount rate which we studied in our time value of money chapter. Are you all able to get this, guys? Is everyone able to understand? Now, the cost associated to equity share capital is called as KE. What do you mean by KE? K stands for cost. E stands for equity. Is that clear? So cost associated to your equity share capital is called as what? KE. Cost of equity. Is that clear? Let us say cost of equity is what? 12%, which means for this 30 crore rupees, what is my cost? 12%. Is that clear, guys? So I'm incurring a cost of 12% on this 30 crore rupees of funding through equity route. Is that clear? Next, the cost incurred in respect of preference shares is called as KP. K means cost, P means what? Preference shares. Is that clear? Let us say the cost of preference is 11%. Just an example, guys, just an example. Is that clear? Now, which means for me to raise this 20 crores, it cost me how much? 11 rupees. Is that clear? Guys, are you all able to understand? Next, now the cost incurred in respect of debentures is called as, any guess what will be called as? KD, cost of debt. Is that clear, guys? Now let us say this is going to be 9%. Are you all able to understand? Just an example. Guys, are you all able to understand? So I am raising money from multiple sources. Every sources will have a cost associated to it. The cost of equity share capital is called as KE, cost of equity. Cost of preference is called as KP. Cost of debentures is called as KD. Remember, in this chapter, cost is always expressed as a percentage. Is that clear, guys? Now, in this chapter, we will be seeing how do we compute the cost of equity, KE? How do you compute KP? How do you compute KD? And so on. For every source, What is the cost? This percentage I gave you, how do you compute that is what we are going to study in this particular chapter. Is that clear, guys? Now, how will we do that? Simple. I just give you a bird's eye view right now. Now, equity share capital, preference share, for example, debentures you take. Now, you can frame the cash flow equation from the perspective of the company, right? There is an initial inflow followed by a series of outflow. Today, I receive the money. Right, every year I need to pay interest or whatever it is. At the end of the period, I need to repay back the capital and all. Now, the rate that equates this to is ideally what? My discount rate for debenture is called as cost of debenture. Is that clear, guys? Now you guys are able to understand. Now you guys are able to link it to what? Your time value of money. Is this clear, guys? Similarly, you do for other components also. Is everyone able to understand this, guys? Is everyone able to understand? This is a conceptual clarity that you need to have. Now, in our example, I told you, the cost incurred for 30 lakhs is 30 crores is how much? 12%. For 20 crores, it is 11%. For 50 crores, it is 9%. Now, overall, I've raised how much? 100 crores. Sir, for 100 crores, what is the cost of capital? Basically simple. On 30 crores, it was 12. On 20 crores, it was 11. On 50 crores, it was 9. Overall, how much is the cost? Now, I can actually compute this for the respective component, whatever is the cost you arrive, that divided by the total, you get the effective cost, overall cost of capital. Guys, correct? We will see how to compute. Don't worry about that and all. So this is called as KO. What is it called as, everyone? KO. KO, where O stands for overall cost of capital. Is this clear, guys? Which means this is source-wise cost. Average everything with the respective rate. You get, sir, totally you have raised how much? 100 rupees, 100 crores. Net effective overall cost of capital is how much? Is that clear, guys? Are you all able to understand this? How to compute, we'll see later. Don't worry about this. This is called as KO. KO is also known as WACC. WACC. What is it called as? WACC. WACC stands for weighted average cost of capital, right? Why weighted average and all? We will see at the respective time. I am just giving you guys an introduction. Every chapter, the background is the backbone. Remember this. This is an investment, and I always go by the saying of Abraham Lincoln. If you give me 6 hours to chop down a tree, I'll spend the first 4 sharpening the axe. Now, right now, let's focus on building the subject, and automatically execution will not take at all any time. You yourself will see it for yourself. Is that clear, guys? Is everyone able to understand this? And in this chapter, what are we going to do? We are going to compute the source-wise cost and also the overall cost. Is that clear? Source wise, once you compute the cost, overall cost is nothing but the weighted average of these figures. What to do, how to do, why weighted average at the respective point of time, we will be seeing this. Is that clear for everybody? Is that clear for everyone? Please take your concept decoder. Please take your concept decoder. Yes, taken? Okay. Now look at this in the introduction. In the introduction, certain things I'll ask you to mark. Please mark it. The cost of capital is the return expected by the providers of capital. Providers of capital means what? Providers of equity are equity shareholders. Providers of preference share capital is preference shareholders. Debentures, debenture holders, and so on. Is that clear? So, cost of capital is what? Guys, cost from the perspective of company is generally, the thumb rule is what? Cost from the perspective of the company is nothing but the return from the perspective of the investor. Guys, correct? Don't say shareholder. Investor is a common terminology, right? This guy is an equity shareholder. This guy is a preference shareholder. This guy is a debenture holder. Common name I'll call investor. Investor means what? A person who invests in the securities of the company. Is that clear? Get used to these jargons. Is that clear? Terminologies, jargons. Is that clear, guys? Yes. Now, cost of capital is what? The return expected by the providers of finance. The most important thing. The most important thing is what? Expected by the providers of finance, right? And to the business as a compensation for the contribution to the total capital, and it is always expressed as what? In a rate, that is percentage. Now, the most important thing which many students miss out, the word expected. Sir, why are you stressing so much on this word? Now, guys, I want you all to understand one thing. In this particular chapter, first forget the chapter, in this subject, is this subject, or in this subject, are we going to do all the calculations or workings before a transaction happens or after a transaction happens? Before. Why? Decision making is what we do. We don't do post-mortem work. We don't do recording. Is that clear? We don't record the transaction. We are going to take decisions using this subject. Is that clear, guys? Now, when we are taking decisions with this subject, now the amount that I have actually paid, right, as a cost, right, to the shareholders, that is not required. Or in other words, don't worry about the actuals. Right? Actual cost is not the cost I'm trying to compute. The company paid so and so dividend. It's a past event. No. I am looking at the future expectation. Is that clear? Which means the expectation of the return of the investors is going to be my cost from now on. Correct or not? If I don't fulfill their expectation, people will not invest in my company. Which means for you to take decisions, you are not bothered about the actuals, you are bothered about the expectations. Is that clear? Hence, we follow the concept of opportunity cost. Opportunity cost means what? In costing, we have seen, for those who are directly watching my FM lectures, opportunity cost means the value of something that is foregone. Is that clear? Hence, in FM, we use the concept of opportunity cost. Now, many students struggle here. They say, now costs are only if I pay, I incur a cost. No. For your information, look at this. What are the different sources of finance? Equity, debt, preference, even retained earnings is actually what? It is also a source of finance. Guys, correct? Company self-financing. Are you all able to understand? Now, understand, there is a cost of equity. Yes, there is a cost to debenture, KD, cost to preference, KP. There is also a cost for retained earnings that is called as KR. Is that clear for everyone? Right? Now, if I take my reserves and use it, don't think, sir, reserve my money, free money. No. Now, this is the reason why I'm saying we are not talking about actual cost. We are talking about opportunity cost. Is that clear? Now, this retained earnings belongs to whom? Equity shareholders. On this also, they will ideally be expecting a return. Guys, correct? Hence, we will be seeing it later on. KR is ideally equal to KE. Is that clear? Cost of retained earnings is equal to cost of equity. That also has a cost. Sir, I don't pay anything. You need not pay anything for us to take decisions. For the purpose of decision making, we follow the concept of opportunity cost model. We don't go based on actuals. Expectation of return of the stakeholders is actually the cost from the perspective of the company. Is this clear? Is this clear? And be extremely clear, all the calculation, this entire chapter is done from the perspective of the company only. Is that clear? Is that clear? At times, in certain calculations, we might do it from the perspective of investor. Why do we do it? Because some data might be available from the perspective of an investor. We do it from the perspective of investor, and we'll say return for the investor is equal to cost of the company. Ideally, we are computing only the cost, right? Based on the data available, sometimes we can do the calculations from the perspective of investor. But please understand there is a common doubt which many students have. Sir, is this chapter done from the perspective of investor or from the perspective of company? This chapter is done purely from the perspective of the company only. Is that clear? And what are we going to do in this chapter? We are going to calculate the cost for every single source of finance, and also we are going to compute what? The overall cost of capital, called as KO or WACC, weighted average cost of capital. How to do? We have not yet started. I'm just giving you guys a big picture of this chapter. Is that clear for everybody? Is everyone clear with this? Perfect. Now, before we get into this particular chapter, I want you all to know one thing. Ideally, this is nothing but, cost is nothing but, I told you, discount rate expressed always as a percentage. Is that clear? If I give an absolute number, it doesn't make sense. For example, there is a student who scored 30 marks. There is another student who scored 90 marks. Which student is better? Now, this student got 30 out of 30. This student got 90 out of 500. Now you tell me which student is better. Now, 30 out of 30 means absolute number will not make any sense. Now, when you are expressing it as a percentage, this guy got 100%. This guy got what? Hardly, not even 25% he got. I saw 20%, not even 20% he got. Guys, are you clear with this? So when you are expressing something as a percentage, only then it is readily comparable. Absolute figures are not comparable as such. Hence, basically the cost of capital is always expressed as a percentage. That is nothing but the discount rate calculation which we saw in time value of money. Is this clear for everybody? Is this clear for everyone? Yes. Now, before we enter into this cost of capital chapter, every time for every single chapter, guys, trust me, this particular concept book, a lot of efforts have gone into it, because for the structuring and sequencing, for you to enter into this chapter, there are certain terminologies and concepts which you need to know before you enter into this chapter. What is that is what we are going to see. Shall we get started, guys? Yes. Now, the following are a few terms and concepts which will be used throughout this chapter. Every chapter I have this. Now, number one. Now, always remember, we are going to calculate what the discount rate basically are for the respective source of finance. and discount rate. For that purpose, we need to match cash flows, inflows, outflows and all. Guys, correct? Is everyone able to understand? Now we are doing this from the perspective of company. Company is going to receive the money, right? Now there will be an initial inflow followed by series of outflow. For example, I am taking money from debenture. Today I will receive money, and every year I pay interest. At the end of the period, I will repay back my capital. Is that clear, guys? Right, which means there is an inflow followed by a series of outflow. Recall, I told you, time value of money. Every complete financial transaction will have both inflow and outflow. There can't be just a one-way traffic. Not possible. Not possible. If there is only one-way direction, one-way movement of funds, it's called as donation, or someone has stolen money from you. That's about it. There has to be a two-way, two-way relationship when it comes to any monetary transaction. Is that clear, guys? Now, for that, first, different types of issue price. Issue price means what? The price at which I am issuing a particular security. Am I right, guys? Now, this is going to be the inflow initially for the company. Am I right, guys? Now, this affects my cash flow. Are you all clear with this? Now, issue price, you guys have heard this word. Accounts. In your 11th standard or 12th standard itself, you would have learned. The price at which a particular security is a common word, means what? It could be equity share, preference shares, debentures, whatever it is. A particular security is issued is called as issue price. Now you guys know issue can be at par or premium or discount. Guys, you guys know face value. Face value is the base, right, on which all your dividend or interest computation is done. Now I can either issue a share at par or at a discount or at premium. Guys, clear with this? Now, this will affect my initial cash inflow. Agreeing with me or not? Yes, perfect. Now, similarly, redemption value. What do you mean by redemption value? The value at which I am going to repay back, right, my investors at the end of the life of that particular instrument. Now, this can also be at a par, discount, or premium. You guys are aware of this? Basic, right? And note, in the absence of any information, always assume that the redemption happens at par. Is that clear, guys? Yes, next. The most important part here is about flotation cost. It's also called as issue cost. The most important segment of discussion here. Now, what is this flotation cost or issue cost? Flotation costs are those costs associated with the issue of new securities. Example, brokerage commission, underwriter's commission, etc. Is that clear? Now, these costs applies only to new issues and not to existing securities. In case the flotation cost is given in the question, the issue price must be taken after deducting for the flotation cost to arrive at what? The net proceeds. Now guys, what is it? Now, flotation cost means what? The costs incurred for actually raising this money from the public. For example, you guys would have definitely learned this underwriting commission. You guys are aware of that. Now, before a particular share, I mean, when you're issuing a share, I mean, shares or anything, at least minimum subscription should be met 90%, right? Now, if not, the issue will be actually called off. You need to refund back from escrow account and all. Law accounts, everything comes into picture, guys. Now, what happens if this issue is not subscribed at least the extent of 90%? Hence, I go to an underwriter and ask him, look, you underwrite. In case of shortfall, you actually undertake that you will subscribe and buy the shares on your behalf. Guys, you are aware of this. For this, I pay him a commission. Now, this cost is associated with the fundraising activity. Agreeing with me on this or not? So, let us say the issue price is 100 and the flotation cost per share is 2 rupees. Today, net inflow that I will receive is how much? 100 minus 2, 98 only. Guys, correct? Now, in this chapter, we are once again going to deal with the inflows and outflows. Now, here, my flotation cost is an outflow. And from the issue price, if I subtract the flotation cost, I arrive at something called as net proceeds. Proceeds means what? The amount that gets generated out of it. Net proceeds. Net means what? Netting after netting off your flotation cost, which means the net proceeds is going to be my cash inflow as on date. Are you all able to understand? Are you all able to understand? Is that clear, guys? This is going to be treated as the cash inflow. So since this one flotation cost is an outflow, it has to be reduced. Is that clear for everyone? Is everyone able to understand? Perfect. Now, another example of flotation cost is you need to prepare something called as prospectus. You guys have studied law. Now, prospectus For that, you need to do some projections and tell the company, convince the investors that, our company is the best company in the world, whether it is actually or not, whatever it is, you need to do everything, right? Now, and on top of it, you need to print, circulate, that incurs a lot of costs, guys, correct? All these are related to fundraising activity. So any cost relating to this raising of funds is called as what? Flotation cost. Is that clear? It should be subtracted with what? Your issue price to arrive at what? The net proceeds, which is going to be treated as what? The net cash inflow for the company as at the beginning. Is that clear for everybody? Next one. Now, there is a common doubt. I told you we have something called as doubt busters and all. Now, I'll tell you. Many students have this doubt commonly, hence I created this. Now, if the flotation cost is, say, 1%, exam they have just given, flotation cost is 1%. Okay. Now, sir, is this 1%? Should it be applied on the face value or should it be applied on issue price? For example, face value is 100. Issue price is, let us say, 120. The company is issuing it at a premium. Who knows? Could be. Now, should I apply this flotation cost of 1% on my face value or should I apply it on issue price? What do you think I should do? Guys, come on. What do you think I should do? Huh? You should have an opinion. You think how many of you say it should be applied on face value? Allah Tugumpa, please. Okay, how many of you say it should be applied on issue price? Logically, whatever you think. Okay. Now, in my opinion, logically, it has to be applied on issue price. Reason, underwriter's commission. Now, underwriter commission, you will pay on the face value or on the issue value. Now, he is not bothered how much your face value is. Look, I am underwriting to purchase the so many value of shares. The value is at the issue price. So, on the issue price only, you will incur the cost in general. Am I right? Guys, correct? So, ideally speaking, it has to be issue price. However, there is one controversy here. Institute is taking a different stand in different question. Randomly in some questions, they apply it on face value. Randomly in some questions, they apply it on issue price. Sir, what should I do? Simple. If it is specifically given in the question, apply it on issue price on or on face value, then no issue at all, no problem. It's clearly given. If the question is silent, you can take any one model, either apply it on face value or apply it on issue price. But always write a note. Whenever you get a flotation cost expressed as a percentage without, giving anything with, it is silent. It is not expressed either as a percentage of face value or as a percentage of issue price. Now, what you need to do is take a note. Based on your note, you just write for your note, the answer is correct. Is that clear, guys? Right? But my opinion, the correct thing to do is what? Is to apply it only on issue price, because on the issue value only the cost is incurred. Is that clear, guys? So if the flotation cost is, say, 1%, it can either be applied as a percentage on issue price or on face value in the absence of information. Students are expected to write a note regarding the approach followed in exam. This is something that I wanted to inform you all very clearly. Is that clear, guys? Randomly in some sums they have applied it on face value, some sums they have applied it on issue price. Now, if they have applied on face value, you have applied on issue price, the answer will be different. It will be different. But that's why I said write a note. For your note, the answer is correct. Is that clear? They will not reduce marks. Is this clear, guys? Right? That's about it. That's about it. Now, the next and the most important concept here, before we get into this chapter, a very important concept called as concept of tax savings in interest. Such a very important concept. Based on this only, the debentures and all these, other bonds and other things will actually function. Shall we begin, guys? Yes. Now, what is this, sir? Concept of tax savings on interest. Now, I will give you guys an example. This example is mentioned here. No problem at all. Let us say there are two companies. Guys, focus here. Let us say there are two companies. What are they? A and B. Both the companies are in the same business, competitors, same business. Okay. Let us say both the companies earned the same operating profit. Operating profit means what? EBIT. Both the companies earned 100 crores each. Is that clear? Now, there is only one difference. Now, both the companies raised the same amount of capital also. Everything is same. Only one difference. Now, what happened? Company A raised 200 crores. Company A and Company B, both these companies raised how much? 200 crores. Only difference is Company A raised this money through debentures, whereas Company B raised the same amount of 200 crore, right, from preference share capital. Is that clear? Now, sir, what is the cost, sir? Let us say debenture interest is 15%. How much is it? 15%. Sir, preference share capital, sir, how much the dividend? Exactly the same 15%. Is that clear, guys? Is that clear? Now, both the companies are in similar business, same EBIT, same capital amount also. Only one difference, source alone is difference, right? Other component, equity share capital, they raised the same amount, don't worry. But the next 200 crores, company A raised it from debentures, company B raised it from preference. Is that clear, guys? Is everyone able to understand the context? Now, in this case, let us see how their net final profit available to the equity shareholders looks like. Shall we begin? Yes. Now, what is the format, guys? EBIT, earnings before interest and tax. From this, you subtract interest. For company A, what will be the interest? 15% on 200. How much is that? Everyone answer, please answer. 30 crores. Company B, interest will be 0. No interest because debenture, I haven't raised anything, which means how much is going to be my earnings before tax? How much is that going to be? For company A, it's going to be 100 minus 30, 70 rupees. For company B, it's going to be 100 minus 0, 100 rupees. Is that clear? Now, from EBT, I need to pay tax. Tax, let us assume, is applicable at the rate of 30%. Is that clear? Now, how much should company A pay as tax? 30% on 70. How much is that? 21 crores they need to pay. Whereas company B, 30% on 100, 30 crores. Is that clear, guys? Is that clear? Now, from earnings before tax, if you subtract tax, you will arrive at what? Earnings after tax. Company A has a EAT of how much? 49. Company B has 70. Now, from earnings after tax, now you need to reduce what? Preference dividend, right? Only after paying them, the balance amount is available for the equity shareholders. Now, company A, how much is the preference dividend? I didn't take any rupee from preference, even 1 rupee I didn't take from preference, hence it is 0. Or for company B, 15% on 200, how much is it? 30 crores. Same as company A only, here is going to be how much? 30 crores. Is that clear, guys? Is that clear? So now, if whatever is the balance amount left belongs to whom, guys? Belongs to the equity shareholders. Net earnings available to whom? Equity shareholders. Company A, how much is it? 49 minus 0, 49. Company B is going to be 70 minus 30, 40. Now, if you notice, both the companies had the same profit. Both the companies raised the same amount. Both the companies had the same cost also. But what happened? Company A is left with a balance of 49 rupees, whereas company B is left with only 40 rupees. Now, what happened here? What happened here? Same 30 crores only was paid by company A as well as company B. Source alone was different, no? But why is there a difference in the profit? Why is there a difference in the profit? This is purely on account of tax impact. Now, what is that, sir? Simple. Now, what is the base on which tax amount gets calculated? Everybody answer. Earnings before tax. Earnings before tax is what? EBIT minus interest. Is correct? Now, no doubt these two companies paid 30 crore rupees. The 30 rupees only they paid as their cost to the provider of the respective finance. However, for company A, since they raised it from debenture mode, that 30 rupees was allowed as a deduction while computing their base on which the tax amount could be computed. Is that clear? Whereas for company B, there was no deduction allowed with respect to your preference share and all. No, it comes later after tax computation only. Is that clear? Hence, since they didn't pay any interest, now here they had to pay 30% on entire 100. Whereas company A, they had to pay 30% only on 70 rupees. Or in other words, they actually need not have to pay 30% on this 30 rupees. Guys, correct? The base on which tax needs to be computed got reduced to the extent of how much, guys? To the extent of how much? 30 rupees. Or in other words, can I say how much is the tax saving for this particular company A? For this company A, on this 30, they need not have to pay 30%. Am I right, guys? How much was that? So 30 into 30%. This is the tax saving. Am I right, guys? How much is this? Rupees 9. Is that clear? Now, clearly, that is the difference between the two. So company B paid a tax of 30, whereas company A paid a tax of only 21. The difference between that is how much? 9. Company A saved their tax bill or tax amount by how much? 9 rupees. How, sir? On the amount of interest paid, they need not have to pay any tax because that was reduced from the base on which the tax gets computed. Is that clear, guys? Is that clear? So there is clearly a tax saving for this company. Is that clear? And the difference in the tax, 9 rupees, is reflected as the difference in profits. Are you all able to understand here? Are you all able to understand? And the only source of finance which has a tax benefit is this debenture or borrowings, debt. Basically, debt means what? Any type of borrowing. It could be a bank loan, it could be a debenture, it could be a bond or anything. Is that clear, guys? Are you all able to understand? This is a very, very important discussion here. Are you guys able to understand this? Right? So tax is a deductible expense, right? For the purpose of, your interest is a deductible expense for the purpose of computing your taxes. Is that clear, guys? There is a section in your Income Tax Act, section 36(1)(3). 36 is a broad section. It has multiple deduction. It is section 36(1)(3). That also gets changed in your Income Tax Act 2025. All the sections will be changed. But 36(1)(3) talks about deduction on interest. As per that section, you get a deduction of interest. Is that clear, guys? Now, the most important part, let me come to this. Now, guys, because I raised money from debenture, now to the debenture holders, I paid how much? 30. But because I raised money from debenture, parallelly, I saved 9 rupees also. Am I right, guys? Are you all able to understand? Or in other words, can I say the net cost of debenture is 30 minus 9. It is only 21. Agreeing with me on this? Guys, is everyone able to understand? A savings in my tax is purely happening because of what? Raising money through my debenture mode, which means I paid 30. Because I paid this 30 as interest, because I took it from my debenture mode, I could save how much? 9 rupees. The net cost for me is how much? 30 minus 9, only 21. Am I right, guys? Am I right, guys? Are you all able to understand? So here, in this case, can I say, guys, the net cost of debt debenture is going to be how much? 30 minus 9, which is equal to how much? 21 rupees. Am I right, guys? Now, this 30, how did you get it? This 30, how did you get it? This 30 is actually nothing but your interest amount. Am I right, guys? This 30 is nothing but your interest amount. Correct? Right? So this is nothing but your interest amount. 30. Now, this 9, how did you get? The tax on interest. Am I right, guys? This is nothing but the tax on interest. So, on this 30, I need not have to pay 30%. This is nothing but the tax on interest. Am I right, guys? So, can I say this is nothing but interest into tax rate? Am I right, guys? This is nothing but interest 30 into tax rate 30%. Am I right, guys? Are you all able to understand? Are you all able to understand? Or in other words, every year, whenever I am paying an interest, parallelly there will be a savings in tax. Correct? Guys, correct? The savings in tax should also be netted off. My net cash outflow will only be 21. Am I right? Guys, please focus. This is a very important thing. Are you all able to understand? Now, or in other words, I have expanded this and told you this 30 is nothing but interest. 9 is nothing but the tax rate applied on interest. Or interest, if I take it out in common, can I say this is nothing but interest, the whole into 1 minus tax rate. This is going to be my annual cash flow whenever I am raising money from debenture mode. Are you all able to understand? Guys, in this case, interest is how much? 30 into 1 minus. What is the tax rate? 30%, 0.30. So how much is that? 30 into 0.7. How much is it? 21 rupees. Is that clear? So always remember, when we are preparing this cash flow equation, no? Guys, every time I'm preparing cash flow equation, for debenture, if I'm raising it, initial cash inflow, right, followed by series of outflows, right? Every year, what is the annual cash outflow? It is not 30, it is 21. Why? No doubt, the gross there is an outflow, but parallelly there is a savings. Net off, it is going to be interest into 1 minus tax. So every time for debentures or bank loans, whatever it is, even for bank loan, it is interest only, it is allowed. Now what I need to take is what? I need to take interest into 1 minus tax rate should be taken as the cash flow. Reason being that interest is a tax deductible expense and there is always a tax savings if you are actually borrowing money from your debentures or debt route. When I say debt, it is a common debt. Debt means it could be debentures or it could be bank loans, borrowings, whatever it is, corporate borrowings, whatever it is. Is this clear, guys? Is everyone able to understand? So remember this, guys. So for cash flow for debt mode is what? I into 1 minus T. Logic, this is what it is. Are you guys able to understand? I hope you guys are catching up running notes. You know, if you miss this out, that's about it, right? Clear with this? Any issues, any problem here? Right now, that's about this concept called as tax savings on interest. Now here you write down this tax savings. Now this word, this is also known as AKA, also known as tax shield. Tax shield means what? Tax savings. In this case, tax saving is how much? 9 rupees. Huh? This 9 rupees is also known as tax shield. Is that clear, guys? Is everyone able to understand? Is everyone able to understand? Guys, is everyone able to understand? Any problem here? No. Fine, guys. And always remember this, guys. Always remember this as a thumb rule. We'll be seeing later also. The cost of debentures, cost of debt will always be the least. The cost of debt will be lesser than KE and KP. Reason? It is tax deductible in nature. Is that clear? Because of the tax deductibility in nature, debt is always the cheapest source of finance. Sir, which means it is the best source? No. Reason and all we'll be seeing throughout the course of our subject. Don't worry, just take one thing at a time. I'm just saying it is the cheapest source of finance. I'm not saying it is the best source of finance. Reasoning, we will be seeing it, throughout the course of our subject. Is that clear, guys? Right? Advanced level we'll be seeing later. Just for the time being, you understand this. So the first thing, did you guys understand there is a concept called as tax shield or tax saving on interest? So whenever you have debentures or debt mode, the annual cash flow will be what? Everybody? Interest amount into 1 minus tax rate. When I say interest, I mean interest amount. This is rupees, right? Into 1 minus T. T stands for tax rate. Is this clear, guys? So I'm calculating the annual cash flow. Is that clear, guys? Is everyone able to understand? I pay 30, I get a benefit of 9, net of only 21 is going out of my pocket. Is that clear, guys? Fine. That's about this particular basics background required for this particular chapter. For this particular chapter, yes. So now let's move on to the first source of finance, which is called as debentures or debt. Is that clear? Shall we get started? So the first source of finance that we'll be doing is what? Debentures. We'll be calculating the cost of debentures. Is that clear? Now I told you in this particular scenario, the company has raised 50 crores from debentures. Now what is the effective cost R, the KD of debentures? What is it? We will be seeing. Is that clear? How to compute and all we will be seeing. Is that clear, guys? Is everyone able to understand? Yes. Now debentures, as you all know, comes with a fixed interest called as coupon rate attached to it. You guys are aware? Now what happens in case of a debenture when a company is issuing debentures, right? So every year they need to pay a fixed amount of dividend, or in other words, the cash flows are equal. Am I right, guys? When will there be unequal cash flows? When there is an amortization. That is every year, at the end of every year, if I repay. Guys, remember the last sum of time value of money. In that case alone, rate is same, but the balance on which I compute is different. Because of that, the cash flows become unequal. But generally, I issue it, and at the time of redemption, I pay it. Is that clear, guys? Is everyone able to understand? Now, with this background, let's go to the next one called as cost of debentures. Now, first of all, for you to understand this cost of debentures, now, debentures are classified into two. What are they? Irredeemable debentures, redeemable debentures. Now once again, this is where the entire time value of money comes in. Now irredeemable debentures means what? Perpetuity model. Are you all able to understand? Redeemable debenture means what? With a finite life. Is that clear, guys? Whatever we saw in time value of money, right? Now we need to calculate what? The KD in case of irredeemable debenture. How do you compute? KD in case of redeemable debenture. How do we compute? Is what we are going to see now. Shall we get started? Yes. Now, cost of irredeemable debentures. Cost of irredeemable debentures. Shall we do it first? Yes. No. What do you mean by irredeemable debentures? They are issued, so I collect the money. Will I repay? No. There is no concept of repayment. I told you it's allowed in India, right? So it's called as irredeemable debenture. Now, what is the formula here? KD is equal to I by NP into 1 minus, or I into 1 minus tax rate divided by NP. Now, where I stands for interest payment, means amount, not interest rate, right? T stands for tax rate, NP stands for net proceeds, KD stands for cost of debt after tax. Understood? Logic? Okay. Now what have they given? What is the formula? What is the formula? KD is equal to, so 1 second, so we are doing now KD. Okay, so they've given KD. So this is in case of irredeemable, correct? Irredeemable model is equal to I into 1 minus tax rate divided by net proceeds. Am I right? This is the formula given. Now, very simple, guys. Logical. Don't forget. You need not have to mug up anything. Now, recall our discussion. Recall our discussion in the time value of money chapter. Now, I want to calculate the present value. The present value of a bond. Bond means a debenture. So recall B0, that is the value of bond today, is equal to what? Now every year I am going to receive the same cash flows, right? Interest divided by annual cash flow divided by discount rate. Am I right, guys? Equal cash flows up to perpetuity. You forgot interest divided by discount rate. Discount rate in this case is called as KD. How, sir? I told you here, whatever is the cost from the perspective of the company is the expectation of return from the perspective of investor. Is that clear, guys? Are you all able to understand? Now. This is what B0. B0 means the bond, the value of the bond today. Now this B0 is nothing but, in this case, no, 1 second. Now what we have done, now this is the computation we are doing from the perspective of whom? From the perspective of investor. Now if you do this from the perspective of company, what happens in this case? Interest is not the actual cash outflow. I into 1 minus T becomes the cash outflow. Is that clear, guys? Are you all able to understand? Why? Because I'm paying an interest, I'm getting a tax saving. Is that clear? Hence, ideally here, for me, it's going to be into 1 minus T, the relevant cash outflow. Some small tinkering I will do because from the perspective of the company, I have these benefits. Is that clear? And also, B0 means what? The market value of the bond today. But this is not the amount I will receive. Now, from this, from some flotation cost I will incur, net of that, what I receive today is only net proceeds. Is that clear, guys? Now, cross multiply this. Now, if KD goes here, right? Now, what happens? Can I say this is nothing but KD is equal to I into 1 minus tax divided by net proceeds. Is that clear? So, this comes to the denominator. Are you all able to understand? This goes to the numerator, and that's your formula. Guys, done. Now, since we sharpened the axe, look at this. One formula is over already. Is this clear, guys? Time value of money concept. That's all it is. Is everyone able to understand the logic for this? Should you mug this up? Should you mug this up? I am telling you more than 80% of the students mug this up and they struggle and somehow they feel, now somehow I just go and write, I bank on SM. Trust me, guys, in FM you can score 50 out of 50, easily you can score. If not, 45 you can score. My student has actually scored it. Now, I don't want to take this credit that because of me. No, he followed sincerely whatever I said. I told you I'm like that walking stick. If you don't use the stick, then there's no use at all. Right? He actually followed it and he got that. A full mark. That's not that's not something that is impossible, guys. It is a possibility. That's why I keep motivating you guys. Keep doing it. Go in the right direction. Practice whatever I give you. You will definitely be able to succeed. Is that clear? So now you guys understood this, guys. What is it? What is it? This comes from time value of money concept. Value of bond today, present value is equal to annual cash flow divided by discount rate. Now, since we are doing this from the perspective of company, one small change, annual cash flow will have an, adjusted for tax rate because the net amount is only my outflow. Is that clear? And today inflow, what do I have? It's not whatever the market price. I don't get it readily. From that, some flotation cost needs to be adjusted. So with that, we get this formula. Is that clear, guys? Is that clear? Or can I give you a quick way to directly remember? Can I give you a quick way to directly remember? Simple. From the perspective of company, what is it? Numerator is what I pay. Denominator is what I receive. Simple. Whatever I pay divided by whatever I receive is the net effective cost. Guys, are you all able to understand? As simple as that, guys. Nothing beyond this. I'm giving you the derived logic. I'm giving you the direct logic also. With this, you can easily remember this chapter, this particular area. Are we clear here? Are we clear? Any issues? Any problem here? Is this clear for everyone? Right? So, what is the formula for computing the cost of irredeemable debentures? Everyone. Interest into 1 minus tax rate divided by net proceeds. Simple. Effectively, what I pay by what I receive. What I pay, I into 1 minus T. What I receive, net proceeds. That's the amount of my KD. Is this clear, guys? Any issues? Any problem here? Now, tell me, time value of money is helping us? Yes? Right. That's about the first part of discussion in this area. Is this clear, guys? And with this, we are done and dusted with cost of irredeemable debentures. Is that clear? Now, moving on to the next one. What is the next one? The next one is cost of redeemable debentures. Redeemable debentures means what? It has a finite life. Guys, correct? It has what? A finite life. Am I right, guys? Yes. Now, in this case of redeemable debentures, now please understand there are two ways in which you can compute the cost of redeemable debenture. How many ways are there? Two ways of computing the cost of redeemable debenture. Method 1 is called as YTM method. YTM stands for yield to maturity. What is it called as? Yield to maturity method. Write down here itself. Pull an arrow and write. YIELD. Whenever they use the word yield to maturity, yield means it refers to IRR model. Is that clear? Yield to maturity. Called as YTM. Is that clear, guys? Hello? Right? YTM stands for what? Yield to maturity model. Now, yield to maturity means what? Simple. IRR method. Now, what should you do? Equate your inflows with your outflows. The rate that makes your NPV 0 should be your IRR. Clear with this, guys? Now, how do you do that? Take one trial, arrive at the NPV. If it is positive, what will you do? Now, increase the denominator so the value becomes, reduces. You will try, pray God, it should be equal to 0. Oh, Samyo, yeah? So, then what happens? You reduce it. Now, you will definitely get one negative, right? Some positive, negative, interpolation, arrive at the rate. Is that clear, guys? This way of doing is called as what? Yield to maturity, YTM method, also known as present value method, also known as IRR method. These are, different terminologies used in exam. Hence, I have put it everything in a single place, right? So that you can easily understand, whenever these alternative terminologies are given, it refers to the same method. Is this clear? Guys, are we done? Are we clear here? Now, shall we quickly take one example and solve it? Let's do this. Come on, write down. Write down. This is, redeemable. Write down, guys. Redeemable debentures within bracket IRR, or what is it called as YTM, or also it is known as present value method. Shall we do this? Hello? Okay, let's do this. Now, I'm giving you guys an example. Let us say the issue price is going to be 900 rupees. Issue price is 900. Face value of a debenture is going to be, let us say, 1000 rupees. Coupon rate means, everyone, interest rate is 10%. The life or the period of the debenture is going to be 10 years. Is that clear? Now, guys. Now, in this case, what do we need to do? We need to calculate what? KD. So, calculate KD. Now, guys, 1 second. How much is the issue price? 900. Now, 900 is the issue price. Is there any flotation cost? No, not given means don't take anything. Which means, in this case, the net proceeds is equal to issue price 900 rupees. I can take it as what? My net proceeds. Is that clear? Now, first thing, what should you do? Now, you should generate that cash flow equation. Am I right? So, the rate that equates my present value of inflow with present value of outflow is going to be my IRR. In this case, the IRR for debenture is called as KD. Is that clear, guys? Right? Sir, IRR means return, sir. Return is from the perspective of investor. From the perspective of the company, it's the cost. Is that clear, guys? Have the clarity. When someone asks you, why is it called IRR? Return. Why are you doing it in this chapter? Cost. Simple. Return from his perspective is cost from my company. Cost from the perspective of the company. But one second. Generally, return from the perspective of investor is equal to cost from the perspective of company. General thumb rule. However, in this case, it will not be exactly equal. Why? Because for him, inflow is what? Interest. For me, outflow is not interest. Interest into 1 minus t. Because I have a tax saving. Because of that, it could be a little different. One more thing. For him, when he is paying the money, he will only pay the issue price. But for me, the amount I receive is issue price minus flotation cost. So when there is a flotation cost, so obviously because of that also, the return from the perspective of investor will not be equal to cost from the perspective of company. Right? So general thumb rule is both are same. But because of a few reasons, it could be different. Is that clear, guys? And these are all very practical reasons. Are you all able to understand? This is the way to look at the subject, guys. This is the way to look at the subject. The same financial transaction is being looked at from two different perspectives. From the perspective of the company, inflow is followed by a series of outflow. The same switch it from the perspective of the debenture holder, outflow is followed by a series of inflows. Is this clear, guys? So return should be equal to cost subject to a few justifiable reasons. As simple as that. Now you guys are getting the clarity and hold here. Now coming back here. Now let's compute the KD. For that first IRR technique, we need to do what? We need to write the cash flow equation. So write down. So first inflow. What is inflow? 900 is equal to, they have clearly mentioned it's going to be what? It's going to be for 10 years, right? So can I say it's going to be, so at the end of first year, what is the amount I will be receiving? I mean, what is the amount I need to pay to the, what is the amount I need to pay to whom? This guy. That is, what is the amount I need to pay to the debenture holders? How much is that, guys? 100. Am I right? How do you get 100? So it's 1000 into 10%. Is that clear? Now in this question, I've ignored taxes. If tax is given, into 1 minus t needs to be done. Is that clear, guys? Right? Any issue here? No. So here I would say what? It's going to be, 1 second. It's going to be 100, right? So it's 100 divided by 1 plus kd to the power 1. Kd is nothing but r. Am I right? Plus second year. Once again, 100 divided by 1 plus kd to the power 2 plus 100 divided by 1 plus kd to the power 3 plus dot 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 dot. It goes on. In the last year, what happens? 100 divided by 1 plus kd to the power 10. Guys, correct? Plus, I also get back my amount. Or in other words, I am the company. I need to repay the original amount that I took from them. Guys, correct? Issue was at discount maybe, but redemption, nothing is given, should be happening at par. So which means at the end of the period, I should also repay what? 1000 divided by 1 plus kd to the power 10. Is that clear? Is everyone able to understand? This shows that you have understood this particular, the cash flow equation shows that you have understood the nature of the transaction. Is that clear, guys? This is an indicator. Now, once again, I'm telling you guys, now it's a smart way of doing. You spend more time in debenture, preference automatically will be over. Automatically preference will be over. Why? Instead of interest, there will be dividend. That's all. Is that clear? Instead of KD, it will be KP. That's about it. And of course, remember, tax rate, that adjustment will not be there. We will see that. Don't worry. Is that clear? Smartest way of doing it. Done? Done? Now, what do we need to do? Now, your NPV is what? Present value of inflow minus present value of outflow. Guys, correct? This is an inflow. This is an outflow. Present value of inflow minus present value of outflow should be equal to 0. Guys, correct? So, what is the present value of inflow here? It's basically 900. Am I right, guys? Guys, correct? So, once again, can I say 900 minus. Now, this is the present value of outflows from the perspective of company. Am I right? Now, can I say this is nothing but what? 100 into, tell me, present value interest factor annuity. Why? Same equal cash flows, no? For how many years? I mean, for how many percentage? I don't know. KD percentage. For how many years? 10 years. Is that clear? Now, plus last 1000 rupees I need to pay into present value interest factor of KD percentage for 10 years. Is that clear? So, this is going to be the present value of cash outflows. This is going to be the present value of cash inflow. It's already in present value. That's why I didn't multiply with any factor. This should be equal to 0. And the rate that makes this 0 is going to be my IRR, right? This inflow minus outflow is called as what? NPV. The rate KD that makes my NPV equal to 0 is called as IRR. Am I right, guys? Everybody? Yes, is that clear? Now, what do we need to do? Take 2 trials. How do you take 2 trials? Generally in exam, they will give you the tables, right? So based on the present value tables given in the question, right? You should know that these are the trials. If that is not given, I told you, you start with 15% and based on positive or negative, increase or decrease it to 20 or 10 as the case may be and do it. Is that clear? But don't worry, here I will handhold you. So first, let us take, guys, can we quickly do this? Let KD equal to 10%. First trial, can we take, guys? KD is equal to 10%. Are you guys doing it along with me? Very, very interesting, guys. Very interesting chapter. Trust me, guys. This is going to give you guys tremendous level of knowledge as well as marks in exam. Right? That's about it. Now, KD is equal to 10%. Now, tell me, guys. Put it up here. In this case, 900 minus 100 into. Now, what is the present value interest factor annuity of 10% for 10 years? So, you guys know how to do that. 1 divided by 1.1 is equal to m plus is equal to m plus is equal to m plus, like that for 10 times you need to do. Basically, how much you get, or you can also refer to the table. This time you will refer to the table. Go to the appendix. 10% 10-year annuity table. Which table you will go? Annuity table. Yes, this one, A7. 10% for 10 years. You get how much? 6.145. 1445. Okay, 144 you guys took. Okay, fine. 144 we can take. No problem. Into 6.144. Plus next one, 1000 into present value interest factor of 10% for 10 years. So you can go to this table, that is present value table. Here, this table, 10% for 10 years is going to be 0.386. You got 385. Okay, 385. No problem. You can take that. So into 0.385. Suppose in exam they have given it, guys. Don't use your calculator and do all these things if they have given, right? That much sincerity they are not expecting. So you can copy, paste and use the table. Use the table figures only if it is given, right? Sir, one more doubt. Sir, how many decimals can we round off? Generally, 3 decimals you can round off. No problem. You can stop at 3. That's not a problem. If you want, keep it till 4. That's your choice, right? But 3 is, it's enough. Now, guys, do the calculations. Tell me how much is it coming out to. Isma, how much is that? How much you get? No, this total is how much? 900 minus 999.4 something. Okay, so that's roughly about 1000 now. Okay, no problem. It's going to be giving you a negative 100. Am I right? Guys, it's going to give you a negative 100. Am I right? Is that clear? Is that clear? Fine. Next. Let's go to the other one. What is it? Now, the next trial we'll take, let KD is equal to, since I have it with me, 12%. Okay. In exam, they will give you the table. Don't worry about it. Okay. Now, since KD is equal, let KD is equal to 12%. Shall we quickly do this? In this case, present value, of inflow is equal to 900 minus, yes, 100 into the annuity factor, 12% for 10 years. How much is that? So 12% means, I think it should go down. Present value interest factor only is there. Huh? Okay, this is annuity. Sorry, ma. Okay, fine. I got it. The question here is, it is in negative. NPV I'm getting negative. Sir, why are you increasing the discount rate? Sir, if we increase the discount rate, how will it be? It will turn to positive, right? It will further reduce it only. No, that is the question. Okay, very good question. I will tell you. This is where things change, because now we are computing from the perspective of company. From the perspective of company, just imagine what has happened here. This is inflow. This is outflow. You are arriving at NPV. Now, at 10% you get a negative figure. Negative NPV. Now, you want your NPV to increase or decrease? You want your NPV to increase, correct? You get a negative NPV here. Am I right, guys? Now, I want my NPV to be equal to 0. Am I right? Which means you want your NPV to increase. If you want your NPV to increase, your cash outflow, this is outflow, no, should decrease. If you want your cash outflow to decrease, you need to increase your discount rate. Is that clear? Is everyone able to understand? Guys, in the previous, when we did time value of money, there we did from the perspective of investor. Are you understanding this? When we did this from the perspective of investor, what happened? It was initial outflow followed by series of inflow. So inflow amount was there directly. So more the discount rate, lesser will be the value of inflow. Hence, lesser will be the value of NPV. But here we are computing the present value of what? Outflows here. Am I right, guys? Is everyone able to understand this? Is everyone able to understand? Here we have switched the sides. Yes, good question you asked me. We have switched the sides. Is that clear? Hence, now I'm getting what? A negative NPV. Now, what is my objective mission? To increase NPV. Let's try to do something to the discount rate, right? The rate, and make sure that NPV becomes, increases from this level. If I want to increase my NPV, right? What I need to do? This is inflow, this is outflow. I need to reduce my outflow. If I have to reduce this final answer, now the discount rate I need to increase. Is that clear? Is that clear? Hence, the next trial I am increasing it. Now you are able to understand. Is everyone able to understand? So remember this. This is why we do it like this. Or another way of doing it is, guys, what you can also do, I'm telling you, you can also keep this as, this way. This minus 900 is equal to 0. Ideally, in that case, it's going to be what? Outflow minus inflow. But anyways, it's going to be 0 only, no? Both are equal. This way also you can do, and normally, just like how you did there, that way also you'll get the answer. Here you'll get a positive number. Exactly 100. Then you increase the discount rate, you'll get a negative answer. Right? That way also you can do. But my suggestion is, in this case, you can do it like this. Is that clear? Now you guys are understanding what I'm discussing here. You can also take it out to the other side and do it just like how we did. You can treat this as inflow and that as outflow. It doesn't make any difference because we are looking to make this 0. If the answer is not 0, then it will be different. That's why. Is that clear, guys? Now you understood why I'm increasing the discount rate to increase the NPV. Because here we are talking about present value of outflows. So if you want to increase NPV, you need to reduce the outflow. To reduce the outflow, you increase the discount rate. Is that clear, guys? Is everyone able to understand? Right? This is what it is. This is the logical understanding here. So KD is 12% for 12% annuity. 12% how many years? 12% 10 years. This one now. 5.650. Guys, correct? So write down here into 5.650. Yes. Plus what is the other outflow? 1000 now. Into present value interest factor of 12% for 10 years. Sorry. Yeah, 12% for 10 years only, no? Present value interest factor is here in this table. Yes, it is in A3. So 12% will be, sorry, A4. So 12% for 10 years. 0.322. Guys, yes, is everyone getting this? Guys, I am doing a mix of everything. Earlier, I asked you guys to do your calculator. Now, I want you guys to know how to pick it from the table. So in the classroom, we are literally exploring every single possibility. Clear with this? In exam, if they give you the table, why should you take the pain of doing that into in your calculator? Is that clear? No. It's going to be how much? 0.322, is it? Okay, 0.322. So this is the present value of inflow. This is the present value of outflow. So present value of outflow, how much is it coming out to? Calculate and tell me. 887. So you're getting how much? 13 positive. Is that clear? So now shall we come up with that summary table? Yes. Now what is it? R NPV. If R is 10%, NPV is going to be negative 100. If R is going to be what? 12%, NPV is going to be what? What is it? Positive 13. Is that clear? But for me to get an NPV of 0, so I clearly know that my R, that is the KD, lies somewhere in between 10% to 12%, or in other words, it is 10% plus something. So by how much should I increase it over and above 10%? So now clearly we know that look, if I increase my rate by 2%, by how much is my NPV increasing? It is increasing by 113. Am I right? From negative 100, it became what? Positive 13. Guys, correct? But I want my NPV to increase only by what? 13. Sorry, I want my NPV to increase only by what? 100. Am I right, guys? So by how much should my rate increase? So here I can say R and NPV. So here it's going to be what? So for increase in 2%, there is an increase in NPV of 113. For increase in, how much should be the increase? For an increase in exactly 100 rupees. Is that clear? So now how much is it? I will say first base 10% plus. So what is the increase you want? 100 divided by increase you have 113 for how much? 2%. Is that clear? So how much is it? 100 by 113 gives you 0.88%. 0.88 something into 2, isn't it? It's going to be 1.7699%. It's going to be 10% plus 1.7699%. It's going to be 11.7699% roughly. This is going to be what? Your IRR, or in other words, your KD. Is this clear, guys? Is everyone able to understand? Is there any issue here? Is there any issue here? Now, did you also understand why I increased the discount rate to increase the IRR? Here because we are discounting the outflows, not the inflows. Sir, no sir, I find this confusing. I want to do it the other way around. Yes, you can do it exactly how we did it before. Then also you will get the same answer only. Here you will get positive 100, you will get negative 30. That's all. Ulta it will be. That's about it. Is this clear, guys? Is this clear? Right? Are you all able to understand? Hence, what is going to be my KD? In this case, KD is going to be 11.7699%. Is that clear? This is for what? Finite life. Is that clear? So cost of redeemable debentures using what model? IRR model or yield to maturity model. This is how you need to do normal IRR calculation. Everybody able to understand? Perfect. Now, the second model is called as a shortcut model. What is it? Shortcut model. Now, guys, here once again, YTM model. I have given all the methodology. Step 1, step 2, step 3. Step 1, identify the cash flows. Step 2, calculate the NPVs of the cash flows as identify the discount rate. Calculate IRR. That's all I have done. Right? Here we know it in detail. Am I right, guys? That's about it. Now, the next one. Approximation method, also known as shortcut method, also known as formula method. Right? Now, there is a second way of doing shortcut method. In exam, they can ask you. So, in the recent MCQ also, they had asked this. Case study based MCQ, they had asked this. So, calculate KD as per shortcut method or formula method, right? Or approximation method. In this case, the cost of redeemable debenture under approximation method. What is the formula? KD is equal to I into 1 minus T plus RV minus NP by N whole by RV plus NP by 2. What is it? I into 1 minus T plus RV minus NP by N the whole by RV plus NP by 2. Is that clear? No? Okay. Now, looks difficult, right? Looks difficult, right? No mnemonics, no memory tricks and all. Guys, this is absolutely logical. I will clearly tell you what is what. Now, in the next few minutes, you guys will automatically, tell the formulas by yourself. That's about it. Shall we do it? Shall we do it? Okay. Now, guys, just focus here. Now, the same example we will take. What is it? The same example we will take. That is, here we have, this one. I'm just copying this example here. Okay, now we are going to do the same question under what method? Yes, approximation, shortcut method. Right, 1 second, I'm just copying this example here. Okay, now this is what? KD as per shortcut method. Now guys, now every year, how much is the interest I pay? Now, what is the formula that they mentioned here? KD is equal to I into 1 minus T plus RV minus NP by N whole by RV plus NP by 2. This is the formula. Now, in this case, guys, what is the interest amount I pay every year? 10% on 1000. How much is that? Hello? It's going to be 100 into 1 minus tax rate. Ideally should come in this question. I said ignore the tax rate. Basically, it's not given. That's about it. If not given, then don't take it. Ideally, you should take. Is that clear? Now, plus, what is the redemption value? Redemption value, nothing is given, which means assume that every debenture is going to be redeemed at what? At par. Is that clear? So, when I'm repaying them back, I'll repay 1000. But today, what was the amount I got? Issue price. How much is that? 900. Is that clear, guys? Divided by, what is N? N is the life. 10 years. The whole by, what is RV? Redemption value? 1000. Plus, what is the net proceeds? 900 divided by 2. Just do the calculation. What do you get? 100 into 1 minus 0, it's going to be 100. Plus 1000 minus 900 is 100. 100 by 10 is 10. Divided by 1000 plus 900 is 1900. By 2 is going to be 950. 950 is going to be 110 by 950. How much you get? Into 100. How much you get? 11.58% approximately. Am I right? Now, this answer is as per shortcut method, but the correct answer is what? As per 11.76 percentage. Is that clear? The correct method is what? Is only your IRR method. IRR is a superior method, but this is for shortcut, right? This is for shortcut. Now, another way of computing KD, but is this an exact value of KD? No. It's the shortcut approximation method. Is that clear? Now, coming to the logic of this formula, guys, this is very, very simple. Now, with respect to debentures, what is the cost you incur? Interest. Is correct. In the numerator, I say interest into 1 minus T. Why? Because when I pay, parallelly I say taxes. Hence, this amount, the major amount of cost for me is what? Interest into 1 minus T. Is that clear? Next. Now, when I raise the money, how much did I get? Everybody answer. 900. But when I'm repaying, I should repay how much? 1000. Which means overall, for every debenture, I actually incur an extra cost of how much? 100. Am I right? So, redemption value minus net proceeds indicates the extra cost that I am incurring overall. Am I right? But wait, this is overall for a period of 10 years. Annually, how much is it? Hence, divided by n. Is that clear, guys? So here, overall, I pay how much? 100 rupees more. So divided by 10 if you do. So every year, literally, I am only the annualized cost, amortized cost of this difference is only how much? 10 rupees. Is that clear, guys? Now, isn't it logical? Right? So I into 1 minus t plus RV minus NP by n. RV minus NP gives you what? The total extra amount I pay, but that is for the entire period, divided by n, you get per annum. Is that clear? Because this is also per annum only, no? Make this also per annum. Divided by what? This is the overall cost. Divided by the value of debenture. Now there are two values, sir. What? One is the amount I received today, that is net proceeds. The other one is the amount I am going to repay them. Guys, are you understanding? Sir, the amount I receive from them is different. Amount I pay from them is different. Amount I pay back to them is different. Sir, which amount should I take as a base? Don't worry, take a simple average of the two. Is that clear, guys? Isn't it simple? You guys tell me, isn't this simple? Such a logical formula. Students are, mugging this up like anything. Smart way of studying is conceptual learning, guys. Now, what does it tell me? The formula. Now, don't look at this. Interest into 1 minus tax. I into 1 minus t. This is one component of cost. Another component is difference. RV minus NP. That's for the entire period divided by n. The whole by RV plus NP by 2. That's all you're done with the formula, guys. Why should you mug up? My commitment to you, no need to mug up even a single formula. And that's about it. Is everyone able to understand? Right? Once again, you tell me I into 1 minus t plus RV minus NP by n, the whole divided by RV plus NP by 2. Simple average of the capital I received and the capital I paid. Is that clear? Redemption value plus net proceeds by 2. Is this clear, guys? Is everyone able to understand? Now, is this method a good method? The answer is no, but this we use only for convenience sake. Is that clear? Now, why, sir, this method is not good? Clearly because this ignores the concept of time value of money. In IRR, we consider time value of money? Yes, sir. Here, how do you say that, sir? We are ignoring time value of money. I will easily prove it to you. RV means what? Redemption value. How much the amount? 1000. When does redemption happen? At the end of 10th year. Net proceeds means what? Amount I received today. How much is it? 900. When does it happen? T0. Now, directly we are subtracting a figure receivable, a future cash flow with the present cash flow. Now, this clearly is what? This clearly is actually a deviation from your time value of money. That's why we call it as approximation method. Okay, don't break your head. Okay, fine. So, simply we can do it. Is that clear, guys? Or another thing you can do is, first you calculate under approximation method and see. Now you will know approximately your IRR will find in this range. With this you can take trials. Are you all able to understand? Guys, is everyone able to get this? This is another way of doing it. So approximation method will see 11.58. Here how much it was? 11.7699. Don't worry. What should you do? Somewhere in between this will be there. One trial 11%, another trial is 12%. Between the two, if you do, you will get it. Is that clear, guys? Yes, this way you can do it. Approximation can be used for that. Guys, this if you actually, these are some beautiful nuances of the subject, right? If not for this, I don't know what else is beautiful. I mean, that's how I actually adore the subject. It's such a beauty, guys. You need not mug up anything at all. Is that clear? Fine. Are we done here? Are we done here? So, is this the best method? The answer is no. So, correct method, perfect method, right method is only your IRR. But for convenience sake, we use something called as a shortcut or a formula, or also known as approximation method. Is this clear for everyone? Is this clear for everyone? What is the formula? Everyone tell me. Interest. It is not interest rate. It is I, interest amount, into 1 minus tax rate plus RV, redemption value minus net proceeds, divided by n, number of years, the whole by simple average of the two, RV plus NP by 2. You guys only told now. Now, where is the question of mugging this up? And that's about this beautiful formula. Is that clear, guys? Now, one more thing I want to tell you. Now, this is the formula we generally use. Is that clear? Now, there is one more thing, rarely used formula. What is that? Now, RV minus NP by N. What is that? RV minus NP shows the overall extra amount I pay divided by N gives me the annualized extra cost I incur. With respect to what? The difference between my redemption amount and my net proceeds, guys, correct? This is also a cost only, no? So if this is also a cost, on this also tax benefit should be allowed, no? Guys, if this is also a cost, on this also tax shield will be there. Because of this, you will save some taxes. Guys, agreeing with me? So if you are assuming that even on this amount, there is a tax saving, which means once again here also you can put 1 minus t. Am I right? Guys, is everyone able to understand? And since here also you have 1 minus t, here also you have 1 minus t, you can take it out in common. In that case, what will be the formula? The formula is I plus RV minus NP by 1, the whole into 1 minus t divided by RV plus NP by 2. Here, what is the assumption? Both the interest as well as the difference between my net redemption value and the net proceeds, both are tax deductible. Hence, I'm taking it. This is a rarely used formula. Then, sir, why are you giving it? It is given in your study material, right? That is the reason I've given it. Is this clear, guys? That's about KD, guys. That's about KD. And once KD is over, almost KP is also over. Is this clear, everyone? Is everyone able to understand? Guys, are you all able to get this? Is there any issue here? Is there any issue here? Everyone clear with this? Yes? Now, 1 second. Let me just sum this up. Now, first, what are we? In which segment are we in? KD, cost of debentures. Everyone, please focus here. We are in KD. Under KD, there are two models. What is this? The first one is irredeemable. The other one is redeemable. Right? Redeemable. Irredeemable. There's only one formula. What is that? What I receive divided by what I pay upon what I receive. What is that? I into 1 minus t divided by net proceeds. Right? Now, in case of redeemable debentures, how many models are there? Two different methods are there. One is called as YTM, yield to maturity, or IRR, or the present value method. The other one is called as a shortcut formula or approximation method. IRR method, you guys know how to do it, normal IRR. Formula method, formula you tell me. Interest into 1 minus tax rate plus RV minus NP by N, the whole by RV plus NP by 2. And that's about it, guys. That's about your discussion with respect to KD. Is that clear? Now, 1 second. Now, before we move on to the numericals, 1 second, you tell me one thing. Now, there are a few things that you need to keep in mind. Doubt busters. I have created these doubts. Now, please focus on this before entering into numerical problems. These are some commonly committed mistakes. Shall we do this? Yes. Now, first, sir, one common doubt. Which method should I do? Finite period. Should I use IRR or should I use shortcut method? In the absence of any specific information, student may use any of the two methods, that is YTM or approximation, to calculate KD. Is that clear? Fine. One doubt clarified. Yes. So you can use any of the two methods, which is YTM or approximation. Approximation method gives only the approximate value of KD, whereas YTM gives you the accurate value of KD. Is that clear? Under approximation method, in the absence of any specific information, students may use any of the two formulae to calculate KD with logical assumption. Means what? Tax rate, I told you, no, under formula also you had two. What? One was with the assumption, general formula is tax shield is applicable only on interest. The second formula is what? Tax shield is applicable on both the interest as well as the spread between my redemption value and my net proceeds. Is that clear? Now, which one to follow? Preferably the first formula. Now, my suggestion is follow the first formula. If in exam specifically they have given, right, that even your the difference between your net proceeds and what is that? Redemption value net proceeds, if that is also tax deductible nature, only then you use the second formula. Is that clear? Perfect. Next. Now, what do you mean by net proceeds? Guys, very important. What do you mean by net proceeds? Amount I receive. Issue price minus flotation cost. Now, 1 second, guys. Please focus here. If you have a sticky note or something, please write it down somewhere. Now, in the question, issue price is not given. Now, suppose in the question, issue price is given. Take issue price. From that, subtract what? Flotation cost. Clear? If issue price is not given, then you can, and suppose in the question, the current market price is given. Means what? Today, if I go to the market, it is trading at this price in NSE, BSE. Right? Then if in the absence of issue price, you can take current market price as the issue price and do the calculation. So, assume that CMP is equal to what? Current market price is equal to issue price. From that, subtract flotation cost and do it. Is that clear? Any problem? Guys, are you all able to follow this? But if the current market price is also not available, then assume that the issue happened at face value. Is that clear, guys? Is everyone able to understand? Sir, all the three data is given, sir. What should I do? Obviously, follow the same priority. Give first priority to issue price. Not available. Go to CMP, current market price. Not available. Then assume face value. Without face value, they will not give any question. Is that clear? Right? And one more thing. Sir, flotation cost, sir, not given. If it is not given, assume no flotation cost. Flotation cost given, sir, 2%. That's all. What will you do? You can either apply it as a percentage of issue price, or you can apply it as a percentage of face value. Whatever you do, please write a note, because institute is randomly taking any of these two methods for different problems. Is this clear, guys? Is this clear? Now always understand, this is very important, not just for KD, KP, KE, everywhere. This order of priority is extremely important. Note it down in your concept decoder itself. This is the order of priority for calculating what your net proceeds. Is that clear? Now from this only you'll subtract what? Flotation cost. Are you all able to understand? If issue price is given, take it. If not, take current market price. If that is also not available, take the face value. Is this clear, guys? I'm readily giving you the exam related tips as well. Is that clear? Now with this quickly, shall we just do a couple of sums before we wind up, just so that we get a completeness in this area? Shall we, guys? Let's do this. So please go to your solved question bank, page number 5. Please come on, make it fast. Make it fast. Yes. Shall we begin? Now, let's get started. Shall we, guys? Yes. Now, problem number 1. A Limited issued. Now, guys, focus. Issued 30,000 shares, or issued 30,000 15% debentures of rupees 100 each. The cost of the issue was how much? 30,000. Now, cost of the issue means what? Yes, issue cost means flotation cost. Don't say cost of issue means cost of debt. No, KD, no. It is what? It is actually nothing but your issue cost. Is that clear? That's nothing but your flotation cost. Determine the cost of debenture if they were issued at scenario 1 par, scenario 2 premium, scenario 3 discount. Is that clear? Now, one second. Now, I want to tell you all one very important thing. Now, this question, we can do it either using finite life. Is there a finite life? No. So life is not mentioned, which means this is an irredeemable debenture. That's how you need to identify. Irredeemable debenture, what is the formula? What I pay by what I receive. Interest into 1 minus tax rate divided by net proceeds. Is that clear, everyone? Is that clear? Very simple, isn't it? No. One second. Now, guys, there are two ways of doing the calculations. One, you can do all the calculation per debenture model. Means what? Interest per debenture. How much is it? 15% on 100. 15 into 1 minus tax rate. Nothing given. 0. Divided by net proceeds. Net proceeds will be how much? Now, nothing is given. So, issued at par only. No. Guys, 100. First one. Okay. 100 minus. Now, issue cost. In this case, issue cost is given in a total value. The 30,000 rupees bulk. 30,000 rupees is the flotation cost for how many debentures? 30,000. Per debenture, how much is the cost? 1 rupee. So minus 1 you can do. Is that clear? This way you can do. Or another way of doing is what? Totally you do. The total interest, how much is it? 15 rupees per debenture into 30,000 you can do. Is correct? It's going to be 15 into 1 minus tax rate into 30,000. Am I right? Similarly, divided by denominator. Per share I receive how much? 100 into 30,000. This is the total value minus the total flotation cost. You will once again get the same answer. Why? 30,000 can be taken out in common. It gets knocked off. Are you guys able to understand? Or in other words, you can do the calculations on a per debenture level or on total level. Answer will not change because of that. Is that clear, everyone? Is that clear, everyone? Guys, are you all able to understand? Now here, the art of observation is life is missing, right? Not your life, right? So that is fine. We will miss later. But look at this here. Life of the debenture is missing. Means clearly what is this? This is an irredeemable model. Are you clear with this? So don't say that assumption I will take a shortcut IRR. What assumption? This is not your finite life. This is with infinite life. Is that clear, guys? Shall we quickly do this question? Yes, please do it here. Write down question number 1. See how simple isn't it? Now that's why I said we spent a lot of time last about more than 1.5 hours we have spent in this area. Now not even a single sum. Now you see the speed with which you can do the sums. That's exactly what I'm telling you, guys. Smart working. Spend more time on the preparation. Execution will take lesser time. That's the smartness here. Else even if you do 1,000 sums, you will somewhere feel you will not get the confidence. right? Conceptually be strong, and then we'll solve variety of questions in our question bank. Literally different variety of sums I've kept. I've not missed even a single variety. If at all in exam they ask, it could be based on the concept or discussion which we have made in the classroom. I can clearly assure you on that. Is that clear? Now write down here question number one. Question number one. Write down, guys. Write down. First common thing, whatever it is, write down. What is the formula? K is equal to, yes, interest I into 1 minus tax rate divided by net proceeds. Is that clear? Yes. Now we'll do it at in the total level. In the total level means, what is the total interest? That also I can write down, no? What is the total interest? Come on, tell me, guys. It's going to be 15%, no? On what? On 30,000 into 100. Am I right? 30,000 debentures into 100. This is the total debenture capital value on that 15% figure. Rupees 4,50,000. Is that clear, everyone? Is that clear, everyone? Right. Now what do we do? Write down scenario number 1. What is scenario number 1? Right. Issue at par. Issue at par. Issue at par. Now what is this, guys? Now in this case, come on, tell me. So KD is equal to, now what is going to be my numerator? Come on, interest 4,50,000 into 1 minus tax rate not given 0 divided by net proceeds. Now guys, in this case, how much will be my net proceeds? How much will be my net proceeds? Can I say net proceeds is going to be, so 30,000 debentures into 100. This is the value I should have received ideally, right? But out of this, I need to pay how much? 30,000 rupees as what? The cost of, the flotation cost. Is that clear? So this is clearly 4,50,000 divided by 29,70,000, right? Obviously into 100, right? Into 100 you can put, even otherwise it's understood. Anyways, how much is this, guys? 15.15% is going to be my effective cost of capital. Effective cost of debentures. Is that clear, everyone? Is everyone able to get this? Now, second one, quickly write down scenario number 2. What is it? Issue at premium. Issue at premium. Now, in this case, write down KD is equal to interest into 1 minus tax rate, 4,50,000 into 1 minus 0 divided by, I'm issuing it at what, guys? I'm issuing it at a premium, which means 30,000 debentures are issued at how much? How much the premium? 10%. 100 plus 10% on 100 is 110. Every debenture was issued at 110. This is the total amount, right? I would have received from the debenture holders. However, I need to pay how much out of my pocket as flotation cost? 30,000 rupees. It's going to be 4,50,000 divided by 32,70,000. How much does that come out to? 13.7666. 7614 something. Okay, 13.76%. Is this clear for everyone? Is everyone able to understand? Any issues here? No. Next, let's go on to scenario number 3. What is it? Issue at discount. Shall we? Yes, let's do this. In this case, KD is equal to, come on everyone, interest 4,50,000 into 1 minus tax rate 0 divided by the discount at 10% means 10% on 100 is 100. So 10% on 100 is 10. So 100 minus 10 is 90. So what is the amount I receive from the debenture holders? 30,000 into 90. Am I right? Right. From that subtract how much? 30,000. So you get what? 4,50,000 divided by. Yes. So it's 27 lakhs minus 30,000 is going to be 26,70,000 into 100. How much you get, guys? 16.85%. Is that clear? Is everyone able to understand? Is everyone able to understand? Is there any issue here? No. And that's about this particular question. Are we done? Now guys, I want you all to take the last page of your notebook. Please take the last page of your notebook. If you have already attended my costing lectures, you guys must be knowing this. But for those who are first attending my FM lectures, right? So now in that particular last page, go to last page. It's okay. No, last page does not mean that story and all will be written. Not that page. Last blank page. Okay, that last blank page only. So In that last blank page, you take the heading Library of Adjustments. I'll tell you what this is. Library of Adjustments. Now, this is the biggest value addition of attending the lectures. Now, what is this? I'll tell you. Every time we finish up solving a particular question, so what I will do is I will dictate something called as library of adjustments. Now, what you need to do here, you need to have some columns here. Chapter number, question number, page number, and leave a big column for adjustment. Now, what is this? For example, now this is chapter number 2, question number 1, right? Now, this question, where did you find it? In our question bank, page number 5. Now, this is where the question was there. Now, in your notebook, whatever is the page number, I want you all to number your page notebook also. Please number your notebook, guys. I think I forgot to tell you. Please number your notebook. 400 pages long size rule notebook. Number it. Give the reference here. Now, adjustment, I will dictate. Now, from now on, you need to update this. Every time we finish a question, I will dictate adjustment alone. The other parts you need to fill in. Now, why are we doing this? Now, basically, guys, now every single question has its own learning objectives, right? Some new value addition will be there in every single question. Now, we are capturing it all together. Now, the day before your exam, where many students struggle is, they do not know how to start, how to end, how to revise and all. Now, if you open this library of adjustment, clearly it will tell you, okay, this particular question number 1, this was the adjustment, the unique thing that we learned. Question number 2, learning adjustment. Suppose you want to revise, let us say all the sums relating to KD. It was covered in question number 1, 5, 9 example, right? Now these adjustments, now quickly what you can do, okay, this is there in the textbook in this page number, in the notebook in this page number. Now you can open it, quickly revise that particular question alone, right? This actually saves a lot of time. Now, I expect you all to do it with 100% sincerity, and please guys, do it whenever online folks, please do it. Whenever I'm dictating it, go and update it. Now, sir, 1 page is enough, not enough. Now, I am not asking you to leave some pages in the back. Don't do that. Start from the last page, go reverse. It's absolutely fine. It's absolutely fine. I don't want you guys to predict the pages, right? It's absolutely fine. Go from the reverse. Now, this actually has been a life savior for so many students. You will not believe, some students have called me exactly at 5 or 5:10 after they step out of their exam hall after FM. They've called me, sir, this was actually a life savior for us. Thank God we actually wrote this down. Now this I don't print and give and all. No, this gets dictated during the lectures, and I want you all to write it. Now when you are experiencing the classroom discussion and you're writing it, it actually stays in your memory, and it's easier for you to actually recollect and track the sums with the solutions. The solutions are already given in the book itself. No sir, then why are you asking us to track down the notebook page? No, it's not like that. Solutions are also given in your study material. Then why are you attending the class? It's not like that. In fact, my book itself has a solution, no? But it's not about the final destination. It's about the journey of how to read the question and then arrive at the solution. In the classroom when we are discussing, you would have made some mistakes and all these things. I would have asked you to mark something in a red ink, and I follow this color coding and all, no? All those things are extremely important. The day before your exam, when you're opening up, these red ink items will pop up, and automatically it saves a lot of your time. You will relive the classroom moment. Trust me, that's the experience you get, and I want you all to not miss that experience. For that, first, you need to make note of this. Fine? You guys are clear? Now, let me dictate this library of adjustment. Write down. KD hyphen cost of irredeemable debenture. Cost of irredeemable debenture. Semicolon. Semicolon is one dot on the top and one comma. Semicolon. Issue at par/premium/discount. Issue at par/premium/discount. Issue at par/premium/discount. Is that clear? Is that clear, guys? So basically, every single sum, whatever we are going to learn additionally, we will just be marking it here in this adjustment. So from now on, I will only dictate this, right? The other components, I want you all to note it down, like chapter number, question number, page number, and all. You should only write down. Is that clear? Right? Now, just one more thing, guys. Here, I just wanted to get into this question number 1A. Question number 1A. 1 second. I just want you all to just read this particular question number 1A. No doubt, it's more or less, if you solve 1, you can also solve 1A. But there's one small catch here. What is it? We will see. And with this question, we'll wind up the session. Fine. Now, what is it? 5 years ago, Sona Limited issued 12% irredeemable debentures at what? 103 rupees. At a 3 rupee premium to their par value of 100. Which means what? Face value was 100. And 5 years ago, at what rate did they issue? The issue price was 103. The current market price of these debentures is 94 rupees. Right? If the company pays a corporate tax at a rate of 35%, calculate its current cost of debenture capital. Now, there is one mistake which many students do in this question. That's the reason I wanted to take 1A and do it. Now, what have they given? 5 years ago, Sona Limited issued what? 12% irredeemable debenture. Irredeemable debenture, KD calculation. Formula. Interest into 1 minus tax rate divided by net proceeds. Now, how much is the interest, guys? 12% on 100. How much is it? 12 rupees into 1 minus tax rate, 1 minus 0.35 divided by, what is my net proceeds, guys? What is my net proceeds? Issued at 103, right? Now, the issue price is given and the current market price is also given. Which one will you take? Issue price, but that is where you make a mistake. Now, why? Guys, this is the reason I gave you all the background of the subject and all. Are we doing a post-mortem work, or are we dealing in decision making? Now, this was the issue price when 5 years ago when the debenture was issued. Clear with this? Sir, that debenture only? No, sir. Yes, that debenture only. Now, the debenture is continuing now. Right? Now, today if I go to the market and if I raise this debenture, what is the amount at which I will be able to raise this debenture? Or in other words, what is the amount of amount at which I will be able to issue this debenture if I go to the market today? Current market price is only 94. Is that clear? Hence, we are going to deal with futuristic decision, guys. Correct? Hence, for the purpose of this calculation, what we do is, so cost of irredeemable debenture is I into 1 minus T, which is nothing but 12 into 1 minus tax rate. How much is tax rate? 0.35 divided by net proceeds. Net proceeds is going to be what? 94 should be taken. Is this clear, guys? Minus flotation cost, that is not that. Is this clear, guys? If I go to the market today and raise the money, same debenture, how much will be the cost is what we are calculating. Sir, I am not paying this, sir. I am not getting 94, sir. I got 103, sir. That you do it in your financial accounts. You record 103. I am not denying that. Here we are talking about decision making. If I go to the market today and raise money from debenture, what will be my cost? This is only relevant for my future decisions. Am I right, guys? Is everyone able to understand? This is the catch here. 5 years ago, issue price is irrelevant. Right? There's a concept in costing we would have studied. Sunk cost. Right? The sunk cost concept, something that's happened in the past, is irrelevant for decision making. Right now, if I go to the market and raise money from debentures mode, what will that be the case? So write down here question number 1A. Quickly, let's wrap it up with this. Question 1A. Write down, guys. Question number 1A. Write down. Write down. Cost of irredeemable debentures. Formula. Guys, come on, tell and write. I told you, learn like a child, behave like a professional. Right? So formula, KD is equal to I into 1 minus tax divided by net proceeds. Now in this case, what is I? It's going to be rupees 12 into 1 minus tax rate is 0.35 divided by, what's my net proceeds, guys? Take a rating. Write down rupees 94. Is that clear? So into 100, so whatever it is, how much is this, guys? So 12 into 65. So 1 minus 0.35 is 0.65. Okay, so 7.8. This comes to 7.8. Am I right? Divided by 94. How much is that? Into 100. It's going to be 8.29%. Or 8.29 round off to 8.30%, whatever it is roughly. You can even write 8.2978%. Even put it here and stop. Is this clear, guys? Is everyone able to understand? Please take a red ink and write a note. Note. The issue price, the issue price of 103, the issue price of 103 is pertaining to the issue made 5 years ago. The issue made 5 years ago. And does not indicate the current issue price. And does not indicate the current issue price. Hence, the same has been ignored. Hence, the same has been ignored. And CMP has been taken. What is CMP? Current market price has been considered for net proceeds calculation. And current market price has been considered for NP, net proceeds calculation. A very, very important adjustment here. Please mark this as important. In a big sum, just this adjustment if they give, what will you do? This adjustment if they give, what will you do? 5 years ago, now many students will think, sir, issue price you told, no sir. Take issue price means current issue price. Because the past issue price don't take, that is irrelevant. But based on that only the actual cost is computed. Yes, sir. I am talking about the futuristic decision. For that, actuals, past data is irrelevant. Is that clear? Please go and update your library of adjustment. Write down. Question 1A, give the cross-referencing. Write down. Quick. KD hyphen cost of irredeemable debenture. KD hyphen cost of irredeemable debenture. Write down. Semicolon. Use CMP as NP. CMP, current market price, as NP, net proceeds. Within bracket, ignore old issue price. Within bracket, ignore old issue price. This is just for our understanding. Now just tell me, if you read this the day before your exam, if you read this in your library of adjustment, now definitely you will know what happened in the class. Now you will go check it. This red ink item and all will pop up. Guys, correct? This is where you get the best learning experience, because you will never forget this for a lifetime. Is that clear, guys? Right? So with this, I am concluding this session. Please revise whatever we have covered till now, and also practice the 2 sums which we have done. I will see you all in the next one. Thank you all so much. Bye. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So in the previous session, we got started with this beautiful chapter called Cost of Capital. So we got introduced to this chapter, and we also studied the basic concepts to enter into this chapter, like your tax shield and all of those things. And then we got started with the first source of finance, namely your debentures or debt. And we saw how to calculate the cost of debt. Under that, we had 2 models: debentures, irredeemable debentures, redeemable debentures. Cost of irredeemable debentures, what is the formula? Interest into 1 minus t divided by net proceeds. So I into 1 minus t, we are talking about interest amount, numerator cash flow, denominator cash flow, not interest percentage and all. Is that clear? So yes, what I pay upon what I receive. We saw the logic also about that, the time value of money. On the other side, redeemable debentures broadly classified into 2. One is your YTM formula, 2 ways of calculating. First, YTM or IRR or present value method, where we saw that, frame the cash flow equations and using IRR, 2 trials, 1 positive, 1 negative NPV, interpolation, arrive at the answer. Is that clear? And the other one is going to be your shortcut or approximation or formula method. What is the formula? Interest into 1 minus t plus RV minus NP by N, the whole by RV plus NP by 2. Excellent, right? So that's about it. Or there is also a second formula. What is that formula? So where even the difference between redemption value and net proceeds, that is also eligible for your tax shield. In that case, it's I interest amount plus RV minus NP by N. The whole numerator is multiplied with 1 minus tax rate divided by RV plus NP by 2. This is a rarely used formula. Unless and until the question specifies to use this formula, don't use it. Use only the first formula. Is that clear, guys? This is what we have seen. And I have also told you. So for the purpose of net proceeds, how will you calculate net proceeds? Issue price minus flotation cost. If in the question issue price is not given, what will you do? You will take the current market price. If current market price is also not available, then what will you take? You'll take the face value. This is extremely very clear. Is that clear, guys? Is everyone able to understand? Right. So this is how we generally, this is what we generally follow. Is that clear, guys? Right. And we also saw in that in the last session, the last question that we saw, 1A, the past issue price, it is irrelevant. Though that would have been an actual amount. Here we are in the subject where we are going to take decisions. Past whatever happened is not actually relevant for us. For us, the most important thing here is, if I go to the market to take debentures today, what will be the scenario? Is that clear? We are dealing in a futuristic subject. We are not bothered about the past. Is this clear, guys? Have all these things in your mind. Now, shall we go and do the next numerical problem? We did 1 and 1A. Shall we just get started with question number 2? Yes, guys, come on. I want you all to do it. Come on, let's get started. Let's get started. I will read the question for you, and please, you also make sure that you are, being extremely attentive. Let's get started. A company issues 10 rupees 10 lakh 12% debentures of rupees 100. Wait, what is the meaning of this? Rupees 10 lakh means 10 lakh rupees worth of debentures, which means how many debentures were issued? 10 lakh divided by 100. How much is that? 10,000. Am I right? So they have issued a total of 10,000 debentures. Is that clear, guys? Is that clear? Yes. Next, the debentures are redeemable after the expiry of a fixed period of 7 years. So after a period of 7 years, the debentures are going to be expired, which means the period is given finite life, which means in this case you can either do it under IRR or shortcut formula method. Fine. The company is in the 35% tax bracket given, required to calculate the cost of debt after tax. Whenever they are saying cost of debt means KD. Even if it is not mentioned after tax, we know it is after tax. Why? That's why we take the tax shield 1 minus T. Is that clear? Now calculate KD if the debentures are issued at scenario A, par, scenario B, 10% discount, scenario C, 10% premium. Is that clear? And if a brokerage is paid at the rate of 2%, what will be the cost of debentures if the issue is at par? Which means for the first part of the question, the flotation cost brokerage is not there. Only for the second part of the question, we have this brokerage. Is that clear, guys? Shall we get started? Shall we get started? Let's do this. So question number 1. Please, online folks, do this along with me. Printed a solution available and all. It's another story. Now, do not look at the solution. Attempt it by yourself. Attempt it by yourself. So, and only when you do it in the classroom along with me, the learning experience will peak. Right? Shall we begin? Hello, everyone. Come on, let's get started. Question number 2. Question number 2. Now, guys, come on. Tell me. In this question, have they mentioned which method to use? ITM or shortcut? No. If nothing is mentioned, you can use any method. Which method you want to use? Obviously formula only, because easiest, right? So, but it's just an approximation method, guys. But anyways, nothing is given, you can use anything. Is that clear? Let's get started. Write down the formula. Shortcut formula. What is that? Write down KD is equal to, yes, come on, everyone, answer, tell and write. I into 1 minus T, very good, plus RV minus NP divided by N, the whole divided by RV plus NP divided by 2. Is that clear? Right? And now in exam, you should write where I stands for what, T stands for what, RV, NP, and N and all. You should write down the full form of every abbreviation. Exam, please write it. Here but exam, write it. That is a must. Is that clear? Now write down. Now there are 3, first part 1, under that ABCD, write down, guys. Part 1, under part 1, you have 3 scenarios. A, what is A? Issue at par, write down, issue at par. Shall we begin? Okay, guys, come on. In this case, can we list out the ingredients first? Shall we list out the ingredients? Okay. Now, first, in this case, what is going to be my I? I is equal to, so in this question they have given, it's what, 12% on 100. Am I right? So 12% into 100 gives you 12 rupees. I is a figure amount, right? It is not percentage. Then, so are we okay, T, okay, it's given. Okay, T is how much? 35%. Then RV, how much is RV? Now, nothing is mentioned, which means the redemption will happen at par. Very good. So it's going to be rupees 100. Then NP, net proceeds today, issue it at is at par. So ideally, it's going to be 100 minus 0. Why minus 0? In the first part, there is no brokerage, flotation cost. Is that clear? It's going to be 100 rupees. Is that clear, everyone? Guys, clear with this? Perfect. Right. Then what is it? What is it? N. Okay. What is the life? 7 years. Guys, everyone answer, please. Everyone, even online folks, you answer. Tell and write. It stays with you forever. Right? So KD is equal to 12 into 1 minus 0.35 plus 100 minus 100 divided by 7, the whole divided by 100 plus 100 divided by 2. Is this clear for everyone? Guys, is everyone able to understand? Hello? Yes. Now tell me, guys, so how much is this? This is going to be 12 into 1 minus 0.35. How much is that? 12 into 0.65 gives you 7.8, right? So 7.8 plus 0, am I right? Divided by 100 plus 100 is 200 by 2 is 100 only. Is that clear? Or how much is this going to be? 7.8 by 100, it's going to be 7.8%. Is that clear? Is everyone able to understand this? Is everyone able to understand? Guys, please answer. Everyone able to understand? Any issues here? Guys, clear with this? No. 1 second. 1 second. A small observation. Here, the issue was at par. Redemption also is at par. Hence, there is no difference in the spread. Am I right? Hence, the only cost of debenture was interest. That too, post the tax. Is that clear? Guys, correct? Or can I say, when the issue and the redemption is at par with no flotation cost, anything, now directly the only cost is going to be my interest. Am I right? So directly, this is nothing but, now how did you get this? 12 into 1 minus 0.35 divided by 100 plus 100 by 2 is 100. Am I right? This is the effective cost. Am I right, guys? 12 by 100 is what? 12%. That is nothing but interest rate. Can I directly say in this case, so the KD value itself is going to be interest rate into 1 minus tax rate. Guys, correct? Directly I can say no, right? It is not, you need not mention this in exam. I'm just giving you an observation. Are you understanding this or not? Is everyone able to understand? The only cost is interest. When the issue is at premium, and I mean, when the issue and the redemption is at par with no flotation cost or anything, in that case, directly KD is nothing but interest rate into 1 minus tax rate. Is that clear, guys? Are you all able to understand? What was the interest rate here? 12%. So 12% into 1 minus tax rate. So 1 minus 0.35 is 0.65. So 12 into 0.65 is how much? 7.8% itself directly you can arrive. Are you all able to understand this? So if both the issue and the redemption is at par, directly KD is what? Your interest rate into 1 minus tax rate itself. Is that clear? It's a small observation that we can make. Could be helpful in your MCQ areas where step marking is not required. Am I right, guys? Is that clear? Is everyone able to understand? We are even exploring how to save some time in your MCQs as well. Is that clear? Is everyone able to understand? Any issues here? Guys, clear with this? Perfect. Now shall we move on to B? Guys, come on, don't waste your time. Quickly do it. What is B? Issue at discount. Now in this case, there is only one change. What is the change, guys? So the net proceeds alone changes. Baki, everything else is same. Net proceeds, how much is that? So 10% discount means 100 minus 10. It's equal to what? 90. Am I right? Come on, write down. KD is equal to I, interest amount, 12 into 1 minus tax rate, 0.35 plus RV, 100 minus NP, 90 divided by N, 7 divided by 100 plus 90 divided by 2. Is this clear for everyone? Guys, clear with this? How much is this going to be? 12 into 0.65 is going to be, yes, the same thing we did, 7.8 plus. Now 100 is what? Redemption. I need to redeem it 100, but today I received only 90, which means overall the cost was 10 for a period of 7 years. How much was this coming out to? It's going to be 1.4 1.4285 rounded off to 1.429 divided by 100 plus 90 by 2. How much is that? 95. Huh? So how much is this going to be, guys? 7.8 plus 1.429 divided by 95 into 100. How much is that? Come on, quickly calculate. 9.7147. Okay, 9.715% approximately. Is that clear, everyone? So when you are issuing it at a discount, the cost is going to be 9.715. Is that clear? Guys, everybody please reciprocate. Yes. Next one. C. What is C? So the issue is at premium. Issue is at premium. In this case, what will be the net proceeds? 100 plus 10. It's going to be 110. Is that clear? Now, in this case, what happens, guys? In this case, what happens? Come on, tell me. KD is equal to, yes. So it's going to be the first one, that is 12 into 1 minus tax rate 0.35 plus RV. Redemption value is how much? 100 minus NP 110 divided by 7, the whole by 100 plus 110 divided by 2. In this case, 12 into 1 minus 0.35 gives you 7.8. Now, one second. Now, what has happened here? Guys, everyone, focus here, focus here. Now, I issued at what? 110. Redemption is at 100. What is the meaning of this? I received 110 rupees, but at the time of repayment, I am paying only 100, which means in this case, there is no extra cost. The company is saving some money. When I took money from the public, I received 110 rupees, but at the time of repayment, I'm paying back only 100, which means the difference between the two, the company is saving 10 rupees overall, which means this will go on to reduce their cost only. Are you guys able to understand? This is also a possible scenario, no? Yes. In this case, how much is the company saving? 100 minus 110. The cost, actually there's no cost, there is a gain, hence minus 10 rupees have gained over a period of 7 years, but 10 by 7 per year, how much is it? Everyone, take a red ink and write down minus 1.429. Is that clear, everyone? Now, people will have a doubt. How can this be in minus? If I issue at a, if I issue at a premium and redeem at a discount, obviously this will be the scenario. Is that clear, guys? Now, divided by 100. 100 plus 110 is going to be 210. 210 by 5 is going to be 210 by 2 is going to be 105. Am I right? So divided by 105. How much is this going to be? 6.067%. Is this clear? Is everyone able to understand? Is everyone able to understand this? Now, if you see, if it is at issued at par, the cost was 7.8. Now, if I'm issuing it at a discount, how much was the cost? It was 9.715. If I'm issuing it at a premium, it is 6.067. If you notice, basically, now the cost divided by the amount, right? That is the capital. Now, at par means the capital value on an average is how much? 100 only. Guys, correct? So it is 7.8. Suppose if I'm issuing it at a discount, I incur the cost for a lesser capital amount. For receiving only on an average 95, 100 plus 90 by 2. For receiving only on an average 95 rupees of capital, the cost incurred is so much. Hence, since the denominator is reduced, overall the cost is going to be slightly increasing. Is that clear? Whereas if I am issuing it at a premium, what happens, guys? In this case, I receive more money. The cost incurred is for a more capital. Denominator has increased. Hence, my overall cost is reduced to just 6.0 something percentage. Is this clear, guys? This is how you need to look at it. Is that clear? Now, let's go on to the second part of the question. What is that? What is that? Come on. Now, suppose a brokerage is paid at a rate of how much? 2%. Okay. Fine. And what are they saying? What will be the cost of debentures if the issue is at par? Now. Brokerage, how much they have given? 2%. On what? Nothing is given. But in this question, no problem. Why? The issue price is at par. The face value and the issue price is coincidentally same. Suppose the issue price was different and the face value was different. What should you do? You can either take it as a percentage of issue price or you can take it as a percentage of face value, but please write a note in this regard. Is that clear? Yes. Come on, let's do this quickly. So part 2 of the question. Write down, guys. Part 2. Part 2. Now, Write down. So here they have given brokerage is how much? Brokerage is equal to 2%, which means the net proceeds is equal to issue price minus flotation cost. Am I right, guys? Which is nothing but 100 minus 2% on 100. That's going to be 100 minus 2, which is equal to 98 rupees. Is that clear, everyone? Now write down. KD is equal to, yes. So 12 into 1 minus 0.35 plus RV. What is the redemption value? I redeem it at 100, but the net proceeds was only 98 divided by 7, the whole by 100 plus 98 divided by 2. So tell me this is 7.8 plus, so 2 divided by 7, how much is it coming out to? 0.2857286 divided by 100 plus 98 by 2 is 99. Am I right? So divided by 99 into 100, how much is it coming out to? 8.168%. This is my effective after tax cost of debentures. Is that clear, guys? Is everyone able to understand? Is there any issue here? Guys, is everyone able to get this? That's about this particular question. Please go and update your library of adjustments. Write down KD hyphen cost of redeemable debentures. KD hyphen cost of redeemable debentures within bracket formula method or shortcut method, whatever it is. Cost of redeemable debentures within bracket formula method or shortcut method, bracket close, hyphen r/premium/discount. 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 Is that clear, everyone? Is that clear? Okay. Okay, guys. Now shall we move on to the next one? Yes, let's move on to the next one. Now, guys, before that, one thing I want to tell you. Take your concept decoder. There we have done irredeemable debentures. Then we have done redeemable debentures under the two methods and all that. Outbusters also done. Now, all the issues relating to KD in this chapter, guys, basically is scattered in your study material. It's scattered along this entire chapter, but I have neatly condensed it and put it all in a single area. So, other issues in KD, it's mentioned here in page number 7. Now, there are some other issues in KD. Number 1, amortization of debenture or bond means what? Recall the 9th sum we did in time value of money chapter. What was that? Now the redemption is not happening in a single shot. Every year you make an equal amount of payment. In that case, sir, how will we compute the cost of debentures? Wait, every year you need to arrive at the cash flows. Guys, correct? Every year you need to arrive at the cash flows, and in that case, what you need to do? So in that case, you need to equate inflow with outflow. IRR method you need to do. Guys, correct? You can't use shortcut method and all that. Ideally, you can't use. Definitely the answer will be completely different. Are you all able to understand? Is this clear, guys? In that case, what you need to do? You need to put it in a table approach, and year-wise, you need to arrive at the the amount of cash outflows and all. Every year, there will be a principal plus interest repayment. Interest will be on diminishing balance method. You guys are aware? Refer question number 9 of time value of money chapter. Based on that, you need to prepare the cash flow equation, and only using IRR method you need to solve. Is that clear, guys? Is that clear? This is exactly what I have mentioned. So take your pen and write it down here. Write down here. Refer. That was question number 9 only, no? Correct? Write down question number 9 of time value of money chapter. Of TVM chapter. Is that clear? Now, how to do this and all, clearly you can just go and see that. Is that clear, guys? There we arrived at the value of the bond. Guys, we arrived at the value of the bond. Now, in this case, they will give you the the issue value. They will give you the, the manner of payment, cash outflows and all. So, inflow, outflow, everything will be there. Frame this equation, and the rate that equates my present value of cash inflow with my present value of cash outflow is called as my IRR. You guys know that, right? Everybody, you guys know that? That's about it. Is this clear, everyone? Is this clear, guys? That's about this. Next one, cost of convertible debentures. Now, please wait. We will do it separately. Now, I don't want to. These are some special issues. So, we will do it separately once we finish the other components of cost. That is KE, KP and all these things and all we will finish. And then we will come back to this. Is that clear? A special area separately will be done. Is that clear, guys? Zero coupon bond special area will be doing it separately. Don't worry. I will come back and do this. Now, one very important thing I want to do, there is one sum also I've kept it. Treatment of short-term debt. What do you mean by short-term debt? Typically, short-term debt refers to your creditors, your bank overdraft, short-term borrowings. Now, sir, in that case, sir, how do I calculate the cost of debt in case of short-term debt? First of all, understand this chapter comes in. Now, among the three objectives of our subject, this chapter comes in which objective? The first objective, financing decision. When I say financing decision, I am talking about long-term sources of finance. Am I right, guys? So in this chapter, please understand, we are only dealing with what? Long-term sources of finance. Short-term sources of finance should be ignored for the purpose of computing your overall cost of capital, KO, or WACC, weighted average cost of capital. Is that clear? We will do a separate sum. Do not worry. Short-term debt is a part of current liability, not a part of capital employed. Hence, while calculating WACC or KO, we should not consider the short-term debt example creditors. Is that clear? It should be ignored in our chapter. This will be considered for the purpose of computing your working capital, which we'll be seeing separately. Is everyone able to understand? Please have this in your mind. Please have this in your mind. However, in a past exam question, they had asked us to compute weighted average cost of capital by considering even the short-term source of debt. Is that clear? When it is specifically given, yes, you consider, but for that, definitely it should not be included for our overall cost of capital area. Is that clear, guys? Cost of capital. When I say capital, I talk about capital employed, the long-term sources. Is that clear, guys? Right? That's about it. Is everyone able to understand? Anyways, we'll be doing a sum in this regard. Is that clear? Guys, please reciprocate. Please reciprocate. Be active, guys. Be active. Right? Next. Cost of long-term bank loan. Now, I wanted to discuss this. Cost of long-term bank loan. Term loans are there. Simple, guys. Term loans, when you have term loans, what happens in this regard? Term loans are exactly same as what? Debentures. Debt only, no? Guys, everyone, please answer. It is exactly same as what? Your debentures. Debt only. It is a mode of raising money. Am I right, guys? Now, guys, what is the formula to calculate? What is the formula to calculate the cost of debt? I into 1 minus T plus RV minus NP by N, the whole by RV plus NP by 2. Am I right, guys? Now, you tell me one thing. When I go to a bank and ask for a loan, is there a concept of irredeemable loan? Bank will give you irredeemable loan, huh? So that is, you need not pay back. That's a donation. No, there is no concept of irredeemable loan. So which means loans come with a finite life. Am I right? Number one. Number two, there is no concept of issue price, redemption price and all. No. Whatever is the amount of loan that you took, that exactly needs to be repaid. No concept of par premium discount. Am I right, guys? Am I right, guys? Which means here redemption value means the amount I need to repay. Net proceeds means the amount I received today. These two are same. Am I right? And when these two are same, so it becomes 0. RV minus NP becomes 0. Which means the only cost associated with respect to term loan is interest amount, that too adjusted for tax. Denominator, you only have what? The value of the loan. Am I right, guys? Let us say I took 100 rupees of loan, right? And let us say the interest rate was, let us say 10%. Is that clear? Now, in this case, and let us say the tax rate was 30%. Now, what will be the cost every year? How much interest I need to pay? 10 rupees, 10%. However, into 1 minus tax rate 0.3 divided by what was the amount of loan I took? 100. Am I right? Or in other words, 10 by 100 is the interest rate itself. 10% into 1 minus 0.3. Basically, this is nothing but what? 70%, 0.7 of 10%, which is going to be 7%. Guys, correct? Or in other words, just like what I told you a few minutes back, that is when the issue price or when the net proceeds and the redemption value are the same amount issued at par, in that case, directly the cost is what? Interest rate into 1 minus tax rate. Am I right, guys? That is exactly what I have mentioned here. It is nothing but interest rate. Don't say I. I is interest amount. Here, interest rate itself you can take. Why? That is the only source of, that is the only cost for you. Is that clear, guys? Interest rate into 1 minus tax rate. Is everyone able to understand? Now, this is nowhere given in your study material, but institute study material is not there. This was once a past exam question. The institute is expecting you to apply the knowledge of debentures in term loans and say that this is how you need to do. Is that clear? If you want, you can also apply that shortcut formula and see. RV and P will be the same amount and all. So it will get knocked off, and ideally you will bog down to only this. Is that clear, guys? Is everyone able to understand? Hence, when it comes to term loans, I call it as KT ideally. If you want, you can call it as KD. T stands for term loan. Is that clear? That is my abbreviation. In exam, you can just write cost of term loan, or KT short form you can write within bracket cost of term loan. It is absolutely your choice. Is that clear, guys? What is the formula in this case? Directly the only cost is interest rate, but remember there is a tax saving. So interest rate itself into 1 minus tax rate. Is everyone able to understand this? Is everyone able to understand this? This is a very, very important thing once again. Are you all able to understand? So there is no concept of a premium or discount. Are you all able to understand, guys? Any issues, any problem here? Any issues, any problem here? No. And that's about this concept of long-term bank loan. We will be seeing once again all these things in a comprehensive sum, where we need to calculate overall cost of capital. There, every component you need to calculate, and then finally calculate what? Overall cost of capital. We will do that, at the respective place. Is this clear, everyone? Right. Now, with this, let us go and move on to the next source of finance, called as preference shares. Shall we get started? Guys, shall we get started? Yes. Now, guys, preference share capital. Now, in case of preference, first, what is the nature of preference shares? Now, guys, on one hand, you have equity shares. On the other hand, you have debentures. Now, when it comes to equity shares, you all know there is no contractual obligation on the part of the company to pay any dividend. Guys, correct? So, if they want, they can pay dividend. If not, they need not pay dividend. Guys, correct? Are you all able to understand? Whereas for debentures, what is it? Fixed amount needs to be paid by way of interest. Am I right, guys? Now, there is a hybrid source of finance called as preference share capital. There is a hybrid source of finance called as preference share capital. It takes one character from your debentures, one character from equity shares. Is that clear, guys? Now, what is that, sir? With respect to the character it takes from debt, now every year a fixed amount of dividend needs to be paid. Is that clear? A fixed amount of dividend needs to be paid to the preference shareholders. Is that clear, guys? Yes. And now with respect to the with respect to the character it takes from equity shares, here shares are issued. You don't issue debenture for them. And most importantly, the amount you paid them is called as dividend. It is not called as what? It is not called as your interest. Is that clear? And most importantly, preference shareholders generally do not get any voting rights. Are you all able to understand this? So then, sir, why are we issuing preference shares? What is the point, sir? You pay fixed amount that is also not tax deductible. Then what is the point of issuing preference shares? I will tell you when we do ratio analysis. There you will be able to understand and appreciate the concept. Is that clear, guys? The reason why a company issues preference shares, that reasoning we will see later on. But for now, you guys are clear with this understanding. So it is a hybrid animal altogether, right? It takes one character from equity and one character from debentures. Is that clear? So when it comes to preference shares, I need to pay a fixed dividend. Now recall, EBIT minus interest, EBIT minus tax, EAT. Only after I pay taxes, I can pay what? Preference dividend, which means preference dividend is not a tax deductible expense. Is that clear? Or to put it in accounting terms, it is an apportionment of profit, not a charge or expense with respect to, not a charge on profit. Is that clear, everyone? Is everyone able to understand this? Very good. Now, look at this. The preference shareholders, please keep underlining, the preference shareholders are paid dividend at what? A specified rate on the face value of preference shares. The payment of dividend to the preference shareholders are not charged as expenses but treated as apportionment of after-tax profit. Recall that entire income statement sheet. Hence, dividend paid to preference shareholders does not reduce the tax liability of the company. Like the debentures, preference share capital can also be categorized as redeemable, irredeemable. Now, what to do, we will be seeing. Is that clear, guys? Is everyone able to understand? Any issues here? No. Now, once again, guys, preference shares, I am raising money through this preference share route. Now, I have two options. One is irredeemable preference shares. Means what? So I will raise the money today and I'll keep it with me forever. There is no concept of redemption. The other one is what? Redeemable preference shares. Is that clear? Now, guys, trust me, you already know the formulas for both the methods. Now, let's see what it is. Now, guys, preference cost on preference shares is called as KP. K stands for cost, P stands for preference share capital. Is that clear? Now cost of irredeemable preference shares, A. Now, what is it going to be? Simple. KP is going to be equal to PD, preference dividend, divided by P0, P0, or you can say even NP, net proceeds. Is that clear? P0 means value as on today. The price of preference share as on today, or the most better, the best terminology is NP, net proceeds. Is that clear? Simple, simple. Numerator has what I pay, denominator has what I receive. Is this clear, everyone? This is ideally your net proceeds. Net proceeds means what? Issue price minus flotation cost. Is that clear, everyone? Guys, everyone, please, what are you doing? Reciprocate, guys. Is everyone able to understand this? Right? So now, in this case, this is the same formula, the logic we all know. Am I right, guys? We have already seen the same logic there in irredeemable debentures, the same time value of money logic only. Are you all able to understand? Annual cash flow divided by discount rate, and then you just cross multiply it. So here, the value NP today is going to be equal to what? The present value is going to be annual cash flow dividend, preference dividend divided by discount rate, KP. Or in other words, this cross multiply, KP is equal to preference dividend divided by net proceeds. Is that clear? That's what we saw here. Is everyone able to understand? Any issues, any problem here? No. Logical? Guys, logical? Yes. Remember, now in debentures, what was the cost of irredeemable debentures? Interest amount into 1 minus tax rate divided by net proceeds. In this case, that 1 minus tax rate will not come. This is directly only the preference dividend divided by 1 minus tax rate. Why? Because there is no concept of tax shield or tax saving when it comes to preference shares. Is this clear for everyone? Any problem? Any issues? No. Is that clear? Now, that's about the cost of irredeemable preference shares. Now, let's go to part B. What is this? Cost of redeemable preference shares. Once again, there are two manners or approaches in which you can calculate the KP in case of redeemable preference shares. What is that? Number one, IRR, YTM, yield to maturity, or IRR, or present value method. Is that clear? And a second one is your shortcut approximation or formula method. Is that clear? IRR method. What do you need to do? We know this. What is it? So, present the cash flow equation. So, cash flow equation will be what? First, your inflow, the net proceeds, should be equal to the present value of outflow. What will be outflow? Preference dividend divided by 1 plus KP to the power 1 plus preference dividend divided by 1 plus KP to the power 2, so on till the last year. Is that clear? And in the last year, I will also repay with the redemption value. Now, equate this cash flow equation, or you can bring the inflow to the other side, and you can say that basically your KP is the rate that makes my NPV equal to 0. Take two trials. One trial will have a positive NPV. One trial will have a negative NPV. Do interpolation and arrive at the KP value, R value, KP value. Is this clear, guys? Anyone has any problem? This is the effective cost of preference shares. Is that clear? Is everybody able to understand this? Is everybody able to understand this? So the nature here is going to be pretty much simple. The same amount gets paid every month, every year, which means you can also use annuity table to actually knock it off. Is that clear? But for redemption value, the last year alone, over and above the annuity table, you also have the present value interest factor. Is that clear, guys? You're aware of this? This is the reason why I took all these concepts there at the time value of money level itself. Now you look at this. It's easy for us to understand. Is that clear? Now, the next one is the shortcut method. The shortcut method. Now, you guys tell me what is going to be the formula. You guys logically think and answer. Come on, write down. Take the heading in your notebook. Write down. Cost of preference share capital within bracket KP. Now, under that, now I want you all to tell me the formula for what? Redeemable preference shares. Redeemable preference share. Now, what is the formula, guys? Can anyone tell me? KP is equal to, come on, logically think. What is the first cost here? Interest of interest, it is going to be preference dividend. Into 1 minus T will come. No, why? There is no tax shield on this. Plus, the same issue can be here. The difference spread between what and what? Redemption value and my net proceeds. Write down. Plus RV minus NP. This is the cost incurred for the entire life of the preference shares. So divided by N, I will get the annualized cost. The whole divided by the preference share capital. Which one should I take, sir? I receive one amount and I pay one amount. What should I take? No confusion. Simple average of the two. What is that? RV plus NP divided by 2. As simple as this, guys. That's all it is. Now you tell me, is this difficult? Guys, is this difficult? Such an easy area. Am I right? That's about it. Look at here. Look at this. KP is equal to preference dividend plus RV minus NP by N the whole by RV plus NP by 2. Is everyone able to understand? Where PD stands for annual preference dividend, redemption value, net proceeds, number of years. You guys know all these things. Am I right, guys? Hello? Yes, is everyone able to understand? And that's about this particular area. Doubt busters, once again. In the absence of any specific information, student may use any of the two methods, that is finite life. You have two ways of doing it. One is IRR, the other one is formula approach. Which one to do? Question is silent. You do anything. Which one will you do? Formula method, easy. Next one. Approximation method gives only the approximate value, but IRR gives the correct value. Next, net proceeds means what? Issue price minus flotation cost. If issue price is not given, what will you take? Current market price, if it is given. If that is also not given, assume the issue happens at face value. Is that clear? Is everyone able to understand? Flotation cost, if it is given, you take it. If not, assume it to be 0. Is this clear, guys? Have this as a standard thing. Is that clear? Now, if both issue price and the current market price is given, what will you take? Issue price only. Now, at times, you can find in institute publications, instead of issue price, they take current market price. Sir, many students ask this doubt. Sir, what can I do, sir? It is actually not correct, guys. Do not worry. Do not worry. You please take only the issue price. It is absolutely correct. Latest issue price you take. Don't take past and all. Is that clear? That is very, very clear. Are you guys able to understand? Current issue price, if it is given, take that and do it. If both issue price and current market price are available in the question. Now, in this particular chapter, there is a lot of contradiction made in institute solution. You need not have to worry. When they are correcting in an exam, they will actually be very, very clear. And that is the reason why I'm telling you all this. You can trust me on this. Do not worry at all. Lots of doubts I get in this chapter when people look at the institute publication and they say, sir, answers they are giving like this. Our conceptual learning is 200% correct. I can tell you with the 200% level of assurance. Definitely that is only correct. You can write it in exam and come. Nothing to worry about this. Is that clear, guys? They randomly take one. Each time they can take. If they are taking different values, we can't do anything about that. So our learning is absolutely correct and in a very structured way. Is this clear, everyone? Right. That's about your concept of preference shares. Now, can we just go and do some numerical problems? Guys, come on, guys. Let's quickly do it. Let's quickly do it. So we will be doing another 2 more sums. One in, irredeemable model. The other one in redeemable model. Guys, shall we do it quickly? Come on. Let's do this. If R Energy Limited, question number 3. If R Energy Limited is issuing a preferred stock, means what? No. Preferred stock means preference shares. This is ideally, I feel this was taken somewhere from, it's in Indian question only, but this looks like US English because they have stock. They don't call it as shares, they call it as stocks. Fractional stocks are possible. In India, you can't buy fractional stocks. For example, I want to buy, 1.5 shares of Reliance. Can I buy? Fractionally, I can't buy, no. I can only buy one, or in multiples of one. One lot is one. In cash market, one lot is one share. Whereas in US, it's not the case. In US, you can buy fractional stocks. That's why they don't call it a share, they call it a stock. Right? Sir, why do we need? Simple. I have 100 rupees. I want to invest 100. What they do? 100 rupees divided by the current market price. So you will get whatever is the equivalent number of stocks that gets credited to your demat account. Is that clear? So based on your amount of investment, you can actually arrive at the number of stocks. That's how in US it generally happens. Is that clear? So fractional shares of stocks is possible there. And preferred means what? Preference shares. You guys know preference. Why is it called preference shares? They issue shares. That's why it's shares. Preference means what? Over equity, they get preference for what? For paying dividend. And not just that, at the time of winding up, they also get preference with respect to repayment of the capital. You guys are aware of that? That is why it is called as preference capital. Preference share capital. Is that clear? Is everyone able to understand? Now, what are they saying? R Energy Limited is issuing a preferred stock at rupees 100 per share. Per share, they are issuing how much? 100 rupees. Okay. With a stating dividend of rupees 12 and a flotation cost of 3%. What is the cost of preference shares? We need to do. Now, 1 second. Is the life given here? Guys, is the life given here? No, which means this is irredeemable. Come on, write down question number 3. Everyone, come on, make it fast, guys. We should finish in 36 seconds. Question number 3. Write down. Write down. So, KP, first of all, write down. This is what? Irredeemable debentures. Sorry, irredeemable preference shares. Irredeemable preference shares. Write down. Write down. Irredeemable preference shares, write down. KP is equal to, come on, write down. It's going to be what? Preference dividend divided by net proceeds. Am I right, guys? Now, what is the preference dividend? 12 rupees, right? Divided by what I pay, divided by what I receive. How much do I receive? 100 rupees minus what? 3% on 100 is going to be 3 rupees. Am I right? So it's going to be 12 rupees upon 97 rupees into 100. How much is that? So the answer is 12.37%. Is this clear, guys? This is going to be my effective cost of preference shares. I pay 12 rupees and I get only 97. Effectively, the cost is 12.37. It is not 12, it is 12.37. Why is it more? Because the amount I receive, denominator has reduced. So this is the cost for raising 97 rupees effectively, which means my effective cost of capital is 12.37. Cost of capital means cost of preference. Is that clear? Please go on and update your library of adjustments. Write down. Write down. KP hyphen cost of irredeemable preference shares. KP hyphen cost of irredeemable preference shares within bracket direct. KP hyphen cost of irredeemable preference shares within bracket direct. Is that clear? Is that clear, guys? Done? Now, let's move on to the next question, number 4. Shall we get started? Okay. Preferential Limited issued 30,000 15% preference shares of rupees 100 each, redeemable at a 10% premium after 20 years. Now, how many shares they are issuing? 30,000. What is the dividend rate? 15%, right? Of how much? 100 each. Perfect. The redemption value is going to be how much? 10% at premium, 10% premium after 20 years. 20 years is the life. Redeemable or irredeemable? Redeemable. Life is 20. The issue management expenses were how much? 30,000. What is this? Flotation cost. Excellent. Is how much? 30,000 rupees. Very good. Find out the cost of preference share capital if they are issued at a par, premium, discount. Is that clear? Now, please understand, these three are three different scenarios of issue price. In all the three situations, redemption value is what? 10% premium only. Is that clear? So don't assume. So issued at par means redeemed at par. Issued at premium means redeemed at premium. Issued at discount means redeemed at discount. No. This is independent of redemption value. In all the three scenarios, redemption value is how much? It is happening only at what? At a premium of 10%, 110 rupees. Is that clear? Shall we do this question? Shall we do this question? No. Understand. Now this question basically can be done in any of the two manners. That is basically, of course, one is shortcut method, IRR. Which one you want to do? Nothing is mentioned. Let's do shortcut method, number 1. Number 2, the calculations can be done on a per share level, or it can be done in total. Whichever way you do, you will get the same answer only. Is that clear? Yes. Now, I think here the solution I've given in total. Can we do it on a per share basis? Okay, let's get started. Come on, write on question number 4. Come on, guys. 1 minute and we should be done. Question number 4. Now, first, write on formula. Everybody tell and write. KP is equal to, guys, tell and write. Come on. I'm telling you, tell it. Yes, is equal to, yes, preference dividend plus RV minus NP divided by N, the whole by RV plus NP divided by 2. Is that clear? Yes. Now, write down the first one. What is it? Situation number 1, am I right? Or whatever it is, A, yeah? Okay. Situation, part 1. Okay, you can take it as part 1. Write on. Part 1. Yes, issued at par. Issue at par. If you notice, I'm very careful with the word. I didn't say issued. I'm just saying issue is at par. Because if it is already issued, then our subject is not even into existence. We are futuristic subject. Correct? So before a transaction happens, we are doing it. So when the issue is at par, if we say issued, it means it's already done. Is that clear? So for this on an exam, they will reduce marks. No, but I am telling you, when you are doing something, do it with a class. You actually know the subject. So hence I'm saying these small things, actually, maybe not right now, but in life, it matters a lot. Shall we get started? Yes, come on. Now let's do this. First, in this case, when I'm issuing at par, come on, tell me, guys, what is my preference dividend? Everyone. How much is it? 15% on 100. It's going to be rupees 15. Please write down. It is not a percentage. Then tax rate. T. How much is tax rate? Oh, sorry, it's not tax rate. It's not there. Okay, very good. This for this. I mean, still in debentures. I'm so sorry. Very good. There is no concept of tax shield here. Then RV. How much is it? Now it's going to be 110. How did you get this? Rupees 100 plus 10% on 100 premium. Is that clear? Now in all the situations this is the case. They have given. Then N is equal to 20 years. That's about it. Yes, NP is equal to, what is NP? How much is NP, guys? Now NP should be, one second, NP should be what? NP should be, in this case, one second, in this case, issue price is going to be at 100 minus flotation cost. How much is the flotation cost? It's given in bulk, 30,000 for the entire issue. How many, for 30,000 is the cost incurred for issuing how many shares? 30,000 shares, which means per share, how much is it? 1 rupee. So we can write it here, guys, correct? So what we will do is come down and write flotation cost is equal to rupees, take a writing and write down 30,000 divided by 30,000 shares, which is going to be equal to rupee 1 per share. Is that clear? So which means net proceeds is how much? Rupees 100 minus rupees 1. It's going to be how much? 99 rupees. Is this clear, guys? You can also do it like this, or sir, I want to do it in bulk, sir. Do it fully. Total preference dividend is 15 into 30,000, right? The total redemption value 110 into 30,000. The total in net proceeds is 100 into 30,000 minus 30,000 as a whole. Like that also you can do. Denominator also will be multiplied 30,000. 30,000 in the numerator, 30,000 in the denominator. Anyways gets cancelled. If you want, you can do it like that also. Shall we get started? Shall we get started? Yes. Come on, let's do this. Write down. KD is equal to. KP is equal to. I'm still there, stuck in debentures, is it? Okay. So KP is equal to. Yes, 15 preference dividend plus RV 110 minus 99 divided by 20, the whole divided by 110 plus 99 divided by 2. Is that clear? So now how much is this? 15 plus, now 110 minus 99 is 11. Am I right? 11 is the overall cost incurred for a period of 20 years. So how much is this going to be? 11 by 20. You get 0.55. The whole divided by 110 plus 99 by 2. How much is that? 104.5. Okay, very good. So it's 15.55 divided by 104.5. It's 14.88% roughly. Guys, correct? So just write down, it's going to be 14.88%. Is this clear for everyone? Is this clear for everyone, guys? Everybody, guys are clear with this, right? No. One second. Go to your solved question bank. Now they have done it in total. Did you notice this? Net proceeds and all, you see 100 into 30,000 total amount minus 30,000. So you get this, all these things. If you do it in total also, you get the same answer. This will not change. Numerator is multiplied with 30,000. Denominator is also multiplied with 30,000. It gets knocked off anyways. So per share basis or total basis, if you do, it doesn't make any difference. Is this clear for everyone? Any problem? Yes. Let's do the next part of the question, which is part 2. What is part 2? Part 2. Issue at premium. Issue at premium. Now everything is same. What changes is only your net proceeds. Am I right? So write down net proceeds is equal to. Now what is my premium? 10%, which means issue price minus flotation cost. So how much is my issue price? 110. Am I right? Minus flotation cost is 1 rupee. Net amount I receive is how much? Rupees 109. Is everyone able to understand? Is there any issue here? Guys, any doubt? Any doubt? Is everyone able to understand? Perfect. Now write down KD. So KP. I think I should use red ink every time we do cost of preference, it seems. Okay. KP is equal to. Write down. KP is equal to. Yes, 15 plus RV. Redemption value is always at premium in this question given. So 110 minus net proceeds 109. Am I right? Divided by how many years? 20. The whole divided by 110 plus 109 divided by 2. So it's going to be 15 plus 110 minus 109 is 1 rupee here. Yes, 1 by 20 gives you 0.05 whole divided by 110 plus 109 is 219 by 2 gives you 109.5. Am I right? That's 109.5. And 15.05 divided by 109.5 gives you 13.744 percentage. Is this clear for everyone? And that's about the second part of the question. Shall we move on to the third part? Write down part 3. What is that? Issue at discount. Now guys, in this case, what is going to be my net proceeds? Net proceeds will be at a discount means, yes, come on, issue price minus flotation cost. What is my issue price? 10% discount means 90 rupees. Will you receive 90? No. Out of this, I need to pay how much? 1 rupee of flotation cost. How did you get 1 rupee? 30,000 by 30,000. We already did. Is that clear? So effectively, I get how much? Rupees 89. Is that clear? Now, let's do this. KP is equal to preference dividend. How much is that? Everyone, guys, tell and write. 15 plus RV 110 minus NP 89 by 20, the whole by RV 110 plus NP 89 by 2. Is that clear? This should be etched in your memory. You should not forget this. Come on. So it's going to be 15 plus 110 minus 89 is 21. Huh? Correct? Huh? 21 by 20. It's 1.05. 1.05 divided by 110 plus 89 gives you 199 by 2. 99.5. So it's going to be 16.05 divided by 99.5 into 100. You get how much? 16.13. Okay, 16.13 percentage roughly. 16.1306. 1306, so 131 percentage roughly. Is that clear? 1306. So the next number is more than 5. Hence we'll round up to 131. Is that clear? Everybody, you guys are clear with this? Any issue, any problem here? No. Please go and update your library of adjustments. Write down KP hyphen cost of redeemable preference shares. Cost of redeemable preference shares within bracket formula method or whatever the shortcut method hyphen par premium discount. Within bracket formula method hyphen par premium discount. Within bracket par premium discount. So KP hyphen cost of preference shares, cost of redeemable preference shares within bracket formula method hyphen par premium discount. Are we done? Okay. Now guys, let's move on to the next source of finance called as equity share capital. So now we are going to move on to the next segment called as cost of equity share capital, popularly called as KE. K stands for cost, E stands for equity. Now guys, understand there is one thing which is very, very unique about equity share capital as a source of finance. What is this? There is no contractual obligation on the part of the company to pay any dividend. Is that clear, guys? Right? Hence, under this particular source of finance, right, in order to calculate KE, there are many methods. There is no single method. There are so many methods. Before that, first of all, let us understand one thing. Is there a concept of redemption when it comes to equity shares? No. Can you say redeemable equity shares? If you call it redeemable, then it is not equity share only. It is actually not repayable at all. Don't say, sir, it is repayable. That is repayable at the time when the company is wound up, when the company is shutting down its operation. You receive, the company need not pay it at all, repay it at all. Is that clear? Then why are investors buying it? I told you there is a ready secondary market where they can sell and exit at any given point of time. Is that clear, guys? Right? So first of all, understand this is the most unique nature of equity share capital. Two unique features. What are they? Number one, there is no contractual obligation on the part of company to pay any dividend. They may or they may not pay any dividend. That is number one. Number two, there is no concept of redemption when it comes to equity shares. It is always perpetual, irredeemable only. Is this clear for everyone? Is this clear for anyone? Because of these two unique features of equity shares, there are more than one methods to calculate the cost of equity. Are you all able to understand? So just like any other source of finance, cost of equity is nothing but the expectation of equity shareholders. Please be very clear. We are not talking about the actual amount paid. We are talking about futuristic. So what is going to be my cost of equity? So the cost of equity is nothing but the expectation of equity shareholders. Is that clear, guys? Please have this very clearly. Please have this very clearly. KE computation is quite complex since there is no fixed contractual obligation for equity shareholders. Moreover, there is no concept of redemption. Because of these two features I've clearly mentioned in the concept decoder itself. Because of these two features, please underline. Please underline. What are the two features? No fixed contractual obligation, no concept of redemption. Because of these two features, now the calculating cost of equity, there are multiple methods. There is no single method to calculate KE, but different methods are there. Is that clear, guys? Now, what are the different methods to compute the cost of equity? One is called as dividend price model, dividend price approach, or the other one is called earnings price model. Then you have something called as growth model, popularly called as Gordon's model, right? Then you have realized yield approach, right? Realized yield means yield. Yield means IRR generally. Is that clear? IRR model. Then you have a very popular model called as CAPM, capital asset pricing model. Now this is there at the intermediate level. At the intermediate level, it's very easy. They will give you all the ingredients of the formula and they will do it. At the final level, it's more advanced. Whatever you learn here is going to be the stepping stone for your final. Why this entire chapter is there in your final in a completely different manner. We will be seeing in AFM in a completely different manner, right? That's going to be real stock market related areas. We'll be seeing it integrated with whatever we are learning at the intermediate level. So literally we are laying the foundation stone here. If you are really strong with this at the final level, it's going to be a breeze, a cakewalk for you. Is that clear, guys? Right? Now, CAPM is another method. Now, the first doubt which many students have, sir, which method I need to follow? Now, guys, you need to follow the method based on the wordings of the question. The question will give you certain words. Based on the wordings of the question, you need to identify what is the expectation of the examiner, which method they are asking you to follow. Is that clear? Is everyone able to understand? So for this, you should know when to use which method. The background logic is important. Is that clear, guys? Right? Number one. Number two, sir, whether I use dividend price approach or earning price approach or Gordon's model, realized yield, CAPM, sir, in all the methods will I get the same answer? The answer is absolutely no. Every model will give you a different answer. Then which is correct, sir? It is not like that. Based on the assumptions a particular model is developed, so that particular model is correct for the assumption it takes. Is that clear, guys? So every model will give you a different solution only, different answer only. Now, every model, when we are learning, we will understand the assumptions of a model and then we will see why the formula has come. Is that clear, guys? No need to mug up anything. Is that clear? So when to use which model depends on the framing of the question, the wordings of the question. Is that clear? And each and every approach will give you a different answer. That particular approach has certain assumptions. For the assumptions, the answer is correct. Is this clear, guys? Is everyone able to understand? Right. Now, shall we just go and start the first model? What is that, guys? First model, dividend price approach. But before that, I just want to quickly recapitulate that income statement format here. So we are in what? Cost of equity, KE. Now, guys, can you all tell me that format of income statement, EBIT, something we see, no? Yes, come on, tell me. EBIT minus interest gives you earnings before tax. Am I right? Yes. From this, subtract tax gives you earnings after tax. Now, after this, what will I do? Preference dividend I will pay. Now, you get what? Earnings available to equity shareholders. Earnings for equity shareholders. Short form, I call it as EFE, classroom discussion. It's basically earnings available for equity shareholders. Classroom, I'm telling EFE. EFE means what? This entire amount belongs to whom? Equity shareholders. Now, out of this, if the company wants, they can pay equity dividend. Now, whatever is the balance, it's what? Retained earnings. So can I say, guys, ideally, this amount itself belongs to whom? Equity shareholders. Right? Out of this amount is paid today. The balance, retained earnings, what will the company do? They'll reinvest it into the business and make sure the company grows. In future, if it grows, once again, it belongs to equity shareholders only. Is that clear, guys? So only if it is paid to the shareholders, only if it is paid, it doesn't mean that, they're receiving it. They enjoy this in a different way. If the company grows by way of share price, it will grow in the secondary market. That way also they can earn. Is that clear, guys? Are you all able to understand? Hence, shareholders themselves, every time they don't expect the company to pay dividend. At times the company is not paying dividends also. They are fine as long as the company is managing the funds well. Right? We will be learning this in the dividend decisions chapter. Right? I told you, there's a chapter called dividend decisions. It's one of the objective also, name of the chapter also. Right? That will be saying when to pay dividend, what is the optimum dividend to be paid, and all. We will be seeing it there. Is that clear? But understand, this EFE means what? Earnings available for equity shareholders itself is the earnings available for them. Out of this, today I pay so much. The balance, what I do, I keep it as reserves. I plow it back. Means what? I reinvest it into the business. My business grows. Obviously, the share price will also grow. Overall objective is wealth maximization gets achieved. Is that clear, guys? Is everyone able to understand? Now, example, I'll give you some figures. Let us say EBIT was 100 crores. Okay. Let us say interest was 10 crores, which means how much the EBT? 90 crores. Right? Let us say, guys, example, I'm telling you. Let us say tax was 20 crores, which means EAT is how much? 70. Out of this, I paid a preference dividend of 30 crores, which means earnings available for equity shareholders is how much? 40 crores. Is that clear, guys? Is that clear? Now, out of this, let us say the company paid an equity dividend of 10 crores, which means how much the retained earnings? 30 crores. Is this clear? Is everyone able to understand? Is everyone able to understand? Any issues here? Any problem here? Guys, clear with this? So all these are in crores. Am I right? Now, or in other words, can I say, now let us say the company has a total of 10 crore equity shares, not capital, 10 crores equity shares, right? Now, can I say the earnings per share? What is it? Earnings per share, popularly called as EPS, is going to be how much? What is the earnings available to the equity shareholders? 40 crores. Can I say it is going to be earnings available for equity shareholders divided by number of equity shares? Can I say this like this? So which means for me a total of 40 crores is available for how many shares? 10 crore shares, which means the earnings available per share is going to be how much? Rupees 4, not crores, rupees 4. 40 crores is the earning available for 10 crore shares. Per share, what is the earning available? 4 rupees. Is that clear, guys? Are you all able to understand? Now, can you tell me what is the dividend per share? DPS. Simple. It is going to be the total dividend paid divided by number of equity shares. Guys, correct? How much the total dividend paid? 10 crores. So I paid 10 crore rupees for how many shares? 10 crore share, which means per share I paid a dividend of 1 rupee. Is everyone able to understand this, guys? Or in other words, can I say, guys, how much was the EPS, earnings per share? Every share earned how much? 4 rupees. Now, this entire 4 rupees, did the company pay? No, I will say it is broadly classified into 2. What? DPS. Out of this 4, the company paid only 1 rupee. Am I right, guys? The balance was what? Retained earnings per share. Am I right? What is the retained earnings per share? The balance was 3 rupees. Or you can say it is 30 crores divided by 10 crore shares. Is that clear? 3 rupees. Are you all able to understand? Is everyone able to understand this? Guys, is that clear? So how do you compute EPS? Earnings available for equity share. What belongs to me? Divided by number of shares. Is that clear? DPS means dividend per share. Total dividend divided by number of equity shares. Right? And the balance is retained earnings. Or I can say out of the total earnings per share, the dividend per share was 1 rupee. The balance 3 rupee was retained earnings per share. Is this clear for everyone? Is this clear for everyone? Which means earnings per share is a broad figure. Out of EPS only, DPS comes. Out of earnings only, dividend is paid. Is that clear? You tell me, out of this, which amount belongs to equity shareholders? The entire amount. Today, it is paid by way of cash. This amount is reinvested into the business that also belongs only to the equity shareholders. Do you have the clarity? Do you have the clarity? This is what is unique about the concept of equity shares. Is everyone able to understand? Now, with this background, let's get started with the different methods. The first method called as What is it? Dividend price model, right? Now, dividend price approach or dividend price model. Now, guys, dividend price model. When will I use dividend price model? Now, please underline this. You should know, guys, the assumptions of model is required for what? Only then you will understand. Based on the wordings of the question, you will pick the right method. Am I right, guys? Now look at this. This is also known as dividend valuation model. This model makes an assumption that the dividend per share is expected to remain constant forever. Is that clear? Now, what is the assumption? If you are expecting the dividend to remain constant forever, guys, correct? In this case, you will use what method? Dividend price method or dividend price approach. Is that clear, guys? Now, in this case, cost of equity is what? Dividend divided by the net proceeds today, guys. Correct? P0 they have mentioned, or you can even say net proceeds. Is that clear? P0 is basically what? The market value of equity today, right? The price as on today. Are you all able to understand? Right? That is nothing but what? Your net proceeds. Is that clear, guys? Are you all able to understand? Sir, what is the logic for this formula? Now, we all know this, similar to what we have seen in irredeemable debentures, irredeemable preference share model. What is this? The price as on today. The value, the present value of equity share is what? Now, in case of equity share where I am expecting the dividend to be constant, so it is equal cash flows up to perpetuity. What is the present value of equal cash flows to perpetuity? Annual cash flow divided by discount rate. Am I right? What is the annual cash flow? Dividend divided by what is the discount rate? I call it as KE. Now cross multiply this. So what happens? KE is equal to D divided by P0. When I say P0, I refer to what? Net proceeds. Is this clear, guys? Is everyone able to understand? Is there any issue here? Is there any issue here? Do you have any problem in understanding this? This is called as what? Dividend price approach. Is that clear? So basically, what do? I discount what? Dividend. I discount dividend at what rate? KE rate, and arrive at the present value. Or if you cross multiply, KE is equal to simple what I pay divided by what I receive. Like this you can understand. It's nothing but dividend divided by your P0 or net proceeds, as the case may be. Do you have any issue here? Is everyone able to understand? When I say net proceeds, what is this? Issue price minus flotation cost. Is this clear, guys? Is everyone able to understand? Perfect. Now, the first model is called as dividend price model. When will you use it? When you are expecting your dividend to be constant up to perpetuity, and I'm using dividend as the base for arriving at the value of equity shares. Is that clear? Is everyone able to understand, guys? Reciprocate. Yes. Next. Second, earnings price model. What is it? Now, just now we saw. Guys, look at the screen. Now, 4 rupees is the EPS, earnings per share. Right? Out of this, dividend is paid 1 rupee. Balance retained earnings 3 rupees. Correct? Now, you tell me, ideally, the entire amount of 4 belongs to equity shareholders. But dividend price model takes into account only what? The dividend, discounts the dividend using what? The rate, which is KE, and then arrives at the value of equity share. Guys, correct? Because they are dealing in cash flows. What is the amount that is getting paid to the investor is only 1 rupee, the dividend. Is that clear? So, dividend price model uses only the dividend to value the equity share. Cross multiply, you get KE value. Is that clear? Now, there is another model which says everything is same. The assumptions are same as dividend price model. Basically, what is that? Now, earnings is expected to remain constant throughout. But what I'm saying is, look, this is not the only amount that belongs to equity shareholders. This is also the amount that belongs to them. Or in other words, what belongs to equity shareholders is the entire earnings, 4 rupees. Hence, don't only consider dividend. Consider the entire amount that belongs to them. This is called as earnings price model. In this case, what is going to be the formula? Earnings per share, EPS, divided by what? P0. That is nothing but net proceeds. Are you all able to understand the same logic? The present value of equity share. How will you arrive at it? Annual cash flow, which is earnings divided by discount rate. What is it? KE. Cross multiply, you will get KE is equal to E divided by P0. Is everyone able to understand this? Is there any issue here? The first model considers only dividend. The second model considers earnings. Both the models assume that the dividend or the earnings is going to be constant throughout the life of the company. Only if it is constant, you can use this particular method. So what if it is not constant? It means this method can't be used. As simple as that. Is this clear, guys? Is everyone able to understand? Any issues, any problem here? Any issues, any problem here? When the dividend is constant for the entire perpetual life of the company, then you use a dividend price model. If the earnings is expected to remain constant and the company is expecting to do what? Is expecting to discount using what? Earnings instead of dividend. In that case, you will use the earnings price model. Is that clear, guys? Is that clear? Is everyone able to understand? Perfect. Now, the next one is called as growth approach, also known as a Gordon's model. Now, what is Gordon's model? Growth approach, simple. Now, in this case, what I'm assuming is, look at this, as per this approach, the rate of dividend growth remains constant, which means what? Every year, the amount of dividend is going to grow at a constant rate. Guys, we have seen this, right? Up to perpetuity, it is a sum of growing cash flows up to perpetuity. Are you all able to understand? Now, when the earnings, dividends, and the equity share price all grow at the same rate, the cost of equity may be computed as follows. What is the formula? D1 divided by P0 plus G. KE is equal to what? D1 by P0 plus G. Sir, how did they arrive at this particular formula? Very simple. Very simple. Now, you guys tell me, when my cash flows are growing up to perpetuity, now what is going to be the present value? That is, in this case, P0, present value of the share. How will you arrive? Recall, I told you. Cash flow at the end of year 1. Can I call it as cash flow? Here is D1, right? Yes. Divided by discount rate. In this case, I call it as K minus growth rate. I call it as G. How would we arrive at it? Now, recall, time value of money, sum of growing cash flow series. Excellent, guys. Very good. You recalled it. Correct? Yes, perfect. Now, in this case, in this scenario, I want to calculate what? K. How will I do that? Simple. First, cross multiply. P0 into KE minus G is equal to D1, or I can say KE minus G is equal to, so this alone goes down, it becomes what? D1 divided by P0, or KE is equal to, this goes to the other side, I can say KE is equal to D1 by P0 plus G. As simple as that. That's about it, guys. Now you tell me, is there anything here? Now you understood why we sharpened the axe. Right? If you skip the time value of money, you cannot understand anything here. The entire subject, I told you, it is like oxygen. You can't see it, but its presence can be felt throughout. This is what it is. Are you all able to understand? That's why this derivation I did there. Suppose here, if I talk about geometric progression and all, now this chapter itself has its own complexity, then you will be mixing and doing one khichdi only here. Right? There is absolutely no sense in doing it. That's why we are learning it in a very graded manner. Are you all able to understand? Is there any issue here? Right? So when I expect my dividends to grow at a constant rate, what is the formula? I use Gordon's formula only, reverse work and arrive. KE is equal to D1 by P0 plus G, where D1 stands for dividend receivable at the end of the first year, right? Divided by P0, net proceeds. Is that clear? That is nothing but issue price minus flotation cost plus G, growth rate. Is this clear? Is everybody able to understand? Is everyone able to understand? Guys, any issues here? No. That's called as what? The Gordon's model. Now, simple, guys. Once again, here also, instead of D, the company can also, discount. Instead of discounting dividend, they can also discount growth. I mean, they can also discount earnings. Guys, correct? In that case, it will be E1 by P0 plus G. That's about it. Is that clear, guys? Instead of considering the dividend, if I consider earnings for the purpose of valuing my equity share, I call it as what? I call it as earnings price model. This is called dividend price model. I mean, this is called as dividend growth model. That will be called as earnings growth model. Is that clear, guys? So instead of dividend, you can also use what? Growth. Is that clear? So the first two methods were what? Assume that dividend is constant. Assume that earning is constant. And the third method as what? Assume the dividend is growing at a constant rate or earnings is growing at a constant rate, called as Gordon's model, also known as growth model. Is that clear, guys? If you are discounting a dividend, it's called as dividend growth model. If you are discounting what? Your earnings, it's called as earnings growth model. Are you clear with this? Is everybody able to understand? Are you guys clear with this? Right? Now, guys, suppose D1 means what? The next year, year 1. Right, dividend. Suppose in the question they have given last year dividend was so much. How will you arrive at D1? Simple. Let us say past year dividend was 10 rupees and they expect the dividend to grow at the rate of 5%. The next year's dividend will be how much? That is D1 will be 10 plus 5% of 10, or in other words, I can say 10 into 1 plus 0.05. Am I right, guys? Correct? Is everyone able to understand? Right? How much is this going to be? 10.05. Am I right, guys? It's going to be what? 10.05. Correct? Is everyone able to understand? Yes, it's going to be 10.5. It's going to be 10.5, not 0.5. It's 10.5. Right? So the next year dividend D1 is going to be equal to what? 10.5 rupees. Is that clear, guys? Or in other words, can I say D1 is equal to D0 means the current dividend today into 1 plus D. You get the next year expected dividend. Are you guys clear with this? P0 means what? Basically the net proceeds per share. Guys, correct? Or current market price, they have given net proceeds. G is a constant growth rate. Is that clear, guys? Now, always understand one thing. Guys, always understand one thing. Now, there is one thing that I want to tell you all. Now, if the company is going for a fresh issue, only then flotation cost will come into picture. Am I right, guys? Correct? In that case, P0 is what? Issue price minus flotation cost. Correct? Suppose we are just talking about existing equity shares are issued in the past, sir. Now, in that case, no, the past price is irrelevant. We take the current market price, but you tell me in this case, am I issuing anything? No. In this case, will I incur any flotation cost? No. So, if you are computing KE for an existing equity share, you just take the current market price. Flotation cost anyways is not incurred. Is that clear? I need not incur this. Are you all able to understand? Is this clear for everyone? So, for existing equity shares also, past data is not relevant. We take only the current market price because in future, based on this only, we are going to expecting this is going to be the cost. Is that clear? But anyway, since it is already issued, I don't have any flotation cost. Now I need to incur? No. Are you all able to understand? Hence, for existing equity shares, do not adjust what? Your flotation cost. For new equity shares, yes, it should be adjusted. Why? I'm going to incur. It affects my net proceeds. Are you all able to understand? Is there any issue here? The same logic should be applied even for KD, KP also. Existing preference, don't adjust flotation cost. Existing debentures, don't accept flotation cost. Is that clear, guys? This is exactly what I've mentioned here. Put a highlight symbol, extremely important. In case of newly issued equity shares where flotation cost is incurred, the cost of equity shares with an estimation of constant dividend is calculated as follow. So subtract your flotation cost. In case of existing equity shares, don't adjust flotation cost. So whether it is existing equity shares or preference shares or debentures, flotation cost should not be adjusted. Is this clear for everyone? Have the clarity and move around. Are you guys able to understand? Any issues, any problem here? No. Now guys, what is the formula for KE in dividend growth model? D1 by P0 plus G. Is that clear? D1 by P0 plus D. Derivation, it's nothing but we saw P0 is equal to D1 by KE minus D. With that we arrived. Is that clear, guys? Right? Initially, arriving this figure on the spot might be a little difficult, but by practice automatically, I am telling you, you will only remember this, that you will forget, right? Because this will be so frequently used. Is that clear, guys? Is that clear? Is everyone able to understand? Now, D1 means what? Dividend payable at the end of first year, correct? Now, I have put this in doubt busters. Many students have this doubt. Now, for some reason, I don't know why Institute has to, stop this contradiction. Now, what has happened? Confusion between D1 and D0. Sir, how do I know whether in the question the dividend given is D1 or D0? D0 means current dividend. D1 means payable at the end of first year. For our calculation, we should take D1 or D0? D1. If the word dividend expected is given, what will you take it as? Expected means payable at the end of year 1 only. You take this as D1. If the word dividend paid is given, you take it as D0. If the question just says dividend, then sir, what will I do, sir? You can either take it as D1 or you can take it as D0, but please write a note in this regard, because based on your note, your answer will be different. Guys, look at this. I am creating the doubt and clarifying it here itself, right? Because this will be a doubt I know you will have. Now, let me tell you one step above. I have seen even some suggested answers or even some RTP questions where they have given dividend paid. They have given is, let us say, 10 rupees. In the answer, they have considered this itself as D1. Why? Sir, paid is given. No, sir. Students are fighting with me as if I created this, issue in the exam. Guys, I am telling you, this is a mistake. Institute cannot do it like this. Guys, correct? Hence, my suggestion will be, whenever dividend comes, write a note. Sir, dividend paid is there, write a note. When dividend paid is there, you will say, since the word dividend paid is given, it should be considered as D0. Always write a note. For your note, your answer is correct. Is that clear? I get a lot of messages on Telegram from students. Sir, in this question, they have done it like this. Yes, ma, it's a mistake. Right? Please understand. If the word dividend paid is given, it's D0. If the word dividend expected is given, it is D1. Even if in the institute suggested answer they have taken otherwise, it is a mistake. Then, sir, if exam they take it like this, remember one thing. While correcting your answer sheet, institute will not have suggested answer. They have something called as marking scheme. That marking scheme generally will be prepared extremely careful. They are extremely careful while preparing the marking scheme. Suggested answer is for publication. No, in the examiner's hand, they will prepare marking scheme. You guys have not seen marking scheme. Marking scheme, you know how it will be. For one solution, the answer will be so elaborate. They will give it in such a manner. For this step, you should give quarter mark. Like that, marking scheme will be there. Stepwise marking will be given. Quarter mark and all, no. So stepwise they will give total up. When they are totaling, they will round off. Is that clear? This is how they do. So stepwise, if the student has missed one step, that step actually carries more weightage, means it will go off for you if you have not written it. Now, when they are preparing to this level, it will generally be extremely careful. Do not worry. Now, in the solution, when the marking scheme, they would have clearly mentioned if there is a scope for assumption, they will clearly mention an alternative answer is possible. The student should be awarded marks in case he has done this. For this alternative answer, this will be the answer. Once again, the steps will start. Is that clear? So you will get marks for your note, but for that you should write a note. Is that clear, guys? Are you all clear with this? I am creating the doubt and clarifying it here. Please, guys, online folks, please make a note of this. Are you all able to understand? Whenever the word dividend comes, dividend paid means D0, dividend expected means D1. If the question is silent, you take anything, but irrespective of whatever it is, write a note. Is that clear? Right? Now, growth rate we will see later on. Right? This also we will see later on. Nothing to worry. Now, shall we just do a couple of sums in this regard? Now, first of all, understand till now what we have done. Now, dividend in KE calculation. 3 methods we have done. The first method is called dividend price model. So we take the dividend as the base of discounting, assume that it remains constant. What is the formula? D divided by P0. Remember, D0, D1, D2, D5, D100, everything is same because dividend is constant there. Is that clear? Right? So it is what? D divided by P0. What I pay by what I receive. Is that clear? Next, earnings price model. E divided by P0. Right? Whether say E0, E1, E2, everything is same because we follow this method only when dividend or earning is constant. Next, growth Gordon's model. Under that, dividend growth model, earnings growth model. Dividend growth model formula E1 by P0 plus G, or earnings growth model E1 by P0 plus G. Is that clear? So, or in other words, can I say when it is constant, you can either use a dividend price model or earnings price model. In case of growth, you can either use a dividend growth model or earnings growth model. Is that clear? Like this we can remember. So constant and your growth. Is that clear? We can keep it like this. Both can be done either under dividend or earnings. Is that clear? Now, sir, when the dividend data is also available, earnings data is also available, then, sir, which method should I follow? Both data are available now. Should I follow dividend method or earnings method under constant growth, as the case may be? Generally understand dividend is preferred over earnings. Why? That involves actual cash flow. Am I right, guys? Our subject deals with what? Cash flow. Hence, generally, dividend is preferred over earnings for all calculation purpose when both are given. I'm literally creating the doubt and telling you, write it down somewhere. Write it down somewhere. Is that clear, guys? When both the data, EPS and DPS data is available, generally, DPS is preferred over EPS for calculation purposes. On this note, let's get started with question number 5. Let's get started with question number 5, shall we? Yes, guys, come on, let's do this. Now, question number 5. Now, a company has paid a dividend of 1 rupee per share of how much face value? 10 rupees face value last year, and it is expected to grow at the rate of 10% every year. Now, clearly understand, the company has paid a dividend of 1 rupee, right? Face value 10. Last year, this was paid last year, clearly given, which means this is D, guys, come on, answer. D0, right? And it is expected to grow at the rate of 10%, which means you need to use what method? Dividend growth, Gordon's model. So 10% means it's going to be the growth rate. calculate the cost of equity if the market price per share is going to be 55. What is this 55? P0. Are you clear with this? So let's write down question number. Write down question number 5. Question number 5. Please write down. So what model we are going to use? Dividend growth model. Is that clear? Dividend growth model, also known as what? Gordon's model. Gordon's model. Remember, Gordon's model can be applied on dividend or on earnings, but generally we use it on dividend. Similarly, your dividend price or earnings price, generally we prefer dividend price model. Dividend involves cash flow. So we deal with cash flows in our subject. Is that clear? Right. Next one. Write down formula. Everyone tell and write. KE is equal to P1 by P0 plus G. Derivation, you guys know it. Is that clear? No, wait. Don't fill it up. Write down. D1 is equal to, can I say, D0 into 1 plus G. Guys, correct? Now, what is D0? Everybody. Rupees 1 into 1 plus, what is my growth rate, guys? 10%, which means 0.10. So 1 into 1.1 gives you 1.10 rupees. Is that clear? Guys, correct? So now, write down. KE is equal to rupees 1.10 divided by, what is P0? It's given in the question, 55 plus, what is my growth rate? 10%. Guys, correct? It's going to be 0.10. So how much is this? 1.1 divided by 55 is going to be 0.02. Yes. So it's going to be 0.02 plus 0.10. That's how much? 0.12 or 12% is going to be my cost of equity. Is this clear, guys? Is this clear? Which means, now what does it mean? It means, is going by this dividend growth model, I'm saying, now my equity shareholders are expecting 12% of return from me. Is that clear? Which means going forward, if I need to raise money from this source, I need to incur what is the cost of equity? 12%. Is that clear, guys? Is that clear? We are using this for decision making purposes. Are you all able to understand? Is there any issue here? No. Just go and update your library of adjustments. Write down KE hyphen dividend growth model. Write down KE hyphen dividend growth model. KE hyphen dividend growth model. Is everyone clear with this? Guys, please answer back. Is everyone able to understand? Okay. Now, with this we have finished 3 models. Am I right? Dividend price, earning price, and then we've also finished growth, Gordon's model. Now, let's move on to the next one called as realized yield approach. Now, what is this realized yield approach? Now guys, understand this very, very clearly. Now, when will a company use this particular model? This model is generally used when the company is not able to predict the future. Guys, clear with this? Now, when the company is not able to predict the future, that is, sir, I don't know whether my dividends will be constant or it will be growing. We do not know what to do. Now, in this case, sir, what can be done? Wait. Now, guys, please look at me. Now, recall I told you earlier, return from the perspective of an investor is equal to the cost from the perspective of company. Guys, correct? Now, this model follows that approach. It says, no problem. Let me do the calculation from the perspective of the investor, and his IRR is going to be your cost. Is that clear? Which means in this case, I will be calculating IRR for a finite life. Sir, how's a finite life? That guy has a ready secondary market for exiting. Guys, are you all able to understand? Hence, I know this comes with a finite life. Are you all able to understand? Are you all able to understand? Hence, I can arrive at his every year cash flow. For him, there will be an initial outflow followed by a series of inflow. Right? Now, what we will do, frame the cash flow equation. The rate that equates my present value of outflow or inflow with outflow, as the case may be, is going to be called as IRR. Or in other words, the rate that makes my NPV 0 is going to be called as IRR. Now, this is a return from the perspective of investor. I should take it as a cost from the perspective of company. Is this clear? So, some students, without knowing this, what they do, Suddenly, sir, they have given Mr. A is an investor doing all these things. Sir, is this chapter computed from the perspective of the investor or from the perspective of company? They have this doubt. Look, this chapter is calculated from the perspective of company. If the company is unable to predict its future, in this case, they go to this method called realized yield method based on the principle that return from the perspective of the investor is equal to the cost from the perspective of company. Is that clear, guys? Are you all able to understand? Any issues, any problem here? No. Now, directly let's jump to the next question, number 6, and see how this needs to be done. Shall we get started? Now, let's get started, guys. Let's do this. Now, Mr. Mehta had purchased a share of Alpha Limited for how much? Rupees 1000, which means 1000 rupees is his outflow. Am I right? Now, he received dividends for a period of how many years? 5 years at the rate of how much, guys? 10%, which means 10% is what? Not interest rate, dividend rate. Yes, 10% dividend. He is receiving equal amount of dividend for how many years? 5 years. At the end of 5th year, he sold the shares of Alpha Limited for how much? 1128. Sir, how did he sell? Secondary market. Now you understood why I gave this concept of secondary market in the introduction. Are you all able to understand? This was actually a past exam question. Now, without knowing this basics, this is the reason I'm telling you the entire subjects is interlinked. Now, students on the online, please watch it in the same sequence. I will keep linking it here and there. That's why I framed the subject in a certain way. Is that clear, guys? Now, you are required to compute the cost of equity as per what? Realized yield approach. Realized yield or yield to maturity or IRR approach. These are all one and the same. Is that clear? Now, shall we get started, guys? Shall we get started? Which means I have an outflow followed by a series of inflow. How much is the inflow every year? 10% on 1000, 100, 100, 100, 100, 5 years. At the end of 5th year, one more inflow, sale value. Are you all able to understand? The rate that equates my present value of inflow with present value of outflow, or in other words, the rate that makes my NPV equal to 0 is called as IRR. In this case, it is called as a rate, which is K. Is that clear? Which means take one trial, positive NPV, another trial, negative NPV, and interpolation arrive at the exact IRR value. In this case, IRR is a return from the perspective of investor, cost from the perspective of cost from the perspective of company, cost of what? Equity share capital. Hence, it's called as KE. Are you all able to understand the logic and the structuring? Let's get started. Question number 6. Now, sir, how do you get the trials? I have already cleared this doubt earlier. What is that? Generally, in exam, they will give you what? They will give you the table. Based on that, you can identify. If not, start from 15%, 15% increase or decrease, so 20 or 10 as the case may be. Clear? Are you all clear with this? Shall we get started? Yes. Let's get started here. Let's get started here. Write down. Write down, guys. It's going to be first write down year, then write down cash flow, then write down. Now, 1 second. Now, there is there is a way to do this. Now, what you can do is, ideally, there's a cash flow here, guys. Ideally, what you can do is, here itself, NPV calculation, little easier. I mean, your IRR calculation, little easier you can do. What you can do, one trial you can take. Let us say present value interest factor. Example, I'm telling you, if you want to take 10%, you can take it here. You will get present value cash flows for 10%. Another thing, present value interest factor of example, I'm saying 12% or 15%, right? Present value cash flow, you'll get here itself. Guys, are you all able to understand? You can multiply this. So here, you get one NPV, a positive or negative figure. You get another positive or negative figure, as the case may be. And based on this, you can do interpolation. You need not waste your time 2 times. So here, directly the cash flows are given. The same with the 2 different factors, you will arrive at the present value cash flows. Is that clear? This way, you can frame your solution. Is that clear, guys? Now, but in this question, it is pretty much simple. I will tell you why. Write down present value interest factor at the rate of, take 12% discount factor, and just write down present value cash flows. Just write down present value cash flows. Come on, guys, tell me year. No, you should start with 0, because today I am investing how much? I am purchasing the shares at how much? 1000. It starts with year 0. Am I right? Write down. Year 0, then 1, 2, 3, 4, and 5. Am I right, guys? Yes. Now, write down. So, year 0, how much is it going to be? Cash flow. Guys, come on. Negative 1000. Year 1, cash flow. 10% dividend. How much is that? 100. Year 2, 100. Year 3, 100. Year 4, 100. Year 5, I receive 100 plus sale value 1128. How much is that? 1228. Is that clear, guys? Frame the cash flows properly. Now, present value interest factor. How much is that? First, 1 by 1.12, am I right? Is equal to how much is it? 0.893. Then is equal to 0.797 is equal to 0.712. Then 0.636. Then 0.567. Guys, correct? Then 0.506 or 7. I expected this. Now, you would have started from this. So, this has to be 1. Why? This is already in present value. Now, from now on, 1 by 1.12 is equal to, you need to do here. Is that clear, guys? Are you all able to understand? When you are starting with 0, be extremely careful. The present value interest factor is 1. Why? Because it's already in present value only. Is that clear? So, write down the other things. It's 0.893. Am I right? 0.797. Then 0.712. Then 0.636. Then 0.567. Is that clear? Now, pray God that overall, when you are doing it, it should be equal to what? 0. Guys, this is NPV calculation, no? Correct? This is outflow. This is inflow. Arrived in present value. Guys, correct? So, first line item within bracket 1000. Second line item 100 into 0.893 gives you 89.3, 79.7, 71.2, 63.6. Then 1228 into 0.567 gives you 696.276. 276. Add up everything. How much you get? Go on, add up. How's it now? So what has happened? 696.27. 89.3 plus 79.7 plus 71.2 plus 63.6 plus 692.276. You get how much? I think 696, I think. Okay. 1000.076 minus 1000. So roughly you get what? 0. So what has happened? God has answered to our prayers, is it? Okay, right? So now guys, exactly since this is 0, so can I say my KE is what? Equal to 12%. Guys, are you all able to understand this? Are you all able to understand? Is there any issues here? Guys, this is a smart way of doing this IRR. Now, smart, I'm not talking about taking exactly 12%. Right? That was pure luck, right? Not luck. So I know that sense, hence I did it. But guys, I'm telling you in exam what you can do. You can prepare this template. You got my idea? Here, cash flow. First trial, you take the discount rate and present value cash flow. Second trial, discount rate, cash flow. Now here you get one positive figure, here you get one negative figure. Down what you need to do, just interpolation, arrive at the answer. That's all. IRR, don't take much time. This way you do it, it's easier for you with all your calculation tricks and all. Quickly you do it. Is that clear, guys? In exam, now make sure that you are actually spending less time and scoring maximum marks. Exam situation is a high pressure, high tension situation. Is that clear? Don't waste your time. So write down here. Since at discount rate of 12%, NPV is equal to 0, KE is equal to 12%. Is this clear, guys? Is this clear? Is everyone able to understand? Is there any issue here? This is called as what method? Yield to maturity method or yield method. Is that clear, guys? This is called as what method? Realized yield method. Is that clear? Realized yield means what? This investor has realized this yield, so his yield is going to be my cost. His return is going to be my cost. This method is based on that principle. Is everyone able to understand? Now, clearly, if a particular question now gives the data that is from the investor's perspective, you know you need to use what method? Realized yield. Will you ask which method should I use? You obviously know in this case you need to use what? Realized yield method. Is that clear? That's why I'm telling you, once you open up to the subject, you will be able to figure things out. Are we done here? Yes. That's about this question number 6. Please go and update your library adjustments. Write down KE hyphen realized yield method. KE hyphen realized yield method. KE hyphen hyphen realized yield method. Are we done? Are we done here? Fine. Now let's move on to the last method under your KE, which is called as CAPM model, capital asset pricing model. Mark this as important. Ideally, this is a part of your CA final at the intermediate level. It's very much simple because you need to know the formula, and every other answer, every other component of the formula they will give you is just a plug and play. Shall we get started? Yes, let's do this. Now, CAPM model under this, KE is equal to RF plus beta times RM minus RF. What is it? RF plus beta times RM minus RF. Beta, you guys know, alpha, beta, gamma. You guys know this, some statistical expressions. You guys are aware of that. I don't want you to know what beta means. I'm just telling you, you guys have seen this symbol, no, beta? Okay. Says RF plus beta times RM minus RF, where KE stands for what? Cost of equity. RF stands for risk-free rate of return. Beta stands for beta coefficient. RM stands for rate of return on market portfolio, right? Means market rate of return. Is that clear? Now, sir, what is all these things? What is all these things? Quickly, I will just explain. Here. Catch up running notes. Guys, you can't find this explanation in your study material and all. Please catch up running notes. My commitment, zero mugging up. It's just 2 minutes and we are done with this area. Now, what is this? RF means what I told you. Risk-free rate of return. Right? Risk-free rate of return. And RM means your market rate of return. Beta means beta coefficient. Now, you guys tell me. Now, if I go and park my funds in an FD, right? Let us say I will get 10% return. They will pay 10% interest, 10% return. You guys tell me, is this return risk-free or it is with risk? FD. Risk-free or with risk? Risk-free or with risk? Risk-free, no risk. Are you guys able to understand? There's no risk here. Guaranteed, no? Guys, clear? Now, if I am going to the markets, and if I want to invest my money in share market, now you guys tell me, will I be having a risk or not? Guys, will I be having a risk? Yes. Now, you guys tell me, if I am taking risk, I will expect more return. Am I right, guys? Guys, everybody, if I'm taking risk, will I expect the same return? No, more risk, more return. Correct? That is the concept we follow universally. Am I right, guys? Now, here, look at this. Let us say I'm going to the market. In market, I have so many shares. Correct? So many companies are being listed. ITC, HUL. I have so many companies like Tata Motors, Tata Elxsi. You have so many companies, guys. Yes. Now, each company, will it have the same risk or different risk? Every company will have its own risk. A particular company or stocks or shares risk is expressed by way of beta. So what does beta signify? It signifies the risk of a particular company. Is that clear, guys? Is that clear? Is everyone able to understand? Now, in this context, let me just give you a numerical figure. Now, RF, which is nothing but risk-free rate of return, let us say, is how much? 10%. RF is how much? 10%. Now, generally, if I go to the market, right, in share market, on an average, let us say the market's rate of return. When I say market, it means general market. You guys have heard of the word Sensex, Nifty. These are basically stock indices. In final, we'll be learning more of that. Index, they call it as an index that represents a market. Markets are generally, how is it functioning? Means there's so many stocks here. Which stock are you referring to? As a representative, I'm talking about Sensex or Nifty or Bank Nifty, or as the case may be. It's an index, a representative. It's a representative of the market. Is that clear? Generally, the market, if I go to the market, it provides me a return of, let us say, 15%. Is that clear, guys? Now, how much extra does the market give me? Guys, everyone tell me, how much extra the market gives me? RM minus RF. How much is RF? 10%. How much is that? The market gives an extra of how much? 5%. Agreeing with me? This RM minus RF is called as market risk premium. What is it called as? Market risk premium. Means what? Means what? The premium that the market is giving me for the risk I take. Three words, all the three words are logical. What do you mean by that? The premium the market gives me for the risk I take. Is that clear, guys? So, for the risk I take, the market is giving me a premium of how much? 5%. Is that clear, guys? Are you all able to understand? Now, this 5% is a premium given by whom? The market in general. But let us say, I want to buy shares of ITC. Now, ITC's risk is expressed as beta. Beta, how to compute? We will be seeing it in CA final. There I'll be making an elaborate discussion. For about 1 hour, we'll just see what is this beta, how do we compute and all. It's a lengthy discussion we'll be seeing. At the intermediate level, they'll give you the beta value. Is that clear? It will be in a decimal. 1, 1.5, 2, 2.5, whatever it is. Let us say the beta coefficient of a particular stock, a company is, let us say, 2 times. Which means 2 times it is risky. Now, for a normal risk I take in the market, I should get 5% extra. Now, for this company stock, it is 2 times risky. Hence, I should get 2 times premium. Hence, how much should I get? 2 into 5 extra 10%. Or in other words, what is the return that an investor will expect from this particular stock? No doubt he wants that FD return minimum. That anyways you need to pay 10% plus beta times the market risk premium, RM minus RF. Now you guys understood the logic, right? I need to get how much? 10% plus 2 times of what? The difference, 15 minus 10%, which means 10% plus I need to get additional 10%. Overall, the investor's expectation is how much? 20% return from this stock. The investor's return is equal to the company's cost. Is that clear, guys? Is everybody able to understand the logic for CAPM, capital asset pricing model? Such a beautiful model, such a beautiful model. We will be seeing more about this in our CA final. That I told you, I'll be dealing with the beta value and everything. Is that clear, guys? Are you all able to understand? So come on, tell me CAPM model. What is the formula? So KE is equal to RF plus beta times RM minus RF. Now in the question, if they give you market risk premium is so much, it means directly they have given what? RM minus RF value. Is that clear? Are you all able to understand, guys? Is that clear? Is everyone able to understand? Now in the question, let us say they have given market risk premium is, example I'm telling you, market risk premium is 5%. Is that clear? And they have given RM is going to be how much? 15%. Can you calculate RF? Yes. How? RM minus RF is equal to how much? 5%. And RF is how much? I know that this is 15%. Am I right, guys? Sorry. RM is how much? 15%. So 15% minus RF is equal to 5%, or RF is equal to 15 minus 5, 10. Is that clear? This way they can trick you. Are you all able to understand? So clearly understand in this question, what many students do is they are in a very they are in a hurry. Return on market portfolio, okay, fine. Market risk premium, this means RM. They immediately take it. This is not RM. This is RM minus RF. Market risk premium. Is that clear? The moment they read the word market, they conclude it is RM. No, market risk premium means RM minus RF. I told you the premium that the market provides for the risk you take, guys, correct? The premium the market provides for the risk you take is called as what? Your market risk premium, RM minus RF. So CAPM model, what is the formula, everyone? So RF is so RKE is equal to RF plus beta times RM minus RF. Is that clear, guys? Let's quickly go and do one sum, and with that we'll be done. Now, what is this? Calculate the cost of equity capital of H Limited, whose risk-free rate of return equals how much? 10%. What is 10%? Come on, give it a name. Hello, guys, come on. RF. The firm's beta is 1.75, which is beta. The return on market portfolio is equal to 15. What is it? This is RM. No, only RM. It is not RM minus RF. Where have they given premium? They have just mentioned what? Return on market portfolio, which means market return. Is that clear? So now in this case, you need to do it. Come on, quickly do. Question number 7 now. Write down question number 7. KE is equal to, what is it? RF plus beta times RM minus RF. Now what is RF? So 10%. What is beta? 1.75 into RM minus RF. What is RM? 15% minus what is RF? 10%, which is equal to 10% plus. The market risk premium is 5, right? So 5 into 1.75, which means they are expecting how much? 8.75% for the stock. Am I right, guys? Is everyone able to understand? So how much is this equal to? 18.75% is going to be what? My cost of equity. Is everyone able to understand? Is there any issue here? Guys, are you all able to understand? Right? That's about this particular concept of CAPM method. Now, one more thing I want to tell you. In exam, instead of giving RF, they can give you FD rate of return is so much, or they can also say GOI bonds. What is GOI bonds? Government of India bonds. These are also risk-free rate of return only, no? So if they give GOI bonds and all, don't think it is something else. It is nothing but RF. Instead of giving it directly as RF, they can give it as GOI bonds or risk-free bonds or something like that. Is that clear? Write it somewhere in the concept decoder book itself. Is that clear, guys? That's why I asked you to, bring this concept decoder and write it. Please write it there itself somewhere. These are nuances. Past exam questions have come like this. Is that clear? Quickly update. Write on. So, what is that? So, this could also be called as GOI bonds interest or FD interest or whatever it is. Is that clear? Learn it conceptually. It stays with you for a lifetime. And with that, we have completed what? KE calculation. All the methods are done. Is that clear, guys? Please go and update your library of adjustments. Write down KE-CAPM approach. Write down KE-CAPM approach. CAPM approach. KE-CAPM approach. Within bracket, direct. Within bracket, direct. Is that clear, guys? Quickly, let me just sum it up. There are broadly 5 models here we saw. One is a dividend price model. What is it? Dividend is assumed to be constant. So KE is equal to D divided by P0. Earnings price model. Assume earning is constant. E by P0. Growth model. Under that, dividend growth, earnings growth. Formula KE is equal to D1 by P0 plus G. Or E1 by P0 plus D. Now, in the absence of information, generally, we only go as per dividend models. Okay. Next, realized yield approach, computed from the investor's perspective, where he can readily sell the stocks in the secondary market. His IRR is going to be my cost. His return is going to be my cost. CAPM model, what is the formula? RF plus beta times RM minus RF. Now, clearly, based on the wordings of the question, you can know which method to use. No, guys, correct? If it is constant, the first 2 models should be used. Am I right? If it is growing, the third model should be used. And investor's perspective data is given. Realized yield. If they have given RF, RM and all, then you will use CAPM model. As simple as that. Clear with this, guys? Learn this conceptually and it will stay with you for a lifetime. Look, if dividend is expected to be constant, dividend price model. Earnings is expected to be constant, earnings price model. Dividend and earning are expected to grow at a constant rate, use Gordon's model. If it is difficult to forecast the future, use dividend realized yield approach. When the cost of equity or expectation of the investors is dependent on risk, that is high the risk, high the expectation, vice versa, then use CAPM model. Is that clear, guys? Risk-based approach. Is that clear? This could be even an MCQ and all. You can answer it. Are you all able to understand? With this, I am concluding this session. Till now, we have seen KD, KP, and KE. Now remember, I also did KT term loan. That is nothing but in your KE only. I mean KD only. Is that clear, guys? Right? With this, I am concluding the session. Please revise and practice all the sums we have covered till now, and I will see you all in the next one. Thank you all so much. Bye-bye. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So let's continue our discussion in this chapter, cost of capital. So till now, we have completed KD, KP and KE. Now let's move on to the next source of finance, the last source of finance, also known as what? Cost of retained earnings, which is called as KR. K stands for cost, R stands for retained earnings. Is that clear? Now guys, retained earnings actually belongs to whom? It belongs to whom? Equity shareholders. Now I told you guys earlier itself, we saw this this income statement and all, that let us say the company earned 40 crores. Out of this 40 crores, the company paid 10 crores as dividend. The balance 30 crores they retained as retained earnings. Now, in the next year, this 30 crore rupees forms part of their capital employed, right? Equity share capital, reserves and surplus, retained earnings. This forms part of their capital employed. This is also a source out of which they can fund their investments. Am I right, guys? So this is also a source of finance only. Am I right? Now, sir, retained earnings, does it come with a cost? Yes, it does come with a cost. Now, you may not actually pay anything out of your pocket, but this retained earnings belongs to whom? The equity shareholders. The entire EFE belongs to them. Is that clear? And this 30 crores in our example, retained earnings, belongs to equity shareholders. So on this also, they will be expecting a return. Guys, correct? Yes. Hence, very simple. KR is equal to KE. What is it? Remember, KR is equal to KE, because this retained earnings belongs to whom? Equity shareholders. KE means what? The expectation of return on equity share capital. Hence, KR is equal to KE. Is this clear, guys? Are you all able to understand? But remember, there are two exceptions to this rule. What is that? That alone I will tell you. Is that clear? So first of all, KR is equal to what? KE. So how do I compute KE? Any of the different methods. Dividend price model, earning price model, your Gordon's model. Then you have a realized yield approach, and finally you also have CAPM method. Any of those models, right? The way you calculate KE is equal to KR. Is that clear? Is everyone able to understand? Why, sir? Because this amount also belongs to equity shareholders. Sir, but I don't pay anything if I take money from my retained earnings. We are not talking about actuals. We are talking about, I told you, opportunity cost. Means what? The value of the next best alternative sacrifice here. Basically, this amount belongs to equity shareholders. Hence, they expect some return out of this. Is that clear, guys? Is everyone able to understand? Now, retained earnings belongs to the equity shareholders, and hence it is very much part of equity. Like other sources of finance, retained earnings also involves cost. It is the opportunity cost of the dividend foregone by the shareholders. Please underline, it is nothing but the opportunity cost of dividend foregone by shareholders. Right? Now, please focus and underline all these things. Later on, I have seen some students, online students, the past, they have messaged me, sir, I don't pay anything out of my pocket, sir. Then why are you saying it is a cost? That's what I'm explaining right now. Our subject deals with your opportunity cost concept. You need not pay anything out of your pocket. Here I'm talking about imputed cost, opportunity cost. That is the value of sacrifice. Is that clear? This is also an amount that belongs to them, and they are actually expecting some return out of this. Is that clear, guys? Remember, you don't get anything free of cost in life. Always have that in your mind. Nothing comes free of cost. The same is the case that goes in a company as well. Next. Therefore, KR is often interchangeably used with a KE, and KR is nothing but the expected return of the shareholders from the investments in the shares of the company. The formula used to calculate the cost of retained earnings are same as the formulas used for calculating cost of equity. Hence, KR is equal to KE. Now, there are two exceptions to this rule. What is this? Now, exception number 1. Now, guys, for the purpose of KE computation, whenever I say P0, that is my net proceeds. Now, guys, what do I generally do? I adjust for flotation cost. Am I right? What do you mean by flotation cost? The cost incurred for raising this money. Am I right? Now, when it comes to retained earnings, do I have any flotation cost? No. Why? The money is already with me. Are you all able to understand? Remember, in KE, that too in case of new equity shares only, we use what? We use flotation cost. Is that clear, guys? Now, in this case, in case of KR, you follow the same formulas that we use for KE computation, but please remember, for the purpose of arriving at net proceeds or P0, never adjust flotation cost. Is this clear, guys? Are you all able to understand? You can use the same formulas we used for KE computation without considering flotation cost. Is that clear? Suppose flotation cost is given. For KE calculation, you will consider flotation cost. For KR calculation, once again the same formula without taking your flotation cost. Is that clear? Suppose we are using dividend growth model, T1 by P0 plus G. That is correct. Here P0 for KE calculation, you will take the issue price minus flotation cost. Whereas for KR calculation, same formula once again you do, where you just take the issue price, do not take what? The flotation cost. Is that clear? Is that clear? Guys, are you all able to understand? Is there any issue here? Any problem here? No. Is that clear? That is number 1. So for the purpose of calculation KE, please underline all these things. Extremely important. Now P0 is equal to net proceeds realized, which is issue price less flotation cost. For what purpose? KE calculation purpose. However, for the purpose of computing KR, it is the current market price that we generally take. Is that clear, guys? Guys, are you all able to understand? Now, it's slightly different. Slightly different. for the purpose of P0, for the purpose of computing KR, P0 is taken as what? The current market price. Why? I don't issue anything. Am I right, guys? So the first priority is given to what? Current market price. Sir, if current market price is not available, then you take issue price. Is that clear? Ulta. Generally, we first consider issue price, then go to current market price. Is that clear? But in retained earnings, I don't issue anything. So if current market price is given, you take that. If that is not available, go for next best alternative is issue price. If issue price is also not available, then go for face value as P0. So what is considered as P0? I'm telling you here. Is that clear? Here itself, you write on order of priority. First, current market price. If that is not available, go to issue price. If that is also not available, then go to your face value. Sir, if current market price and issue price is available, what should I do? Generally, we take current market price for the purpose of computing KR. Is that clear? But for the purpose of KE, we will take issue price. Is that clear, guys? These are some fine points here. Now, let me clearly tell you one more thing. Once again, a controversial area. Institute sometimes take CMP. Sometimes they take issue price for KR purposes. Sir, what should I do? Write a note. Right? Institute suggested answers also I've seen this difference. Please write a note in this regard. What will you write? For the purpose of KR, P0 has been considered as current market price. Is that clear? For your note, your answer is correct. Is this clear, guys? This is a controversy. I think Institute should only put an end to this. Left, right, and center. One time they take CMP, one time they take issue price. Are you understanding the logic here? We're talking about retained earnings. I don't issue anything here. In this case, the logical thing to do is to take current market price. Is that clear, guys? Is that clear? Everybody having a clarity, right? Everywhere else, for all the sources of finance, first priority issue price. That is not available, take current market price. That is not available, take a face value. For KR alone, first priority is current market price. Why? I'm not issuing anything. It's a very unique source of finance, right? If that is not available, take issue price, and that is also not available, take face value. Is that clear for everyone? Right. Now, this is what I mentioned. However, ICAI has used current market price and issue price interchangeably in their solutions for calculating KR. In this case, students are suggested to write a note regarding the approach followed in their answers. Is that clear, guys? This is why I have created these doubt busters. Many students generally find an issue here. I'm giving you guys a solution. Fine. Now, what is the first exception? Generally, KR is equal to KE. First exception is what? If there is a flotation cost, that flotation cost should be ignored for the purpose of computing KR. Is that clear? Number 2. Exception number 2. Now, suppose in the exam, they give you personal income tax. Personal income tax means income tax of the investor. Is that clear? If they give personal income tax and personal brokerage of the investor, in that case, KR is equal to KE into 1 minus personal income tax rate into 1 minus brokerage rate. Is that clear? Sir, what do you mean by this? I will give you guys an example. Let us say, guys, KE is equal to 10%. I expect 10% of return from the company. Guys, clear? Now, always remember, I told you, recall, first lecture, introduction, I told you, in India, if you want to trade in share market, you need to open a demat account with a stock broker. You can't say, sir, I don't want broker. This is not real estate. Real, you have to, through broker is a member of the stock exchange. Only through him, you can actually access the terminals, as we call it, right? Everything will be studying in CA final about the way market functions. But here, this knowledge is enough. Now, every time I transact means what? Buying or selling the shares, I need to incur something called as a brokerage. Is that clear? Is that clear? Now, brokerage is a cost for me. Am I right, guys? Now, let us say my brokerage is 5%, which means out of my earnings, effectively I will lose 5%. 95% of that only I will earn. Am I right, guys? So, into 1 minus brokerage, I'm telling you how much is brokerage? 1 minus 0.05, which means 95% of this 10% only I will get. Guys, correct? Which means how much is that? 9.5%. Guys, correct? Correct? Yes. 10 into 0.95 is 9.5%. Am I right, guys? Now, sir, this 9.5 belongs to you. Wait. Our income tax department is charging us. They want a piece of this cake. So they also are asking us, let us say, income tax rate is 30%, which means this 9.5 also I will not fully get. Right? On this, only 70% I will earn, because balance 30% I give it to the income tax department. Am I right, guys? So this into 1 minus 0.3. Are you all able to understand? Are you guys able to understand? Or in other words, So I lose 5% here. So 95% of 10% is what I earn. On that further, I lose 30%, which means 70% of this only I earn. Is this clear, guys? Effectively, I have two different types of expenses as an investor. One is brokerage, the other one is what? Personal income tax. After adjusting for all this, how much amount lies with me? Ideally speaking, 10 into 0.95 into 0.7. Effectively, my earnings is only 6.65%. Is that clear? Is everyone able to understand? See, instead of 95, you write it as 0.95. Instead of 70, you write it as 0.7. The other, only one you keep it as a percentage, others you convert it into a decimal. It's easy for you to calculate. Is that clear? So 10%, 10 into 0.95 into 0.7, if you do, you get what? 6.65%. Is that clear, guys? Effectively, this is how much an investor will earn. Am I right, guys? Guys, are you all able to understand this? Is this clear? Or in other words, I will say KR is equal to KE into 1 minus TP. TP means tax rate of personal, that is individual. So TP means a personal income tax rate into 1 minus TB means a personal brokerage. Is that clear, guys? Now, 1 second. Don't worry. All these things, if it is given in the question, it needs to be considered. Don't worry about it. If it is not given, forget it. Are you all able to understand? So KR is equal to KE. That's all. Suppose personal income tax rate is given, suppose personal brokerage is given, that also needs to be adjusted. Is that clear? Once they ask this was also not given properly in the study material, but once they ask this, is that clear, guys? Is that clear? So that is the reason I have actually put it in the doubt busters instead of putting it in the main segment. Is that clear? I have literally analyzed all your past exam questions and I'm coming up with this. Is this clear, guys? So KR is equal to KE. Two exceptions, remember. Exception number 1. Now, use the same formulas that we use in KE, but without considering flotation cost. Number 2, if the personal income tax rate, personal brokerage of investor is given, KR is equal to KE into 1 minus personal income tax rate into 1 minus brokerage rate. Why 1 minus 1 minus? Because these are all outflows from the perspective of investor, and the expectation of return of the investor is equal to the cost from the perspective of company. Is that clear? We are doing everything from the perspective of company. This once again is based on the principle that the return of the investor is equal to cost from the perspective of company. Is this clear for everybody? Is everyone able to understand? Have the clarity, and that's about this particular segment. Is this clear, guys? So any separate formulas? No. KR is equal to K. Two exceptions. Exception number 1, ignore flotation cost, and exception number 2, personal income tax rate brokerage is given. That also needs to be adjusted. Is everyone able to understand? And most importantly, P0 for the purpose of what? Your KR is equal to what? Current market price. If that is not given, take issue price. If that is also not given, take face value. This order is important. Is everyone able to understand? And Institute has taken this interchangeably. Sometimes they've taken current market price and all. Everywhere when you see this, write a note and leave it there. Is that clear? Now let's go on to some numerical problems. We'll do a few numerical problems. Shall we get started, guys? All right, on question number 8. Come on, quickly. Let's do this. Question number 8. The face value of equity shares of a company is rupees 10, while the current market price is how much? 200 rupees per share. The company is going to start a new project and it's planning to finance it partially by new issue and partially by retained earnings. Now, what are they saying? Face value 10 rupees, current market price. If you go to the market, what is the price? 200 rupees. New project, they are going to partially finance it by issuing fresh equity shares, partially by retained earnings. You are required to calculate the cost of equity shares as well as the cost of retained earnings. If the issue price will be 190 per share, flotation cost will be 5 rupees per share. Dividend at the end of first year is expected to be 10 rupees. Growth rate will be 5%. Now, first we need to calculate K. Which model will you use? Which model will you use? Gordon's model. Yes, dividend growth model. Is that clear? Which means K is equal to P1 by P0 plus G. But remember, in this case, for the purpose of KE calculation, P0 flotation cost, P0 net proceeds will be what? Issue price 190 minus flotation cost 5. Is that clear? However, I will use the same formula for computing KR, but this time what will I consider? Flotation cost you ignore, but will you consider 190? No, you will consider current market price. For that purpose only, I have kept this sum. Is that clear, guys? Is that clear? The order of preference, both issue price is given and current market price is given. Now, for the purpose of KE calculation, this should be given the priority. For the purpose of KR computation, this should be given the priority. Are you guys able to understand? Just go and do this. Guys, for every adjustment we are seeing sums. That's the reason why I have coined this in a certain way. Right? Please write down. First write down. KE is equal to, come on, write down formula, everyone tell and write. P1 by P0 plus G. Now what is D1? It's given in the question. Guys, D1 is given or D just they have given? Dividend at the end of first year, very clear, will be how much? 10. So it is D1. Very good. So 10 rupees divided by, what's my P0, guys? Now, issue price is 190, but will the company receive this? No. Out of this, 5 rupees will go off for flotation cost. Am I right? 185. Plus, what's my growth rate? 5% is 0.05. Is that clear? How much is this? 10 by 185 gives me how much? 0.0541 roughly. 405 they have given, round it off to 41 plus 0.05, or in other words, it's going to be what? It's going to be 0.1041, or this is nothing but 10.41 percentage is my cost of equity. Is this clear for everyone? Guys, come on, next one. KR is equal to same formula, D1 by P0 plus G. Now what will you do here? D1, 10, P0, take a rating. What is it? Write down 200, pull an arrow and write CMP, current market. Is that clear? This is the reason I asked you to bring those color inks and all. One look at this question, you will know the solution. You will know this red ink will pop up the day before your exam and you're revising. Plus G is what? 0.05. So 10 by 200 is exactly 0.05. Am I right? So it's 0.05 plus 0.05. That gives you how much? 0.10, or I can say it's nothing but 10%. Is that clear? So KE is equal to KR is equal to KE. But when will KR not be equal to KE? When I have a flotation cost, or where I also have this brokerage, personal income tax rate and all. Is that clear, guys? Are you all able to understand? Just go and update your library of adjustments. So write down. KR hyphen. Write down. KR hyphen. Ignore flotation cost. Semicolon. Quickly write down. Ignore flotation cost, semicolon. Use CMP for KR and IP for KE. Use CMP for KR. CMP means current market price. CMP for KR and IP for KE. IP means issue price for KE. Is that clear? That's about this question. Let's move on to the next one. Clearly, what was the learning objectives? We have noted down. Is that clear? Now just imagine when you're looking at the sheet the day before your exam, you will know in every sum what we did. Is that clear? What is not revised is as good as not done. Guys, correct? In audit you would have studied what is not documented is as good as not audited. It's as simple as that here. What is not revised is as good as not done. So I am enabling you to revise the day before your exam. Trust me, 2-3 times you can revise the entire subject. Within the last day you will be able to do that. That is the power of your library of adjustments. Let's move on to the next one. Now question number 9. What is this question saying? Now calculate KR when KE is 20%, the rate of flotation cost is 5%, and the personal income tax rate is 30%. Flotation cost in this case means from the perspective of that guy, investor, brokerage. What will you do? Write down quickly. Just quickly write this and close off. Question number 9. Question number 9. KR is equal to, come on guys, KE into 1 minus TP into 1 minus TB, right? Any abbreviation you want, you can write. This is nothing but 20% into 1 minus, what is the tax rate? 30. 0.30 into 1 minus, what's my brokerage? 0.05. Am I right? So it's 20 into 0.7 into 0.95. Huh? Yes. How much is that? 13.30%. As simple as that. Is that clear, guys? Is everyone able to understand? Any issues, any problem, please tell me. Guys, are you all able to understand? The solution is small. That's all it is. Guys, clear? Shall we move on to the next one? Yes, please go and update your library of adjustments. Write down. KE with the personal in IT and KR with personal IT and brokerage. KR with personal IT. IT means income tax. KR with personal income tax and brokerage. That's about it. Let's move on to the next sum. Question number 10. Question number 10. Shall we get started? Guys, let's get started. Now look at this. ABC company provides the following details. What have they given? RF, beta. Now look at this. Look at this. They have given what? RM minus RF. Directly given. Right? Had I been the examiner, I would have given RM. Right? Because RF is required. RM is not required. RM minus RF, if it is that, directly you take it. Is that clear? And in exam, don't expect them to give it like this. They will give it as market risk premium. Right? They will not give this easily. Is that clear? And in exam, RF will not be given as RF. You can expect it as GOI bond interest and all. It means a risk-free rate of return. Calculate the cost of retained earnings on the basis of CAPM. Quickly, can we do it? Same CAPM method, directly do it, guys. Nothing great, no? I think this is a study material question. That's why I kept it. Write down. Guys, 100% of the study material is covered in our classroom. Over and above that, wherever possible, past exam RTPs and all we'll be doing. Of course, for regular batch students, separately, supplementary material will also be covered. Right? All your past exam RTP, MTP questions will also be covered. Right? And even the case scenarios are covered. Right? Write down. Question number 10. Write down. KR is equal to formula RF plus beta times RM minus RF. Is that clear? So what's my RF? 7% plus what is my beta? 1.2 times of what? RM minus RF is given directly as 6%. So now it's going to be 7% plus 1.26 is going to be what? 7.2%, right? It's going to be a total of 14.20%. Is that clear, guys? Any issues? Any problem here? That's about this question. Go and update your library of adjustments. Write down KR-CAPM approach. KR-CAPM approach. Is that clear? Okay, guys, are we done? Now, let's go on to the next segment of discussion called as, now we have computed the cost of each source of finance, guys, correct? Now, let's go on to the last one called as weighted average cost of capital. WACC within brackets is also known as KO. We have seen this, right? The abbreviation, we have seen this earlier. Correct? Yes, right. Now, let's go on to this next concept called KO. Now, guys, at the beginning of this particular chapter, I gave you guys one example, right? Let me take that example once again. Okay, let me take this example once again. Right. Now, let me take this example, guys. Now we saw earlier, I gave this example initially. I'm just taking this up once again. I raised 30 crores from equity share capital, right? Now, the cost of equity share capital was 12%, which means for this 30 crore, every rupee I raised costed me how much? 12%. Now, I raised 20 crores from preference share capital. Every rupee I raised cost me how much? 11%. 50 crores from debt. Every rupee costed me how much? 9%. So, for 30 crores, the cost is 12%. For 20 crores, the cost was 11%. 50 crores, the cost is 9%. Now, I want to know, fine, all those things are fine. For 100 crores overall, what was your cost? Is that clear, guys? Now, can I say, very simple, it is going to be the respective cost divided by 100. Am I right, guys? Simple. For 30 crores, how much was the cost? Guys, can I say 12% into 30 crore? This would have been the cost for equity. Am I right? Plus 11% was the cost on 20 crores. Am I right, guys? Plus 9% was the cost on 50 crores. Am I right, guys? So this is going to be, if I multiply this respective source, I have the total cost. This would have been, if I add, this is the total cost I need to pay to all the providers of finance divided by the total amount I raised. Guys, divided by 100 if I do, I will get what? My overall cost of capital. Am I correct? Guys, is this clear? Understandable? Is this understandable? Respective cost, you add up, you get the total cost divided by the total amount you have raised gives you the overall cost of capital. Am I right? Everyone able to understand this? Yes. No. One second. Now this, can I also rewrite this as, look, please look here. Can I also rewrite this as 12% into 30 by 100 plus 11% into 20 by 100 plus 9% into 15 by 100. It can be rewritten like this. Am I right, guys? So I am rewriting this as 12% into 30 by 100 plus 11% into 20 by 100 plus 9% into 50 by 100. Can I rewrite it like this? Guys, are you all able to understand? Are you all able to understand? Any issue, any problem here? Any issue, any problem here? Right? Now, how much does this come out to? How much does this come out to? 12% into 30 by 100. Oh, please, 12 into 30 by 100. How much is it coming out to? 3.6. So 3.6% plus 11 into 20 by 100. How much is it? 2.2% plus 9 into 50 by 100. 4.5%. Add up. How much you get? 3.6 plus 2.2 plus 4.5. You get how much? 10.3%. Is this clear, guys? Is everyone able to understand? Are you all clear with this? Or if you do it this way also, you'll get the same answer only. 30 crores into 0.12. How much was this? Overall, you get 3.6 crores here. Am I right? 3.6 crores is the cost. Then 20 crores on that 11%. How much you get? 2.2%, 2.2 crores amount. Then on 50 crores, you have 9%, 4.5 crores. Add up 3.6 plus 2.2 plus 4.5. Overall, you incur a total amount of 10.3 crores. For how much capital? 100 crores of capital. The effective percentage of capital is only 10.3%. Are you all able to understand? Is this clear, guys? Guys, are you all able to understand? Or in other words, the respective cost, you get the total amount you need to pay, amount divided by the overall capital that you raise, gives you the effective cost of capital, overall cost of capital. Are you all able to understand? This, can I rewrite this as follows? Can I say this is nothing but, if I want to put it as a formula. Now, you guys tell me, this 12% is what? KE, am I right? So this 12% is what? KE. This gets multiplied with what? Now look at this, 30 by 100. Or in other words, can I say this is nothing but the weight of equity in the overall capital. Guys, correct? Or in other words, 30 by 100 represents the weight or the proportion of equity funding in the overall capital employed. Am I right, guys? Guys, are you all able to understand? So I call this as what? WE. WE means what? Weight of equity. Guys, agreeing with me? Proportion or a weight of equity. Is that clear? Plus this 11%. What is this? Guys, one answer. KP. So this KP is multiplied with what? It is multiplied with 20 by 100. Or in other words, it is a proportion of preference in your capital employed. That's nothing but WP, weight of preference shares. Am I right, guys? Plus the last one is what? KD, right? Into what? Proportion of debt in your overall capital, WD. Am I right, guys? It's nothing but KD into WD. Is that clear? Are you all able to understand this? This gives you KO. Are you all able to understand? So suppose retained earnings is there, KR into WR. That also will be there. Is that clear? Here I'm just giving you for this example. Or in other words, weighted average cost of capital. This is the reason for the name. The respective cost should be multiplied with what? The respective proportions. The proportions are weighted for what? For the proportion to which they contribute to the overall capital. Hence the name weighted average cost of capital. It's not 12% plus 11% plus 9% by 3. It's not simple average. It is a weighted average. What is the weight? The weight is the proportion to which they contribute to the capital employed. Is this clear, guys? Is everyone able to understand? Or logically you tell me, 12% is the cost for the entire 100, entire amount that you raised? No. 12% is the cost only to the extent of 30% of my funding. 11% was a cost only for 20% of my funding. 9% was a cost only for 50% of my funding. Overall for my funding, what is the effective cost? The respective cost multiplied by the respective proportions, I will arrive at the weighted average cost of capital. Is this clear for everyone? So if someone is asking you, you raised money, what was the capital? This KO. Sir, on an average, sir, each source had its own cost. I average out overall for 100 rupees, raising 100 crores. This was my effective cost. Is that clear? Individually, every source has its own cost. I average out and I say overall for 100 crores, this is my cost. Is this clear for everyone? Is everyone able to understand? Is there any issue here? Is there any issue? Guys, clear with this? Any problem? No. Now, this weighted average cost of capital, this is what we need to do. What is the formula? KEWE plus if retained earnings is there, KRWR plus KPWP plus KDWD, respective cost multiplied with the respective weights. You arrive at the weighted average cost of capital. Should this be mugged up? Should this be mugged up? Absolutely no. Now, let me tell you one additional thing. Now here, whatever was the weights we took, 30 by 100, 20 by 100, 50 by 100, these are all book value weights. Guys, correct? We took the book value, no? Guys, book value means what? The amount which is recorded in your books. Guys, are you all understanding? Is everyone able to understand the weights? How did we arrive? 30 crores by 100 crores. This 30 crores was recorded in the books. Guys, correct? Accounted value. The amount at which face value would have been recorded here. Are you all able to understand? Guys, is that clear? Now, parallelly, there is a market. The boss is watching. For each and every component, parallelly in the market, I can also have market value, no? Guys, correct? Is everyone able to understand? Let us say this 30 crores. How did you arrive, sir? Every share has a face value of 10 rupees. Example, I issued 3 crore shares. So 3 crores into 10 gave me what? 30 crores. Suppose in the market, every share has a value of 20. The market value of equity will be 3 crores into 20. It will be 60 crores. Guys, correct? Preference shares, let us say 2 crore into 10. This was the value. But the market value for every preference share, let us say is 12 crores. I mean, let us say is 12 rupees. 2 into 12 rupees, it will be 24 crores. Guys, are you all able to understand? Let us say preference market value is also 50 crores. Example, I'm saying you. Now, in this case, what is the total market value of this particular company? 60 plus 24 plus 50. How much is that? 134. 134 crores. Now, the proportions will be different. 60 by 134 will be the weight of equity. 24 by 134 will be the weight of preference. 50 by 134 will be the weight of debt. Is that clear? Hence, always remember, the weights can be computed using two approaches. One is your book value weights. The other one is your market value weights. Is that clear? Cost will it change? No. For the purpose of cost, we anyways consider only the market values and all these things. Don't worry about that. But when you are computing the weighted average cost of capital, you can either take the book value weights or you can take the market value weights. Is that clear? Is that clear? Now, which is more correct? The most correct one is obviously the market value weights, because market is the king. Is that clear, guys? Always remember this. Is that clear? Sir, in the question exam, they have asked us to compute WACC, weighted average cost of capital. Now, they have not given us which method to follow. You take any one method and you do it. No problem. Write a note. Specifically mentioned, then as per that method, you do it. Is that clear, guys? Guys, please reciprocate. Are you all able to understand? So which means now always remember, for every component of every source of capital, there will be a book value as well as a market value. Is that clear? Now the weights can accordingly be computed on the basis of book value weights or on the basis of market value weights. Is this clear for everyone? Now that's about this particular segment of discussion, weighted average cost of capital. Are you all able to understand? Is that clear? Is that clear? Now one small thing, can I tell you? Observation. Right? We will see it later on, but one very small observation. Now, can anyone tell me? KE, KP, KD and all is given. Now, I told you, generally, KD is the cheapest source of finance. Debt is the cheapest source of finance. Why? Tax deduction, tax shield. Excellent. Very good. Right? Now, KE is generally higher. Why? KE represents your expectation of return from the investor's perspective. Am I right? And investors, your equity shareholders perspective. Equity shareholders are risk takers. Obviously, more the risk, they will expect more return. Whether the actual return is there or not, we don't know. Expectation is what we're talking about. Is that clear? So KE is generally the costliest source of finance. KD is generally the cheapest source of finance. Is that clear? Now, when I add all these things, KO, you tell me KO will be more than KE or it will be less than KE, or what is KO? KO will be more than everything. KO can never be beyond, in this case, 12%. It can never be below 9%. Why? It's an average. Example, I'll tell you. Suppose 100% of my funding is through equity. Entire 100% entire cost of capital will be equal to 12% only. Guys, correct? Correct? Costliest source of finance is what? Equity in this case. Now, here 30% of the total capital only I've taken it in. but at 12%. Guys, are you all able to understand? Right? Suppose if I'm taking entire 100, all equity company, in that case, max my cost of capital can only be what? 12%. Sir, some proportion I'm taking it from a lower cost of finance. In that case, obviously it averages out and your weighted average cost of capital will also start reducing. Am I right? Because some component you are taking it from a cheaper source of finance, overall it reduces cost. Guys, correct? Huh? Suppose I keep on reducing. Now let us assume 100% I take only from debt. 100% from debt I take, which means entire cost of capital will be equal to 9%. Are you all able to understand? Or in other words, your cost of capital KO can range only between, in our example, 9% to 12%. Or in other words, it can never go below KD. It can never go above KE. Is that clear? It will range only between this, depending on the proportions of your capital employed. Is this clear, guys? Are you all able to understand? We'll study more about this in a chapter called capital structure. Are you all able to understand? Many students have this misconception. Overall cost means, sir, it's a sum of everything. It's not a sum of everything as such, my friend. It is a weighted average. Is that clear? So costliest source entirely I take, max it can be 12%. Fully from cheapest source, max it can go down by 9%. Now in between this only the averaging happens depending on the proportions. That's why we say it is weighted average cost of capital. It averages out depending on the weights that you incorporate. Is that clear for everyone? Is that clear, guys? Now in real life I will tell you, 100% from debt, is it possible? No. Which means what? There is no owner for the company, only creditor. Is it possible? How will you incorporate the company? For you to incorporate the company, there has to be owner. How will you have? Absolutely not possible. Is that clear? Practically not possible. Are you all able to understand this, guys? Yes, that's about it. That's about it. Trust me, this is a beauty, guys. This entire subject is actually a beauty. Now you can play around with the figures like anything. The solution is not difficult. It's about understanding the technicalities. Right? That's why I'm building the subject like this, so that even if there is one or two riders, you will be in a position to manage. Is that clear? Now let's go and look at our concept decoder book. Okay, look at this. Weighted average cost of capital. The company usually does not procure the entire funds from a single source. Am I right? Now, rather it makes a mix of various sources of finance, right? Hence, the cost of capital will be equal to the weighted average cost of individual sources of finance. The WACC is also known as overall cost of capital, which includes the cost of different sources of capital and depends on the capital structure. What do you mean by capital structure? What do you mean by capital structure? Capital structure means the mix of different sources of finance, equity, your retained earnings, preference, debentures. This mix is called as capital structure. That's a separate chapter we'll be seeing called capital structure decisions. Means what? Structure. Capital structure means the structure of capital. Structure of capital means what? From which source, how much I have raised. This actually is called as capital structure. And I say, what is the capital structure of this company? Say, yes, 30% I've taken from equity, 20% from preference, 50% from debt. This proportion is called as capital structure. And the proportion determines your overall weighted average cost of capital. Is this clear, guys? And the proportions could either be book value weights or market value weights. Is that clear? Have the clarity, guys. Have the clarity, right? Now, hence the total cost of capital. Okay, this we have done. Now, WACC is preferred because the proportions of various sources of funds in the capital structure are different. To be representative, therefore, the cost of capital should take into account the relative proportions of different sources. Now, WACC represents, please underline this, the minimum rate of return at which the company produces value for the investors. What is the meaning of this? Now, I will just give you a brief and then I will not deal much about this right now. Now, let us say the overall cost of capital, we just calculated. Now, how much was that? 10.3%. Now, guys, recall the big picture. Our subject has 3 objectives and all. Now, overall, I am raising 100 crores. What is the cost for 100 crores? 10.3%. 10.3%. Now, every rupee I raised, it costed me how much? 10.3%. Now, when I raise the money, what am I going to do? What will I do with this? I am going to invest it. Now, understand, when I am investing this money on my fixed assets, I should make sure that it generates a return that is at least equal to 10.3% or more than that. Is that clear? That's why we call this as minimum required rate of return. It is not the actual return. Minimum required rate of return. Why? My cost, at least I should be able to recover. Am I right, guys? So the minimum required rate of return in exam, some questions they will say minimum required rate of return. You should understand that means weighted average cost of capital. Is that clear? Minimum required rate of return is nothing but my weighted average cost of capital, WACC or KO. Is that clear, guys? And whenever I'm investing, we will see in investment decisions chapter, my investments should at least give me what? It should at least give me a 10 point, in our example, 10.3% or more. If it is more than that, it means overall the company is doing well. Am I right, guys? For every rupee I raised, I incur 10.3. So the return I should get from my investment should be more than 10.3. So hence, this is kept as a threshold. This is kept as a threshold limit beyond which you should start earning. Is that clear for everybody? Are you guys having the clarity here? Right, I'm linking all these areas that I will be seeing more about this. Steps to calculate WACC, we will be seeing it. Is that clear, guys? Now, for calculating WACC, there's a choice between what and what. Everyone underline this. Book value weights and market value weights. While book value weights is operationally easy and convenient, why? Readily available in your books. The market value weights is more correct and it represents the firm's true capital structure. Is this clear? Now, with this, shall we just go and solve some numerical problems? Guys, let's get started. Now you do it, you will get a crystal clear clarity on the entire subject. Let's do this, guys, shall we? Let's get started. Question number 11, huh? 10 is done? Yes. Let's go on to question number 11. Now, mark this sum as important. Please mark this as important. Let's do this, shall we? Okay. Calculate the WACC using the following data. Using the following data by using A, book value weights, B, market value weights. Means what? They are asking you to do this sum both under book value weight and under market value weights. Now, guys, this weights will only affect what? Your WACC. It will not affect individual computation of KE, KP, KR, KE and all. Clear with this, guys? KD and all. Right? Now, what have they given? The capital structure. Structure means what? Sources. Is that clear? Of a company's as under. Try to learn these jargons. It will be easier for you. What have they given? Debentures. What is the value of debentures? 5 lakh. And they've clearly given face value is 100 per debenture. Is that clear? If you divide that, you will get the number of debentures. Am I right? Preference shares, 5 lakh value, 100 rupees per share. Equity, 10 lakh value, 10 rupees per share, which means 1 lakh equity shares have been issued. Total overall, what is the total capital employed? 20 lakhs. Now look at this. The market prices of these securities are as follows. Now currently, debenture is quoting at how much? 105. How do you know? Debt market. In debt market, you'll get it. Is that clear? Preference shares are quoting at how much? 110 rupees. In equity market, in your cash market itself, it gets quoted specifically mentioned as preference. Not that popular. It is not that vibrant and all. But anyways, right? Remember, guys, market value. You need not exactly take this market value from share market. For example, even a private company can have a market value. How, sir? You call a valuer, ask him to value. Is that clear, guys? You call a valuer, ask him to do a valuation and arrive at the pricing. Is that clear, guys? That way also you can do. But generally, for listed companies and all, it's easier. Readily, just open and you will get it. Is that clear, guys? Open the website and you will get, the NSE website or any broker's website you see, or Google it also, you'll get it. Is that clear? Equity shares, market price, 24. Additional information. Rupees 100 per debenture, redeemable at 10 at par, 10% coupon, 4% flotation cost, 10-year maturity. Now wait, what have they given? What have they given? Now, they have given some data for us to compute KD. Am I right? Next. 100 rupees per preference shares, redeemable at par, 5% coupon, 2% flotation cost, 10-year maturity. This is given for KP. Next. Equity shares have 4 rupees flotation cost. Market price is going to be 24. Is that clear? Next. The next year, expected dividend is 1 rupee with an annual growth of 5%. Now, this clearly means KE, I have multiple methods. Which method should I use? Dividend growth model, Gordon's model, dividend growth model. The firm has practice of paying all the earnings in the form of dividend, which means whatever they earn, they pay as dividend. Is that clear? Next. The corporate tax rate is how much? 30%. Now, use YTM method to calculate. Oh my God. Debentures and preference shares. Now, look how comprehensive sum, 10 mark sum. So, KD calculation. YTM means what? IRR. KP calculation, IRR. KE calculation, Gordon's model. Now compute independently. And finally, what will you do? Using book value weights, compute WACC. Once again, using market value weights, compute WACC. Now you understand the entire chapter. Guys, now we did this slowly to reach this point. From now on, the chapter will be flowing in a, it will be a little faster. That's about it. When you build the subject, you need this time. Now later on, we've already sharpened the axe. Now it's just time to start cutting the tree. Shall we get started? Shall we get started? So no, don't say, sir, we need to do this and all. YTM, be happy, right? Oh, Samyoy. Pray God that you should get NPV 0 and all. Start doing. Else we will only get 0 in exam. Okay. So please focus. Shall we do it, guys? Okay. Anyways, I am there. I am going to give you the trials. I will give you the trials now. What is the problem? Get practice to it, guys. Get used to this, right? So let's get started, shall we? In exam, they will give you, generally they'll give you the trials by way of tables. Question number 11. Now what will we do? Write down step 1, easiest part we will do. Which is easy? Everything is easy only. So yes, KE we will calculate. Direct no. Guys, write down. Calculation of KE within bracket, write down on the top. What model? Dividend growth model. Write down dividend growth model. Write down formula. KE is equal to now D1 divided by, guys, instead of P0, we'll write P0 minus F, flotation cost. Let's be very clear. Or if you want, you can write P0 and write down where P0 stands for net proceeds, that is issue price minus flotation cost, whatever it is you can write. If you want, you can put it as P0 minus F just for clarity purpose. Or no, sir, I want to put it as P0. Come down and write what P0 stands for, as the case may be. Is that clear? I told you for every question you need to write where D1 stands for, P0 stands for, G stands for and all, right? Plus G. Now D1, how much the value given in the question now? What is it? Now clearly given what? Next year expected dividend, which means D1. How much was that? 1 rupee divided by, what is P0, guys? P0 is 24, write down 24 minus F. What is flotation cost given in the question now? 4 rupees plus what? G. What is G? Write down 5%. So 1 by 20, how much is that? Into 100, it's 5% plus 5%. So KE comes out to how much? 10%. Is that clear? The first source of finance we have computed. Easiest part, directly done. Any problem, any issues? Any problem, any issues? No. Shall we move on to the next part of the question? Guys, shall we get started? Yes? Okay. This is step number 2. Step number 2. Now what do we compute now? Yes, write down calculation of KD. Within bracket, what method? YTM method. YTM method. YTM method. Now what is this, guys? How do we do this? Now you need to prepare that cash flow table. Recall, you can do it in a smarter way. Year, cash flows, then one trials present value factor and present value cash flows, another trials present value factor, present value cash flows, and all. Very good, very good. Now guys, now let's do this. Now this is what? Debentures, right? Okay. Now with respect to debentures, now first I have what? Cash inflow. Am I right? What is my cash inflow? What is my cash inflow? Yes, tell me, guys. Issue price minus flotation cost. What is my issue price? It is 105. Issue price not given. Next alternative, what will you take? Current market price. You will take 105. Now debentures are redeemable at par is given. Nothing is mentioned about issue. Nothing is given. Take current market price. Is that clear? Perfect. Redemption is at par given. If nothing is mentioned also, we will take it as par only. Next up, coupon rate 10%. Why do we need it? For computing annual cash flows. Is that clear? Next up, 4% flotation cost is given. Now nothing is mentioned in the question. 4% on what? Issue price or face value. Now you can take anything. Can we take issue price? Ideally it's correct. Guys, are you all able to understand? We will take that. Guys, are you all able to get this? Yes. Then redemption value you all know. Shall we get started? Write down. First, before we start, first ingredients list out. What is it? First, write down. This is going to be the first one, net proceeds. Write down net proceeds at T0. T0 means what? Or you can write year 0. Year 0 means today. Correct? What is it? What is it? It is going to be what, guys? Come on, tell me. It is going to be rupees 105 minus within bracket 4% on rupees 105. Is that clear? What is the assumption? So your flotation cost is a percentage on your issue price. Is that clear? So write down is going to be 105 minus 105 into 0.04 gives me 4.2 4.20, which means it's going to be how much? Rupees 100.8. Rupees 100.8 is my inflow as on date. Is that clear? Guys, are you all able to understand? Now, every year, I will be having an annual cash outflow. How much is that? How will you compute? 10% of 10% of face value. How much is it? Guys, come on, tell me, no? 10% on 100, how much is it, ma? 10 rupees, right? That's all, Yes. Tax saving should come. Guys, are you all able to understand? Now we are talking about KD. Don't forget that tax shield. So write down here. Please write down here. Annual cash outflow is equal to, write down, I take a red ink and write within bracket 1 minus T. Why? I pay interest. Parallelly, I save tax. Net outflow should only be considered. No. Guys, is everyone able to understand? Don't miss this. Don't ever miss this. If you have made a mistake, take it a red ink. All of you guys miss this. Right? Take a red ink. Till now, we are into KP, KE and all, no tax shield. You forgot comfortably. This is where I'm telling you, you need to have this. And now you understand the importance of color coding. You should know that when you're looking at the solution, you should know that you made this mistake in the class so that you will not repeat it in the exam. Write down, write down. Now, this is going to be what? This is going to be, how much is the interest amount? 10 rupees. Am I right? It is all rupees. How did you get 10? 10% on 100 into 1 minus, what's my tax rate? 0.3, which means every year I have a cash outflow of how much? 7 rupees. Is that clear? Why are we doing all these things? To prepare that. I mean, it's a cash flow equation. Am I right, guys? Hello. Guys are clear with this? Right. Next up. Next up. Yes, redemption value. How much is redemption value? It's given. How much is that? How much is that, guys? Rupees 100. Is that clear? So this is going to be my inflow today. Outflow, annual outflow is 7. At the end of the period, it's going to be 100. Am I right? Now, guys, cash flow equation. Can you just frame this for me? What is my cash flow equation? Yes, come on. Rupees 100.8 should be equal to every year I am going to receive how much? I'm going to pay how much? 7. So can I say rupees 7 into very good. Present value, interest factor, annuity of how much percentage? That we need to compute. What 10%? That only needs to be computed. Right? Write down of KD percent. For how many years? For 10 years. Am I right, guys? For 10 years. Plus, at the end, I need to pay rupees 100 into present value interest factor of KD percentage for how many years? 10 years. Is that clear, guys? Now, KD means the rate that equates my present value of cash inflow with my present value of cash outflow. Is that clear, guys? Are you all able to understand this? This is how you need to do it. Is that clear, guys? Is that clear? Now, let's do this sum. Let's do this. Write down. Write down. Calculation of NPV at 2 trials. Now can we go and do the trials? What are the trials? Within bracket, write down. First trial we will take 5% and the next trial we will take is 7%. Assume this is given in the exam. Guys, assume this is given in exam. Is that clear? Right? That's why I'm doing here. I am not giving it. I've not given it. But assume this is given in exam. Generally, they will give it in exam. Don't worry. Right? Now, write down. Write down. Easy to do this. Here. Cash flow. Then write down. One second. Write down. Discount factor at the rate of 5%. Write down discount factor at the rate of 5%. Present value cash flow at 5%. Is that clear, guys? Next, come on, you tell me. Discount factor at the rate of 7%. Then PVCF at the rate of 7%. Is that clear? Is that clear? Any problem? Any issues? Guys, now what we need to do, NPV is nothing but the total that you get here and the total that you get here. Am I right? With this, you need to do interpolation. Am I right, guys? Now, let's do this first. Year 0. Now, 1 second. What I will do here, year 1 to 10, I can put no. Why? Annual cash flows are equal. So, in this case, what will I do here? I will just write the annuity factor. Guys, correct? You can play it smart, no? Right? 1, 2, 3, for every year, you just keep on doing it. Now you can merge it. It's a very small table. That's why if you see, I put a very small table. You guys were wondering, why I put a small table? Okay, this is the wonder, right? The reason for the wonder is this. And one more 10 you should give. Why? The last year redemption value, there we take only the present value factor. Now you guys are understanding. You can do it like this in exam. It saves a lot of time. Guys, are you all able to understand this? Right? Smart way of doing it. Clear with this? Shall we do it now? Now, year 1, what is the cash flow? Now, positive, negative. Negative. Positive. I receive it. Here I'm talking from the perspective of company. Inflows are followed by series of outflows. Am I right, guys? Are you all able to understand? If you put this as negative and that as positive, still you'll get the same answer. Guys, but still, my opinion, you please do it like this. Is that clear? So, 100.8. Now, annual cash flow, how much is it? Look at this. 7. And year end, redemption value, how much is that? 100. Put it here. 100. Now, year 1, discount factor, how much is it? Year 0 is 1. 1 to 10 years, how do you do it? 1 divided by 1.05 is equal to M plus, like that 10 times you do. How much you get? 7.7217, rounded off to 7.722. Is that clear? Last year, how much you got? 0.614. Is that clear? Now marry the figures. It's going to be what? 1 second, guys. I'm so sorry. All these should be negative. Am I right? These are outflows. Correct? Guys? Correct? No. Write down. This is going to be what? 100.8. 7 into 7.722 gives you how much? 54.05. 54.05. 054 ideally. Then you get 61.4. Yes, that's all. These two are negative, guys. These two are negatives. So you put it up, how much you get? 4.05 plus 61.4. Get 115. Now 15.45. Sorry, 14. 14.65. 14.65 in negative. Right? This is in negative. Are you all able to understand? Are you all able to understand? Any issues? Any problem here? Now let's go on to do this discount factor at the rate of 7%. Year 0, 1. 1 to 10, I will tell you it is 7.024. You did oh, very good. Right? Last year, 10th year, how much was that? 0.508. Generally, these figures will be given. But I want you guys to be independent. At times, suppose they have not given, what will you do? You should know how to do it. That's why I'm telling you. Is that clear? So now marry the figures. Year 1 is going to be what? 100.8. Now here you get 7 into 7.024 within bracket. How much you get? 49.17. Then 100 into 0.508. It's going to be 50.8. 50.80. How much you get? 0.83. 0.83 positive figure. Is everyone able to understand? Is everyone able to understand? The first trial was 5%. Correct? Now at 5% you get negative. Now what I need to do? Now I want my NPV to be 0. Now how will my NPV equal to 0? Now here inflows are in. Inflow is in positive. Outflows are in negative. Guys, correct? Now for me to increase my NPV, what should I do? I should try to reduce my present value of cash outflow. When you will be able to reduce your present value of cash outflow? By increasing the denominator discount rate. Hence, the next trial I took was 7%. Is that clear, guys? It depends on whether you are discounting the inflows or outflows. If you are doing the inflows, then it will be complete. If you're doing the inflows, it will be completely different. Are you all able to understand? Guys, clear with this? Right. This is what it is. Now, what will you do? Interpolation. You can also use that formula, or logical also you can do. Formula is what? Lower rate plus NPV at a lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. That is the formula. Or logical approach also, if you want, you can do that. Absolutely no problem. Shall we do this? So I know that IRR is equal to 5% plus something. Am I right, guys? Guys, correct? It is 5% plus something. It lies between 5 to 7. 5% plus something. Guys, correct? Yes. So now, what should we do? Now, if you want, I'll put it here. So, R and NPV. If R is 5%, NPV is how much? Minus 14.67. If R is 7%, it is positive 0.83. But I want my NPV to be 0. So how much is it? Now simple. For a 2% increase in my rate, my NPV increases by how much? From minus 0.67, it becomes plus how much? 0.83, which means by how much it increases by 0.83 minus of minus 14.67, which means 0.83 plus 14.67 is going to be, it increases by 15.5, no? 14.67 plus 0.83, sorry, 65 either. Sorry guys, my mistake. 14.65. Okay, right. It's going to be how much? 15.48. Guys, correct? But I want my NPV only to increase by how much? 14.65, which means by how much should this increase? Very simple. So IRR is going to be what? Base 5% plus. Now we have seen this. I want my IRR to actually, my NPV to increase by 14.65. However, 15.48 is the change for how much change? 2% change. Is that clear, guys? Are you all able to understand? This is the change for 2%. How much would be the change for 14.65 rupees? Is that clear? Are you all able to understand? So how much is this going to be? 14.65 divided by 15.48 into 2 gives you 1.89%. So it's going to be 6.89% roughly. Is that clear, guys? Is that clear, everyone? Guys, are you all able to understand? Answer is what? 6.89%. Now, if you take 5% and if you take 10% as trial, now what happens? The difference is more, spread is more. Hence, the answer will not match with 6.89. You will get a slightly different answer. Is that clear? So, based on the trials, the answer will be different because we are using something called as interpolation. Are you all able to understand? Any problem? Any issues with this? No. Guys, clear? Now, repeat this for what? Once again, you need to repeat this for KP, right? So, now we got what? KE, KD. Quickly, shall we do for KP also? Write down. Step number 3 here. Step number 3. Calculation of what? KP within bracket YTM method. Are these redeemable or irredeemable? Redeemable only. That's why we have all these issues. Irredeemable means it's very simple. Directly we can do. Okay, guys. So come on, tell me. My KP, once again, first I need what? Net proceeds. How much is my net proceeds? Now please read the question. Market price is 110 rupees. Very good. Then what is my flotation cost? So look at this. What do you have? Guys, come on. What do you have here? Yes, 110 rupees. And flotation cost is what? 2%. Right? So write down here. Net proceeds is equal to 110 minus 2% on 110. The 2% on 110 is how much? 2.2. 110 minus rupees 2.2. That gives you how much? 107.80. Is that clear? Next, annual preference dividend is the outflow. Am I right, guys? What is it going to be? Read the question. How much they have given 5% coupon rate. Ideally speaking, it should be dividend rate. Mistake in the question. It's okay. Don't get too technical. 5% coupon rate. 5% is calculated on what? Face value 100. Which means how much is that? 5 rupees. Any dividend and all? Any interest tax shield? No. It's applicable only on KD. Is that clear? So how did we get this? Rupees 100 into 5%. Then what is my redemption value? Nothing is given, right? It's going to be what? Rupees 100. Are you all able to understand? Now, shall we calculate, guys? Shall we calculate? Yes, write down. Calculation of NPV. Calculation of NPV at 2 trials. What are the trials? I tell you, 3% and 5%. right? Generally, the trials will be given in the question. If not given, I told you what to do also. Now, sir, you asked us to take first 15%. Based on that 10 or 20, you asked us to take. Sir, this is nowhere in the range, sir. Don't worry, it will be given generally. That's why I'm telling you. Don't worry. Institute will not make your life that miserable. See, they are bad. I mean, I'm not saying like that in, if you are bad, I am your dad. Something like that. But they are not evil. Please understand that they will not definitely make your life so miserable and all. So generally, guys, on a jovial note, I am saying, right? So no matter what, ICA is our mother body, right? You should always respect that, no matter what. Yes, there are some issues. All these things are there. We need to, it needs to be rectified. But no matter what, whatever it is, that respect should be given. Coming back here, guys. Now, write on template. Very good. Here, cash flows. Write down. That's why if you recall, I didn't use present value interest factor on the top. I use discount factor. Why? We use both the present value interest factor and annuity factor. Be clear with the wordings. That's why I used the discount factor. Is that clear? At the rate of 3%. Then PVCF, present value cash flow. Then discount factor at the rate 5%. PVCF, right? PVCF. Are we done? Now write down, guys. Here 0, 1 to 10, then 20. Your tables are, yes, it is here 10, and that's about it. Is that clear? Then here you have a total. Here you have a total. Shall we get started? First year, inflow, outflow. Inflow. We're talking from the perspective of the company. Write down 107.80. Followed by every year 5 rupees outflow, 10th year 100 rupees outflow. Is that clear? Are these addable as such? No. Why? Different time intervals. Time value of money concept. Discount factor. Year 0, 1. 1 to 10, I'll give you the factor. It is 8.530. 530. Then last year, anyone got it? Wow, you guys have done it, huh? You did it now. Calculator. Excellent. Very good. Very good. You guys are getting the speed. Very good. Now, that's how you should be. Now, come on. Present value. Marry the figures. 107.80. Then 5 into 8.53. How much you get? Within bracket, 42.65. Okay. Then 100 into 0.74. For this, I will tell you. 74.4. Guys, do your own calculations. Some people have deposited their calculator inside the bag. Right? Anyways, I get the figure. No. What is the problem? Guys, do it, guys. This will be easy now. Exam, you will be finding it extremely difficult. Can you peep into our next person's paper and all? They would have also done wrong. So don't do all those things, guys. Be self-dependent in life. Next one. The discount factor rate of 5% is, anyways, year 0, 1. Anyone done? 1 to 10 years. Oh, total panliya. Ama? Evlo varudhu? Sorry, total panla. What is the total? Negative, Negative 9.25. Okay. Discount factor, year 0 is always 1. 1 to 10, annuity. Excellent. 7.7217 is 722. Round off. 3 decimals is accepted. Then year 10, 0.613 something. 39, then it is 4. 39 means it's more than 0.5. So you take it as round off to the next number. Is that clear? Now present value cash flows. First figure, 107.80. Next, 5 into 7.7222. How much? Within bracket, 38.61. Very good. Then guys, pick your calculator. Your hand should move like anything. Come on. 100 into 0.614. 61.4. Sorry, I should have told this. Okay. So how much is that? Positive 7.79. Is that clear? Now, let's calculate IRR. Write down. Calculation of IRR. Shall we get started? Write down. Calculation of IRR. Interpolation. Now, what is it that you got? Like, guys, R and what? R and the other one. Okay, can we use that formula and check? This one we'll do using formula. You should also get habituated to it. Formula is what? Yes, lower rate plus NRV, NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. Is that clear? Guys, now with the logic, this formula seems easy. Am I right? Guys, yes or no? With the logic, this formula seems easy. So what is my lower rate? 3% plus NPV at lower rate. How much is it? 9.25. Am I right? Okay, you can take this minus 9.25. Okay, 1 second. Yes. So you get minus 9.25 divided by NPV at lower rate minus 9.25 minus 7.79. Not minus of minus. This is positive only, no. Guys, correct? Into what? Higher rate minus lower rate. What is higher rate? 5%. Lower rate? 3%. Is that clear? It's going to be 3%. Now guys, 1 second. This what is the denominator? 9.25, 7.79. Add that to how much you get? 17.04. So there is a negative in the numerator. Denominator is negative 17.04. Am I right? Numerator minus, denominator minus, it gets knocked off. Am I right, guys? So if you want, you can say plus minus of 0.29 divided by minus 17.04 into 2%. Am I right, guys? Is everyone able to understand? So what happens? This minus and this minus gets knocked off. It is going to be 3% plus 9.29 divided by 17.04 into 5. Okay, sorry, ma. 9.25 by 17.04. That is correct, no? Into 2. How much is that? 1.085. 0856. Okay, 0856, whatever it is. It's going to be how much? 4.08% approximately. Guys, correct? This is the final answer. Am I right? Finally, we have done it. Okay, shall we get started now? Shall we get started now? Yes, let's begin. Let's begin. Now, what should we do? WACC. Come on, let's get started. Shall we, guys? Write down. Write down. Part. Now only we are getting to part A of the question. What is part A? Write down. Calculation of WACC within bracket book value weights. Is that clear? Shall we begin? Write down. Write down. Source. Source means what? Source of capital. Correct? Book value within bracket in rupees. Next. Weights. Weights means what? Proportion. Am I right? Then write down K. K means what? Cost. KE, KD, KP, whatever it is. Is that clear? It is expressed in what? Percentage. Am I right, guys? Yes. Then write down WACC within bracket KO. Is that clear? 1 second, 1 second. What will we do? This is going to be within bracket weights into K. Is that clear? The respective cost into respective weight gives me what? The weighted average cost of capital. Are you guys clear with this? Now, what is the first source? Book. Debenture. Write down. 10% debentures. Next source. How much percent preference shares? 5% preference shares. This is just for presentation. Next, equity shares. Guys, correct? Equity share capital. Now, book value, figures. Give me the figures. 5 lakh, then 5 lakh, then 10 lakh. Is that clear? Total it up. How much you get? 20 lakhs. Next, book value. What is the weights? 5 by 20 is 0.25. 5 by 20, once again, 0.25. 10 by 20 is going to be 0.50. Total it up, you should get 1. Correct? Sum of weight should be equal to 1, no? Next one. K, respective cost. Pick the figures. Cost of debt, how much? Don't go in the same order, ma. Cost of debt. Cost of debt is what? 6.89. We did this, no? Now, if you pick the wrong figures, operation success, patient dead. What is the point then? Come on, be careful. 6.89%. Next, preference share capital. Just now we did 4.08. Yes. Equity share capital, 10%. Can I add this? Definitely not. These percentages are for the respective capital. It can't be added. Please don't add this. Right? Multiply with the respective weights and arrive at the figure. Come on, tell me first. 0.25 into 6.89. Figure. 1.7, 725, yeah. 7225, 723. Okay, 723. Next, 0.25 into 4.08 gives you 1.02%. Next, 0.5 into 10%, this I will tell you, 5%. Yes. Now add up. This can be added. How much you get? 7.743%. Is that what you get? Guys, is this what you get? Roughly 1.723 plus 1.02 plus 5. Correct. Then 7.743% you get, no? Exactly. Guys, are you all able to understand? So write down KO within bracket WACC is equal to 7.743%. This is the overall weighted average cost of capital using book value weights. Is everyone able to understand this? Right? A comprehensive question. Are we done with the question? No. The next part 2. This is simple. We need to do it using market value weights. That's about it. Shall we do this? Write down. Part B. Part B. Now what is this? Calculation of weighted average cost of capital within bracket market value weights. Is this clear? Let's get started. Template, you guys now tell me. Source of capital. Now what will you put? Market value within bracket in rupees. Next, very good. Weights. Then next, K, that is cost of capital. Then that is in percentage. Very good. I heard someone saying it. Yes, correct. Next, what is it? WACC, that is KO. What is it? Weight into K. K means cost, respective cost. Is that clear? Sir, why are we not writing KE, KCK? You know, obviously the respective cost will be different, no? Guys, yes. Now, first one, what is it? Now, first source is 10% debenture. Now, once again, leave a line gap next to source. 5% preference share capital. Leave a line gap next to equity share capital. Is that clear? Now, market value, debentures market value. Now, first, how many debentures are there? 5 lakh divided by 100. Remove 2 zeros. You get how much? 50,000. Sorry. 5,000. And every debenture has a market value of 105. Now, here, write down. 5,000 debentures each valued at how much? Rupees 105. How much is that? Very good. 5,25,000. This is the reason why I asked you to leave this line gap. Is that clear? Understanding? Yes. Next, 5% of preference capital, preference shares. How many preference shares are there? Same, 5,000. Every preference share is valued at 110. Write down. 5,000 into 110. Rupees 110. Figure. 5,50,000. Is this clear for everyone? Next, how about equity share capital? How many equity shares are there? So 10 lakh by 10 gives you, remove 1 lakh shares. Every share is valued at 24 rupees. It's 2.4. So 24 rupees, which means 24 lakhs. Write down here. How many shares? 1 lakh shares. Each valued at 24 gives you 24 lakhs. Total it up. How much you get? 34 lakh 75,000 is the overall market value of the company as a whole, right? Now weights, 525 divided by 34 lakh 75,000 gives you how much? Okay, round it off, 0.151. Going to be 0.151. 550,000 divided by 3475. How much is that? 0.158. Okay, then 24 divided by 34.75 gives you 0.691. Make sure if you add, you get 1. There is some round off and all. Please be careful. It has to be 1. Is that clear? Is it coming out? Then come on, tell me the respective cost. Copy paste from here. That will not change. How much was that? Come on, guys. It's going to be 6.89%, 4.08%, and 10%. Can this be added as such? No. Next, marry the figures. Weight into proportions. Come on, tell me. 1.04%, 0.64%, 6.91, 6.91%. Add up, how much you get? 8.59%. Is that clear? Hence, my KO is equal to how much? 8.59%. Are you all able to understand this? Is everyone able to understand? Look at such a comprehensive question. Sir, an exam will take so much time. Don't worry, since you're doing it for the first time, it took so much amount of time in exam. Once you practice, that's why I'm asking you guys to practice, right? Once you practice, you'll get that speed along. First time when you're doing, you can't expect that speed. It's okay. Guys, you're all able to understand? So this sum actually summarizes whatever we have learned till now. We have computed every single source of finance, the cost for every single source of finance. Namely, in this case, we have done KD, KP, KE. In fact, KD and KP we have done using YTM method also, not shortcut, right? In previous sums and all we did shortcut. This full-fledged sum we did YTM, the YTM approach, and then for KE we used Gordon's model and all. Guys, correct? Right? And after that we computed WACC using market value weights as well as using book value weights. Mark this sum as important. Such a full-fledged problem. Please write down. Please write down. Write down. WACC within bracket. WACC or hyphen. WACC hyphen. Book value and market value weights. WACC hyphen. Book value and market value weights. Book value and market value weights. Semicolon. Semicolon. Calculation of KE within bracket Gordon. KE within bracket Gordon's model, bracket close. KE within bracket Gordon's model, bracket close, comma. KD and KP within bracket YTM approach. KD and KP within brackets YTM approach. Is that clear? That's about it. Mark this as important, right? Every single thing is being covered, and this is what the sum says. Is that clear? It's a perfect, it's a perfect recapitulation of the entire chapter that has been done till now. Is this clear for everyone? Is this clear for everyone? Now, 1 second. Now, under this question number 11, I have kept some sub-questions. I've kept some sub-questions. Means what? Questions which are similar to question number 11, but it might have a few, one or two adjustments here and there. How many sums I've kept? 11A. Similarly, 11B. Then 11C. Then 11D. Look, all these summer past exams, MTP, RTP and all is there, right? And then 11E is also there. Is that clear? Now, I want you all to do these sums. Practice it. Please practice it once and let me know if you have any doubts. Is that clear, guys? Now, if there is a commonly asked doubt, then I will do it in the next session. Anyways, I will be discussing the adjustments and all, right? There is no point in doing once again the entire sums. One sum comprehensively we have done, right? Then every sum I will pick and anyways discuss the nature of adjustments, which is unique alone. But guys, I want you all to take this as a homework. Online folks, please take this as a homework before watching the next session. 11 A, B, C, D, E. 5 questions you practice. That's when you will get the practice and command over this subject, right? Just like that auditing, your FM will not work out. Take your pen out on a new notebook, practice homework notebook you take on that, separately start working out, right? And then see, and then start watching the next lecture. In the next lecture, I'll be discussing the unique adjustments for you to appreciate that. No, you need to have solved this question. Only then you will know where you get stuck and all. If you have made a mistake, take a red ink, do the corrections and all. This will definitely enhance your level of understanding. Is that clear? So with this, I am concluding this session. Please revise and practice all the sums we have covered till now. And I will see you all in the next one. Thank you all so much. Bye-bye. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now, let's continue our discussion in this chapter, cost of capital. So in the last session, we did question number 11, a comprehensive question wherein we had to compute the cost of equity, cost of debt, cost of preference, every components of cost we had to compute, and over and above that, we also had to do what? Your weighted average cost of capital, KO, using book value weights and using market value weights. Right, guys? Yes. Now, under this question number 11, I have kept some 5 sub-question, means questions of similar nature. I have grouped it together. Quickly, I will run through this. Ideally, this is something that is meant for your practice, but quickly, I will just go through it just so that you get a confidence of solving it, right? Ideally, I asked you guys to actually do these 5 questions before watching this session. If you have not completed this, pause the video now. Please fully finish these 5 questions and then continue watching the session. Now let's get started quickly. Question number 11A. Now they have given the following details are given: equity share capital, 12% preference, 15% redeemable debentures, 10% convertible debentures. The value is given. Then the cost of equity capital for the company is 16.3%. Means what? For this particular company, directly the KE value is given. Income tax rate is how much? 30%. You are required to calculate the weighted average cost of capital of the company. Now look at this. In this case, no other data is given, which means KE figure is already available. Now preference, redeemable debenture, convertible debenture, all these 3 are assumed to be irredeemable in nature. Life is not given. In that case, what is the formula to calculate? For example, KP, what I pay upon what I receive. That is, from the perspective of the company, preference dividend divided by net proceeds. In the absence of information, take it as what? Face value. Is that clear? Which means preference dividend is what? 12% on 100. 12 divided by 100. Directly it is 12%. Now 15% redeemable debenture. What is it? Interest into 1 minus tax rate divided by what? The net proceeds, which is nothing but 100 in this case. Absence of information, take it as 100. Similarly, convertible debentures. Now sir, convertible debentures you said you will do. Don't worry. That happens. Convertible debenture means what? Debentures which can be converted into equity shares at the time of redemption. Now for that, they should have clearly given at the time of redemption what is the share price of every equity share and all. In this question, nothing has been given. So forget all these things. Name alone is given as convertible debentures. Forget it. So just do it normally. It's going to be 10 into 1 minus tax rate divided by 100. Is that clear, guys? Normally you need to do. That's all it is, which means 10% into 1 minus tax rate, you get 7%, right? Look at this. 7% is this. Here is going to be 15 into 1 minus tax rate. So how much is that? So 15 into 0.7, am I right? So that gives you how much? 10.5%. Look, this is what they have arrived. KP directly 12%. Look, they have arrived at 12%, and KE arrived at 16.3%. Now they have given all the values here. Based on this, arrive at the weights, multiply the respective cost, arrive at the WACC. As simple as that. Is that clear, guys? Nothing great in this question. Look, I've also given a note here. In the above solution, the cost of debentures has been computed without considering the impact of special features like redeemability and convertibility in the absence of requisite information. Now, ideally, in case of convertible debentures, we will be seeing later on. Don't worry, I have excellent lineup of questions which we'll be seeing. Right? So what there we will be seeing in case of convertible debentures and all, if the value of equity share at the end of the life is given and all, what you need to do, we'll be seeing it. Don't worry about that. In this absence of information, this is the best you can do. Is this clear, guys? Are you all able to understand? So clearly, this question is very much directly similar to question number 11. Am I right, guys? In fact, much more easier. Is that clear? So please go to your library of adjustments, write down question number 11A. Please write down. Question number 11A, write down. Similar to question number 11, write down. Similar to question number 11, within bracket, direct. That's all. It was a very, very direct question. Nothing beyond this. Similar to question number 11, within bracket, direct. Shall we move on to the next one? Question number 11B. Guys, this was a past exam question. PEP stands for past exam paper. So September 24 attempt. Now, the capital structure of this company as on 1st of April is given as follows. Equity share capital, 10% debentures, 12% preference shares. So the capital structure has 3 different sources of finance. Additional information. Risk-free rate of return 10%. Beta given. Return on market portfolio RM is given 12%. The equity shares have a current market price of what? Rupees 70 per share. This is what they have given. So with this data, what can you do? Using CAPM method, you calculate what? KE. Am I right, guys? Yes, you calculate KE. So KE is equal to RF plus beta times RM minus RF. With that, you need to do direct. Any problem? No. Next. The debentures are trading at a market price of rupees 80 per debenture, and the debentures are to be redeemed after 5 years at par. Okay, so which means they have given what? The current market price, so that can be taken as the issue price, and redemption is after 5 years, redeemable debentures. Okay, next. Preference shares redeemable after 5 years at a premium of 5%, presently selling at what? 104 rupees. Which means what? The issue current market price is how much? 104. Redemption value is going to be how much? 105. Am I right, guys? So preference is also trading at, face value is what? 100 rupees. Based on this, you can arrive. Redemption value is there. And what? Your net proceeds is also there. Is that clear? The tax rate is given. The cost of debentures are to be calculated on YTM model, which means cash flow. You need to prepare the cash flow equation and do that. The present value factors of 10% and 14% are given, which means the two trials you need to take is what? 10 and 14. Based on these two trials, you need to arrive at what? You get one positive NPV, negative NPV, interpolate. You need to use this for what, guys? IRR for calculating what? KD. Am I right? KP. Nothing given. We can use formula approach. Is that clear, guys? That's about this question. You are required to calculate weighted average cost of capital after tax of T limited using market value weights. Now, for each of these components, equity share capital, what is the market price? 70. Debentures, what is the market price? 80. Preference market price is given as 104. Number of the securities multiplied with the market price, you arrive at the market value of each of the securities. Am I right? To arrive at the total, based on this, arrive at the proportions. Is that clear? The approach, the solution, I'm telling you, past exam question, guys. Past exam question. This would have been at least for about 8 to 10 marks. I don't exactly remember, but easily for 8 to 10 marks, this would have been. Is that clear, guys? Is that clear? Any problem here? Now, this is the smartest way of doing. We did one main question completely. I grouped all the similar questions and I'm proving it to you that, look, this is all it is. This is ideally meant for your practice, but still I am actually, discussing all these things. Is that clear, guys? Everybody? Yes, that's about this particular question. Please go and update your library of adjustments. Write down. WACC, WACC hyphen market value weights. WACC, WACC hyphen market value weights, semicolon, WACC, WACC hyphen market value weights, semicolon, write down, KE within bracket CAPM, KE within bracket CAPM, semicolon, KD within bracket IRR, semicolon, KP within bracket formula or approximation method. Is that clear? KE CAPM, KD IRR, and KP is formula method. Look, this question has all the varieties. Is that clear, guys? Has all the varieties and pretty much a direct question. Any issues, any problem here? That's about this question number 11B. Now, next, let's move on to question number 11C. This was an MTP question. Every attempt you have 2 series of MTP. Now, September 24 attempt, right? MTP number 2. This question was tested. What is it? Now, calculate the WACC using the following data. Using what? Market value weights. Now, look at this. This question has one unique thing. What is it? Now, how many sources of finance are there? Capital structure, 4 sources. What are they? Equity, reserves and surplus, preference, and debentures. They have given the book value. Is that clear? Yes. Now, the market prices of these securities are given as follows. So, debentures, it's given 105. Preference 115. Equity share value is how much? 27 rupees per equity share. Additional information they have given. 100 rupees face value per debenture. Redeemable at a premium of 10%. Coupon rate is what? 10%, 4% flotation cost. Flotation cost is given as just 4%, which means you can take it as a percentage of issue price, or it can be taken as a percentage of face value. Preferably take it as a percentage of issue price. Write a note. No matter what, please write a note always. I told you. So now they have given all these things. Perfect. Then 100 rupees face value per preference share, redeemable at par, 12% coupon, 2% flotation cost, 10-year maturity. So both have what? Finite life. How about equity shares? What method? Look at this. Equity shares have 4.5 rupees flotation cost. Market price is 227, which means net proceeds 27 minus 4.5. Correct? The last dividend paid by the company was 2 rupees, which means this is D0, which is expected to grow at an annual growth rate of 9%, which means growth rate is 9%. Gordon's model we need to use, right? The firm has a practice of paying all the earnings as dividend. The corporate tax is going to be 25%, which means KE is equal to D1 by P0 plus G. How much is D1? D1 will be last year dividend 2 into 1.09. Am I right? Growth rate 9 divided by what is P0? Yes, come on. What is P0? Yes, the market price is given as 27, and here you have 4.5. So 27 minus 4.5. Am I right? Plus, what is G, guys? G is going to be 9%. calculation if you do, you will get KE. Is that clear, guys? That's about it. Now, calculate the overall cost of debt and the preference shares by taking the average of, look at the uniqueness of this question, by taking the average of the respective cost using what? YTM and approximation method. Look how they've asked this question. For what and what? For calculating KD and KP, what you need to do. Now, two methods are there, no? YTM, approximation. Which method they're asking you to do? They're asking you, for example, KD, compute under YTM, then once again compute under shortcut approximation method. Sir, which value should I take? Take a simple average of these two. So this plus this divided by 2. Uniqueness of this question. Is that clear, guys? Sir, why are we taking it like this? Given, so we are taking. That's about it. Is that clear? Now, nothing new here. The only difference is what? Now, compute under both the methods and take a simple average of the two. Is that clear, guys? Is that clear? But for that, I think this question is very, very normal. Am I right, guys? Is that clear? Any issues, any problem? Right? That's about this particular question. But remember, one more thing, very important in this question. KR needs to be computed. Guys, correct? For the purpose of computing KR, KR is equal to KE. Now, don't take KE. Now, what should you do? Here, for the purpose of computing KR, flotation cost should not be considered. Is that clear, guys? So, you have that in your mind? You guys did that? Very good. You guys did that? For the purpose, I'm asking, yes, you've done it. Very good, very good. So, for the purpose of computing KR, flotation cost should not come into picture. Guys, correct? That alone you need to take care. So, don't say KR is equal to KE and directly do it. I told you, KR is equal to KE. Two exceptions. Exception number 1, when you have flotation costs, that should be ignored. And exception number 2, when personal income tax brokerage are given, that should also be considered for the purpose of computing KR calculation. Is that clear? But for that, everything is same in this question. Is that clear, guys? Is that clear? Any issues, any problem here? No. That's about this question. Please go to your library of adjustments. Just update. Write down. Similar to question number 11, semicolon. Similar to question 11, semicolon. Similar to question number 11, semicolon. KD and KP. KD and KP. KD and KP within bracket write down average of YTM and approximation method. Average of YTM and approximation method. That is the new learning here. Learning as in nothing new as such, but just that you should know this is another way of testing in your exam. Is that clear, everybody? Guys, are you all clear with this? So, KD and KP within bracket average of YTM and approximation method. Semicolon, semicolon, semicolon. One more extra thing was KR. Write down. Just write down. Semicolon KR. Why? KR was not there in question number 11. Nothing new. We have already done it separately, but this was there in this question. That's about it. Right, guys? Any issues, any problem here? Everybody clear with this? That's about your question number 11C. Now, let's move on to question number 11D. Is there anything new here? Let me see. So, this company has the following capital structure at book value. Now, equity share capital. They have given preference, debentures and all. Equity shares currently traded at 100. The company expects to pay a dividend of 5 rupees next year, which means this 5 is what? D1. Am I right? With dividends projected to grow perpetually at the rate of 5%, which means this is G. Corporate tax is given 35%. Calculate WACC based on the current capital structure. Okay, that's all. That's all is given. Okay, fine. That's the first part of the question. So now KE you can calculate using Gordon's model. Now, with respect to preference, have they given the life? No, assume perpetual. Perpetual preference shares. What is the formula? What I pay by what I receive. Preference dividend divided by net proceeds. It's going to be 12 divided by net proceeds. Absence of information considered to be 100. Similarly, irredeemable debentures. Life not given, right? So, assume irredeemable. Formula. Interest amount into 1 minus tax rate divided by net proceeds. So, it's going to be 10 rupees into 1 minus 0.35. Divided by 100. That's about it. KE, KP, KD, you get it? Use these weights and arrive at what? So using what? That's about it they have given. So using these weights, you arrive at the weighted average cost of capital. Is that clear? Guys, is everyone able to understand? Is there anything new here? In fact, it's very simple. Next. Now look at this. Recalculate the weighted average cost of capital if what happens? The company raises additional 5 lakh rupees of debt by issuing what? 12% debenture. What is this? Currently, this is the capital structure. Correct? Totally, how much amount they have raised? 40 lakhs. Now they are saying over and above the current capital structure, the company is going to raise 5 lakhs by issuing a new security called what? 12% debenture. Now they have only 10%. Now they have another fourth source of finance called 12% debenture. Is that clear? Now, because of this, what will happen? An increase in the expected equity dividend to rupees 7 per share, while the growth rate remains at 5%. However, a decrease in the market price of equity shares will happen. What will happen? 90 rupees. What they are saying, now if the company raises additional 5 lakh rupees from a new source called 12% debentures, now two changes. Change number one, new source of finance comes in, right? So you need to calculate the KD for this 12% debenture. How will you do that? Life given? No, which means assume it to be perpetual. Formula, interest into 1 minus tax rate divided by net proceeds. It's going to be 12 into 1 minus 0.35 divided by net proceeds of 100. Is that clear? Guys, correct? Now, what happens? The KE, old KE you can't use. Why? The components are changing. Because of this, KE will also change. The new expected dividend is going to be 7. D1 is 7. Growth rate continues to be 5. Market price P0 becomes 90 rupees. Based on this, once again recalculate KE. So new KE, KP and 10% debentures KD will remain the same. New 12% debenture will also come in. Now 4 source of finance with 4 different proportions you need to use. Based on that, calculate the new cost of capital. Is that clear, guys? Anything different here? Very, very simple and straightforward. In fact, that's about this question. Is this clear? Are you guys understanding the approach? You want me to do this fully? Guys, I've considered this as a waste of time to do repetitive question. Now, if you notice, ideally, I told you we have finished the entire chapter except for something called as marginal cost of capital alone. But if you still notice, I have kept totally, we have done, as of now, 11 sums we have done, no? Overall, there are 26 sums, 15 more sums we have. Sir, what, sir? Why so many questions? Varieties of sums we will be solving. Right? That's why these are all elementary. That's why I kept it under question number 11. Now just imagine the day before your exam, if you want to revise, it will be very easy for you to do this. Right? That's the reason I did grouping across all your publications. MTP, RTP, past exam, study material, everything I combined and put it neatly in a sequential order so that when you are doing one variety of sums, all the similar varieties, you can do it together. It's easy for you to revise. Is that clear, guys? Now please go and update your library of adjustments. That's about this question number 11D. Write down, please. Write down. Quickly write down. Write down. Similar to question 11, semicolon. Now what is the change? That alone we will write down. Similar to question number 11. Base is similar to question number 11, semicolon. Calculation of new KD and new KE. Calculation of new KE, new KD and new WACC. This is what we need to compute, no? Calculation of new KE, new KD and new WACC. When new debentures are issued. When new debentures are issued. Write down. When new debentures are issued. That's about this particular question. Are we done here? Are we done here? Clear? Any issues? No. Next. Question number 11E. A past RTP question. Now, capital structure of this company is given 12% debenture, 14% preference, equity, 3 sources of finance. Additional information. Rupees 100 per debenture. Okay, first information on debentures. Redeemable at a premium of 6%, which means, so redemption value is equal to how much? 106. Next, flotation cost 5%, 5 years maturity. Current market price is how much? 115, which means net proceeds will be how much? 115 minus flotation cost 5% on 115, or you can take 5% on 100 as the case may be, because they have just given flotation cost is 5%. That's all. On what? Not given. I told you can take an assumption. Is that clear? So nothing given, you take it whatever you want. My suggestion, the correct way is what? On issue price, because on issue price only you incur the cost. Is that clear? Fine. Next. So life, finite life. Have they given any specific method? No. Can we use shortcut? Yes. Next one. Preference. Face value 100. Redeemable at a premium of 10%, which means redemption value, everybody, 110 issued at discount of 2% with a flotation cost of 5% on the issue price, which means the net proceeds is going to be how much? Discount of 2% means 98 minus 5% on 98. Is that clear? You can do the calculations and see. Is that clear? This is going to be the net proceeds. The current market price per preference share is going to be how much? Okay, right. Okay, now I get this. One second. That's what I was about to tell you. Okay, fine. Now, the current market price per preference share is 108 and it has a maturity of 10 years. Now, guys, please mark this component alone as important. Now, look at this. I just read till this and gave you something, right? No, it should be read fully. It should be read fully. Generally, guys, come on. Please focus here. Such a very important. This is new. Now there's a way of reading question. This is where in finance, slightly certain things you need to experience it, only then you will understand the impact. What is it? Now, guys, full on focus. This is one common doubt which many students have asked me in, till now. Many students have asked this before. I want to clarify, right? They thought MTP, I think MTP or RTP. RTP they thought was, done. They have done a mistake in the RTP. No, guys, let me be very clear. Now, look at this. What is the face value of preference shares? 100. Redeemable at premium of 10%. Forget this, no problem. Issued at a discount of 2% with a flotation cost of 5% on issue price. Now, suppose this was not given. What will you do? Sir, face value is 100. Discount 2% on 100 means. So now I will issue at 98. Am I right? In this question, they have given issued at discount is given. Along with that, the current market price is also given as how much? 108. Now, logically you think, recall, I have told you, this is where I give you the practical insights. In the market, if I go, I can raise this money at 108. Am I right? Or in other words, in the market, if I go and issue, I will be in a position to get how much? 108 rupees for every preference share. In this case, why will the company issue at 98 rupees? Are you all able to understand? Right? No. In this case, what it means is, in the market, it is currently quoting at how much? 108. Now, the company is planning to issue it at a discount of 2%. Means what? The discount of 2% should be applied on the market price. Or in other words, in the market means secondary market. It is going to be issued at how much? I mean, it is quoting at how much? 108. Now, for those people who are subscribing in the primary market, now the company is wanting to raise funds. Am I right? So in the primary market, they are saying, don't worry. As compared to the secondary market, I will issue it at a discount of 2%. Is that clear? So when the market price is given and the discount is also given, remember the discount should be applied on the market price. Is that clear, guys? This is one new variant of adjustment. Is that clear for everyone? Do not forget this. Had they not given this sentence, they would have applied the discount on face value. Since they have given the market value as market price as well as the discount, it should be applied only on what? Your market price. So on the market price, you discount it and apply the discount and say, okay, fine. As compared to the secondary market, I'm going to issue it at what? I will issue it at a 2% discount. Guys, clear with this? So what will many people will come and subscribe? No. Why? Now they will buy it from the primary market, sell it in the secondary market. Readily they can make a 2% profit. Is that clear, guys? Are you all able to understand? Now, at when it is quoting at 108, no idiot company will actually, issue it at 98 rupees. It's a loss for the company, no? Guys, correct? For every preference share, they know that the one share is worth 108. So why will they issue it at 98 rupees? Maximum they will issue it at a discount on the market price. Is that clear, guys? Are you understanding the logic here? Is that clear? Is that what they have done? Look at this. Issue price is, look at this. Please mark this as important. Today you might not know its importance. Later on when you are revising, you will get it. It is 108 minus 2% on 108. Is that clear? So when both the current market price and discount rate is given, the discount should be applied on the current market price. Is that clear, guys? Everyone? Right? And I think that's about the major part of the question. Now, next one, equity share has a flotation cost of 5 rupees. Market price per share is currently quoted at 30. This company's last paid dividend is how much? 4 rupees. And the company is expected to give an annual growth rate of 9%. Gordon's model. And they have a practice of paying all the earnings in form of dividends. No problem. So in this case, what happens? D0. Am I right? D0. Growth rate is how much? 9%. G. What's going to be my D1 by D1 is going to be, yes, 4 into 1.09. Guys, correct? Divided by P0. How much is P0? 30 minus 5. Am I right, guys? plus G. What is my growth rate? 9%. This is going to be a KE. Guys, correct? Is that what they've also done? Yes, 30 minus 5 and everything. Is that clear, guys? That's what you do. And based on market value weights, so number of securities issued into the current market price, arrive at the market value. Based on that, arrive at the proportions and arrive at the figures. Is that clear, guys? Right? Now, the most unique thing in this particular segment is regarding what? Regarding your preference shares, whether it is preference debentures or equity, doesn't matter. When the current market price as well as discount is given, the discount should be applied on the current market price to arrive at the issue price. Is that clear, guys? Please go and update your library of adjustment. Write down similar to question number 11 semicolon, similar to question number 11 semicolon, similar to question number 11 semicolon. Write down similar to question number 11 semicolon. Write down issue price is equal to CMP minus discount on CMP. Write down issue price is equal to CMP minus discount on CMP. Okay, write it in a red ink. If you have already written it, take a red ink and put a box. Why? This is something many students miss out. Just imagine an exam. You have missed this. What happens? KD, you would have got it right. KE, you would have got it right. Only for that, they will give you marks. KP, wrong. Because this is wrong, KO will also go wrong. Out of an 8-mark question, you will not get more than 2 or 3 marks. Right? This is called as chain error. If you make an error at the beginning, that will have an impact on the subsequent steps. From that point onwards, the entire question will be actually striked off. Is that clear? That's why I'm giving you guys in a red ink and all. Now, just imagine in a span of half an hour, we took these 5 questions, analyzed, and we just beautifully took these important learnings alone, and we have recorded that in our notebook, library of adjustment. That's about it, guys. Clear with this? This is as good as doing 6 different sums, right? Main question number 11, which we did elaborately, and 5 similar questions with different wordings and all. We have seen it. Is that clear, guys? All these are past exam, RTP, MTP, some study material question, everything put together. Just look at this, guys. You are able to solve it. That's the power of conceptual learning. Now you understand cutting. If you give me 6 hours to chop down a tree, spend the first 4 in sharpening the axe, right? That's the reason I'm telling you the power of conceptual learning can take you heights. Any kind of question you will be able to do in a very, very quick manner. Now you have updated your library of adjustments, right? And that's about this question number 11E. Now let's move on to the next sum, shall we, guys? Now let's go on to question number 12. Shall we get started? Yes. Now, mark this sum as important. An excellent sum, a very, very good sum, a very good sum. A very good sum, guys. In my opinion, I would rate this as one of the best sums. So this is something that when I looked at it for the first time, I was very happy with the way in which it was kind. I will tell you why and all. Shall we get started? Okay. This sum has 2 or 3, yes, 3 catches. This sum has 3 catches in it, right? Catches means this sum has 3 different, hidden adjustments in it. Now, we are not going to learn anything new. The same WACC only, but an excellent sum. That's the reason now I told you. Literally, we have finished the chapter conceptually. Look at the variety of sums we'll be solving, right? Shall we begin? Yes, let's get into this beautiful question. Number 12. Guys, RTP. I didn't take it from anywhere else. RTP, right? Good, excellent sums. A rich variety of sums will be solving. Now, shall we begin? Guys, read this question carefully. Now, guys, now, I want you all to be extremely sincere when you read this question. I told you, the way a batsman hits a shot depends on the way he reads the ball, right? The way it releases from the bowler's finger, right? The way you read it determines the quality in which you're going to answer it. Now, guys, assume you are sitting in the exam hall and this question is appearing before you. Now, I want you all to bring that survival instinct within you. Let us say you don't know how to swim, but I am dropping you in the middle of the ocean. What will you do? You will give up and say, fine, I will die, or you will do something to grasp for your breath. You will do something to grasp for your breath. That is called survival instinct. Bring that survival instinct right now. And one more thing, guys. Between one attempt and next attempt, you have 4 months. Correct? Now, 4 months of delay is equal to 4 months of delay in qualification. Correct? Now, the moment you are qualified, at that point of time, adjusting for time value of money. So, 1 month salary, let us say, is 1 lakh rupees. Now, 4 month salary is equal to, simple calculation, 4 lakh rupees. So, which means if you are missing one attempt, the cost, opportunity cost is how much? Guys, 4 lakh. For that, every single paper you need to do it properly. And a paper consists of multiple sums. Every sum need to be solved properly. And solving a sum properly depends on the quality in which you read it. So now, the quality in which you read this question will save you 4 lakh rupees in your life per attempt. Right? Now guys, I'm not kidding. This is the way a chartered accountant should look at, things in life. Right? We should have this monetary perspective also. I'm not kidding. Now, there are so many people, so many students whose life has changed because of this qualification. Just imagine the people who are dependent on you, your parents and all. The moment you qualify, it's something else. You yourself will get that kind of confidence. For that, right now, when you're doing your work, bring that survival instinct. Every single sum that you're doing, tell yourself, I am doing this for my own benefit. Right? Trust me, you will thank yourself for a lifetime. Shall we get started? Let's do this. Now, determine the cost of capital of Best Luck Limited using book value weights and market value weights. Sir, this is similar to question number 11 only, no? Let's read the question. Yes, the base is similar. From the following information. What is that? Number 1. What are the sources? Equity, retained earnings, preference shares, debentures. How many sources of finance? 4 sources of finance. Book value is given. Every source of finance, book value is given. Is that clear? Market value is also given. Equity shares value is 2 crores. Retained earnings not given. Preference given. Debentures given. Wait 1 second. First, let me clarify one thing. What is the very apparent thing here? Something apparent here? Sir, for retained earnings, there is no market value. Why, sir? Can anyone tell me why? We are not issuing, that is okay. Okay. Now guys, simple. The market value of equity, 2 crore rupees, means what? The market value of equity shares, guys, correct? Now, when I say market value of equity, it means what? It generally refers to whatever belongs to the equity shareholders. Am I right? Or in other words, this 2 crore rupees is nothing but the market value of whatever belongs to the equity shareholders. Are you all able to understand? So when I say market value of equity, it refers to market value of equity share capital plus market value of retained earnings, because at the end of the day, both these sources of finance belong to whom? The equity shareholders only. Are you guys able to understand? So in the share, in the market, equity shares will only get traded. Retained earnings, how will you trade? You want me to buy retained earnings. How can you do that? So the retained earnings, the value of that is already factored into your equity shares quoted in the market. Are you all able to understand? Is that clear? Is that clear for everyone? Now, sir, in this case, how should I do it? Suppose if I have to calculate the KO as per market value weights. Now, sir, in this case, the retained earnings market value is 0, sir. Now, how can you do it? Now, let me tell you, there are 2 ways in which you can do it. Number 1, approach number 1, take the value of retained earnings as 0. So we compute KE, KR, KP, KD. Guys, correct? Multiply with the respective weights. Am I right, guys? The total, you get total market value. So this by this, this by this, this by this, you get the proportions. Am I right, guys? Now, in this case, the weight of retained earnings, you take it as 0 itself. No problem. This is one way of doing the question. Is that clear? Another way of doing the question is what? Now, I told you, this 2 crore rupees is the market value pertaining to equity share capital as well as pertaining to retained earnings. Now, what you need to do, simple, 2 crore apportionate between equity shares and retained earnings. Using what proportion? Using the proportion of their book value. Is that clear? Which means, so 1.2 crores plus 30 lakhs gives you 1.5 crores. Am I right? Or 150 lakhs. This 2 crores into 120 lakhs divided by 150 lakhs will be the market value of equity share capital. 2 crores into 30 lakhs divided by 150 lakhs will be the market value of what? retained earnings. Is that clear? This is another way of doing it. So component wise arrive at the market value, then do the proportions and you can arrive at it. Is that clear, guys? Is everyone able to understand? Is everyone able to understand? So when you have retained earnings, always remember market value of retained earnings is not done separately. It is included in what? The market value of equity shares. Now in that case, what should you do? Two ways of doing it. Number one, take the weight of retained earnings as 0. Right? Entirely take it only as equity share capital and do it. Or number two, apportion the market value of equity shares into what? Between market value of equity between the equity share capital and the retained earnings in the book value proportion, and you apportion and do it. Is that clear? Is everyone able to understand? Now, one small thing can I ask you? Between the two approaches, if I follow, will the answer change or not? Will the answer change or not? Will the answer change or not? No, yes. The answer is yes and no. Yes and no. I am telling you the answer. Yes and no. Sir, what is this yes and no? When KR is equal to KE, whichever method you do, the answer will not change. Proportion overall is same only. But when KR and KE are different, when can they be different? Two reasons. Number one, flotation cost. Number two, brokerage and personal income tax rate. In this case, then depending on the method, the answer will change. Is that clear, guys? Are you all able to understand this? Guys, is that clear, everyone? Is that clear, everyone? Clear with this? Now, sir, which method should we follow? I will tell you my opinion. When KR is equal to KE, you follow anything you want. Right? You can even retain this. No need to distribute. You can also do it anyways. When KR and KE are different, better to apportion and do it. Is that clear, guys? Because the answer will change. So we will get the market value of retained earnings, market value of equity share capital and do it. Is that clear? This is my suggestion. As institute given something like this, answer is no. Is that clear, everybody? Right? You do it in whichever way you want, but remember, whatever method you do, please write a note. FM is an open-ended subject, right? There are multiple interpretations possible, multiple answers possible. Please write a note stating your assumption. Is that clear? Is that clear? Did you guys understand the basic issue of this question? This is very, very basic. One issue only we have solved. I told you there are 3 issues in this question. Here, first, done. Perfect. Shall we move on to the next one? Additional information. Now, why have they given additional information? To calculate the cost of respective components, equity, retained earnings, preference, debentures and all. Shall we do this? Perfect. First, equity shares are quoted at how much? 130 rupees per share. And a new issue is priced at what? 125 rupees per share. It will be fully subscribed. The flotation cost will be how much? 5 rupees per share given. Is that clear? Yes. Next. Now, the dividend. During the previous 5 years, dividends have steadily increased from 10.6 to 14.19 per share. The dividend at the end of the current year is expected to be how much? 15 rupees per share. Okay. So, which method should you use? Gordon's model, huh? Gordon's model. Yes or no? Yes. Gordon's model, then what is the growth rate? We have to find out. How will you find out? IRR. Huh? No. I'll tell you. You are right. We need to use Gordon's model. For Gordon's model, what do we need? D1 by P0 plus G. Am I right? Perfect. In this case, what have they given? Dividend at the end of current year is given 15. P0 is there. Into 1 plus D, if I do, I'll get D1. No problem. Right? P0. Based on this figures, you will get P0. G not available. Or in other words, if you get G alone in this question, you can do this under Gordon's model. Is G given? No. But they have given us a hint to find out G. What is it? During the past 5 years, what has happened? Dividends have steadily increased from 10.60 to 14.19 per share. Means what? In a span of 5 years, dividend has grown from 10.6 to 14.19. They have given you the past trend of dividend. With this, you can find out what? You can find out the growth rate. Is that clear? How, sir? Look, 5 years ago, the dividend was how much? 10.6. In a span of 5 years, steadily every year there was a growth rate. It became how much? 14.19. Or in other words, can I say, this is a future value, this is a present value, or in other words, can I say, 14.19 is equal to 10.60 into 1 plus G to the power 5. Right? It's a compound interest. 10.6 rupees, when grown for 5 years, became 14.9. So 14.9 right? This is like an FD calculation, guys. At the end of 5 years, the value was how much? 14.9 is equal to beginning value into 1 plus R the whole power n, or 1 plus G the whole power n. If you calculate this, you'll get G value. Are you all able to understand? How to calculate that we will see. Is that clear? Is everybody able to understand? Are you able to understand this? Is that clear? Now, ideally speaking, 10.6 is ideally what? This happened 5 years ago. Is that clear? This is ideally happening at when t minus 5. And this 14.9 happened when t 0. Or in other words, the time gap between these two periods is only 5 years. Is that clear? Based on this, what can I find out? I can only find out G. Is that clear? But for that, this 10.6 has no relevance at all. Are you all able to understand? We will do it. Don't worry. Is that clear? I'm giving you guys the approach to the sum. Is that clear? Based on this, arrive at G. Once you arrive at G, next year, D1, how will you calculate? This is D0, 14.919. Correct? Sorry, guys. Oh, it's given now. Sorry, guys. D1 is given. Sorry. My bad. So D1 is given. So 15 rupees. So 15 is given. Divided by P0, you will arrive at it. Plus G, whatever you arrive at the G figure, you will arrive at it. Is that clear? You will plug it here. Is that clear? I am so sorry. Here, 15 is D1 given. Or in other words, once again, let me be very clear. 10.60 and 14.19 are nowhere relevant for calculating K. These two figures are relevant only for the purpose of computing G. Is that clear? Right? In a span of 5 years, 10.6 rupees has grown on to become 14.19. What is the growth rate? To identify the growth rate, they have given a trend. Is that clear? Are you all able to understand? Perfect. That is the second catch of this question. First catch was with respect to the market value of equity. The second catch is with respect to your growth rate calculation of G. Is that clear? Next, preference shares, 15% each. Preference shares, face value 100. Realize 105 per share. Simple. Directly you can do that, right? Is life given? Life is not given. Irredeemable only, no? Guys, yes. So the formula is going to be what I receive by what I pay. 15% preference dividend divided by net proceeds 105. Right, that's about it. Next one. Debentures. The company proposes to issue a 11-year 15% debenture. Wait. 11-year means finite or infinite? Redeemable, irredeemable? Redeemable. 11-year period is given. 15% debentures, which means 15% is what? Coupon rate, interest rate. Very good. But the yield on debentures of similar maturity and risk class is 16%. Rotation cost is 2%. What will you do with this? What is this? What is this? Any guess? Saving ilama. The yield on debentures is how much? 16%. Means? Whatever you are thinking, you tell it loud only, then I will understand. YTM means what? They themselves have computed the KD and given. From the viewpoint of investors, if they invest in similar bond, they will receive 16%. Excellent. That is correct. That is correct. Now, with this, what can I do? Is what is the third catch of this question, right? If I tell only, then you will understand, right? Many students actually struggle in this area, right? That is what is the third catch of this question. This is the reason I say it's an excellent question. Watch out for these kind of questions, right? Now, once you learn this conceptually and you do it, any kind of similar questions you'll be able to handle. Is that clear? That's the reason I'm doing it right now in the classroom. Guys, now with this, now this 16% means what? An investor, a debenture holder, investor investing in debenture in a similar company's debenture expects a return of how much? 16%. With this, what can I find out? Which means that itself is my cost, no, sir? No, I have some rotation cost adjustment, but it's not that simple. I will tell you what it is. Is that clear? That is the third adjustment in this question. That's about it. Corporate tax is 35%. Ignore dividend tax and all. Fine. Okay, leave that. That's not there now. Rotation cost would be calculated on base value. Excellent. In this question, they themselves have clearly given it. Now, guys, that's why I'm telling you, read the question fully. Now, some students, just like that, they read it. And then they'll say, assumption I've written in exam, sir. Assume to be calculated on issue price. What assumption? They have clearly given it should be calculated on face value. Is that clear? Now, what I will do, guys, now I will give you guys 2 minutes time. Online folks, pause the video now. First, read the question carefully. Digest the facts properly. Now, if you want, take a pen or a pencil, whatever it is, read the question. Whatever areas you feel you are prone to commit a mistake, circle it or underline whatever it is and keep. When we are solving, I will ask you guys for the respective figures. I want you all to just keep throwing the answers to me like a bullet. Will you guys do it? Right? Online folks also, please do it. If I'm asking you something, assume I'm standing in front of you and asking and teaching. So please answer back to the screen. It's okay. In life, you will get only if you give. So give the answers first. It stays with you for a lifetime. Right? So pause the video now. Take 2 minutes and then continue watching the lectures. Okay, guys. So now let's get started with this question number 12. Shall we begin? Yes. So now first we need to calculate what? KE. For the purpose of computing KE, what do we need to do? We need to compute the growth rate. Am I right? So please write down. This is question number 12. Write down. Question number 12. See, I'm treading slowly at the initial level because you are new to the subject. You need to get used to it. Once you are done, once you're getting used to this, automatically, we will all increase a little bit of pace and you will automatically understand. This is the best strategy, the way to learn the subject. Now, write down step 1. Calculation of KE within bracket. What method? Gordon's model. Right? Gordon's model. Now, for that, the first thing I need to do is what? Calculation of G. Under that, come down and write working note hyphen calculation of G. G stands for growth rate. Now, what have they given? Please read the question. Please read the question. During the previous 5 years, the dividends have steadily increased from 10.6 to 14.19 per share. Now, this is what they have given. Forget the other part, right? Which means, guys, can I say, now, during the last 5 years, am I right? So, which means T minus 5. This is T minus 5. And this is T0, which means in a time span of 5 years, what has happened to the dividend? So, at T minus 5 years ago, the dividend was how much? 10.60 per share. And slowly, in a span of 5 years, what it has happened? It has grown on to become 14.19 per share. Or in other words, T minus 5, T0, you leave all that. In a span of 5 years, a 10.6 rupee dividend has grown on to become how much? 14.19 rupees worth of dividend. Guys, correct? Or in other words, can I put this in equation format and can I say 10.60? One second. Yes, 10.60. This. So let's say you are opening an FD. The amount invested was how much? 10.6. In a span of 5 years, it has become how much? 14.19. So can I say 10.60, the amount I invested today, into 1 plus G, the whole power. In how many years it has compounded? In a period of 5 years, it is compounded. So to the power 5 is equal to, what is the future value? 14.19. Now, sir, you are saying this is future value, but sir, this is T0. No, I'm talking about the time gap. Today, if I invest, or 5 years back, I invested, in a span of 5 years, from the time of investment, it becomes how much? 14.19. That is the meaning. Is that clear? Don't say that T0, sir, then how is this future value and all? From the time of investment, if you keep that investment for 5 years, it grows to become 14.19 in a span of 5 years. Is that clear? Is the logic clear? Are you all able to understand? We are bothered about the time gap. Is that clear, guys? Right? Now, this equation, are you all understanding? Simple compound interest. Is that clear? Now, can I say 1 plus G, the whole power 5 is equal to 14 by 14.19 divided by 10.16. Am I right? This goes on to the denominator. Guys, please answer. Divided by 10.16, or 1 plus G, the whole power 5 is equal to 14.19 divided by 10.16. How much is that? 10.60. Sorry, 10.60. So 14.19 divided by 10.6 gives you 1.3386, okay, roughly about 1.3386 or 1.3387, round it off, whatever it is. Is that clear, guys? Now you tell me, how will you calculate the value? How will you calculate the G value? Are you getting it? Are you getting it? How will you do it? Now, there are two ways of doing it, or in fact, three ways of doing it. One, future value table, you can look at it, right? Now, future value table, go to your appendix. Go to your appendix. You should know which table to look at. Future value interest factor. Now, sir, what should we do, sir? Simple. Now, R, or the rate, we are yet to find out, right? Now, 5 years, in a period of 5 years, 1 rupee becomes how much? 1.3386. Guys, correct? Now, what you need to do, go to this 5-year column, see where you get this figure. Where do you get this figure? At 6%. Exactly, you get it? Which means 1 rupee compounded for 5 years at the rate of 6% per annum becomes 1.3389. Hence, from the future value table, I can say that the R, or growth rate, is equal to 6%. Is that clear? Sir, in exam, sir, they will give you 5%, 6%, 7%, like 3 tables they will give you. You should pick the right figure, and that's about it. Is that clear, guys? Are you all able to understand? If exactly a table is not given, the value, suppose the answer that you get here, instead of 1.3386, let us say it is 1.37 something, 1.37, which means 6%, 7%. Between this, it is there. Do interpolation and find out. Is that clear? Is everyone able to understand? Any issues here? No. This is one way of arriving. Write down from future value interest factor table, comma, G is equal to 6%. Are you all able to understand? Any problem? Any issues here? Any problem? Any issues here? Guys, clear with this? Fine, done. That's about it. Now we can do the sum. Yes. No. 1 second. Quickly, I will tell you. This is the first method of doing. Another way of doing it is using something called as log. You guys have studied log in your foundations there, no? Log. Take log on both sides. You'll get something. Finally, you take anti-log and do it. That is another way of doing it. Don't worry. That's not there in your CA intermediate. Now, can I tell you another way of doing it? You can use your calculator and do it. You guys know that? Okay. Now, I will tell you. Now, one second. Now, guys, look at this. Now, this is just in case you need to do it. For example, if it's not given. In MCQ, this kind of question comes in. No other data is available. How will you do it? Using your calculator, you can do. Now, I will not spend beyond 2 minutes time in this. Now, look at this. 1 plus g to the power 5 is equal to this figure. Am I right? Or to the power 5, if it goes to the other side, it becomes to the power 1 by 5. Am I right? So, can I rewrite this? I'm just putting it here. This is not for exam. 1 plus g will be equal to 1.3386 to the power 1 by 5. Am I right? Or 1 plus g is equal to 1.3386 to the power 1 by 5 is what? 1 by 5 is how much? 1 by 5 is 0.2, no? To the power 0.2. Is that clear? Is that clear? Now, to the power 0.2, can you do it in your calculator? To the power 0.2, you can't do it in your calculator. How can you do it in your calculator? Scientific calculator you can do, that is not allowed in your exam. Guys, correct? Sir, how can I do it in my calculator? I will tell you. There is a calculator trick for this. Now, a to the power b. Right? When a to the power b is there. Now, how do you do this in your calculator? For example, guys. For example, I will tell you something. Now, for example, let us say 2 to the power 3. 2 to the power 3 is how much? 2 into 2. 4 into 2, 8. Guys, correct? Now, if the power is in whole number, you can easily do it. If the power is in fractions, how will you do it? If it is to the power 0.5, it's square root. That you can do. You have a function here. But if it is in decimals like 0.2 and all, how will you do it? Can we see this? Now, a to the power b, calculating in your calculator. Now, for example, 2 to the power 3 is there, no? Let's, with the help of this itself, can we do it? Now, what you need to do is, now I will tell you guys one step here, 5-step approach. Step number 1. Now, what you need to do is, square root of a, you need to do it 12 times. Which means what? In your calculator, you have 2. No? Click on square root 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. You click the, put 2 and click on square root. See guys, a to the power b. What is the a value here? 2. Am I right? Purida. So 2 and click on square root 12 times. Is that clear? Now next, what should you do? Then subtract 1. Just click -1 in your calculator. Is that clear? Step 3 into b. Now what you need to do, don't do anything, directly into, what is b here? B is 3. A to the power b, b is 3 into 3. Is that clear? Guys, correct? Step 4, just add 1 plus 1, right? And then step 5, what you should do is, into is equal to, you need to click 12 times. Click on into is equal to, into is equal to, into is equal to, into is equal to 12 times. How much you get? 7.999, that's nothing but 8. Got the answer? Guys, are you all understanding? So there is a recipe manual using this calculator also you can do. What will you do? A to the power b. B could be anything. Purida, are you understanding? What should you do? A, the number, base number. Click on square root 12 times. -1 into whatever is there in the power. Right? Then plus 1. Then into is equal to 12 times and you will be getting the answer. In this case, can we try doing it? Guys, correct? Now, what is A here? Guys, everyone, take your calculator. 1.3386. It is there. Correct? Now, what will you do? Square root 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Done now? Then -1 into B. What is B? 0.2. Then plus 1. Then into is equal to 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. How much you get? What do you get? So 1 plus G is equal to 1.06, or G is equal to 1.06 minus 1, or G is equal to 0.06. Am I right, guys? 0.06, or this is nothing but 6%. Are you guys clear with this? This is a hack of using this simple piece of machine. It can do wonders. Is that clear? Sir, why are you teaching all these things, sir? Flexing your knowledge? No, I need not flex my knowledge. You have already enrolled for this course, so I need not flex. There is no point in flexing my knowledge. If this comes in an MCQ where you are not able to do it, right? If interpolation or something is required. Now, in case of MCQs, if interpolation is required, now doing that wastes a lot of time. Now, step marking is anyways not there. Take your calculator, do this 5-step approach, you'll get the answer directly itself. Are you all able to understand, guys? That's the reason why I'm sharing it with you. Is that clear? Whatever I'm doing here is exam ready for you. Is that clear, guys? Right? And this is how you need to actually, this is how you actually do this. You can actually do it in case of your MCQs. Is that clear, everyone? Is that clear, everyone? That's how it is. Are you all able to understand? So in this case, we got the growth rate. Now let's quickly do this. Right on. So now, Gordon's model, K is equal to, yes, come on, tell and write. T1 divided by, so P0 minus flotation cost, am I right? Plus G. What is D1? Now, they've readily given, it's going to be how much? 15 rupees divided by, what is the current market price of the share? Now, look at this, look at this. This is the current market price. I'm sorry, this is the current market price. Issue price is given. So, first priority, issue price. For the purpose of KR, for the purpose of KR, you can take 130. Is that clear, guys? Are you all able to understand? Yes. So, it's going to be what? 125, right? Minus 5. Am I right? Come on, guys, quickly do it. 125 minus 5 plus 6%. Now, how much is that? It's going to be 15 by 120. It's going to be 12.5%. 12.5% plus 6% gives you how much? 18.5% is going to be what? This is going to be your KE. Is that clear? Is everyone able to understand? Is there any issue here, guys? Is there any issue here? No. Right? Now, that's about this. Now, can we do KR? Guys, can we do KR? Write down KR. Step number 2. Write down KR. Step number 2. In this case, KE, KR will be the same. No. Why? Rotation cost. Write down step number 2. Calculation of KR. Same within bracket. Gordon's model. Am I right? Now, guys, now what is the formula? P0 plus C. Yes, sir. It's going to be KE is equal to D1 by sorry, KR, you're right. KR is equal to D1 by P0 plus G. So KR is equal to, what is D1? Come on guys, tell me, what is it? 15, huh? Yes, it's going to be 15. Now divided by, now once again. Now here you have what? You have current market price. You also have issue price. Now ideally speaking, the priority for KR purpose alone, it is different. The priority should be given to current market price. Ideally you should take what? 130. Now in this RTP, institute has taken 125. Is it right, sir? Now that's where I'm telling you, institute is taking a contradictory stand for every single question. Now I am sticking to the solution which they have given in the study, in the RTP, but please understand, you can definitely take 130, which is ideally in fact the correct answer. Is that clear? Now whenever KR comes, and when both the current market price and issue price are given, I told you give priority to current market price. But always remember, whenever these two are given, please write a note stating your assumption. Is that clear, guys? You logically tell me, in case of KR, retained earnings, do I raise any money? No. In that case, where is the question of issue price? Only the current market price is relevant for me, no? So forget flotation cost, that anyways will not come. But issue price will also not come, no, only current market price will come. Guys, correct? Are you all able to understand? That is the reason why I would always suggest, write a note in this regard. But here I am deliberately taking 125 because it was taken with in the RTP. But sir, I want to take 130. Please take it. Write a note. If you are taking 135, then also write a note. Which means when both the data is available, write a note. Is that clear? Always this is one issue that is available. Is that clear, guys? So write down here. I am taking 125 since it was taken in the RTP. How do we know? You will not know in exam what they are taking. In exam, they will give you, I told you, as per marking scheme, alternative answers are possible, but please write a note. Plus, how much is D? 6%. Correct? I think it's going to be the same, huh? It becomes 18%. Oh, okay. Right, it becomes 18%. So 15 by 12, 125 gives you 12%, huh? 12% plus 6% gives you what? 18%. KR is equal to 18%. Is that clear? Next, step number 3. What is that? Yes, write down. Step number 3. Calculation of KP. Life is given? No, which means, yes, irredeemable. Irredeemable. Yes, what is the formula? KP is equal to what I pay by what I receive. Preference dividend divided by net proceeds. What's my preference dividend? 15 rupees. What's my net proceeds? The current market price. It's given as 105 rupees. Just take it up. How much is that? 15 by 105 gives you 14.285. Round it off to 14.29%. Sir, I want to take 3 decimals. Yes, you're happy. You can. You're happily allowed to take it. Is that clear? Next, what is that? Step 4. What is that? Yes, step 4. Calculation of KD. Now in this case, KD is redeemable, irredeemable. Redeemable, within bracket, write down. Wait. Now any method is given? YTM or shortcut? No, we can use any method. Write down. Approximation method. Is that clear? Any issues here, guys? Any issues here? Right? Now clearly, and this is the reason why I'm asking you to write down all these headings in a green ink. So it will tell you guys how to navigate through the sum. Is that clear? Shall we get started? Now, 1 second. Go to the question. What have they given? The company proposes to issue a 11-year, means life is 11 years. 15% debenture means what? Coupon rate is 15%. Now, the yield on the debentures of similar maturity and risk class is going to be 16%, and the flotation cost is going to be 2%. Now, what is this? Debenture. Okay. Now, for the purpose of debenture, shortcut method. Formula. Interest amount into 1 minus tax rate. I have interest amount 15 rupees. 15% on 115 into 1 minus tax rate. Available? Yes. Plus RV minus NP by N, the whole by RV plus NP by 2. Now RV, redemption value, absence of information. I will take it as 100. Can I take it? Yes. NP, what will I take it? Yes, sir, absence of information. I will take this also as 100. No. So in this particular question, you need to calculate NP. Right? How, sir? For that purpose only, they have given something called as yield and all. Are you all able to understand? Now, what is the meaning of this? Guys, please understand, this is a very, very important. In fact, it's an advanced level concept, but this is very much a part of your syllabus only. Now, what have they given here? The company wants to issue a 11-year 15% debenture. Now, what are they saying? The yield on debenture of similar maturity and risk class in the market, or similar debenture, exactly similar debenture of a similar company. Now, investors are expecting a return of how much? How much? 16%. Perfect. Now, flotation cost, fine, you leave that, which means first. Now, what is the meaning of this? What is the meaning of this? Now, look at this, guys. This is extremely important. Yield means what? The net return on investment. Am I right? Guys, correct? Any problem here? No. Now, what they are saying, in the market, what the investors are expecting, if I invest 100 rupees, I want a return of how much? 16 rupees. This is what the market expects. Is that clear? Is that clear? But I am going to issue a debenture with a coupon rate of how much? 15%, which means I am going to pay only 15 rupees for every debenture. Guys, correct? If I am going to pay only 15 rupees, what should be the current market value of that? Is that clear, guys? Or in other words, what should be the price at which I can issue it? Are you all able to understand this? Are you all able to understand? Or in other words, can I say this is nothing but 15 into 100 by 16? Am I right, guys? Can I say this is 15 into 100 divided by 16? Am I right, guys? Correct? How much is that? 15 into 100 by 16. How much is it? 93.75 rupees. Or in other words, can I say this is nothing but 15 rupees by 16%? Guys, 15 divided by 16 by 100 is nothing but this 100 goes to the numerator and becomes what? 15 into 100 by 16. Am I right? Or in other words, can I say the current market price is equal to interest amount divided by yield? Can I say this formula? Are you all able to understand this? I will give you the logic once again. I will give you the logic, don't worry. Is that clear? Is that clear? Can I say the current market price is equal to interest amount divided by yield? Is that clear, guys? Are you all able to understand this? Any problem here? Now, in this case, I arrived. What was the issue, or what was the issue price of the current market price? How much was that? 93.5. Sir, what is the meaning, sir? Simple. For an amount invested, the investors are expecting how much return? 16%. But in this case, I can't change the coupon amount. Coupon is how much? For every debenture, I am going to pay only 15 rupees. So make this 15 rupees equal to 16% return on investment, which means what? Your investment amount should reduce in order to make this 15 rupees equal to 16% return. How can I do that? Simple. This is what I said. Current market price is equal to interest amount. How much is the interest amount? 15 rupees divided by yield 16%. Or in other words, other way around. Current market price into yield gives you interest amount. How, sir? Current market price. What is this? I arrived at 93.75. Am I right? Now, 93.75 is going to be the amount I'm going to invest. If I'm buying the share today, I will buy it at how much? 93.75 into, I expect how much return? 16% on my investment should be equal to what? My interest amount that I receive, 15. Now, I do not know this amount. Guys, correct? Now, calculate this amount. I will cross multiply and I will say interest amount divided by the expected return should be equal to the amount that you are allowed to invest. Are you all able to understand this? Guys, is this clear? Is this clear? So with this, can I arrive at a formula by saying current market price is equal to interest amount divided by yield percentage? Is this clear, guys? So make this interest equal to 16% return. In that case, how much should be equal to? How much should be what? How much should be my current market price? Are you all able to understand? So write down here, working note. Write down. Take a red ink and write out. This is working note number 2. Am I right? The earlier one was working note number 1, calculation of growth rate. Working note number 1. Write on working note number 2. What is it? Calculation of, write down calculation of issue price. Write down calculation of, okay, you can write calculation of current market price. Current market price. Write down, guys. Write down. Calculation of current market price. Red ink, write down. Red ink, write down. Current market price is equal to interest amount divided by yield percentage. Is that clear? So now write down, this is equal to, how much the interest amount? 15 rupees divided by yield percentage. Sorry, it's 15 rupees, no? 15 rupees divided by 16 percentage. Now how much is that going to be? So 93.75. Is that clear, guys? Is everyone able to understand? Is everyone able to understand? Guys, correct? Now only if I issue at a lesser price, the face value is 100. Guys, correct? If I issue it at 100, if I pay 15, that will be equal to 15% return. Which means I should issue at a lesser amount in order to make the net return for them equal to 16%. Are you all able to understand this? Guys, are you all able to understand this? Any problem here? So here the current market price is equal to what? So interest divided by yield. Is that clear, guys? Are you all able to understand? Or in other words, this is the amount at which, if I issue, this is the amount at which they will invest. Am I right, guys? This into 16% will exactly give them the interest amount. Are you all able to understand? So make this 15 rupees equal to a 16% return on their investment. That is how you calculate it. Is everyone able to get this, guys? Is everyone able to get this? This is a very, very important thing that you need to understand. Are you all able to understand? In this case, guys, in this case, you tell me, what is the coupon rate? 15%. Correct? What is the yield? What is the yield? 16%, which means for every 100 rupee debenture, I will pay only 15. But they are expecting 16, which means I can't pay 16. What can you do? Issue it at a discount, so that denominator, return on investment, is what? Amount from their perspective, the amount they received divided by the amount they paid. Guys, correct? Right? So for them, if the denominator reduces, obviously, automatically the net yield return will increase. Is that clear? Are you all able to understand? Or in other words, can I say, coupon rate, yield rate, these two are there. If yield, that is their investor expectation, is greater than the coupon rate, obviously the shares needs to be issued at a discount. Is that clear, guys? Suppose if it is the other way around, coupon rate is 15%. But our investors are expecting only, let us say, 12%, which means for 100 rupee debenture, I pay them how much? 15. But their net return expected is only 12, which means I will anyways pay 15. But you issue this at a premium. Is that clear, guys? You will issue it at a premium. So from their perspective, they will receive 15, but they would have paid more than 100 rupees. In effect, they will get only 12%. Make this 15 rupees equal to 12% return on their investment. In this case, what will happen? The shares will be quoting at what? A premium. In the previous case, it will be quoting at a discount. Or if the coupon rate is equal to the yield rate, the shares will be quoting at par. Is that clear? This is how companies decide whether to issue securities at par, premium, or discount. Are you all able to understand? Core of finance, guys. Now, having decided all these things and having issued the shares, now you go and account it in your financial accounting. Are you all able to understand? In your advanced accounts, you account it. But how do I decide whether I need to issue it at par, premium, discount? Compare your coupon rate with the yield rate, and based on this, arrive at a decision. Is this clear, guys? Yeah, are you all able to understand? If this is not finance, then what is finance? Are you all able to understand? So it's a comparison between these two. Are you guys able to understand this? Are you guys able to understand? That's one small observation that you can make. Are you all able to understand? This is going to be your nature of issue. Yes, this is something that I immediately wanted to discuss out of this. Guys, clear with this? Now with this, I arrived at the current market price. Now this is not issue price. Why? Clearly they have given flotation cost is there. So write down. Issue price is equal to rupees 93.75 minus how much is flotation cost? 2% on what? On face value. No assumption. Clearly given in the question. So minus 2 rupees. How much is that? 91.75. Many students, due to this level, They forget that CMP and issue price are different. From this, you need to subtract flotation cost. They do this and take this for all calculation purposes. Guys, are you all understanding this? Is that clear? That's about this. Now, quickly, just go and do this question. Now, KD is equal to, write on the formula. KD is equal to, come on, write on the formula. Interest into 1 minus tax rate plus RV minus NP by N, the whole by RV plus NP by 2. I'm sorry, this is issue price. Ideally, this is net proceeds, right? Okay, good, right? Or net proceeds. Okay, what's my interest, guys? 15 rupees into 1 minus, what's my tax rate? 0.35 plus RV, nothing given, assume it to be 100, minus NP, how much is that? 91.75 by N, how many years? 11 years. The whole by RV plus NP by 2, 100 plus 91.75 divided by 2. Can you please calculate? What do you get in the numerator? How much you get? 15 into 0.65 is 9.75. 9.75 plus is going to be 8.25 by 11. 0.75 divided by 191.75 by 2. How much is that? 95.875. So how much is this? 9.75 plus 0.75 divided by 95.875 gives you 10.95%. 10.95% approximately. Is that clear, guys? Is that clear, everyone? Is that clear, guys? Are you all getting it? So remember this. When the coupon rate and the yield of similar debentures or preference shares or equities are given, with this, what will you find out? You can find out what? You can find out the current market price. So current market price is equal to interest amount divided by yield percentage. Logic, I told you, by comparing the coupon rate and yield rate, they arrive at the decision as to whether a share needs to be issued at a premium, par, premium or discount. Is that clear, guys? Is that clear? Now, one small thing I want to tell you. Now, take your this one. That's your solved question bank. Now, look at this. KD calculation they have done now. Exactly whatever we have done only they have done. Now, please understand, when yield is given, I told you, current market price is equal to interest amount divided by yield percentage, no? Guys, correct? This is a shortcut formula. No, sir, I don't want shortcut formula. You can use time value of money concepts and also do it. How, sir? They are expecting a yield of how much? 16%. Now, P0, which means how much would be the current market price? This is equal to the present value of all the future cash inflows from the perspective of the investor. Guys, correct? Every year, how much is he going to receive? 15 rupees. Guys, correct? Into present value interest factor of annuity of yield percentage, 16% for 11 years. Plus, at the end of 11th year, he is also going to receive how much? The entire 100 rupees into present value interest factor of 11%, of 16%, 11 years. If you do that, you will arrive at the present value. There is nothing but the current market price. Are you all able to understand? This is another way of calculating the current market price when coupon rate and yield rate are given. Is that clear? Is everyone able to understand? This is using what? Time value of money technique. But remember, in exam, shortcut method is allowed. Don't worry. Is that clear? Guys, this is an extremely intricate and a depth core area in your FM. Is that clear? Is everyone able to understand? Right? From the current market price, reduce your what? Flotation cost to arrive at the issue price. Now, once again, let me tell you very, very clearly, this calculation is done from the perspective of investor. That's the reason why every year we don't take tax shield. Is that clear? Guys, I am giving you the logic. That is the reason. Since this is computed from the perspective of investor, every year they didn't take the tax shield. Why? Tax shield is from the perspective of the company. Now, from the perspective of the investor, I'm calculating how much will he be ready to pay today. That is the current market price. Is that clear? So immediately shift the perspective and calculate. Is that clear for everyone? That is the reason we don't take tax shield here. Please write somewhere, guys. You have the solved question bank with you. Write it down. This is such an intricate area. You will not get this kind of explanation anywhere. I am not telling this to brag about myself. I am telling this so that you should understand the value of what you are learning right now. Right? We do not adjust for your tax shield here because this is being computed from the perspective of investor to find out how much he is ready to pay. And how much he is ready to pay will be the issue price today. Are you all able to get this? Is everyone able to understand? Clear? That's about it. Now let's quickly move on. That's all. We have calculated everything. Now let's go on and do the sum. Now, Write down the last what is it? Step 5. Write down step 5. Write down, guys. Calculation of WACC, weighted average cost of capital, within bracket. I'll tell you how to frame a template, single template, calculate both using book value and market value weights. Write down book value and market value weights. Shall we do this? Let's do this. Write down. First one, template, you should tell me. Source. Yes. Then, now 1 second. Then, write down. Please write down. Write down. Book value. Please write down book value, market value. Then write down weights under that book value and market value. Is that clear? So what we are doing, we are arriving at the book value amount, market value amount, based on that proportions. Here book value weights, here market value weights. Is that clear? Then write down cost, that is A as a percentage, right? And then finally you arrive at what? Write down WACC under that book value method, market value method. That's all. Is that clear? Single template saves time. Now, but here you need to write that column and all. Am I right? Let's just write down here. 1 second. What you can do is, you can write this as column number A, column number B, column number C. So WACC using book value weights is going to be A into C. This is going to be B into C. Is that clear? So clearly you are telling the examiner how you are computing. Is that clear? Shall we get started? Now write down, guys. Write down. What is it? Equity share capital, line gap, retained earnings, line gap, preference share capital, line gap, debentures, line gap, total. Is that clear? Shall we get started? Yes. Write down. First one, book value of equity shares given. Once again, on the top, you can write rupees in lakhs. We can do that. We can save a lot of space. Rupees in lakhs. Equity share capital. 1 crore 20 lakhs means 120 lakhs. Am I right? Put it up here on the top. 120. Retained earnings. 30 lakhs. Preference share capital. 36. Debentures. 9. Total. Come on. Total it up. 150, 186, 195. Yes, 195 lakhs. Is that clear? Next. Now, guys, now KE figure is different. KR figure is different. Now, what we can do in this case, now I told you, when the market value weights are given, 2 ways of doing it. Ignore market value of KR, compute only for KE and do it. Or split the market value of equity into equity share capital and retained earnings in the book value proportions, and then arrive at the market value of both equity share capital and retained earnings. Anyways, the other 2 will also be there. We can do it. Since in this question, KR and KE are 2 different figures, it's better if we split it and do it as per the method 2. Is that clear? Guys, is that clear? Now, shall we do that? So now, 2 crores should be apportioned to the ratio of 120 is to 30 is nothing but 4 is to 1. 4 is to 1. So which means 2 crores is nothing but 200 lakhs. 200 by 5 into 200 by 5, you get 40. 40 into 4, 40 into 1. 160 and 40. Okay, write down here. 160 and 40. Take a red ink, put a star on the top. Put a star on top. Write down. Come down. Write that star and write down. Market value of equity. Write down. Market value of equity. Write down. Has been apportioned between dash and dash. Equity share capital and retained earnings. Between equity share capital and retained earnings. in the ratio of their book values. In the ratio of their book values. In the ratio of their book values within bracket. 120 is to 30. Is that clear, guys? Is that clear? This is a must. A must. Right? Or alternatively, what you can do? Take this figure as 200. This as 0. That's an alternative way of doing. Is that correct? Yes, that is also correct only. But will I get a different answer? The answer is yes, because KR is not equal to KE. Is this clear for everybody? Right? Now, just go ahead and do preference share capital and debentures given. The figures are given. Quickly, guys, let's close it off. It's been a while since we started this sum. It's taken more than 1 hour, but look at the kind of adjustments that we have done in this question. When I'm teaching you, it takes this much amount of time, but when you're doing it by yourself, it doesn't take this much. Okay, so come on, let's do this. Write down, what is that? How much? So it's going to be 33.75. It's given. Okay, and then debentures 10.4. So total it up, how much you get? 244.15. Perfect, guys. Now the respective cost. Okay, let's arrive at the book value weights. Can we do that? So come on, give me 120 by 90, 195. Point. Okay, 0.615 is it? Okay, 0.615. 0.154. Then 36 by 195. 0.185. Then 9 by 195. 0.046. If you add up exactly, you are getting 1. Very good. Next, market value weights. 0.655. Then 0.40 by 244.15. This is what you did. 0.169. 33.75 by 244.15. 0.138. Then 10.4 divided by 244.15 gives you. How many answers am I getting? 0.043. Add up, how much you get? Last digit alone you add and see. 8 plus 3 is 12. 164. Okay, 9 plus 8 is 17 plus 3. Okay, fine, you get 1. Now what is the respective cost? These figures you must be having. KE. Guys, KE. Pick it up, pick it up. You've done it, no? KE was how much? 18.5. KR 18. KP 14.29. And KD was 10.195. So please write down. 18.5%. 18%. 14.29%. And then 10.95%. Can I add all these things? Absolutely no. They are applied on different percentages. Come on, quickly do this. This into this. So use your calculator trick. 18.5 into this figure, this figure. Single shot, both columns you write down. 11.3775. 0.655 gives you 12.1175%. Then 18 into 0.154 is equal to 2.772%. 0.164 is equal to 2.952%. Then 14.29 into 0.185 is equal to 2.644%. Round off. 0.138 is equal to 1.972%. Then 10.95 into 0.046 gives you 0.504%. 0.043 is equal to 0.471%. Add up everything. 11.3775 plus 2.772 plus 2.644 plus 0.504 gives you how much? 17.2975%, roughly 17.29%. Here you get 12.1175 plus 2.952 plus 1.972 plus 0.471 gives you 17.51% roughly. Is that clear? So write down KO within bracket WACC Book value weights, you get how much? 17.29%. Market value weights, you get how much? 17.51%. Is that clear? Such a comprehensive question with so many adjustments in this area. Are we done here, guys? Are we done here? Okay, cool. And that's about this particular question. Yes, so please go and update your library of adjustments. Write down. Calculation of WACC hyphen. Calculation of WACC hyphen. Write down. KE within bracket red ink calculation of G bracket close. KE within bracket red ink calculation of G bracket close. Semicolon. KP semicolon KR semicolon KD within bracket write down CMP is equal to interest by yield. Red ink. CMP is equal to interest by yield. This formula had to be used in this particular question. Is that clear, everyone? Then bracket close. Then what did you get? That's fine. Flotation cost on face value is a normal thing. If you want, you can write that. That's not a major thing. One more thing, yes, for retained earnings. Write down. Market value of retained earnings. Just write down market value of retained earnings. Within bracket, two approaches. Write down market value. If you want, take a red ink and write. If you've already written it, take a red ink and put a box. Okay. Market value of retained earnings within bracket. Two approaches. Two approaches means what? For the purpose of computing WACC using market value weights. So, first method is 0. The second method is apportionment using book value weights. You guys know that, right? So, just for your understanding, you just write down within bracket two methods. Market value of retained earnings. So, you guys know what it means, right? That's about it. 3 catches. Mark this sum as important. This sum definitely needs to be revisited the day before your exam. Now, that's the reason we are tracking this library of adjustment. So, one look at this, you know this is a must-visit sum. Is that clear? Hello. Right. Perfect, guys. So, now, with this, let's move on to the next one, shall we? Now, quickly, let's move on to the next sum. I don't think next sum will take that much amount of time. Let's quickly do this. Shall we get started? Question number 30. Now, guys, now look at this. Gamma Limited has an issue 5 lakh 1 rupee ordinary shares whose current ex-dividend market price is how much? 1.5 rupee per share. The company has just paid a dividend of 27 rupees per share, and the dividends are expected to continue at this level for some time, which means there is no growth rate in your dividend, constant dividend. Is that clear, guys? Yes. If the company has no debt capital, what is the weighted average cost of capital? Now, guys, now understand one thing. I want you all to know that let us use a technical language, a jargon, or a terminology in our subject. There are 2 types of entities, right? Entities means companies. One is called as levered entity, L-E-V-E-R-E-D, levered company. The other one is called as unlevered company. One second. L-E-V-E-R-E-D, unlevered company. Now, sir, what is the meaning of leverage? Next chapter's name itself is leverage. We'll be seeing that. And what is this, sir? Simple. Levered company means a company which has debt in its capital structure. Is that clear? If a company, one of the sources of finance is debt, then the company is said to be a levered entity. An unlevered entity means what? A company which has no debt in its capital structure, or in other words, 100% equity. all equity entity is called as what? Unlevered entity. Is this clear? Are you all able to understand? So what do you mean by a levered entity? An entity which has, a company which has one of the source of finance is debt. Even if you have raised 1 rupee of debt, right? When I say debt, it means debentures, bonds. It could even mean bank borrowings, whatever it is. Is that clear? So if I have raised some amount from debenture route or borrowings route in my capital structure, that is called as a levered entity. If a company has raised everything through only one source, called as what? Equity. It could be equity, share capital, or retained earnings. All equity, then it's an all equity, unlevered entity. Is that clear? Now you tell me, if I have raised every single rupee from equity share capital, now let us say the company has raised equity share capital overall 100 crores. What is the total capital employed? 100 crores. Now can I say the cost of equity is equal to my overall cost of capital? There is only one source of finance. Are you all able to understand? Or you can say KE into 1. 1 is what? The weight of equity. Debt is 0. Preference is 0. Nothing is there. Is that clear? So can I say for an unlevered entity, can I say KE is equal to KO? Are you all able to understand? Right? For a levered entity, obviously using the weights you compute. Is that clear? You use the same formula here also. KO is equal to KEWE plus KDWD plus KPWP and all. Weight of debenture, weight of preference will be 0, 0 and all. That will anyways be 0. Or in other words, KO is equal to KE. Are you all able to understand? I would suggest, please, write as KO is equal to KE. Don't write KE is equal to KO. KO, the overall cost of capital, is equal to KE because it's the only source of capital. Is that clear? Is that clear for everyone? Right? Now, in this case, what happens, guys? For this company, what has happened? Now, KE we need to compute, correct? How much is KE? Now, in this case, they have given dividend. It is expected to remain same. So, which means dividend price model. Only that can be used. Gordon will not apply. Gordon means growth. So, which means, in this case, what is the formula? Not D1. There is no D1 here. D1, D0, everything is same only, guys. So, dividend D divided by net proceeds or P0. So, KE is equal to D divided by net proceeds or P0. I can even say P0. Is that clear? How much is D? 27 price, 0.27 divided by how much is the net proceeds, or what is the current market price? 1.5 into 100. So 0.27 divided by 1.5 gives you how much? 18%. K is equal to 18%. Since the company is an unlevered entity, all equity entity, they have clearly given, no? What have they given? So it has no debt. So clearly you can say, since the company has no debt in its capital employed, it is an all equity entity, unlevered entity. Hence KO is equal to KE is equal to 18%. Is that clear? That's all you need to do. Are you all able to understand? Understood this concept, guys? Are you all able to clear? Are you all able to understand this? So WACC is equal to KE is equal to 18%. That's all about the sum. Is that clear? Now, one second. There's one thing I want to tell you. It's not relating to this chapter, but it's a common area. Sir, they have given something called as X dividend market price. What do you mean by X dividend market price? Right? Now, guys, understand. Ideally, this is a part of your accounts. You guys have studied in advanced accounts? No. It is there. In advanced accounts, it's there. Oh, that you are very clear. It's there. Very clear. AS? Oh, right. AS 13. Exactly. Investment accounting. Yes, you get it in AS 13. X dividend, theoretical X rights price. You get this in AS 20 also. EPS. Yes, theoretical X rights price. You get that, right? Remember, something like that. Okay, fine. Guys, link between the subjects. Please link between the subjects. Now, guys, there are two things. One is called as X dividend price. The other one is called as dividend price. What is the meaning of this? I will tell you quickly. I will tell you. This is ideally not relating to this chapter, but in general you should know. Now let us say the board of directors had announced that for every share 10 rupees of dividend is going to be declared. Okay, board meeting, I mean the AGM happened, right? Dividend was recommended by board of directors, approved by shareholders, became official. Am I right, guys? Correct. Now the board has recommended, it has approved, and it has become this. Now AGM date, let us say generally it happens in the month of August and all. Let us say on 1st of August, what they have done, they have actually announced that yes, bonus is, your dividend is going to be paid for every share at the rate of how much? The rate of how much? 10 rupees. Guys, okay. Now, 10 rupees will be paid for every share held. Now, you guys see in the share market, secondary market, the share keeps on being trading, no? Every day, someone will buy, someone will sell. Guys, correct? Now, who is the owner of the share? Who holds the share? You might not know. Every day, every single second, the shares of the company could be bought and sold. Now, clearly they will say that there is something called as a record date. The company will say, look, whoever is holding this share as on, let us say, whoever is holding the share as on 5th of August, whoever is holding the share as on 5th of August, in the register of members, you guys have studied that, in the register of members as on 5th of August, whose name is appearing, those people will be getting the dividend. I can't track the share market every second. Is that clear? They will be very, very clear about this. Now what happens? The announcement happened on 1/8. Now they'll say as on 5/8, right? Whoever is holding the shares, what has happened? They will be entitled for dividend. Let us say you are a person who is holding the share. Today, the share in the market, the share price is quoting at 200 rupees, right? Before this news came out. Now the news came out. Now you tell me, you wanted to sell the share. Will you sell it today or will you sell it after 5th? After 5th, why? Anyways, if I hold it till 5th, I will get the dividend amount. Correct? Now, which means for the next 5 days, no one will be ready to sell in the market, secondary market, which means no one will can buy even if they want to. Or in other words, the trading itself will not happen. So this is very bad for the company. Right, guys? Now what happens? Immediately, once this news comes out, what will happen? 200 rupees share price will start quoting at 210, which means today if you sell, no problem, the 10 rupees you will realize today itself. Are you all able to understand? Or in other words, this 200 rupees is called as ex-dividend price, means it excludes the dividend. This 210 is called as cum dividend price, means what? This includes the dividend amount. Is that clear? Now for the next 5 days, it will always be quoting at a cum dividend price. Is that clear? Because whoever is selling will sell it only including the dividend amount. They have held this share so long. Is that clear? Now after 5th, anyways, once again, it gets quoted only at X price. Before 1/8, it was quoting only at X dividend price. Only during the period between the date of announcement and record date, this happens. Is that clear? Are you all able to understand? So that it doesn't affect the trading. Are you all able to understand? Now, the correct share price is 210 or 200. The value of share is only 200. This 10 rupees includes dividend and all. For the purpose of dividend, no, that is not the correct price, right? Hence, for all our calculations, when I say market price per share, the current market price, it only refers to the ex-dividend price. Cum dividend price should not be considered for any calculation purposes. Is that clear for everyone? Is everyone able to understand? So we should never consider what the cum dividend price, only the exit dividend price should be considered for all the calculation purpose. This exactly the same scenario happens even in case of bonus issue. If bonus shares are coming, they will factor the value of bonus inside the share. So cum bonus price will be arrived at in the market, reduce the bonus value, and you will be getting the X bonus price. Is that clear? This was actually tested in the recent exam. MCQ 1 or 2 mark, 2 mark question in MCQ it came. Simple concept of X dividend and cum dividend. Is that clear, guys? Are you all able to understand any issues, any problem here? That is the reason I am creating this issue and I am solving it. Please catch up running notes. I hope you guys have caught up running notes for this. So X dividend price means what? The dividend price excluding the share price excluding the dividend. Cum dividend means it includes the dividend. That is only a temporary feature. This 10 rupees extra always will be quoting only for the next 5 days. After 5 days, anyways, after that, there is no additional benefit for the share. So the 10 rupees value and all will go off. Is that clear, guys? Are you all able to understand any issues here? And that's about this particular question number 13. Please go and update your library of adjustments. Write down WACC hyphen WACC hyphen unlevered firm within bracket KO is equal to KE. Unlevered firm within bracket KO is equal to KE. Unlevered firm within bracket KO is equal to KE. Are we done here? Perfect. Now, let's move on to the next sum. Question number 14. Shall we get started? Yes. Now, from the following information, determine the appropriate weighted average cost of capital relevant for evaluating long-term investment projects of the company. Now, guys, understand cost of capital. We are talking about what? Long-term sources of finance. Am I right? Now, look at this. Look at this. Look at this. Come on, guys. Cost of equity. Given what is 18%? KE. After tax cost of long-term debt. They themselves have given what is this? KD. After tax cost of short-term debt is given. Means what? Your current liabilities like creditors or current borrowings. Then KR, cost of reserve, 15% given. Sources of capital, equity, reserves, long-term debt, short-term debt. Book values are given. Market values are also given. You need to compute what? WACC. 1 second, guys. 1 second. In this case, what you need to do? Now, KE consider, KD consider, KR consider. Now, the cost of short-term debt should be ignored. Why? I'm talking about cost of capital. When I say capital, I'm talking about long-term sources of finance. This is a component of my working capital. Working capital means current asset minus current liabilities. A beautiful chapter at the last end. We will be seeing chapter called as working capital management. There it comes. It is not a long-term source of finance at the moment. So absolutely that should be ignored for our calculation purposes. In this question, guys, 1 second. KE, KD, KR. Three alone. Three components alone. The respective costs are given. Now, book values are given. So, this, and this you should take, ignore this 1 lakh, which means 3 plus 2 plus 4, you get a total of 9 lakh rupees. Market value weights, only this and this you should consider. Ignore this. Is that clear? Right? So, now you get a total of what? 11 lakh 25,000 now. Guys, correct? Now, market value weights, book value weights, respective cost into respective weights, you will arrive at what? The cost of capital under book value weights, cost of capital under market value weights. Now, remember one thing. Now, when it comes to market value weights, now equity alone will have a market value weight. Why? Reserves will not have a market value because the market value of equity includes market value of retained earnings. Now, in this case, what can you do? There are 2 different ways in which you can deal with it. So, option number 1, take market value only for equity share capital. Consider the market value of reserves as 0. Or option number 2, apportion the market value of equity between equity share capital and reserves in the proportion of their book value weights. In this question, 3:2, and based on that, do the calculations. Is that clear? So, if you are using book value weights, 3, 2, and 4, am I right? 3, 2, 4. Based on this, arrive at the weights, multiply with the respective costs, arrive at the weighted average cost of capital. Clear with this, guys? Suppose I am doing it based on market value weights. Now, 2 ways. One is ignore the market value of retained earnings, or the other one is apportion the market value of equity between equity share capital and reserves in the proportion of that book value weights. In that case, 3:2. How much is that? 3 plus 2 is 5. So 75 by 5 gives you, yes, into 3, it's going to be 4,50,000 and 3 lakhs. Am I right? So 4,50,000 and 3 lakhs. This is going to be 3,75,000. Right? With this, arrive at the weights and multiply with the respective cost, you will arrive at the weighted average cost of capital. Is there any issue here? Guys, do you have any problem here? Right? Nothing great in this particular question, but I have kept this question only for one reason. What is that? So, after your short-term cost of debt should be ignored for the purpose of computing your weighted average cost of capital. Is this clear for everyone? Are you guys clear with this? Any issues? Any problem here? Right? So that's about it. You want me to do this once again? It's a very elementary thing, but I kept it separately mainly for this purpose. Please go and update your library of adjustment. Write down WACC hyphen treatment of cost of short-term debt. Write down treatment of cost of short-term debt within bracket to be ignored. Within bracket to be ignored. Within bracket to be ignored. I think I have also mentioned this earlier. Look at this. Treatment of short-term debt. Short-term debt is a part of current liability, not a part of capital employed. Should not be considered. If you want in your concept decoder, go and please write. Refer question number 14. Whatever is the page number. What is the page number? 22. Please write down. Refer question number 14, page 22. Concept book. Give the reference. See, for every single line item, I'm giving you guys a numerical problem in exam. It's going to be a very, very easy thing for you. Is that clear, guys? Are we done? Are we done? That's about your question number 14. Okay, this is about marginal cost of capital, which we'll be seeing later. Fine, guys. So with this, I am concluding this session. Please revise and practice all the sums we have covered till now, and I will see you all in the next one. Thank you all so much. Bye-bye. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now, let's continue our discussion in this chapter, cost of capital. So now, let's move on to the last concept of this particular chapter, which is called as marginal cost of capital, right? Now, what do you mean by marginal cost of capital? Now, let me give you guys an example with that. Directly we will jump to the next question. With the help of this question, we will be doing it. An excellent question we have. By the way, guys, we have almost completed this chapter in terms of broad coverage. Now, the remaining sums which we'll be doing covers the variety of numerical problems that are there in your syllabus as a part of this particular chapter. For example, some small areas like convertible debentures, zero coupon bonds, we have not yet finished, right? There is something called as prevailing rate of interest, right? Whatever it is, holding period return, certain small areas we will be doing it. These are all your past exam questions, or maybe it's there in your syllabus. And guys, the importance of this chapter is that every single attempt, on an average, this chapter gets tested for 10 marks out of the 50 mark component in FM, which means it has a 20% weightage, and this chapter has an impact on the remaining chapters as well as it has an impact in CA final. That is the importance of this chapter, and that's the reason why I am treading extremely cautious in this particular chapter and also a little bit slow for that reason only. Shall we begin? Yes, guys. So now, marginal cost of capital. Now, what is this concept all about? Very simple, guys. Very simple. Now, there is a balance sheet of the company. Okay. Now, let us say at present, the company has raised a total of 100 crore rupees across multiple sources like equity share capital, then retained earnings, preference share capital, and debentures and all, right? Example I'm giving you. A company has raised this 100 crores from multiple sources. Is that clear? Now, this is the current amount the company has already raised. Now, they have raised this in, let us say out of this, they have raised 30 crore from equity share capital, 10 crore from retained earnings, let us say 20 crores from your preference share capital, and the balance 40 crores from debentures. It's coming up correctly? Yes. Now, the respective cost we compute, KE, KR, KP, KD, multiplied with the respective weights, we arrived at the overall cost of capital, KO, guys. Correct? Yes. Now, this is called your overall cost of capital, KO. Now, what has happened? As a part of the expansion program, the company wants to raise, let us say, additional 40 crore rupees. The company wants to raise how much? Additional 40 crore rupees. Now, this additional capital is called as marginal capital. Marginal means what? Incremental. Is that clear? Now, this 40 crores, how are they going to raise? Let us say it is given in the company that the company wants to, let's say it's given in the question that the company wants to raise this additional money in the same proportion in which they had raised the original capital. That is in the same ratio of 3:1:2:4. Which means this 40 crores will also be raised in the same proportion. Am I right, guys? Right? Now, in this case, now calculating the cost of this additional capital is called as marginal cost of capital. Is that clear, guys? Now, I am going to raise some additional funds. Now, the cost of raising this additional marginal means incremental, right? This extra funds is called as what? Your marginal cost of capital. Is this clear for everyone? Is this clear for everyone? This extra marginal capital, it can be raised in any proportion. This proportion will be given in the question. If nothing is given, you can assume that the company raises this additional 40 crores in the same proportion, existing proportion of capital structure. Is that clear, guys? Now, how to compute? Everything is same, right? What you need to do, for example, you have multiple components like your equity share capital, retained earnings, preference share capital, and debentures and all. Compute every component of cost and finally multiply the respective cost with the respective proportion. You will arrive at what? The marginal cost of capital. Are you all able to understand? Is that clear? So the cost of raising the additional funds is called as what? Marginal cost of capital. That's all, guys. Nothing beyond this. Is that clear? Now, with this background, shall we go to the next numerical problem and we solve it? Guys, shall we get started? Yes. Now, let's go on to the next sum, which is question number 15. Question number 15. This was a past RTP question. Please mark this as important. An excellent question once again. Once again, an excellent question. This question is a must visit the day before your exam, right? Now, whatever I'm telling you as important, just like that, I'm not telling, right? If I'm telling it as important, there is a reason. So these are all some examiners' favorites areas and commonly committed mistakes by students generally. Is that clear? Shall we get started? Yes. I will read this question first. I will give you some time to process the data and then you guys tell me what is expected out of the question. Shall we get started? Yes. Come on, let's do this. ABC Limited has the following capital structure, which is considered to be optimum as on 31st of March 2023. Optimum means best, right? Now, currently they have raised how much? 2 lakh rupees. What is the proportion? 14% debenture, 30,000, 11% preference shares, 10,000, and equity, 10,000 shares with a total value of 1 lakh 60,000. Is that clear? Yes. This is what? This is the current capital raised by the company, current capital structure. Any issue? No. The company has a market price of 23.60. The next year's dividend per share is 50% of year 2022's EPS. Exactly. EPS stands for earnings per share. What they are saying, next year dividend is going to be what? 50% of 2022 years earnings per share. Is that clear? They have given something, you take it. D1 directly given up. Yes, next year they have given. Next. The following is the growth trend of EPS for the preceding 10 years, which is expected to continue in future. What have they given? Year and EPS. 2013, 1 rupee. 2014, 1.1. 2015, 1.21. 2016, 1.31. And so on. Till 2022, they have given. Is that clear? Now, why have they given all these figures? Now, they have given all these figures to show the trend at which my EPS is growing. With this, you can calculate the growth rate. Am I right, guys? Are you all able to understand? Is there any issue in this area? Is there any issue in this area? No. Fine. That's about it. Next one. Now, with this itself, directly you can find out. Growth rate is 10%. Why? This year, 1. The next year, it became 1.1. The next year, it became 1.21. The next year, it became 1.31. Or in other words, divide the EPS of any two adjacent year, you will arrive at the growth rate. Am I right, guys? Is everyone able to understand? Is that clear? Right? Now, in the earlier sum which we did, first dividend has become so much in a span of 5 years. Year-wise, they didn't give. Hence, we had to use that calculated trick or that future value table. Here, every year they have given the growth rate. Divide any two adjacent years, you will arrive at the growth rate. Are you all able to understand? So, every year they have given the EPS. With that, you can calculate the growth rate. Is that clear? Yes. Next. The company issued new debentures carrying 16% rate of interest and the current market price of debenture is how much? 96 rupees. Now, at present, they have only 14% debenture. Now, they have mentioned in the question, the company is issuing a new type of debenture. What is it? 16% debenture. Coupon rate is 16%. Current market price is how much? 96. Preference shares. How much? 9.2 rupees with an annual dividend of 1.1 per share were also issued. Means what? Fresh issue they are doing. Next. The company is in the 50% tax bracket. The tax rate is given. Part A of the question, what are they asking? Calculate the cost of new debt, cost of new preference shares, cost of new equity share, assuming the new equity is from what? Retained earnings. Is that clear? Which means, in this case, they are saying, assuming that KE is equal to KR. Are you clear with this? And they are saying new equity share, meaning I'm not issuing shares. I'm picking that when I say equity, it could be equity shares or retained earnings. This time they are choosing from retained earnings. Is that clear for everyone? Perfect. Right? Next, B. Calculate the marginal cost of capital when no new shares are issued. Is that clear? Next, determine the amount that can be spent for capital investment before new ordinary shares must be sold, assuming that retained earnings for the next year's investment is 50% of 2022. And finally, D, compute the marginal cost of capital when the funds exceed the amount calculated in C, assuming that the new equity is issued at rupees 20 per share. Now, part C, part D, we will come back to this later, right? First, read this question, and try to at least arrive at part A and part B first, right? Part C, try to understand what they have asked for. Many students fail in understanding what is asked in the question, right? Attempt it first and then we will get started. Online folks, pause the video now and take 2 minutes time, read the question fully, digest the facts, take your pen out, blue pen, try scribbling something, arrive at the answer, and then we will just discuss and do this question. So you can pause the video now. Now guys, now first they have asked us to calculate what? The cost of new debt, new preference, new equity, right? Assuming the new equity is coming from retained earnings and all, no problem. This is fairly a simple part. Shall we get started? Yes, let's do this guys. Let's do this. Come on. Quickly, let's do this. Come on. Slowly increase the pace. Write down. This is question number 15. Write down question number 15. Yes. This is part A of the question. Am I right? Part A. Under that, write down step 1. What is the first step? Calculation of KD. Write down calculation of new KD. New KD, cost of debt. Now, guys, in this case, life of the debenture, is it given? Come on, guys. Life of the debenture is given? No, which means irredeemable debentures only. So, write down within bracket. What is that? Irredeemable. Am I right? Write down. Irredeemable. Okay. Now, what is the formula? KD is equal to what I pay by what I receive. I into 1 minus tax rate divided by net proceeds, which is equal to, what's I? Now, at 16% into 100 rupees, 16 into 1 minus tax rate is 0.50 divided by the net proceeds given in the question. The market price is going to be 96 rupees. So write down rupees 96. So how much is this going to be? 16 into 0.5 is going to be 8. 8 by 96 into 100. It's going to be 8.333%. Am I right? Yes, that's about it. That's about it. That's the first step. Next, move on to step number 2. What is this? Calculation of new KP. Now, once again, in this question, now, have they given the life of preference shares? No, which means I can take it as irredeemable. Formula. KP is equal to what I pay by what I receive. Preference dividend divided by net proceeds, which is equal to, how much is my preference dividend? Given the question, it's going to be 1.10. And what's going to be my net proceeds? It's going to be 9.20. Am I right? Yes, 9.20. So how much is that? 1.1 by 9.2 gives you 11.95. Something exactly. It's given as 11.956. Okay. You can take it as 11.96%. This is ideally the correct one. 11.96. Huh? Okay. In the question, they have rounded it off to 12%. I mean, the solution, that's okay. We will retain what is correct. Next one. What is that? Write down. Write down step number 3. Calculation of new KE. What model? Gordon's model. Now, for Gordon's model, the first thing is what? We need to calculate what? The growth rate. Am I right, guys? So now write down working note 1. Calculation of G, that is the growth rate. Now guys, how do we calculate the growth rate here? Now for that purpose only, they have given this big one dabba, right? From 2013 to 22 for 10 years. So dividend became 1 next year, 1.1 next year, 1.21, 1.33 and so on. Now how do I calculate the growth rate here? Very simple. Now take any 2 years, for example, 2013. How much was the dividend? I mean EPS 1 rupee. 2014 next year it became 1.1, which means so by how much it has increased? So no, in terms of rupees. So how much is it increased? 1.10 minus 1 is how much? 0.1 divided by the base year EPS. It is going to be 1. So 0.1 divided by 1 gives you what? 10 percentage. Guys, are you all able to understand? Or this also you can take 1.21 minus 1.1 gives you how much? 0.11 divided by the base 1.10. How much is it? 0.1 or 10 percentage. Take the difference between the EPS of any two adjacent year divided by the base year's EPS. You will arrive at this is how you compute percentage increase. No, are you all able to understand? That is nothing but growth rate. Write down here. Please write down. Please write down. Please write down. G is equal to. Now we can take any 2 years. EPS. Which 2 years you want to take? Can we take the last 2 years? Yes. Then write down EPS of 2022 minus EPS of 2021 divided by EPS of 2021. Is that clear? Now how much was the EPS of 2022? So 2.36 minus 2021 2.15 divided by base 2.15. This is nothing but 2.36 divided by 2.15 is equal to how much? 2.36 minus 2.15 is how much? 0.21 divided by 2.15. How much is it coming out to? Some 9.7 thing, right? It's ideally nothing but 10%. You take any two difference between the dividend of, the EPS of any 2 years, it comes to 10 percentage. Is that clear? I think there is some rounding off in this area. That is the reason they have rounded off the figures. That's why it's coming to what? 9 point some percent. For example, here you take, so 1.1 minus 1 divided by 1. Exactly you get 0.1, 10%. 1.21 minus 1.1 gives you how much? 0.11 divided by 1.1. How much you get? 10 percentage. Guys, correct? Every year ideally you should get. I think here these figures are rounded off. Just 2 decimals they have stopped. That's why you are getting this. Are you all able to understand? So now with this we have got the growth rate. Am I right, guys? Now what should we do? Now write down. Oh, we should calculate D1. Okay, write down. Working note number 2. Calculation of what? D1. We need this D1, no? Why D1 by P0 plus D is only your KE formula. So write down D1 is equal to D0 into 1 plus G. Sorry, 1 second. That's the normal formula. Okay, yes, you are right. So in this question, they have clearly given what? They have clearly given the next year's dividend is 50% of 2022's EPS. You are right. In that case, this is not required. Okay, in that case, this is not required. So write down. D1 is equal to 50% of what? EPS of the which year? 2022. So within this is given. Am I right? So then write down. It's going to be 50% of what? 2.36. So that's going to be how much? Rupees 1.18. Is that clear? Is that clear, guys? So that's about D1. Now with this we can calculate KE. Write down KE is equal to D1 by P0 plus G. What is D1? 1.18. What is P0? It's given in the question. Currently the share price is how much? 23.6. Plus what is my G? Just now we computed it's going to be 10%. So write down 1.18 divided by 23.6. That gives you 5%. 5% plus 10%. KE is equal to 15%. Is that clear, guys? Is everyone able to understand? Any problem? Any issues here? No. That's about what? The first part of the question. That's about the first part of the question. Yes, you guys did this already. Very good. Next, what have they asked? Calculate the marginal cost of capital when no new shares are issued. This is what they have asked. Now, marginal cost of capital means what? Now, the cost of raising the additional amount. Am I right? Now, for this, what do you need? What do you need? You need the new KE, KP, KD. Guys, ideally, KE is equal to KR. Ideally, guys, correct? Into the respective weights. Now, have they given the weights in this question? In what proportion they are raising the additional funds? Have they given? No. Which means, but there is a hint given in the question. What? The existing capital structure is considered to be optimum means best, which means what? Currently, the company has raised how much? 2 lakh rupees. And out of this 2 lakh, 30,000 was raised from debenture, 10,000 from preference, and 1 lakh 60 from equity, which means the current proportion weights are how much? 30 by 200. How much is that? 0.15. So 0.15 for debenture. So 10 by 200 is going to be 0.05 for preference, and this has to be 0.80 for equity. Now they are saying this is the best mix. Is that clear? Which means for every rupee raised, so every time I'm raising 1 rupee, in what proportion will it come? 80 paise will come from equity, 5 paise will come from preference, 15 paise will come from debenture. If I'm raising 100 rupees, 80 rupees from equity, 5 rupees from preference, 15 from debenture. Is that clear? If I'm raising 5 crore rupees, I will just maintain the same mix. Are you all able to understand? Sir, new funds, sir, every time you touch new funds, once again you raise it in the same proportion only. Is that clear? Are you all able to understand? So which means, remember one thing, when you have to calculate the marginal cost of capital, you need not know how much extra amount they are raising. All you need to know is what? For the new amount, what is the new KE, KD, KP or whatever it is, and you need to know in what proportion they are raising. Am I right, guys? The proportion, nothing is mentioned, but there's a hint given in the question. My existing capital structure itself is optimum, means what? Now this is the best capital structure mix for the company. So every time they are going for additional funding, they will raise money only in the same proportion, which means, so now whatever new cost we have, respective cost we have computed, multiplied with this existing weights only, you will arrive at the new marginal cost of capital. Is everyone able to understand this? Please go and do this. Write down. This is what? Part B here. Write down part B. Come on, guys. Quickly do it. Part B. Calculation of marginal cost of capital. Now, name, template. Come on, tell me. That's all. Source. Then. Okay, don't write amount. Write directly proportion. Proportion, because we do not know what is the amount they are raising on the new funding, but proportion we know. Is that clear? So write down proportion, then K in percentage. Am I right? And then write down marginal cost of capital. Don't write KO. Marginal cost of capital. Puridalya. Is everyone able to understand this? Yes. Now write down source, debenture, then line gap, preference share capital, line gap, equity shares, equity share capital slash, what is this? Retained earnings. You can just write equity. That's all. Just write equity. Why? They have clearly mentioned it is by way of retained earnings and all. So that's about it. Is that clear? Guys, any issues here? No. Now, what is the proportion? Existing proportions we will use. Calculations, please, you can write. It's going to be what? 30,000 by 2 lakh. Am I right? Or I will write 30 by 200. Preference is going to be what? 10 by 200. And equity is going to be what? 160 by 200. Guys, correct? How much? 0.15, 0.05 and 0.80. Right? Respective cost. Just now we have computed what and what. KD is 8.33%. Then KP is how much? It's going to be 11.96%. Put it up here. It's going to be 11.96%. And then equity 15%. Can't be added, whereas the proportion total is going to be 1. Marginal cost of capital, marry the figures. 0.15 into 8.33. 1.2495%. 8.33333. If you retain it fully, you get actually 1.25%. Right? 1.25%. If you retain the decimals, 8.333333 into 0.15, we do, you get 1.2499999. It's rounded off to 1.25%. And 0.05 into 11.96. How much you get? Yes, you get roughly about 6%. Am I right? Then 0.8 into 15% gives you 12%. Add up 19.25%. You get a One second. There's some issue here. It's not 6%. 11.96 into 0.05. I'm so sorry. It is 0.6%. I'm so sorry. This is 0.6%. You literally get 13.85%. Am I right, guys? So write down here. Marginal cost of capital is equal to 13.85%. Is that clear for everyone? Is that clear for everyone? Which means whatever amount the company is going to raise now, the cost of the additional funding is going to be how much? 13.85%. Is that clear? Is that clear? These are all new KD, KP, KE. Proportion, sir. Then why are we using existing proportion? Sir, this proportion, existing proportion, is maintained even for the new amount raised. That's why we are using the existing weights. Is that clear? So basically, we are only computing the cost of additional funding, new funding, not existing funding. Is everyone clear with this? Is everyone able to understand? Any issues, any problem here? You guys are clear with this? Perfect. Now, with this, shall we move on to the next part, number C? Okay, guys, let's move on to part number C. Now, this is very important. This is where many students generally struggle in understanding. Now, what is this part? What is this saying? Now, determine the amount that can be spent for capital investment before new ordinary shares must be sold. Assuming that retained earnings for the next year's investment is how much? 50% of 2022. What are they asking? Determine the amount that can be spent for capital investment. Means what? Amount that can be spent for capital investment means literally the amount that can be raised. Whatever amount you raise can only be spent on investment. Am I right, guys? So look how they have twisted the words. They are saying determine the amount that can be spent for capital investment. Means what? Determine the amount that can be raised. Right? That can be raised before new ordinary shares must be sold. Assuming that the retained earnings for the next year investment is 50%. What are they asking? I will tell you. I will tell you. Now, please don't write down anything. I will give you the time to write down. What is this? What is this part? C here. Okay, part C. Now, please don't write down anything. Just focus and you will get it in a crystal clear manner. Now, guys, now clearly understand. Now, whenever the company is going to raise money, they are very clear regarding what? Regarding the proportion in which they are going to raise the money. Am I right, guys? Now, what are the different sources? Come on, tell me. Debenture, preference share capital, and in this case, they have clearly mentioned at present it is retained earnings. Am I right? Equity, okay? Or let me put it like this. Equity within bracket retained earnings. Is that clear? Yes, guys? Clear? Perfect. Now, in what proportion are they going to raise this money? Go on, tell me what proportion they are going to raise the money. Yes, 0.15, 0.05, 0.80. Overall, it is going to be 1. Is that clear? Now, what are they saying? How much is the retained earnings available for the company? Read the question. What have they said? Assume that the retained earnings for the next year is going to be 50% of year 2022. Year 2022, how much is the EPS? 2.36. Out of this, 50% they are paying as dividend. Balance 50% is only available for retained earnings that can be used for further investment. Source of finance only now. Are you all able to understand? Which means 2.36 into 50%, 0.5 is equal to 1.18 per share is available. How many shares are there at present? 10,000. So into 10,000. So what is the total amount of retained earnings available? 11,800. Or guys, can I say this is nothing but the amount of retained earnings available is 2.36. I'll put it here itself separately. I'll put it separately here. Workings is going to be 2.36. What is that? EPS. On that, 50% is only retained earning per share. Right? Like that, I have 10,000 shares with me. So it's going to be how much? 11,800 rupees is available for what? Retained earnings. As retained earnings. Is that clear? Now, what are they saying? Look at this. Look at this. Determine the amount that can be raised before new shares must be sold. Means what? Without issuing new equity shares. What are they asking basically? Look, they're asking us to find out what is the maximum amount that should be raised or that can be raised without issuing new equity shares. What is the meaning, sir? What is the meaning here? Now, overall, equity has to be a maximum of 80% of the overall funding. Now, when I say equity, it can either come from retained earnings or from equity share capital. Guys, correct? Now they are saying, no, I don't want to issue equity share capital. Now, let us say that the equity component should come only from retained earnings, right? I don't want you to issue any fresh equity shares. Is that clear? In this scenario, tell me what is the total maximum amount of fresh capital, marginal capital that can be raised. Simple. Now, what is the equity component available right now? 11,800. If 11,800 is 80%, what can be the 100%? How much is this? 11,800 divided by 0.8. How much you get? 14,750. This is the maximum amount that you can raise without issuing fresh equity shares. Suppose if I want to issue, let us say for example, sir, overall I want to raise 15,000 rupees, sir. If I want to raise 15,000 rupees, 80% of 15,000 should come from equity component. How much is 80% of 15,000? How much is it? So 12,000 should come from what? Equity route. However, 11,800 only is there as retained earnings, which means the difference 200 should be coming by way of equity share capital. But they are very clear. Look at the question. Look at the question. Before new ordinary shares must be sold means what? I don't want you to issue fresh equity share capital, or in other words, the entire component of equity should come solely from what? Retained earnings. Are you all able to understand what the question says? Which means this is how you need to reverse work and calculate. Which means 11,800 is the amount available through the equity route. So which means the only source of equity is what? Retained earnings, not equity share capital. If that can be 80%, how much should be 100%? Are you all able to understand? Anyways, this will be proportionate calculation. Are you guys able to understand? They are not asking you how much should be the debt preference and all. They just want you to know how much can be what? The total capital, the fresh capital that can be raised without issuing what? New equity shares. Is that clear? For raising this fresh capital, I need to issue fresh debentures. I need to issue fresh preference shares. But when it comes to equity, I will use only the retained earnings. I will not issue what? My equity share capital. Are you guys able to understand this context? Guys, clear with this? So please write down. This is just for your understanding. I put it here. Please write down. In exam, this is what you need to write. Write down. Write down. Part C. Write down. Heading. Calculation of total additional capital. Additional capital means what? Marginal capital. Is that clear? New funds. Total additional capital, right? Without issuing what? New equity shares. Is that clear? Is that clear? Now, first write down. Retained earnings is equal to, how much is retained earnings? Write down. Come on. Rupees 2.36 is the EPS of which year? 2022. Of that, 50% is available per share. And how many shares are there? 10,000 shares. This is going to be my total retained earnings. How much is that, guys? 11,800 rupees. Please write down. This alone you write down. Enough. Is that clear? Now, that if that is going to be 80%, how much can be my total amount of capital? Fresh capital. Write down. 11,800 is equal to 80% into additional capital. Therefore, additional capital will be what? 11,800 divided by 80%. Is everyone able to understand this? Write down. Additional capital is equal to rupees 11,800 divided by 80%. How much is that? How much? Rupees 14,750. Is that clear? This is very, very small calculation. The problem is with respect to understanding what the question says. Are you all able to understand, guys? Is that clear for everyone? Is that clear for everyone? Guys, is that clear? Right. So please understand this very, very clearly. Please understand this clearly. They are saying, when I say equity, it could either come from equity share capital or from retained earnings. In this case, they are saying they don't want to raise money through equity share capital, which means the entire amount of equity route should come from retained earnings. If retained earnings is how much? 11,800. If that is equal to 80% of the total funds that I'm raising, how much can be the total funds is all you need to calculate. Is that clear, guys? Right? The wordings are twisted like anything. Right? Please write down somewhere whatever is the meaning here. Please write down in a language in which you can understand. Sir, look what they've given. The amount that can be spent for capital investment means what? The amount that can be raised. What can you spend? Only the amount that you can raise can be spent. So indirectly they're asking you for the amount that can be raised. Are you all able to understand this? Right? Amount that can be raised can only be spent. So look how indirectly they have used these terminologies. The amount that can be spent for capital investment is nothing but the amount that can be raised for capital investment without issuing equity shares. Now, are you all able to understand this? You need to read between the lines. That's what they're actually asking you in exam. Is that clear? Look, this is not my own creation, applicable for your exam. RTP. This is RTP is a part of your syllabus. You guys are aware of that. In tax and all, amendments are introduced through RTP only. It's very much a part of your syllabus. Is that clear? Right? That's about the part C of the question. Is everyone able to understand? Next one. Compute the marginal cost of capital when the funds exceeded the amount calculated in C, assuming the new equity is issued at the rate of 20%. Now, what is the maximum amount that I can raise without issuing fresh equity shares? 14,750. This is the total additional capital I can raise. Am I right, guys? When I say capital, I refer to funding. I am not referring to equity share capital. Is that clear? Now, suppose I am raising beyond, if I want to raise additional funds beyond 14,750, in this case, necessarily I need to issue fresh equities only. Guys, are you all able to understand? I proved it and showed it to you, know. Suppose I want to raise 15,000 rupees. 80% of 15,000, how much is that? 12,000 should come from equity route. But I don't have sufficient funds in equity by way of retained earnings. The additional amount needs to be issued by way of 200 rupees should be coming from what? Your equity route. Are you all equity share capital? Is that clear? Now they are saying, suppose I am going to raise amount in excess of how much? 14,750. In this case, I need to issue fresh equity shares? Yes. Now they have given, in this case, compute the marginal cost of capital when the new equity shares can be issued at how much? 20 rupees. Now in this case, what you need to do? Original, whatever we computed, new KD remains same. New KP remains the same. Now KE alone, new KE, we now need to compute. And once you compute that, using the same proportions, arrive at the new marginal cost of capital. Now you guys are understanding this. Are you all able to understand? This could be a 10-mark question, guys. That's why I'm spending so much time. Look at the variety of sums we are solving. Is that clear? Let's go and do this quickly. Shall we get started? Yes, right on part D of the question. Part D. Write down. Write down. Write down. Please write down. When the company spends within bracket raises. When can I spend? Only if I raise. Are you all able to understand? Yes, funding is equal to investment. Am I right? Only if I fund the investment, it can be spent. Am I right? So when the company spends within bracket raises, bracket close, in excess of how much rupees? In excess of how much rupees? No, this one. Total funds I'm saying. In excess of 14,750, write down. In excess of 14,750, comma, it will have to issue new equity shares at the rate of 20 rupees per share. It will have to issue new equity shares at the rate of 20 rupees per share. Is that clear? It will have to issue new equity shares at the rate of 20 rupees per share. It will have to issue new equity shares at the rate of 20 rupees per share. Now come down and write. Therefore, new KE is equal to, what is the formula? G1 by P0 plus G. Am I right? Now, how much is D1? This will not change. We already computed. Look at that. 2.36 into 50%. How much was that? 1.18. What changes is only P0. Take a red ink and write P0. How much is P0? 20. That alone you take a red ink. Now plus G. How much was G? 10% same. 1.18 by 20 gives you 5.9%. Huh? So write down 5.9% plus 10% gives me what? A total of 15.90%. Are you all able to understand? This is the cost of new equity shares. Is that clear, guys? Hello? Are you all able to understand? Any problem? Any issues? Guys, correct? Which means, no. One second. Now, let us say the company is raising a total of 15,000 rupees now. In excess of this figure only now. In this case, 80% of this. How much is it? 12,000 rupees. Am I right? Will be the amount that needs to be raised from equity route. Now, out of this, 11,800 will come from retained earnings. 200 will come from new equity shares. But no matter what, now fresh new KE is how much? 15.9%. Now, KE is equal to KR. Am I right? So, the new KR will also be 15.9%, or in other words, this entire 0.8 will have how much cost? 15.9% only. Are you all able to understand this? Is everyone able to understand? Here we didn't have any flotation cost, no personal brokerage or personal income tax, hence KR is equal to KE. Are you all able to understand this? Any issues, any problem here? Just go and write down. Now, write down. Revised marginal cost of capital. Template, once again, put it. Quickly, guys, let's do this. Source, then directly go to proportions, then, come on. Yes, K within bracket, percentage, then, yes, marginal cost of capital, or you can say proportion into K, whatever it is. Now, what are the proportions? First, source, debenture, preference share capital, and equity. Preference, what are the proportions? 0.15, 0.05, 0.80. The total is 1. Respective costs 8.333% remains unchanged. Preference share capital 11.96% unchanged. Red ink equity alone, cost of equity how much? 15.90%. Am I right? This is the only thing that changes. Can I total this? No. Now marry the figures. 8.333333 into 0.15 is going to be 1.25%. 1.25%. Then 11.96 into 0.05 gives you what? Roughly about 6%. 0.6%. Am I right? 0.6%. And then 15.9 into 0.8 gives you 12.72. 12.72%. Add up everything. You get how much? 14.57%. So now the marginal cost of capital changes and becomes how much? 14.57%. Why? Because now the equity component is coming not from retained earnings, it is coming from equity share capital. Is that clear? While it was coming from what? When it was coming from retained earnings, it was only 13.85. Guys, correct? Now, since that equity component can either come from retained earnings or can come from equity share capital. Is that clear? So now in this case, what happens? Or in other words, can I say, if totally the company wants to raise an additional amount up to 14,750, the additional cost of capital will be how much? Only 13.85%. Suppose if the company wants to raise beyond 14,750, now the marginal cost of or additional cost of capital will become how much? 14.57. This is the learning here. Are you all able to understand this, guys? So the additional marginal cost of capital need not be same. It could change because of certain parameters. Are you guys able to get this? Are you getting the clarity? Right? This is the reason why we spent so much time on this particular question. An excellent question. I think this was also a past exam question, if I'm not wrong. Institute is testing these kind of questions, guys. And especially this part C, mark this as important. Trust me, if had I not done this in the classroom, you tell me, would you be in a position to handle this by yourself? Definitely, reading and interpreting itself is the most difficult part of the question. That's the reason we are doing so many questions as a part of our classroom discussion. Please go and update your library of adjustments. Write down. Mark this as important. Write down. MCC hyphen using existing proportions within bracket. How do we know existing proportions? Very good. That word optimum made the difference. Write down. Within bracket, optimum, bracket close. semicolon, semicolon, MCC, MCC before and after issuing fresh or new equity shares. MCC before and after issuing new equity shares. MCC before and after issuing new equity shares, semicolon, semicolon, red ink, write down, red ink, write down. Calculation of total additional capital, calculation of total additional capital without issuing dash, without issuing dash, without issuing new equity shares. Is that clear? Without issuing new equity shares. Is everyone clear with the conceptual understanding of the question? Look how they have framed it. 10 mark, guys, exam question. 10 mark exam question. That's the beauty of your conceptual learning. That's about it. Don't mug up. This is all it is. Is that clear, everybody? Right? And that's about the sum. Now let's move on to the next question, number 16. Shall we get started? Now, let's begin. Now, question number 16. Now, this is another, that's about it, guys. So, now officially in terms of broad, most important, big concepts, every single concept has been covered now. Now, let's go on and do some multiple variety of problems we'll be doing, and we will clearly close off this chapter. Multiple variety, and look at this, we will be literally covering every single concept in your study material. I will not leave even a single concept. That is the holistic and the broad coverage we are going to do here, right? All these things I will be linking when you are studying final. There I will be linking all these areas. This chapter is one of the most important chapters in entire finance itself. Are you all able to understand? Now, let's get started. Now, there's a company, Masco Limited, wishes to raise additional finance of how much? 10 lakh rupees for meeting its investment plans. Additional funding, how much they need? 10 lakh, which means 10 lakh is the existing capital. Huh? No, fresh amount I need is how much? 10 lakh. Now, look at the question. Now, 10 lakh. It has 2,10,000 rupees in the form of what? Retained earnings available for investment purposes, which means what? Out of the 10 lakh, 2,10,000 can be funded through my own savings. Correct? Just imagine you want to take, you need some money for building a house or something like that. Now you have your own funds of how much? 2,10,000. First you will use that. Then you will go to the bank or someone else for loan. Am I clear, guys? Right? This is what we all do. Logically think. This is corporate finance. For a corporate company, it's going to be what? A retained earnings. Next. Now the further details are available as following. What have they given? Now, debt equity mix. You guys know what is debt equity mix? Debt divided by equity should be in a proportion of what? 3:7. Is that clear? Or in other words, if I am raising totally 100 rupees, 30 rupees should come from debt, 70 rupees should come from equity. Are you all able to understand? Now remember, when I say equity, equity covers two sources inside it. What are they? Retained earnings, equity share capital. Be very, very clear. Be very, very clear. Yes? Perfect. Now, cost of debt. Look at the beauty here. Cost of debt. In real life, this is what happens. Cost of debt. Now, up to 1.8 lakhs. What is the cost? 10% before tax means what? This is a coupon rate, interest rate, which means into 1 minus 3 you need to do to arrive at the KD. Is that clear? Now, if you are raising up to 1.8 lakhs from the debt, if you are borrowing up to 1.8 lakh, cost is how much? 10%. Beyond 1.8 lakhs, what will be the cost? 16%. Is that clear? Why? You try taking a bank loan, you will know. Now, there's something called as CIBIL. You guys know? CIBIL score for everyone. Right? This is basically, it shows the credit history of every person. Now, first, before you go to a bank for a loan, they will check your CIBIL. Sir, I have never given, sir. They will get automatic access. You need not give access. Right? Now that CIBIL will clearly show if you have taken already existing borrowing somewhere. If you have defaulted in the past, everything it will show, and it will give you one rating. Anything above 700 is a good rating. Generally out of 800, 700 is a good rating. If the rating is less, now generally what they do, at times if it is very less, they will say we can't give you loan. If it is slightly less, they will say for you I will give you loan at a higher rate of interest. Now let us say two people, Mr. A and B, go to the same bank for the same personal loan. The rate of interest for each of these two people will be different. You guys are aware of that? Yes, it will be different. Reason, based on your credit history and credit rating, the bank will give you a different rate of interest. Why? If you've already defaulted in the past, or maybe the income is less, which means the bank is taking a risk. More the risk, they will expect more return. Is that clear? The more risk, more return concept is there everywhere in finance. Is that clear, guys? Now, what has happened? Now, debt up to 1.8 lakhs, they are saying 10%. Now, further, if you want to raise beyond that, now the bank is giving, or any debenture holders, they are giving more amount. Now, more if you are raising money, it means there is a small risk here. Hence, for the extra risk they take, they want extra return. That's why suddenly they are saying up to 1.8, this is the rate. Beyond 1.8, this is the rate. Are you all able to understand? These are all real life finance concepts. That's why I'm taking a couple of minutes extra and explaining all these things. You guys should be aware of some basic personal finance. Is that clear? This is also applicable in corporate finance. Next, EPS how much? 4. Dividend payout how much? 50% of the earnings. Now, what does it mean? Out of 4 rupees earnings per share, 2 rupees is being paid per share, which means the balance 2 rupees is retained by the company. Are you all able to understand? Perfect. Next, the expected growth rate of dividend given, current market price per share given, right? 44 rupees. Tax rate is 50%. You are required to, number 1, determine the pattern for raising the additional finance. What are they asking? Sir, extra how much I need? 10 lakh. You tell me this 10 lakh. How will I raise it? From which source? How much? That's called as the pattern. Yes, based on debt equity ratio and all these things. Yes, yes. And remember, equity has 2 component sources. Inside equity, you have 2 sources. What are they? Retained earnings and your equity share capital. Is that clear? Based on whatever I've told you, ideally you must be able to do it. Will you? Yes. Next, determine the post-tax average cost of additional debt. That will do. Determine the cost of retained earnings, cost of equity. Easy, no? What model? Gordon's model. Growth rate is given. Obviously, Gordon's model, right? And KR is equal to K, isn't it? Yes, obviously. Then compute the overall weighted average after tax cost of additional finance. Nothing but, what is this called as? Yes, marginal cost of capital. Additional finance means marginal, incremental. So for additional finance, calculate the cost means marginal cost of capital. Now, guys, online folks, pause the video now. Now, 2 minutes is all I need. Now, is all you should take. First, arrive at the pattern. Scribble something, arrive at the pattern based on debt equity ratio and all. They have given something. And inside that also further, under equity, you have 2 components. What is that? Retained earnings and equity share capital. Inside debt also you have 2. Up to 1.8 lakh, 1 rate. So you should say maybe 10% debt, 16% debt. Is that clear? So 2 is there. Okay, be careful. First you arrive at that, and then the remaining part of the question we will be doing it. Guys, that's all it is. I've decoded the sum for you. Now don't take much time. 2 minutes, online folks. Pause the video now, attempt this, and then come back. Okay, guys. Now let's get started. Right. So very good, very good. All of you have got the correct answer. Almost everyone. So out of 10 lakhs, so debt equity, how much they said? So equity should be 70%. I mean 7 by 10. So debt should be 3 lakhs. Now out of the equity component, how much is my retained earnings? First I have 2.1 lakh. The balance 4.9 lakhs will come from equity share capital. 3 lakh. First 1.8 lakh is at the rate of 10%. The balance 1.2 lakh will be at the rate of 16 or 15 or 16%. This is the structure in which I need to raise money. Is that clear, guys? Is everyone able to understand? Please, let's do this. Come on, guys. Now let's do it fast. That's about it. You guys have understood the subject. Now write down question number 16. Write down, guys. Part A. Write down pattern of raising additional finance. Pattern for raising additional finance. Now, write down. First, in the center, write down, guys. How much additional amount I need? Write down in the center, rupees 10 lakhs. Right? You can do it in the flowchart manner also in exam. Pull an arrow and branch it into 2. What and what? Equity and debt. Now, equity has to be a maximum of how much? 70 percentage. Am I right, guys? So within bracket, 70% on 10 lakhs. Exam, you can't write 10L and all. Now I am writing exam, it can't be written. How much is that? Rupees 7 lakh, right? And how about your debt component? It's going to be 30% of 10 lakh comes out to how much? 3 lakh rupees. Is that clear for everybody? Next, now this 7 lakh, pull an arrow and further branch it into 2. First, write down retained earnings. Exam, write it fully. Now I'm writing RE. Retained earnings. How much is it? Write down rupees 2,10,000. How did you get this amount? Within bracket, write down given. Very good. Now, which means the balance amount, how much is that? 7 lakh minus 2,10,000? 4,90,000. Now, what will you write? Take a pencil, put a circle. Now, okay, this is called as equity share capital. And take a pencil, put a circle and write balancing figure. Right? Please do this. Please do this. So, pencil circle stands for what? Balance figure. Now, just imagine tomorrow you're looking at this. Clearly, you will know under every figure how it is being arrived at, right? This pencil, circle, balance figure and all these are some accounting hygienes, right? You can even follow this in your accounts. In costing also, we have followed this while closing the ledger and all balancing. Follow that here as well. Now, how about debt? Now, pull an arrow, branch it once again into 2. Now, the first one is what? 10% debt. The other one is what? 16% debt. 10% debt. Pull an arrow. How much is that? It could be a maximum of 1,80,000. Within bracket, it's given. And then you have the balance of how much? 1,20,000. That's going to be what? Pencil circle balancing figure. Is that clear, guys? Now, if you do it like this, you are clearly intimating to the examiner that, look, this is how I have arrived at the pattern of funding. Another way of doing it is by way of preparing this in a statement format. Look, this way also you can prepare and show this is the amount I've raised. Now, can I follow this in exam? Absolutely yes. So whatever we are doing in the classroom, it's presentation ready for your exam. Don't worry, you can do this. Is that clear? Now let's move on to the next question, next part of the question. Now, what have they asked? Now, what have they asked? Determine, look at this, post-tax average cost of additional debt. This is what they have asked. Now, 1 second. This 10% debt, 10% is what? 10% is pre-tax, guys. Now, you tell me, this is what? This is, life is not given, irredeemable. In that case, what is the formula for computing the cost of irredeemable debt? So, I into 1 minus T divided by net proceeds. So 10 into 1 minus tax rate is 0.5 divided by net proceeds, absence of information, face value. Or in other words, I told you, when it's directly issued at face value, you can take it as interest rate into 1 minus tax rate itself gives you the KD. Am I right? So here it's going to be what? 5%. Here it will be what? Half of 16%, or 0.5 of 16% is going to give me 8%. Is that clear? Now, this is not what they have asked. They have asked for average post-tax average cost of additional debt, which means they are asking you, now I am raising how much through the debt route? 3 lakh. Now, what is the average cost of raising this 3 lakh rupees? Now, 5% is the cost for 1,80,000. 8% is the cost for 1,20,000. Now, inside this, compute that similar to weighted average cost of capital you need to do and say, look, for on an average for this entire 3 lakh, this is the average cost of capital. How will you arrive at this? Simple. 5% into, so 1,80,000 by 3 lakhs plus what? 8% into 1,20,000 by 3 lakh. If you do this, you will arrive at the average, what? Post-tax average cost of debt. Is everyone able to understand? This is similar to, instead of computing average cost of capital, inside debt, since I have multiple components, inside that I compute that average cost of different variants of debt. Is that clear, guys? Directly I can say, okay, sir, fine. How much is the amount coming to you guys have computed? Very good. 6.2. On an average, sir, 3 lakh rupees I raised on an average cost of how much? 6.2. Is that clear? Exactly 6.2 for every rupee? No. For the first 1,80,000, the cost was 5%. The next 1,20,000, the cost was 8%. Average overall, the cost of 3 lakh was how much? 6.2%. Are you all able to understand? This is what it is. Is everyone able to understand? So this can be separately tested as your MCQ also. Watch out for this. Is that clear? So if you have more than one variance of debt, they can ask you for the average cost of debt not average cost of capital. So weighted average cost of debt can be asked. So here inside the debt, you need to do this concept of WACC. You need to apply it inside here. Is that clear for everybody? Just go and do this. Part B. Write down part B. What is that? Write down calculation of post-tax. Use the same language of the question. Average cost of additional debt. Shall we get started? Now, write down, in this case, I can directly use KD is equal to interest rate itself can be used. Why? Now, everything is at face value. I can directly use it. Recall KT formula, term loan. I told you. It's always issued and redeemed at par directly. Or sir, no sir, I want to use this formula of I into 1 minus T divided by net proceeds. You use that, you'll get the same answer. Is that clear? Into 1 minus tax rate. Is that clear, guys? Yes. Okay, fine. Now, in this case, so tell me, write down KD within bracket. What is the first one, guys? 10%. Write down 10% debt is equal to 10% into 1 minus 0.5. Am I right? So how much is that? 5%. Next, KD of 16% debt. How much is that? It's going to be 16% into 1 minus 0.5 gives me 8%. Are you all able to understand? Is there any issue here? Is there any issue here? Now write down average cost of debt. Now this way also you can do. Now let's do it this way. It's easier for you. Now guys, 1,80,000 rupees was raised at a cost of 5%. 1,20,000 was raised as a cost of 8%. Now write down here 5% into 1,80,000 rupees. Correct? Plus 8% into 1,20,000 rupees. Am I right? Now, if you do this, you'll get the total cost that you are paying. That is your total interest divided by what amount? This is the interest paid for what amount? 3 lakh rupees. So in the denominator, divided by what? 3 lakh rupees. Is that clear? Or an alternative way of doing is what? 5% into 1.8 by 3 or 1,80,000 by 3 lakh plus 8% into 1,20,000 by 3 lakh. If you want, you can do it that way also. Is that clear, guys? Into 100, obviously. So into 100. So how much does this come out to? Please calculate and tell me. 180,000 to 0.05 is 9,000. Huh? Okay. 120,000 to 0.08 is 9,600. So 18,600 divided by 3 lakhs gives you, yes, 0.062 into 100 is 6.2%. Write down 6.2%. Are you all able to understand? Is everyone able to understand? Or in other words, on an average, this 3 lakh rupees was raised at an average cost of how much? 6.2% post-tax. Is that clear for everybody? That's about it. Next, part C of the question. What do we need to do? Next, calculate KR and KE. KR is equal to KE. Guys, what method will you use? Gordon's model. EPS is given. Then payout is given 50%, which means DPS is available. Now, guys, once again, this is earnings per share. Past EPS or next year EPS, is it given? No, which means on this, if I apply 50%, I'll get 2 rupees. This 2, is it a past dividend D0 or is it a expected dividend D1? No clarity. What can you do? You can assume anything but write a note. Is that clear? Since nothing is mentioned, you can assume it as anything. We will assume this as D0. So which means what should you do? So D0 into 1 plus G you should do. Only then you'll get D1. Are you all able to understand? Guys, everybody, is everyone clear with this? Right? Yes, expected growth rate is given. Current market price is given. Let's do this. Write down part C here. Write down part C. Calculation of KR and KE within bracket. What model? Write down Gordon's model. You guys are following the color coding, right? Headings, greening, please follow. Guys, the day before exam, when you are touching this book for revision, that's when you will know. Whatever I'm telling you here is well researched, right? And that's the reason I'm telling you, please do it this way. Okay? And remember, whatever notes you are taking right now, please preserve it at least till you finish your CA. Final, all these things will be useful, right? Wherever possible, I will be linking from here onwards. The learning will be incremental, right? We can't learn everything from the scratch. Background I will give, but you need to connect the dots. So these notes will help you there. Fine. Next. Come on, let's do this. So write down. What is the formula, guys? Write down. KE is equal to KR is equal to formula D1 by P0 plus G. Now in this case, what is D1? So first we will calculate. Okay, we'll do here. Write down D0 is equal to, what is EPS, guys? 4 rupees. 50% of that gives you 2 rupees. Am I right? Yes. So now D1 is equal to, okay, let's write G. What is G? 10%. Given. Am I right? Hence D1 is equal to D0 into 1 plus G, or as nothing but 2 rupees into 1 plus 0.10. How much is that? 2.20. Guys, correct? So which means KE is equal to KR is equal to D1 2.2 divided by P0. It's given now. How much? 44 plus G 10%. So tell me, guys, 2.2 by 44 is 5%. So 5% plus 10% gives you 15%. Is that clear for everybody? So you get the figures here as 15%. Any issue, any problem? No. And please write the assumption. Write down note. It is assumed that the dividend given is D0. It is assumed that the dividend given is D0. This note is a mandate. Without note, your answer will be wrong. Please, whenever dividend is coming, write a note. Even if they have given expected dividend or past dividend, institute is taking a very contradictory stand here. Let's not take any chances. Is that clear? So write down, what is it? It is assumed that the dividend given is taken as D0. Now let's go on to the next one. What is that? Part D of the question. What have they asked in part D? Calculate overall weighted average after tax cost of additional finance. Now look how elaborately they have given this. Nothing but MCC, marginal cost of capital. Write down calculation of MCC. MCC. Is that clear? That's about it. Write down. Now how will you do it? The same thing. Source. You can write amount. Yes, here you can write amount. Then proportion or weights. Yes, whichever you want you can write. Then K as a percentage. And then, yes, you can write weighted cost or nothing but MCC. Whichever way you want you can write. Or you can say weight into K. Whatever it is, you can write it down. Not a problem. Now, write down. Now, guys. Can I do something here? Two options. Both will give the same answer. Option 1. Source. 3 sources you can write. Equity. Or, 4 sources you can write. Retained earnings. Equity share capital. 10% debt. 16% debt. Now, what will you do? For these two, the rate is same. 15%. 15. For this and this, respective costs are given 5% and 8%. Like that you can do. Or another way of doing, entire this 7 lakh common cost only. Know what is that? 15%. For 3 lakh also we compute 6.2%. 2 sources you can average out right now, because inside this averaging is already done. If you want, you can take it. Or sir, I want to take 4 sources and do it. Absolutely you can do. Mathematics will give you the same answer only. Is that clear for everyone? So 4 sources and respective cost you take and do, or 2 sources and you take and do, answer will be the same, because this inside has already been averaged out and we've calculated. You can use that figure or respective figure you can use. Is that clear for everyone? Write down. Equity, debt. I will do 2 sources. Equity. If you want within bracket, you can write what plus what. Retained earnings plus equity share capital. Similarly, equity share capital. Similarly, debt within bracket 10% debt plus 16% debt. Is that clear? Next. Figures. 7 lakh, 3 lakh. 10 lakh rupees. Weight 0.70, 0.30, 1. What is the respective cost, guys? Cost of equity 15%. The weighted average cost of debt, if you want, you can take it in a red ink and do it. How much is that? 6.2%. Guys, correct? Within this 3, So respective costs I had, I averaged out and find out what is the average cost of debt. Is that clear? Now compute the weighted cost. 15 into 0.7. How much ma? 10.5. Very good. 10.5%. Then 1.86%. Add it up. How much you get? 12.36% is going to be what? My marginal cost of capital. Or some people even call it as WMCC, weighted marginal cost of capital. Right? MCC or WMCC, everything is same only. Is that clear, guys? Is everyone able to understand? This is another variety of question in marginal cost of capital. The previous sum which we did, right, that had a different learning. This was also marginal cost of capital, but look at this. We did averaging. First, we had to find out the structuring, the structure of raising the money. Then we did inside debt, multiple sources, averaging out and all. This was the incremental learning in this question. Is everyone able to understand? Go and update your library of adjustments. Write down. Write down. MCC hyphen pattern of raising additional finance. Quickly write down. Pattern of raising additional finance, semicolon. Pattern of raising additional finance, semicolon. Red ink, write down. Post-tax average cost of additional debt. Post-tax average cost of additional debt. That's all. These, in this question, these two are the incremental learnings. Post-tax cost of additional debt. Post-tax cost of additional debt. That's about this particular question. Now let's move on to the next question, shall we, guys? Let's move on to the next one. So with this, we have done what? Question number 16, huh? Perfect. It's done. Let's go on to question number 17, shall we? Okay. Now this was a past MTP question, but I've picked this question for a reason. A good one. Shall we get started? Yes, guys. Once again, I've told you, bring that survival instinct. Assume this question is coming in your exam. Recall. One attempt is equal to 4 lakh rupees. Have this in your mind, right? So what you lose in the attempt is not your exam fee alone. It is 4 lakh rupees plus exam fee, right? So both are actually included. Recall, you guys have attended my costing class. There we did know in one chapter, employee cost. What is the profit foregone due to labor turnover? There we did PV ratio of that sales lost. So contribution lost plus incrementally settlement cost and other things. Everything is included there, right? So recall that. I am not saying this to frighten you. I am saying this so that then and there when you tell yourself, automatically the seriousness will kick in. That is a must, guys. Shall we begin? Right. Now, question number 70. Jitarth Limited has a current debt equity ratio of how much? 3:7. Debt equity ratio, you guys know? Debt upon equity. That's all. 3:7, which means 3 plus 7 is 10. 3/7 means 30% of the total capital should be from debt. 70% should come from equity. Understood? Perfect. The company is presently considering several alternative investment proposals costing less than 25 lakh. What are they saying? They are planning to invest in assets less than 25 lakhs. Means what? Which means they are looking for funding less than 25 lakhs. That is the meaning of that. Guys, correct? Investment. How can you invest? Only if you raise. We are in the first objective of the subject. We are not in investment decisions, financing decision. But we are financing for what? Investment only. Is that clear? So if investment value is given, it means that is equal to the finance value. Are you all able to understand this? This interlinking you need to have. That's why I gave the introduction. Next, the company will always raise the funds required. Look, what have they given? What have they given? Important line. Without disturbing its current capital structure ratio. Means what? Existing weights should be maintained even for every single rupee raised additionally. Are you all able to understand? If I raise 1 rupee extra, randomly from any source I can't take. I have to maintain the same mix. Is that clear, guys? That is the meaning. Now, what are they given? The cost of raising debt and equity are as follows. Now, what have they given? Wow, excellent, guys. KD, KE is given. Now, if you are raising additionally up to 5 lakh, be very clear. 5 lakh of what? Debt alone or equity alone? No. Cost of the project they are saying. Overall, total additional funding up to 5 lakh. In that case, KD will be 10. KE will be 12. Sir, above 5 lakh up to 10 lakh. In this range, if I'm operating, KD, KE, different. It will change. Right? It will increase. Both will increase. Now, sir, beyond 10 lakh up to 20 lakh, further increase in KD and KE. Above 20 lakhs, further increase in KD and KE. Now, what are they saying? You don't have 1 KD, 1 KE. Now, depending on the total amount that you are raising, your KD and KE are changing. Another new variety of question. Now you guys are able to understand why I'm doing so many variety of questions, because I know if I don't do these kind of questions, now what you guys will do in exam if this comes, now I know what you guys will do. You will not just stop there. You will scold me. Then you will pull my linear descendants, and you will pull everyone and scold them also. So I don't want that kind of curse. That's why I'm doing it fully. Clear? Right? So you will scold, huh? Okay. So corporate, in fact, this is the reason why I never wanted to sign up as an exam paper evaluator. Okay, because whether the mistake is at the evaluator or not, he will get a lot of curse. So I want my own life and my future generations also to be very good. So I know, because I was also once a student. So I know that. Coming back, corporate tax rate is 30%. Calculate. Number one, the cutoff rate for two projects, 1 and 2, whose funding requirements are 15 and 26 lakhs respectively. Wait, cutoff rate means what? Cutoff rate means what? Cost of capital. Guys, cutoff rate. I told you, one second. I told you in our concept decoder itself, everything is given. I have asked you to underline. That's why I asked you to take this concept decoder, hard copy, and do it. This is the reason. I will show you this cutoff rate would have been. Look at this. Cutoff rate, hurdle rate, minimum rate of return. The cost should be at least be earned. So the minimum required rate of return should at least be equal to my cost. That's why I said cutoff rate, hurdle rate, minimum rate, and all means what? Cost of capital. Is that clear, guys? In exam, if you see all these things, it means what? Your weighted average cost of capital. Is that clear, guys? Are you all clear with this? Please mark it, or whatever it is, do it. Your entire books. This is the reason I'm asking you to, do all these workings and all, color coding in a certain way. In exam, even if you want to forget, you will not forget. That is the main reason. Fine. Now, what are they saying? Suppose project 1, I want to raise 15 lakh. What is the total cost of capital? Suppose project 2's value is how much? 26 lakhs. What is the overall cost of capital? Is that clear? Any problem? Any issue? No. Next. If a project is expected to give an after-tax rate of return of how much? 13%. Determine under what conditions it would be acceptable. Means what? Now they are saying they have raised money. They are investing it in a project. Investment decisions. Now from that investment, they are earning a return of how much? 13%. Now they are saying determine under what conditions it would be acceptable. Means what? Simple. This is the return from the project. Compare this with the weighted average cost of capital. If this return is more than cost, then you can go for that investment proposal. If this return is less than cost, definitely don't go for the proposal. This is the meaning. Which means project 1 is there, project 2 is there. For each of the two projects, we will compute WACC. Now, part 2 of the question, very simple. Compare that with 13. Right? Wherever the cost is less than 13, that project can be accepted. This is the net meaning of the question. Is that clear? Now, what I will do is, I will give you guys 2 minutes time. Figure something out. I told you, bring that survival instinct. Someone is dropping you in the middle of the ocean. You will not give up and die. Never say die attitude. Bring that survival instinct. Right? Recall this and then start doing it. Start doing it. You will get it, guys. That's about it. Online folks, come on. Pause the video now. Take 2 minutes time. I want the answer by the time we finish. You complete these 2 minutes and then start watching the lecture. Now, guys. Now, what have they given in the question? Now they are saying first, the company wants to maintain a debt equity ratio of 3:7. What is the meaning of that? Whenever they are raising any money, 30% of that will come from debt. 70% of that will come from equity. Every rupee raised, 1 rupee if I'm raising, randomly I will not take fully from equity, fully from debt. No, 30 paise will come from debt, 75 paise from equity. Is that clear? Right. Now, what are they saying? They are considering several investment proposals. All these things they have given. The cost of raising additional money, they have given KD and KE, which means for the first 5 lakh rupees they are raising, right? For the first 5 lakh, KD is 10%, KE is 12%. Now, suppose, sir, I want to raise 7 lakh rupees. First 5 lakh, this is the respective cost. Next 2 lakh, this will be the cost. Exactly. Or in other words, this is like income tax slab rate. Now, don't say project 1 value is how much? 15 lakh. Now 15 lakh comes in third range, which means right from the first rupee till the 15 lakh rupee, now the entire cost is only 13% and 15%. No. For the first 5 lakh, KDK is this. Next 5 lakh, this is the KDK. 5 to 10 is given on next 5. Then 10 to 20, next 10 lakh, this is the respective cost. And beyond 20 lakhs, this is the cost. So literally, you need to do this in a slab-wise basis. Are you all able to understand this? Is there any problem here? Is there any problem here? Guys, is everyone able to understand? Has anyone got the answer? 12.95 is correct. 12.95 for project 1 is correct. Project 2, you arrived at? Okay, anyways, we will do it. Don't worry. Now, guys, 1 second. Now this is just computation driven. Nothing more technical about it. So the answer is already given in the book. Can we just do it in the book itself? Right? Beyond this, there is no conceptual learning, but this is one variant of question. This is like slab rates. Please follow this. Now, what am I saying? Let us say a person wants to raise 8 lakh rupees for the first 5 lakh. This is the KDKE. Then beyond 5 lakh, every rupee I raise, this will be the cost of debt, this will be the cost of equity, which means I said how much? 8 lakhs, right? 8 lakh rupees I want to raise. First 5 lakh, this will be the cost. Next 3 lakh, this will be the cost. Is that clear? So slab wise, so what they have given, first 5 lakh, this is the cost. 5 to 10 means another next 5 lakh, this is the respective cost. 10 to 20, next 10 lakhs, this will be the cost. Beyond 20 lakhs, this will be the respective cost of debt and equity. Is that clear, guys? Right. Now, they are saying, first they are asking what? So now with this, first we need to compute. Simple, guys. Now how you need to do this question? Now look at this calculation of, look at the new variant. Take your pen, right? Underline this, slab wise overall cost of capital. This is what you need to do. Another variant of question that can come in your exam. What is this? Slab wise overall cost of capital. Sir, what is a slab wise? Just now I told you, this is like income tax slab. First 5 lakh one rate, another 5 lakh another rate, and so on. Is that clear? Now, how do we do it? Up to 5 lakh. Now, the weight of debt and equity is how much? Guys, every time it's only 0.3, 0.7. For the first 5 lakh, what is the cost of debt, cost of equity? 10%, 12%. Now, multiply this. Now, I would say KO is how much? 11.4%. Or in other words, for the first 5 lakh, average cost is how much? 11.4. Every rupee you raise, it will be raised with a cost of how much? 11.4%. Is that clear? This is the cost applicable only for every rupee that you raise up to first 5 lakh. Is that clear? Right? Because every time I raise, I will raise 30% of it from debt, 70% of it from equity. I have the respective cost. I arrived at it. Is that clear, guys? Is that clear for everyone? Guys, come on, tell me. Puridama. Is everyone able to understand? Next, what do they say? Above 5 lakh, up to 10 lakh, which means, sir, I want to raise beyond 5 lakh. Wait, this cost is not applicable for you. First 5 lakh, this is the cost. Fixed. Don't worry. Right? Next 5 lakh, what is the cost? Now, weights 30, 70. Now, here, KD and KE are changing. 12%, 13.5%. So, 0.3 into 12 plus 0.7 into 13.5. We are computing the weighted average cost here. Now, literally, you get how much? KO as 13.05%. Which means what? The first 5 lakh, every rupee that you raise has a cost of how much? Average cost 11.4. Now, from 5 lakh 1 rupee to 10 lakh rupees, every rupee you raise will be at a cost of how much? 13.05. So this is at a slab rate. Are you all able to understand? Don't say, sir, I want to raise 6 lakh rupees. It rises in this range. From the first rupee to the 6 lakh rupee, it will be costing 13.05. No. First 5 lakh, this is the cost. The next 5 lakh, this is the cost. Is that clear, guys? Is everyone able to understand the manner of computation here? That's why I said slab-wise overall cost of capital. Is that clear? Next, from above 10 lakh up to 20 lakh, KD and KE are given 13 and 15, which means proportions will not change. Into the respective cost, you arrive at what? KO. This KO is applicable for what? This KO is applicable for what, guys? Now, 10 lakh and 1 rupee to 20 lakh. Now, here, every rupee is bearing a cost of how much? 14.4%. This is the meaning of this. Is everyone able to understand? Guys, is everyone able to understand? Next, above 20 lakh, 14%, 16%. Simple. So, 0.3, 0.7, 14, 16, multiply with the respective ratios with the respective cost, proportions with the cost, you will get 15.4%. Is that clear for everyone? Is that clear for everyone? Now, or in other words, if you want me to put it up in a graphical format, you can maybe write it down in your book itself. This is question number 17. Now, if you want me to put it in a graphical format, I will say up to the first 5 lakhs, I have a particular rate. What is my KO, guys? So it's going to be how much? 11.4%. Am I right? Above 5 lakhs, up to 10 lakhs, it's going to be how much? How much? 13.05. Every rupee raised here will cost me 13.05. Is that clear? Now, 10 lakh to 20 lakh. Each rupee raised in between this range will cost me how much? Weighted average of both debt and equity. This is not debt alone, equity alone. They have given proportions. Weighted average, every rupee will cost me how much? 14.04. Sorry, 4%. Yes, 14.4%. And any amount raised beyond 20 lakhs will cost me how much? Every rupee raised beyond 20 lakhs will cost me 15.4%. Are you guys understanding the concept in this question? It is a slab-wise computation of your KO. Are you all able to understand? So if I'm raising first rupee till 5 lakh rupee, every rupee has a cost of 11.4. 5 lakh and 1 rupee till 10 lakh rupee, every rupee bears a cost of 13.05. 10 lakh and 1 till 20 lakh rupees, every rupee bears a cost of 14.4. Above 20 lakh, if I raise, every rupee will actually bear a cost of how much? 15.4 rupees. This is the meaning of the question. Is everyone able to understand? And slab wise, you need to compute. Are you all clear with this? Are you all clear with this? Perfect. Now, go to project 1 and 2. Suppose I'm going for project 1. What is the investment value of project 1? 15 lakh rupees, which means in that case, how will I raise? First 5 lakh has a cost of first range 11.4%. This one, ma. Correct. The next 5 lakh will have a cost of how much? 13.05. The next 5 lakh will have a cost of how much? So the next range is 10 lakh. No, sir. Wait, but I'm raising only till 15 lakhs. So first range, second range is exhausted. In the third range, I am taking only extra 5 lakh rupees, right? And every rupee taken in the third range cost me how much? 14.4%. Are you all able to understand? Now, for this 15 lakh rupees, what is the overall cost? Right? Now, how do you do? Two ways of doing. Here, I can take proportions. Guys, correct. So, I can take 0.333. Yeah? 5 lakh by 15 lakh. 5 by 15 is 1/3. 0.333. Am I right? So, 0.3333. This is also 0.33333. This is also 0.33333. So, this weights into the respective cost. If you do, you'll get the overall cost. Guys, correct? Or. Another way of doing it is, for 5 lakh rupees, this was the cost, multiply, you get the total amount in rupees, right? For the first 5 lakh. For the next 5 lakh, it costed 13.05, multiply. Next 5 lakh into 14.4, you arrive. This is the total cost in amount. This is the cost incurred for raising how much amount? 15 lakh rupees. Divide the two, you will get the total cost of capital. Or you can do it using proportions. Both are same. I proved it earlier itself. WACC formula itself, I proved it like this only. No. Are you all able to understand? If you want, you can also take 0.333333 and you can do it. 0.33333 into 11.4 is equal to M plus 13.05 is equal to M plus 14.4 is equal to M plus 1 MRC. You get 12.9499 or another word 12.95%. It's 0.3333 common, no? Common number multiplied with different numbers. You can use a calculator trick. 0.333333, retain it into this is equal to M plus, this is equal to M plus, this is equal to M plus 1 MRC. You will get the final answer. That's all. Guys, correct? Is everyone able to understand this? Right? When you are doing all this, suppose the same question comes in your, MCQ, the step marks are not there. Quickly do it using the calculator trick. The simple piece of machine can do wonders. Guys, for that, you need to practice sums. That's the reason why I'm asking you after the session, please revise. If possible, practice the sums with your hand. That's when you will get the complete control of the subject. I have something called as a supplementary question bank also. Please do that as well. Right? Anyways, for regular course students, I'll be discussing that as well. For EVO students also, you guys please do it. You please do it. Everyone take your pen out and start doing it. That's when you will get a complete control and command of the subject. Is that clear, guys? Right? You guys got it? So now, which means for the first project, overall, for raising 15 lakh rupees, what is the overall cost? 12.95%. Guys, are you all able to understand? This is the average cost for raising how much? 15 lakh rupees. Guys, everybody able to understand? Now, second project, what is the value? 26 lakhs. Now, here they have given, they are looking for proposals less than 25, but still they are looking at 26 lakh. Why, sir? Maybe for some reason, which means this is irrelevant data. Are you all able to understand? It means this is irrelevant data. Fine. Now, in this case, what is that? Now, 26 lakh means what? Now, once again, slab rates. First 5 lakh. there is a cost. We already computed 11.4. Next 5 lakh, this is the cost. Next 10 lakh, this is the cost. Then beyond 20 lakhs. So beyond 20 lakhs, I'm taking only 6 lakhs, no, 26 minus 20. So this is the cost. Is that clear? Now, respective weights into respective cost you do, you will arrive at what? The cost of capital for the second project, which is going to be how much? 13.79%. Is this clear? So the cost of the first project, cost of capital for the first project is 12.95. Cost of the second project is 13.79. Is that clear, guys? Now go on to the third part of the question. What is the third part of the second part of the question? If a project is expected to give me a return after tax of how much? 13%. Determine under what conditions it would be acceptable. Now one more thing, be very careful. What have they given here? After a tax return. Suppose here, before tax return is given, what you should do? Into 1 minus t you need to do. Why? Because you are comparing this return with the cost. Cost is after tax. Your return should also be after tax, and only then it should be comparable. Is that clear? Now watch out for these things. Institute is known for doing all this. Suppose they have given pre-tax return, which means this is before tax. Out of this I need to pay tax now. Which means into 1 minus you should do, and only then you will arrive at what? Post-tax return. Here don't do all that. It's directly given post-tax only. Is that clear? Only post-tax return can be compared with the WACC, because WACC is post-tax earlier. WACC is post-tax or not? Yes, how do you know? One component alone is post-tax. KD, how do you arrive? Into 1 minus t, which means post-tax cost of debt only we are computing. That can only be compared with what? With that only be compared post-tax cost of capital. That should only be compared with the post-tax return that you generate from your investment. Is this clear, guys? Are you all able to understand the base from where I'm building this? Guys, right. Please write this down. That's the reason why I'm asking you guys to take your pen out and do it. Right? Different colors you have. Use any color you want. One color for every letter also you can use. So many colors we have. Right? Guys, clear with this. Now what is my post-tax return? 13%. Huh? Okay. Now, my projects are going to give me a return of how much? 13. Project 1 has a cost of 12.95. Whereas project 2 has a cost of 13.79. Now you guys tell me, project 1 if I take, every rupee I raise, I'm going to incur a cost of 12.95, but every rupee using this I'm investing, I'll be able to get a return of how much? 13%. Can I go for project 1 or not? No. Emma, you are borrowing, let us say at 12.95%. You are investing in the share market, let's say in FD, you are earning 13% out of it. Out of the 13%, you will pay 12.95%. Still you will get 0.05%. Yes, your profit only, no? Correct? So you will go for project 1. Guys, when the return is more than cost, it is acceptable. Now, in second scenario, you are borrowing or you are taking funds at a cost of 13.79 and investing and getting only 13%. Will you go for this project? Definitely not. Is this clear, guys? Is this clear? But this is not their own. This is not the only thing they are asking. They are asking for something also. What is it? I'll tell you. Look, if a project is expected to give an after-tax return of 13%, determine under what conditions it would be acceptable. They are not asking whether project 1 can be accepted or project 2 can be accepted. They are asking you when, under which scenario can I accept a particular project. This is what they are asking. Now, this is out of the box, guys. This entire sum, please mark this as important. This is out of the box. That's why some MTP questions are extremely absurd and some MTP questions are extraordinary. This is one of the extraordinary sums under MTP scenario. Now, what are they asking? You will not believe. We need to do interpolation here. Sir, what are you saying? I will tell you. Everything is given, but don't worry. Just focus here. Now, guys, you tell me. Now, KO, I have, and then I have, let us say this one. Once again, let me put it here. KO and project cost. Now, project 1 had a cost of how much? Come on, guys, how much? No. Okay, 12.95. Okay, 12.95% was the cost of KO. What is the cost of project means? I'm talking about the value. Investment requirement. How much was that? It was 15 lakh rupees. Guys, correct? Project 2. This was project 1. Project 2. How much was the value? 26 lakh rupees was the value of the project. What is the cost? 13.79%. Guys, correct? Now they have clearly said whatever is the project, it will give you only 13% return. Which means in this scenario, you are accepting project 1 because the cost is less than 30. You are rejecting project 2 because its cost is more than 13%. Guys, correct? Now we will have to find out under which scenario will my cost be exactly equal to 13%, or in other words, what should be my project cost in order to get a KO of exactly 13%, right? Now I will arrive at that value. Wait 1 second. Why am I arriving? Which means with this, what decision can you take, sir? Simple. All projects with a value of up to this figure can be accepted. If suppose the project value is beyond this, then clearly I know that your cost will exceed the return, hence don't go for it. Are you all able to understand? This is similar to break-even point that we see in the marginal costing but calculations are different. I'm telling you the concept, right? It is the point where my cost is equal to return. So here literally with this we should do interpolation. Are you all able to understand? So when will my KO be equal to 13%? I need to calculate. Is that clear? How can we do that? Simple. Now, if I increase my KO, okay, one second. Now, how do you do this? Simple calculation. Guys, please focus here. Now, if I increase my project cost by how much? 26 minus 15, how much? 11 lakhs. Huh? So, if the project cost is increased by 11 lakhs, by how much is my KO increasing? 13.79 minus 12.95. It increases by how much? 0.84%. Am I right? But I want my KO to max increase by how much? 0.05% only. Guys, are you all able to understand? Which means by how much maximum my project cost can be increased. This is the calculation. Interpolation. Now, this is the meaning of that. Is everyone able to understand this? Is everyone able to understand this? So now, how will you do that? Very simple. Now, in this case, what I need to do is simple. For a 11 lakh change, what is going to be the change in your KO? 0.84%. But the required change in KO is only 0.05%. By how much it should change? Are you all able to understand this? Guys, so for a 11 lakh change, guys, correct? So how much is the actual change in KO? 0.84. But the required change in KO is only 0.05. So which means by how much should my project cost increase? So 11 divided by 0.84 into 0.05 gives you how much? How much is this? 0.654766548, which means my project cost can increase by a maximum of 0.6548, or in other words, 15 lakhs plus 0.6548 lakhs. It's going to be giving you how much? 15.6548 lakhs, which means you can accept all the projects which has a project value up to 15.6548 lakhs. This is the meaning. Because why? Because up to this, your cost will be up to 13%. If the project value is beyond this figure, then the cost will be more than 13%. Cost more than return. You have to end up rejecting it. Are you all able to understand? This is exactly what they are testing you in exam. Another variety of question. Is that clear, guys? I didn't create this question. MTP, your publication, ICAS publication. Institute can make or break an attempt. Please remember that every attempt, one paper in every group will be difficult. It could be any paper. That's the reason why we are giving a complete coverage here in the classroom, so that even if it is difficult for the rest of India, I want you guys to come up with flying colors. 50 out of 50 is possible, right? Past, our student has scored a 50 out of 50. It's no joke. Jan 2025 attempt. 50 out of 50, 100% marks a student has scored. It is possible. Tell yourself that. Many people say this is difficult and all because they don't spend this much time. That's the reason, right? It's easy to blame things on the outside. When you spend this much amount of time, obviously you will not lose. Is that clear, guys? Don't worry. Every single thing I have put it here. Every single thing has been covered here, right? This is the final answer. Are you all able to understand this? Are you all able to understand by interpolation and all? So what is the meaning of this? It means what? So, okay. What have we calculated? If any project is expected to give an after-tax return of 13%, it can be accepted only if the maximum cost of capital is equal to or less than 13%, right? Which means the project would break even. Break even means what? Cost is equal to your return, or in other words, you are left with zero profit. That is the meaning of break even, right? From the project incurring a 13% COC, which means when will I break even? When the project value is exactly 15.6548 lakhs. Is that clear? Right. So which means, guys, in this case, this is going to be the make or break decision. So if the cost of the project is up to this figure, so I mean, if the value of the project is up to this figure, your cost will be less than 13%, which means you can accept it. Exactly, if the value of the project is this, then your cost will be equal to your return. If the value of the project is beyond this number, in that case, what happens? Your cost will exceed the return, and in that case, you can't accept the project. Is that clear? Please go and update your library of adjustments. Write down. Write down. Write down. Calculation of slab-wise KO. Slab-wise WACC. Write down. Calculation of slab-wise WACC. Semicolon. Semicolon. Accept or reject a project. Accept or reject a project. Accept or reject a project by comparing KO with return of the project. With return of the project. With return of the project. Right? That's about it. Mark the sum also as important. Please mark the sum also as important. Fine, guys. Right? So with this, I am concluding this session. Please revise and practice all the sums we've covered till now, and I will see you all in the next one. Thank you all so much. Bye. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now, let's continue our discussion in this chapter, cost of capital. All right? Now, let's move on to the next concept called as cost of convertible debentures. Literally, we have finished the entire base of this particular chapter. Now, certain add-ons we are going to do, small concepts. Now, we saw KD was what? Cost of debentures or cost of debt, right? Now, there is one type of debenture called as convertible debenture. Now, what do you mean by a convertible debenture? Let us say a debenture is issued today with a maturity or life of, let us say, 5 years, right? Now, at the end of 5 years, generally what the company will do, they will repay back the amount to whom the debenture holders. That redemption value, right? The amount that the company repays at the end of the life is called as redemption value. It could either be at a par, premium, discount, whatever it is. Clear for this, guys? Now, there are some type of debentures where at the end of the life of the particular debenture, that is on redemption, instead of paying cash to the debenture holders, now what the company will do is they will issue equity shares, and they will give these equity shares to whom? These debenture holders. Is that clear? Or in other words, the manner of repayment of this debenture is not by way of cash, but it is by way of issue of some equity shares. Is that clear, guys? Now, or in other words, technically in this case, what happens? This is called as convertible debentures because the debentures can be converted into equity shares. Are you all able to understand? Now, there is one catch here. What is that? Now, sir, at the maturity of this particular debenture, mandatorily every debenture, will it be converted into equity share? No. Now, at the end, that is at the life, that is at the on maturity, the debenture holders, the investor, is given an option to either convert this debenture into equity share, or if he wants, the company will pay him cash. Is that clear? Now, let us say you have invested in the debentures of a company. Right? Now, convertible debentures you have actually invested. Life is 5 years. On maturity, now the company is giving an option, right? What they are saying, now every one debenture, right, can be converted into 2 equity shares, or in other words, for every debenture holder, right, who holds one debenture, 2 equity shares will be issued upon maturity. Is that clear, guys? Now, you tell me, this is just an option. It is not mandatory. Now, you have 2 options at the end of the life. Number 1, you say the company pay me cash, which is redemption value, right? Nothing is mentioned. It is at par. Is that clear? Or alternatively, instead of receiving cash, now the company says you have an option of converting the debenture into 2 equity shares. Which one will you prefer? Which one will you prefer? Come on, everyone. Equity share? No. No. You can't just say just like that. How, sir? It depends on what is the market price of the share at the end of 5th year. Suppose, for example, the cash value means what? Redemption. If they are redeeming it in cash, the company is ready to pay 100 rupees. Is that clear? Now, suppose if you want to convert it into equity shares, right? Let us say at present, now every equity share, current market price of equity share is, example, I am telling you, 60 rupees is the value of one equity share. They are saying they will issue 2 equity shares instead of one debenture. Whoever holds one debenture will be given what? Will be given 2 equity shares. Now, every equity share has a value of how much? 60 rupees. How much you get now? 120 rupees. Or in other words, the value of equity share in this case is more than the value of cash. In this case, you will say, no, I will go for equity shares. You pay me equity shares. Is that clear? Sir, I want cash immediately, sir. Don't worry. Ask them to issue equity shares. Go to the secondary market, sell it and encash this 120 rupees. Is that clear, guys? Or let us say another scenario is there. Instead of 60 rupees per equity shares, currently the current market price of equity share is only 40 rupees. Now, in this case, the value of the 2 equity shares will be how much? 2 into 40. How much is that going to be? 80 rupees. Now you tell me, will you ask them to convert it into equity shares or will you ask them for cash? You will now ask them cash only. Any rational investor will go for that alternative which gives him a higher redemption value. Am I right? Or in other words, guys, in this case, the KD calculation is exactly same as a normal KD calculation. What is a normal KD calculation? 2 methods, redeemable debentures. 2 methods. One is IRR method. The other one is shortcut method. In that shortcut method, what is the formula? I into 1 minus tax rate plus RV minus NP by N the whole by RV plus NP by 2. In this case, RV calculation alone is the issue here. RV is what? Higher of the cash value or the value of equity shares. Is that clear, guys? That is exactly what I have mentioned in our concept decoder. Please take your concept decoder and underline this. Now look at this. The holders of convertible debenture have an option. It is not mandatory. Option to either get the debentures redeemed into cash or get specified number of the company's equity shares in lieu of cash. In lieu means instead of cash. Is that clear? The calculation of cost of convertible debenture are very much similar to that of redeemable debenture. While determining the redemption value of the debenture, it is assumed that all the debenture holders will choose the option which has a higher value and accordingly it will be considered to compute the cost of debenture. So redemption value is what? Higher of cash value or the value of equity shares. Is this clear for everyone? Everything else is same. So when it comes to convertible debenture, calculation of redemption value alone is different. What is that? Higher of cash value or value of equity shares? Whichever is higher, you take it. Is that clear, guys? Because that is what every investor will prefer. Am I right, guys? Is everyone able to understand? Right? With this, let's go on to do the next question, number 18. Shall we begin? Come on, let's get started with the question number 18. Okay. Now, a company issued 10,000 15% convertible debentures of rupees 100 each with a maturity of how much? 5 years. Now, 15% is what? Coupon rate. It's a convertible debenture, 100 each face value. Maturity is 5 years. At the maturity, the debenture holder will have an option to convert the debentures into equity shares of the company in the ratio of 1:10. Means what? 10 shares will be issued for every debenture you hold. Is that clear, guys? Perfect. Now, the current market price of the equity share is how much? 12 rupees each. And historically, the growth rate of shares is how much? 5% per annum. Compute the cost of debenture assuming a 35% tax rate. Now, first one, you tell me. Will the debenture, you are a debenture holder of the company. Now, at the end of the life of the debenture, 5th year, maturity, 2 options you have. 1, either receive the redemption value in cash, or number 2, what can you do? You can receive what? The equity shares. How many equity shares? 10 equity shares you can receive. Is that clear, guys? Is that clear? Perfect. Now you tell me, you are an investor. Which one will you prefer? You want to receive cash or you want to get it converted into equity shares? Which one you want? You want 100 rupees cash or you want 10 equity shares at the end of the 5th year? Which one will you want? Equity shares. Why? 10 equity share. What is the value of 10 equity shares? How much? 120. Correct? Wrong. The value of every equity share is not 112 rupees. Now, please understand, read the question carefully. The current market price is what? 12 rupees. Now, when will you be issued equity shares? At the end of 5th year, which means you should consider what? You should consider the value of every equity shares at the end of a 5th year. Is that clear, guys? Is that clear? That should be used for the purpose of arriving at the decision whether you need to receive cash or you need to receive what? Equity share. Is that clear? But your answer is correct. That is get equity shares. But in this case, please understand. Please understand. Even if you do it in present value, you get it. But look, when are you going to take the decision? At the end of 5th year. At the end of 5th year, for every equity share, you will receive how much? Cash option. For every debenture, you will receive how much? 100. Right? Or you will receive 10 equity shares. So 10 equity shares into the market price per share of every equity share at the 5th year should be taken into account. Is that clear? Now, the current market price of every equity share is how much? 12 rupees. Now, they've clearly given every year the equity share is going to grow at the rate of 5%, which means, can I say the future value, that is the value of every share at the end of 5th year will be 12 into 1 plus R, 1 plus 0.05, the whole power n. Compound interest formula. This is future value. Why? Now I have the present value with me. What is the present value? 12. What will be the value at the end of 5th year? Every year it compounds at 5%. This is how much it will be. Guys, are you all able to understand? Once you get this, what will you do? This into 10 will be the value, equity value of every debenture. Is that clear, guys? That should be compared with 100. If this is more than 100, ask them to issue equity shares. If this is less than 100, ask them to pay cash itself. Is that clear? Now, if this is more than equity, if this is more than the cash value, in that case, this should be taken as the redemption value for the purpose of computing KD. Are you all able to understand this? Right? Please understand and remember this. You should not take the present value, today's value. Why? Because the decision of receiving cash or receiving equity shares is taken at the end of 5th year. Hence, the share market price at the end of 5th year is relevant, not today is relevant. Is that clear for everyone? Shall we just go and do this sum quickly? Yes, write down. This is question number 18. Write down question number 18. Shall we get started? Yes, write down. Step 1. Calculation of redemption value of debenture. Right? Now write down. Redemption value is, take a red ink and write higher normal ink of number 1. What is number 1? Cash value of debenture, which is equal to how much? So nothing is mentioned, which means rupees 100. Or number 2, what is this? Value of equity shares. Now, how much is it? For every debenture, I'm going to get how many shares? 10 shares into what is going to be the share price at the end of 5th year. Can I say 12 into 1 plus R, which is 0.05 to the whole power 5. Is that clear, guys? Now, how much is this? 10 shares into 1.05 into is equal to 2, 3, 4, 5 into 12. How much you get? Yes, it's going to be 15.316 if I'm not wrong. Am I right? 3153, yeah. Yes. So 3153, okay, or 3154 ideally. 3154, am I right? Or which means this is the 15.3154 is the market value of every equity share at the end of 5th year. Now I'm going to get 10 equity shares for every debenture, which means for every debenture, what is the redemption value in, if you are going through the equity route, it's going to be 153.154. Am I right, guys? This is going to be what? The equity value. Now you tell me, will I receive 100? Will I want to receive 100 rupees or 153.154 rupees? 153.154. Hence, write down. Therefore, redemption value is equal to rupees 153.154. Are you all able to understand? Is there any issue here? This is the only difference in convertible debenture. No other change. No other change. Everything else is same. Is that clear? Formula, everything is same. In the redemption value alone, you will take the higher of these two figures. Are you guys able to understand? Any issues, any problem? Any issues, any problem? That's about it. Write down. Now, write down. Now, have they given any method to do? KD, which method? Formula or YTM? Nothing is given. Yes, just go and do this. Write down. We will use what method? Approximation. Step number 2, write down. Calculation of KD within bracket approximation method. Write down. KD is equal to, guys, everybody, I need the formula. Come on. I into 1 minus T plus RV minus NP by N the whole by RV plus NP by 2. Very good. Now tell me, what is the interest? It's a 15% debenture. So every debenture I'll be receiving 15 rupees into 1 minus, what's my tax rate? 0.35 plus RV. Take a red ink and update this alone. Yes. How much? 153.154. Normal ink minus, what is the net proceeds I received today? Nothing is mentioned, which means issued at par. No flotation cost. Divided by what's the life? 5 years, the whole by 153.154 plus NP 100 by 2. Is that clear? It's going to be 15 into 0.65 gives me 9.75. 9.75 plus 153.154 minus 100 by 5. You get 10.63. 10.6308 divided by, going to be 253.154 divided by 2. 153 plus 100 is 253 by 2. It's going to be 126.57. 126.577. How much is that going to be? 9.75 plus 10.6308 divided by this figure. 16.10%. You get 16.10%. That is going to be what? Your KD, cost of convertible debenture. Is that clear? The only difference is what? Calculation of redemption value. Everything else is same. Now you guys are able to understand just incremental learning. That's why I'm doing it at the end. Are you able to get this, guys? Are you able to get this? Now this concept is there predominantly in your debentures only, right? Predominantly there in debentures. Convertible preferentials can also be issued. In case that comes, what will you do? Same thing. Redemption value alone, you take it. Is that clear? But generally they ask this. Your syllabus is there only in debentures. Are you all able to understand? Any issue, any problem here? In this case, first step is what? Calculation of redemption value. What is that? Higher of cash value or the value of equity shares? Is that clear, guys? Right? That's about it. No. Guys. 1 second, please focus here. Now, please focus here. When you are computing the value of, the equity shares, you should take the value of the market value of the equity shares as of today or as at end of the life of the debenture. End of life. Now, in one question in a past exam, you know what they did? They said current market price currently is how much? 12. They didn't mention like this. They said the market value of every equity share at the end of first year was 12 rupees. Example. Right? In this case, what will you do? This 12, in this case, the value T0 is equal to 12. Now, as per the wordings of the question, in one question in exam, they said that every share is quoting, or maybe they have given the market price of the share at the end of first year is how much? 12, which means the value as at the end of first year, T1 is 12. Guys, we need to find out T5. Or in other words, you need to compound this only for the next 4 years. Are you all able to understand? Now, 0 to 5 takes 5 years. Already they have given the value as at the end of first year, which means now from first year, second, third, fourth, fifth, just 4 compounding you need to do. In that case, the value of every share at the end of fifth year is going to be 12 into 1.05 to the power 4 only. Are you all able to understand? Guys, so don't jump to the answer. Read the question carefully. In this case, T0 means value as on today is given. Suppose the question value at the end of first year is given, then which means 1 year compounding you need to do, reduce it, because it's already they have arrived at the value at the end of first year. Suppose second year is given, you need to find the value at the end of fifth year, means only 3 years you need to compound for it. Are you all able to understand? This you need to have properly, and this you will be able to get only if you are properly reading the question in exam. That's why at the time of reading itself, in your exam also, take a pen or pencil, whatever it is, circle certain things. In this case, they have given current market price, means today. Market price at the end of first year means at the end of year 1, T1 is given. So which means already 1 year compounding is done. You need not do that again. For the remaining years alone, you need to do the compounding. Is that clear, guys? Go and update your library of adjustments. Write down. Write down. Cost of convertible debenture within bracket direct. Cost of convertible debenture within bracket direct. Are we done? Okay, shall we move on to the next one? Okay, guys, let's move on to the next question. This is question number 19. Shall we get started? Okay. Now, a company issues 15% convertible debentures of rupees 100 each at par with a maturity value of how many years? 6 years, which means, so the life of this debenture is what? 6 years. Convertible means what? At the end of 6th year, cash value or equity share value, whichever is higher, will be the redemption value. Is that clear? Perfect. Should assume that the investor will choose which is beneficial for him. Obviously, any rational person will do that. On maturity, each debenture will be converted into 2 equity shares. If you're holding 1 debenture, you will receive how many shares? 2 equity shares from the company, right? Which means the equity share value of every debenture is how much? So the equity share, the market price of every equity share at the end of 6th year into 2. Guys, clear with this? Since I will be receiving 2 equity shares. The risk-free rate of return is 10%. The market risk premium is 18%. And the beta is 1.25. Why do we need all these things? CAPM to calculate KE. Very good. The company has paid a dividend of 12.76 per share. 5 years ago, it paid a dividend of 10 rupees per share. The flotation cost is how much? 5% of the issue amount. Next. 5% preference shares of rupees 100 each at a premium of 10%. These shares are redeemable after 10 years at par, and the flotation cost is how much? 6% of issue amount. They have given some preference related data also, right? Assuming a corporate tax of 40%, calculate the cost of convertible debenture using approximation method. Use YTM method to compute what? Cost of preference shares. That's all the question says. You need to compute what? KD. You need to compute what? KP. This question KE is asked. KE, they have asked the KE. Yes or not? There's something. Or read the question and tell me. KE is not asked. Then they have given all CAPM and all these things. Why have they given? A beautiful question, guys. A really good question. Now, I'll give you a couple of minutes time. Read the question first. Don't jump to the solution. Read the question first. 1 second. I am not going to do this. KP, normal. Nothing. Then why am I doing this sum? For this convertible debenture calculation only I'm going to do. This is normal vanilla 5% preference of 100 each issued at premium of how much? 10%, which means 110 is what? Issue price minus flotation cost. You will get net proceeds. Redeemable after 10 years at par. Use YTM method. You know how to do that. We have done many sums. This is not a big deal. In the first part of the question, calculating KD, but why so much equity data is given? KE and all, why is it given? Think and answer. A brilliant sum. Think and answer. First part alone, we have some issues and adjustment here. Now, if you're able to get that, excellent. Please don't look at the solution. Online folks, pause the video now. Take 2 minutes. Attempt something. Bring that survival instinct. I've told you. Bring that survival instinct. Attempt this, and then we will get started. Now, guys, now an excellent sum. Now, what do we need to do? KP calculation. I told you it's a normal thing. It's fine. Now, we need to compute KD, right, of a convertible debenture. Guys, correct? Now, for this purpose, first I need to find out what? Redemption value. Redemption value is higher of cash value or the value of equity shares. Guys, correct? Perfect. Now I need to find the share price at the end of 6th year. Am I right, guys? I need to arrive at what? The share price at the end of 6th year, T6. Guys, year 6, at the end of 6th year, what is the share price? I need to find out, right? And that share price at the end of 6th year, right, into 2, because every debenture will get 2 equity shares, will give you what? The equity share value of every debenture. Compare this with the cash value 100. If this is more than 100, then you will ask for converting it into equity share. Guys, this is the concept. Correct? Yes, please answer back. Right. Now for that first thing, what you need to do, arrive at the market share, the share price of every equity share at the end of 6th year. Now for this purpose, what have they given? Read the question. Now on maturity, each debenture will be converted to 2 equity shares. This is fine. Risk-free rate of return means what? RF 10%. Market risk premium means what? What is market risk premium? RM minus RF, right? Then beta value is also given. Perfect. Now, the company has paid a dividend of 12.76 last year. This is D0, right? 5 years ago, it paid a dividend of how much? 10 rupees. Or in other words, a 10 rupee dividend has grown on to become 12.76 rupee in a span of 5 years. With this, you can compute the growth rate. Can I say 12.76 is equal to 10 into 1 plus g to the whole power 5. Remember, we did some calculated trick and all these things, right? With this, you can arrive at the g value. That is, the growth rate can be found out. Guys, correct? Perfect. Now, what have they given? Flotation cost is 5% of the issue amount. Okay, all those things are fine. Now, guys, now what we need to do here is that now we need to arrive at the price of every equity share at the end of 6th year. Am I right, guys? That is what we need to do. And they have clearly given every year the dividend is going to grow. Am I right? Which means clearly you need to use what method? Gordon's model. Am I right, guys? Am I right? Recall sum of infinite growing cash flows up to perpetuity. What is the formula? The cash flow at the end of first year divided by KE minus G. Am I right? Or in other words, P0 is equal to T1 by KE minus G. Am I right? P0 stands for what? The market price of share today. Guys, is everyone able to understand? Which is going to be next year's dividend, D1, divided by KE minus G. Are you all able to understand? But in this case, I don't want to find out P0. I want to find out P6. I want to know the price of the share at the end of 6th year. Guys, are you all able to understand? Now, price of the share at the end of 6th year will be what? From the 6th year. Next year's dividend will be D7. Am I right, guys? So I want to know the share price at the end of 6th year, which means this is going to be next year's dividend, D7 divided by KE minus D. Are you all able to understand? Now, G, we can find out using this growth rate. KE, how will you do? You can't find out. That is the reason they have given what? CAPM ingredients. Are you all able to understand? So, CAPM, basically, you need to compute KE using CAPM, and that should be plugged in the Gordon's formula to arrive at the market price of share at the end of 6th year. Are you all able to understand? They are using two models here. Guys, are you getting this? A brilliant sum. A brilliant sum. D7 you can find out. How? D0 is given, no? How much was D0? So last year they paid a dividend of 12.76. Guys, correct? So 12.76 into 1 plus growth rate to the power 7 gives you what? Gives you the dividend at the end of 7th year. With this, clearly you can find out the value of every share at the end of 6 years. That into 2, you will arrive at the equity value of every debenture at the end of 6 years. Are you all able to understand the concept behind this? Guys, is that clear, everyone? Is that clear, everyone? Right? Shall we do this now? Hello? Shall we do this now? Perfect. Write down. Write down question number 19. Question number 19. A very good sum, guys. This is how your exam questions will be like. Question number 19. Write down. I'm only going to do part 1. What is part 1? Calculation of cost of convertible debentures. Cost of convertible debenture. Write down. Write down. For this, I need to first find out what? The market price of share at the end of 6th year. 6 years is the life. Am I right, guys? Please answer back. Guys, correct? 6 years is the life. Now, how will you find out? I told you it's going to be the next year's dividend, D7 divided by KE minus D. Am I right, guys? For that, first I need to compute KE. Then I need to compute G also. Guys, is that clear, everyone? So write down. Step 1 under this. Write down step 1. Calculation of KE within bracket. KE using what method? Write down CAPM method. Now just imagine, to compute KD, you need to use KD. To compute KD, you need to use KE first. Guys, correct? With that you can compute what? With that you can compute the market price of a share at the end of 6th year. That should be considered as a redemption value for computing what? KD. Look how it is going. Guys, are you all able to understand? They say karma is a boomerang, right? So yes, this also teaches life lessons and all. Clear with this, right guys? Come on, let's do this. Write down. So KE. So how is it? KE is equal to, come on, write down, RF plus beta times RM minus RF. Very good. What is RF? 10%. What's beta? 1.25 times RM minus RF directly given. How much? 18%. Right? So 1.25 into 18 gives you 22.5, is it? So it's 10% plus 22.5% gives you 32.5%. Is that clear for everyone? So now you got what? K. Next, step 2. What is step 2? Very good. Write down calculation of growth. Calculation of G. Literally, we are computing the ingredients of what? Gordon's model. Is that clear? The denominator of Gordon's model. Write down. Now, what has happened, guys? Now, I am just showing it in a graphical format. What they are saying, the recently paid dividend was how much? Come on, answer. The recently paid dividend was 12.76. However, 5 years ago, how much they paid? 10 rupees. Or in other words, can I say this was D minus 5 and this is D0. Am I right, guys? Or in other words, forget all those things. In a span of 5 years, the difference between these two time intervals is what is relevant in time value of money. In a span of 5 years, 10 rupees has grown on to become how much? 12.76. Or in other words, can I say 12.76 future value is equal to present value into 1 plus R the whole power n. Guys, correct? 10 into 1 plus G, that is R, the whole power n is 5, guys. Is that clear? Guys, correct? Any problem here? Or in other words, 1 plus G to the power 5 gives you how much? This by 10. This goes on to the denominator. Am I right? So 1 plus G, the whole power 5 gives you 1.276. Am I right, guys? This goes on to the denominator. So by 10 becomes 1.276. Or in other words, find two ways of doing it. I told you. One is what? Finding for this value in your future value table. Or the other one is use your calculator trick and also find out. Guys, correct? Now, 1 plus G to the power 5 becomes how much? 1.276. Or in other words, 1 rupee compounded for 5 years becomes 1.276 when the growth rate is how much? Let us go and find out in the future value table. Now we have this future value table. In that, for 5 years, when will the value be? How much? 1.276. So 1.276 when it becomes exactly it is there. So when the R or the growth rate is how much? 5%. So write down. So from the future value table, generally they will give you an exam, right? G is equal to how much? 5%. Are you guys able to understand? I'm also opening and showing you how to use the table also. Sir, I don't want to use table. In that case, what will you do? Or in other words, 1 plus G to the power 5 is equal to 1.276, or 1 plus D is equal to 1.276 to the power 1 by 5. 1 by 5 means how much? 0.2. So A to the power B, I gave you the formula. How to do? Square root of A, 12 times you need to do it. Then minus 1, then into B, that is the power, then plus 1, then into is equal to 12 times you do, you will arrive at the answer. Is that clear, guys? This is another way of using your calculator for that. Are you all able to understand? Or generally the table will be given. I have also made you guys self-dependent. Do not actually depend on anything. Is that clear, guys? That's about it. Let's move on to the next one, shall we, guys? Yes. Now, with this, what can you find out? Write down step 3. What is step 3? What is step 3? Calculation of? Sorry, ma? P6. That's what? Calculation of redemption value. Write down. Calculation of redemption value. Exam, write it fully. Are we done? Guys, yes. Write down. Redemption value is higher of A cash value, which is equal to how much? Nothing is given. 100. Yes. B equity share value, within bracket, it's going to be 2 into P6. Am I right? Guys, for every equity share, what is the value of every equity share at the end of 6th year? P6, we need to find out. Right? And for every debenture, I'm going to give them 2 equity share. Is that clear? Which is equal to, wait, we will see. Now we need to compute P6. Guys, come down and write. Come down and write. Now, come down and write. Using Gordon's model. Come on, you guys should tell me the formula. P6 is equal to, everyone. Good, look. P0 is equal to next year dividend. That is D1 divided by KE minus D. The value at the end of 6th year is going to be the next year dividend from P6, which is, so write down D, take a rating, and 7 alone you write it in red. Is that clear? This is new. Are you all able to understand? Are you able to understand why we are doing this? Guys, yes, divided by KE minus G. Is that clear for everyone? Is that clear for everyone? Now, this is equal to, how will you arrive at D7? Now read the question. What was the recently issued dividend? 12.76. This is D0. Guys, correct? So can I say D7 is going to be 12.76 into 1 plus, what is R? R in the sense G. Every year is going to grow by 5%. So 0.05 to the power 7. Are you guys clear with this? Guys, is that clear? This was D0. D7 is going to be into 1 plus D to the whole power 7. Are you all able to understand? It compounds for the next 7 years. Divided by KE. How much was KE? We already calculated. 37.5, 32.5. 32.5% minus growth rate. What is growth rate? 5%. Is that clear, guys? Is that clear? Now come on, tell me. So 1.05 into is equal to, it's going to be 1.407. Okay, into 12.76. 17.95 something. Going to be 17.9546 divided by, so 32 minus 32.5 minus 5 gives you 27.5%. Am I right? Divided by 0.275 gives you how much? 65.28. So write down. It's going to be rupees 65.28 roughly. So at the end of 6th year, the market price per share is going to be how much? MPS at the end of 6th year is going to be, guys, 65.228. So now for every debenture I'll get how many shares? 2 shares. So write down here, equity share value is going to be 2 into 65.28, which is equal to 130.56. Yes. So roughly it's going to be 130.56. So now you tell me, you want 100 rupees or 130.56? Obviously we'll go for the higher of the two. So this is going to be your redemption value. Is that clear for everybody? Is that clear for everybody? Please be very, very clear. And this is the step. This is the step. So now you need to compute P6 using Gordon's model. For you to compute the Gordon's model, you definitely need KE value. For that purpose, KE needs to be computed using CAPM method. Are you all able to understand? Excellent sum, guys. A very, very good sum. Is that clear? Now quickly, let's go and do what? Step number 4. Finally, calculate KD. Write down. Step 4. What is that? Calculation of KD. Quickly, come on, let's do this. Formula. KD is equal to, come on everyone, tell and write. I into 1 minus T plus RV minus NP by N the whole by RV plus NP by 2. Now what's my interest? 15, huh? Okay. So it's going to be how much? 15 rupees into 1 minus, what is my tax rate? 0.40 plus, what's my RV? 130.56 minus, what's my net proceeds? Now look at this, be careful. They've clearly said there's going to be a flotation cost of 6% on my, 5% on my issue amount. Nothing is mentioned. They are issued at par. Am I right? So 100 minus 5 is going to be what? 95 rupees. Are you all clear with this? Divided by, what is N? 6. The whole by, very good, 130 point. Very good. 130.56 plus 95 by 2. 130.56 plus 95 by 2. So 15 into 0.6 gives you 9. 9 plus 130.56 minus 95 by 6 gives you, I think, 5.9. 5.916. 130.56 minus 95 by 6. 5.926. Okay, 5.926 something divided by 112.78. Maybe 112.78. Okay, do the calculation. Tell me how much does it come out to? 13.24% roughly. Comes close to about 13.24. Is that what it comes to? 14.926 divided by 112.78 to 100 gives you 13.234. Okay, 2346 or 24%, whatever it is. Guys, are you all able to understand? Is there any issue here? Is there any issue here? An excellent sum. Look, another variety of sum where we had to calculate the cost of convertible debenture, but in this case, you need to use Gordon's model to calculate the value P7, P6. You had to use Gordon's model. In Gordon's model, you need KE value. To calculate that KE, they had given CAPM. Is that clear? This is the level of adjustment which institute is expecting students to know. Are you all able to understand? We have built this chapter to that level where you can literally apply more than one models to actually, come up with an answer. Are you all able to understand? In this case, KE calculation is not required. However, for KD calculation, you need indirectly KE calculation. Is that clear, guys? Because with that, only redemption value can be computed, with which you can compute your KD, cost of convertible debenture. Are you all able to understand? Right? Then the second part of the question, we've already done. So, preference shares using what? YTM method you need to calculate. Now, look at this. They themselves have given what? 3% and 5%, which means two trials. You guys know what to do. 3% one trial, 5% another trial. Look at this. This is what you need to do. 3%. If you take one negative figure, 5% positive figure, interpolation, arrive at KP. Is that clear, guys? Is everyone able to understand? Is there any issue here? Is there any issue here? This way you can do and close it off. Are you all able to understand? Any problem? Any issues here? That's about the sum. Please go and update your library of adjustments. Write down. Write down. Cost of convertible debenture. Mark the sum as important. A must visit the day before your exam. Cost of convertible debenture. Cost of convertible debenture, semicolon, 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 calculation of redemption value, calculation of redemption value using Gordon's model, using Gordon's model, within bracket, KE using CAPM, within bracket, KE using CAPM, bracket close, semicolon. One more thing, calculation of G, within bracket, you can put calculator trick. You will understand what this method is. Guys, correct? That, square root 12 times and all that. -1 into B plus 1 into is equal to 12 times. You guys know that, right? That's about it. Then semicolon, KP within bracket, YTM. That's all. Mark this sum as important. A signature problem can come anytime in exam. Right? Look at this. KD calculation is using approximation method, formula. But for the purpose of this approximation formula, you need one value called redemption value. For you to compute the redemption value, you need to use Gordon's model. In that Gordon's model, you need one line item called KE. For that purpose, you have to refer to CAPM. Now look at this. 3 different models are used in a single question. If I were an examiner, I would definitely love to test these kind of questions. Just imagine, guys, 3 models in a single question is no joke. At the intermediate level, this is what they are testing. Is that clear? This course, intermediate course, is much more than 3 years of BCom put together. Much more than that. That's why the value of a CA Inter is much more than value of a BCom in the market, right? Look how they have interpreted and how they have evolved 3 models together. An excellent masterpiece of a problem. Shall we move on to the next one? Guys, perfect. Let's go on to the next one. Okay, I think it's 19A. Can you please take it as a homework and do it? Please take it up as a homework and do it. If you have any issue, you can just let me know. One thing I want to tell you. Now look at this in this question 13A. Now look what they have given. The prevailing default risk-free interest rate on a 10-year GOI treasury bonds is 6%. Means what? RF, I told you in exam, they might not give RF value directly, but GOI means Government of India. So Government of India bonds is risk-free only. Anyways, you will get back the amount. So that is what it is. I don't think anything else is major of a difference. Look, 13% convertible debenture were issued on 1/4/2023. Maturity 6 year. At maturity, option to convert debenture into equity share in the ratio of 1:4. Means what? 1 means what you have. 4, that is, first they will say what you have is to what you will receive. For every 1 debenture, you will receive 4 equity shares. The market price of the share is 25 as on 31st of March 2024. The growth rate at the rate of 6%. No. Guys, this question has only one adjustment. What is that? Now look at this. What is the life of the debenture? Now 6 years, correct? Now 6 years. When did I issue this? 1/4/2023 T0, right? T6, that is at the end of 6th year, maturity will happen. Now what have they given? Now this is a convertible debenture. So which means redemption value you need to calculate, higher of cash value or the value of equity share at the end of 6th year, which means first I need to find out the value of equity share at the end of 6th year. Now what have they given? Look at this. What have they given? Look at this. Now the market price of equity share is 25 as on 31/3/2024. When did I issue? 1/4/2023, which means the value at the end of first year is given as 25, which means from first year end to 6th year end, you need to compound it only for 5 years. Are you all able to understand? Observation skill. Look, they didn't give first year, second year and all. Many students missed this out. Now guys, all over India, many students committed this mistake. So how do you know all over India and all? Now, every attempt, right, when the result gets published, in your students magazine, students journal, there is something called students journal, you are aware? In that, there is one section called examiner's comments. Now, paper wise, question paper wise, under that question wise, subsection wise, examiner will give a comment saying this particular question, generally students across India found it easy. Question number 2B, every student predominantly committed a mistake in this particular step. To that extent, they give you insights. You guys are aware of that? No. Okay, but actually there's something called like, all these things, examiner's comments. I know you are not aware, predominantly many students are not aware of this. It gives wealth of information. Based on that, now if there is a commonly committed mistake, institute keeps that into account and further attempts, they keep testing it. It is actually a myth when someone says, if a particular question comes in one attempt, immediately next attempt they will not test it. Who said? I can show you attempts where they have repeated. I analyze past exam attempts. It doesn't happen this way. One predictable guess that you can say is examiner's comments. Now, that based on that only I've created all these doubt busters, and based on my interactions with students only I've created the doubt busters. Be very, very careful. Now, many students miss this. This is the value as on today. This is the value as at the end of first year, which means till the end of 6th year, only 5-year compounding you need to do. Are you all able to understand? Is that clear? Is that clear? Now, one more thing. That's about it. Nothing great here in this question. Now, one more thing I want to tell you. The previous sum, no? We calculated what? P6 is equal to D7 divided by KE minus D. Am I right? Now, one student, you had this doubt. Your approach was correct, but let me clarify that. Maybe online students, you guys might also be having this doubt. Sir, why should I compute P6? I will compute P0. What is P0? D1 by KE minus D. Now, once I arrive P0, then I will say P6 is equal to P0 into 1 plus growth rate to the power 6. Like this we can do, no sir? No, it cannot be done like this. Why? Because now clearly understand what have they given. What have they given? Please clearly understand. Now, the dividend is growing at the rate of 5%. Yes, the growth rate in dividend is only 5%. The growth rate in equity share, they didn't say is 5%. Is that clear? Hence, on what the growth rate applies, only on that you can actually apply the growth rate. So you can't say the share price itself grows by 5%. Only dividend grows by 5%. Is that clear? But whereas in the sum before that we did, they clearly mentioned in that question, the growth rate of shares itself was 5%. That's why on the share price itself we applied 5% growth rate. Whereas here, the growth is only on dividend. Clearly it's given. It paid a dividend of 10 and recently it became 12.76. The growth rate is applied only on dividend. So please understand, when you are doing into 1 plus G, it can be applied on D when the dividend is growing, Or directly if you want to apply on the price, then the growth rate should be on the share price. Is that clear? Wordings of the questions are extremely important. That's why I'm reading between the lines and interpreting and telling it to you. Is that clear, guys? That's about this question. Please go and update your new library of adjustment. Write down question 19A. 19 is done. Write down 19A. Please write down 19A. Write down. This question they had asked what? They had asked to calculate what? Everything, huh? Okay, guys, look at this. They had asked to compute everything. Okay, most importantly, the catch was with respect to convertible debentures. Write down calculation of cost of convertible debentures. Convertible debenture. Cost of convertible debenture. Semicolon. Convertible debenture. Semicolon. Yes. Yes. Write down calculation of redemption value. Calculation of redemption value when market price at take a reading. Market price at take a reading and write T1. T1 means what? At the end of year 1. Market price at T1 is given. T1 alone reading. Balance normal ink. T1 is given. Is that clear? Which means only 5-year compounding you need to do. Am I right? Guys, is that clear? Is that clear? And one more thing, guys. That's about it. Now look at this. Now I told you, no. That's all. This is over. KR is equal to KE. Subject to 2 exceptions. Exception number 1, flotation cost. Exception number 2, personal income tax brokerage is there. Now, this is nowhere mentioned in the study material. But remember, this was a past exam question, May 24 attempt. Now look what they have given. Personal income tax is 20%. Many students didn't know what to do. They thought this itself was the income tax rate. But then they noticed the corporate tax rate is given. Sir, what will I do with this? They didn't know that this was a figure relevant for computing KR. Are you all able to understand, guys? Are you all able to understand? They have given CAPM method. Am I right? So using CAPM, compute KE. And once you do that, what will you do? KR is equal to KE into 1 minus personal income tax rate. Brokerage is not there. Ignore it. That's all. So directly you need to do that. Only the net amount is your KR. Are you all able to understand? KR and KE are 2 different figures in this question. This is another adjustment given here. Is that clear, guys? Past examination question. If you want, please write down semicolon. KR. Write down KR within bracket. When personal income tax rate is given. KR within bracket when personal income tax rate is given. Are we done? KR when personal income tax rate is given. Now one more thing. This is also not mentioned in the study material. Term loan. What is this? KT I told you. How will you calculate interest rate directly into 1 minus tax rate? This was also asked. These 2 things which we covered in the classroom, which is directly not mentioned in the study material, these 2 were asked. This is the reason I'm telling you, if you take your notes the proper way, if you focus properly in the classroom, guys, it's going to be beautiful. You will just love the process of writing the exam, because now you know things. You know that this is the catch. While reading the question itself, you know, okay, these are the catches. That's about it, right? This is what is going to differentiate you from those who have not prepared, right? This should be a differentiating factor. Is that clear? Write down semicolon KT. Semicolon KT. Is that clear? You guys know how to calculate and all, but I'm just telling you, exam ready. Look, in past exam question, they have asked this. Is that clear, guys? Independent ingredients alone they have asked. So they have asked KE, KP, KD, KE. Sorry, this is reading annex. KR, KT. Everything they have asked in this question. Guys, clear? How many marks? 6 mark exam question. That's all. But guys, simple, no? Equity, what? You will find out using CAPM. Simple. Then preference, redeemable after 8 years, selling at 150 rupees. That's all, no? In this case, direct formula, you will put it and you will get it. Guys, correct? These 2. KR, KE into 1 minus personal income tax rate. KT, IA interest rate into 1 minus tax rate. So convertible debenture alone, you will have some major calculation. Maybe for this alone, they will be giving 3 marks. So the remaining put together, you might get 3 marks. Is that clear, guys? Are you all able to understand? 6 mark, I think this is decent decent, normal. It is neither more nor less. In exam, you can quickly crack this, guys. Correct? You have not asked you for WACC. Are you all able to understand? That's about this particular question, guys. Are we done here? Perfect. Now, let's go on to the next question, number 20. Shall we get started? Okay, let's get started. Let's get started. Now, guys, please don't look at the solution. Just read the question. What have they asked? Let us try to understand, and with that, we will complete this question. Annual Limited is considering a raising of funds of about 250 lakhs by any one of the two alternatives methods, which is a 14% institutional term loan or a 13% non-convertible, means a normal redeemable debenture. Right? The term loan option would attract no major incidental costs. Means what? Flotation cost is not there. Right? But generally, guys, in real life, you'll be having something called as processing fee and all. Anyways, it can be ignored. The debentures would have to be raised at a discount of 2.5% and would involve a cost of issue of 2% on what? Face value. What is this? What is this? Cost of issue means flotation cost is given as 2% on face value. Advise the company as to the better option on the effective cost of capital in each case. Assume what? A 50% tax rate. Now, once again. Now, what do we need to do? We need to compare between two different modes of debt only. Guys, are you all able to understand? One is what? Term loan. The other one is debentures. Now, term loan, simple. They have said 14% is the interest rate. Now, KT, directly I can compute. What is it? Interest rate into 1 minus tax rate is going to be my post-tax cost of a term loan. Similarly, debenture, KD calculation. How will you do? Now, once again, is this redeemable or irredeemable? Life is given or not? 13% non-convertible. That's all they have given. Life is not given, which means irredeemable. What is the formula? I into 1 minus tax rate divided by net proceeds. What I pay upon what I receive. Am I right? You remember? Guys, correct? Now, based on that, you compute whichever gives the lowest cost, you go for that alternative. Very simple, isn't it, guys? Very simple, isn't it? Right? Shall we quickly do this and give them which one to go for? Let's do this quickly. Come on, write down. Question number 20, isn't it? Write down question number 20. Write down step 1. Calculation of cost of 14% institutional term loan. Term loan. Is that clear? Now, what is the formula? Write down. KT is equal to interest rate. Everywhere else, I stands for interest amount. Here, directly you can use Y. Because there is no question of, issue value, redemption. Everything happens at par only. Is that clear? Into 1 minus tax rate. It's nothing. The only cost is going to be interest rate. So, interest rate into 1 minus tax rate. How much is my interest rate? 14% into 1 minus, what's my tax rate? 0.5. Am I right? So, clearly this is going to be 7%. Or in other words, for every rupee that you raise from your term loan route, you will incur a cost of 7%. For 100 rupees, the cost is, for every 100 rupee raised, you need to pay 7 rupees as interest. Or for every rupee raised, you need to pay 7 paise as interest. This is the meaning, no? Guys, are you all able to understand? That's about it. Next one. Step number 2. Step number 2. Write down. Calculation of cost of 13% NCD. NCD stands for non-convertible debentures. Right? Get used to these jargons. If you see in news and all, this company issues NCD. NCD stands for non-convertible debentures. Is that clear? Right. Now, what is the formula? Come on, write down. This is irredeemable. Am I right? Within bracket, write down. Irredeemable. Okay. Formula. Guys, come on. Everyone should answer. KD is equal to I into 1 minus tax rate divided by net proceeds. Am I right? So, what's my I? 13% on 100 is going to be 13 rupees into 1 minus 0.50 divided by, yes, what is going to be my, this one, net proceeds, how much is it going to be? Hello? How much? One second. Going to be how much? So it's going to be issued at a discount of 2.5% and would involve a cost of issue of 2% on face value, which means if the issue price is on 100, right? Now, if the face value is 100, discount is how much? 2.5 on 100, which is 2.5 minus what is the flotation cost? 2% on face value, 2 rupees only. Guys, correct? So net amount is how much? 95.5. 95.5 rupees will be your net proceeds. Am I right, guys? No, right? Face value minus discount is going to be your issue price. Issue price minus flotation cost will be your net proceeds. Yes. Okay. Now, right down here is going to be what? So, 5% is 2.5% discount. So, it's going to be 97.5 issue price minus a further 2% on face value, means 2 rupees. Am I right? This is going to be 13 into 0.5, which is 6.5 divided by 94.5. Sorry, 95.5 into 100. How much is it coming out to? 6.806%. Are you all able to understand? Is there any issue here? 6.806%. Are you all able to understand? Now, are we done with the question? No. You need to tell them the final answer. Now, which is better? 7 rupees or 6.806? Obviously, 6.806 gives you a lower cost of interest, lower effective cost. So, write down. Conclusion. It is better to raise the funds of. It is better to raise the funds of rupees 250 lakhs. It is better to raise the funds of rupees 250 lakhs by issuing 13% NCD. It is better to raise the funds of 250 lakhs by issuing 13% NCD since its effective cost is lesser. Since its effective cost is lesser. Since its effective cost is lesser. Is that clear? Okay. Are we done? Okay, shall we just go and update a library of adjustments? Write down, please write down. Please write down. KD versus KT. Write down. KD versus KT, semicolon. KD versus KT, semicolon. Whether to raise the funds. By taking loan or issuing debentures. By taking loan or issuing debentures. Okay, are we done? Okay, guys, perfect. Now, that's about the sum. Now, let's go on to the next concept in KD itself. So, one was this one we saw already, amortization of bond. I told you, refer question 9 of time value of money chapter. Every year, equal repayments and all, EMI options, something like that. Cost of convertible debentures also we have done. Then there is one more type of bond or debenture. It is popularly called as zero coupon bond, or in other words, this is also known as what? Deep discount bonds. Is that clear, guys? Zero coupon bonds or deep discount bonds. Now, what is the meaning of this, and how do we compute the effective cost of this zero coupon bond or deep discount bond is what I'm going to tell you right now. Shall we get started? Yes. Now, zero coupon bond. What do you mean by this? Just by reading the name, what do you mean? Coupon means interest. Zero coupon means no interest. This is a bond, means what? Debenture. Bonds and debentures are same. Is that clear? This is one type of debenture where there is absolutely no coupon payments, means no interest payment. Is that clear, guys? Is that clear? Then, sir, who will buy these kind of debentures, sir? Are you getting it? If there is no debenture, I mean, if there is no interest, then who will buy these kind of debenture? Who will invest in these kind of debentures? No. Don't worry. in this case, what these debentures, how they issue is that, now they issue it at extreme discount and they will redeem it at par. For example, now let us say the face value of one debenture is, example I'm telling you, 100 rupees, right? Now they will issue it at how much? Let us say 20 rupees. I'm just giving you guys an example, right? Now what happens? You need to invest 20 rupees today. Let us say the life of the debenture is, example I'm telling you, the life of the debenture is, let us say 20 years. Now what happens? After 20 years, the redemption value will be how much? You will receive how much? 100. Or in other words, these are those types of bonds which are issued at a discount, redeemed at par. The difference between the two automatically adjusts for time value of money. Or in other words, this is similar to your cumulative FD in debentures. Is that clear? Your cumulative FD, you will not receive any interest during the life of the FD. Am I right? Guys, answer back. You will not receive any interest during the life. It accumulates, and at the end of the life, single shot, you will receive what? The principal amount plus all the interest put together. Guys, correct? This is similar to an cumulative FD model where these are issued at deep discounts, not normal discount, deep discounts, and redeemed at what? Par. Let us say I pay today 25 rupees, and at the end of 20 years, I will get how much? 100. Now, why do you get 100? This 100 is nothing but 25 rupees of principal plus accumulated all the year interest put together. Guys, are you all able to understand? That's how it works off. Are you all able to get this? Guys, in this case of zero coupon bond, simple. From the perspective of the company, there is one inflow. At the end of the life, one outflow. Or from the perspective of investor, initially there's an outflow. Single shot, at the end you will get one inflow. Are you all able to understand? Or in other words, there is no series of cash flow when it comes to a zero coupon bond. Are you all able to understand? Guys, is that clear? In this case, now can I directly say, very, very simple. Now, guys, what is going to be, in this case, what is the effective cost? That is nothing but KD. Am I right, guys? Effective cost is going to be KD. Am I right? Now, how do you compute KD in case of zero coupon bonds? One second. In case of zero coupon bonds, so how do we compute this KD? Now, first, guys, can I say this equation? Let me frame the cash flow equation. KD means what? The rate that equates my present value of inflow with my present value of outflow. Guys, correct? Now, the present value of inflow means the amount I received today. Guys, correct? That is, I will call it as B0. B0 means what? For shares, we call it as P0. Here for bonds, we call it as B0. The net proceeds as on today is equal to, let us say, the present value of all the future cash flows. Guys, correct? Now, first year, how much interest I pay? Nothing. 0 divided by 1 plus R, that is KD to the power 1. Plus next year, 0 divided by 1 plus KD to the power 2. Like that, so on, I keep paying. At the end of the last year, now I will not pay any interest. Now, finally, I will pay what? The maturity value. So, can I say redemption value or maturity value divided by 1 plus KD to the power N? Am I right, guys? Or in other words, all these are 0 only. Or in other words, can I say B0, the present value of the bond is nothing but the maturity value divided by 1 plus KD to the power N. Guys, are you all able to understand? Or in other words, this is nothing but a simple, your compound interest or discounting formula. Guys, the future value is equal to the present value into 1 plus R the whole power N, or present value is equal to future value divided by 1 plus R the whole power N. The same formula only, no. This is the reason why I taught time value of money concept first, and I'm doing it. Now, this is that simple because there is one inflow, one outflow, single cash flow. There is no series of cash flow. In this case, it is much easier for us to do it. Am I right, guys? Is that clear, guys? And the rate that equates my present value of inflow with my present value of outflow is called as KD, or it's called as what? In this case, the cost of debentures. This is also a type of debenture only, bond. Is that clear? But this is a bond with a single cash flow. Is that clear? There is no annual payment of interest and all. Is that clear for everyone? So this is exactly what I've mentioned here. Now look at this. B0 is equal to redemption value divided by 1 plus KD to the power N. Are you all able to understand? Any issues, any problem here? Is everyone able to understand this? Now with this, can we just go and do, the next question? Guys, look at this. These bonds are generally issued at deep discounts and are redeemed at par. There will not be any coupon payments during the life of the bond. KD for zero coupon bond is calculated using what? The YTM, yield to maturity approach, right? And we have arrived at the formula as well. Is that clear, guys? Shall we just go on to the next numerical problem where we'll be seeing about zero coupon bonds, also known as deep discount bonds. Shall we get started? Guys, come on, let's get started with question number 21. Shall we begin? Okay, let's get started. So question number 21. Now, suppose we are considering investing in a zero coupon bond that matures in 5 years and has a face value of how much? 1,000 rupees. Now, look at this. These bonds are priced to yield how much? 10%. What is 10%? Tell me. 10%, ma. It's not redemption value. KD directly is given. Look, from the perspective of an investor, what is a return is the cost from the perspective of the company. He says the effective return is going to be how much? 10%. What is the present value of the bond? Which means 1,000. What is 1,000? Par. Par value means what? Now, what is the nature of your deep discount? So, zero coupon bond issued at discount, redeemed at par. So, clearly, this par value will be the amount I will receive in what? At the end of 5 years. Guys, this is where you need to understand the nature of a zero coupon bond. Generally, you will say, sir, if nothing is given, what is the meaning? Par value is the issue price, sir. T0. Why are you taking it as T5? I'm taking it as T5 because zero coupon bonds are always issued at discount, redeemed at par. The difference is ideally your return. Are you all able to understand? So, can I say, guys, the bond value 0, that is the value of bond today to be issued. Issue price is equal to redemption value 1,000 divided by 1 plus R, the whole power what? 5. Guys, correct? Future value divided by the discount factor gives you what? The present value of the bond. Guys, correct? This 0.1 is going to be your KD. Are you all able to understand? With this, you can arrive at the answer. Is it not? Write down. Quickly write down. Question number 21. Write down. B0 is equal to maturity value divided by 1 plus KD to the power N. So it's going to be what, guys? B0 is equal to, what's my maturity value? So always remember these are redeemed at par, into 1 plus 0.10 to the power 5. So B0 is equal to, so what is the discount factor? 1 divided by 1.1 is equal to 2, 3, 4, 5. You get how much, ma? 0.621, 0.6. Okay, you can say this is nothing but 1,000 into, so 1 by 1.1 to the power 5 is going to be 0.62092. Guys, correct? 0.62092. Am I right? Or this is nothing but the value of the bond today is going to be how much? 1,000 into 0.62092 gives you 620.92 rupees should be the issue price of the bond today. Guys, correct? Are you all able to understand? Which means what? If you issue it at 620 and at the end of 5 years you redeem it at 1,000 rupees, the effective return IRR that the investors will earn will be how much? 10%. Are you all able to understand? Or in other words, from your perspective, if you want the effective cost to be 10%, where the redemption value is fixed 1,000 only, then the issue price should be made at 620.92. This is the meaning of the question. Is that clear for everyone? Is that clear? Which means for you to know this, you need to know how a zero coupon bond functions. Please go and update your library of adjustments. Write down. Come on, guys, write down. ZCB. What is ZCB? Zero coupon bond hyphen calculation of B0. What is B0? Value of bond. Correct. Calculation of B0 when KD and maturity value is given. When KD was given, yes sir. Maturity value is given, yes sir. When KD and maturity value is given. Is that clear? Shall we move on to the next question quickly? Guys, let's go on to the next question. So, question number 22. Guys, we have the last few questions of this chapter. Let's quickly finish it off. Now, what is this? Question number 22. Institutional Development Bank issued a zero interest deep discount bonds of face value 1 lakh each. Look at this. Issued at how much? 2,500. Repayable after 25 years. 1 lakh rupee bond. They're issuing it at how much? 2,500, which means today you need to pay 2,500. You will get one bond. Now you need to hold it for how many years? 25 years. At the end of 25th year, how much will you get? 1 lakh rupees. Is that clear? Deep discount, 25 years. Is that clear? It means discount is how much? 97.5% discount. 1 lakh rupee bond is issued at just 2,500. Guys, during the 25 years, don't come and ask for any interest. I will accumulate and everything and pay at how much? 1 lakh rupees. Is that clear? Compute the cost of debt if there is no corporate tax. Can you do that, guys? Guys, is it possible to do this? Can we do it? Yes, write down. Write down. Question number 22. Question number 22. Shall we get started? Yes. Now we know what do you mean by your KD in this case? The rate that equates my present value of cash inflows with my present value of cash outflow is called as what? IRR, or in this case, that's going to be my effective rate. That is my effective cost of debentures. Am I right? Bond. Guys, are you all able to understand? Is there any issue here? Any problem here? No. In this case, what can we do? Let's do this. Come on, write down. Can I write the formula? You can also use this future value or time, your present value. That formula itself, we can use it, right? Guys, can I say future value is equal to, or this way also we can write. This way also we can write. 1 second. Can I say B0, that is the value of bond today, is equal to maturity value divided by 1 plus KD, the whole power N. Am I right, guys? Hello? Now, today at what price am I issuing it? 2,500. That is B0 is equal to, what is my maturity value? 1 lakh. Yes, 1 lakh divided by 1 plus KD, the whole power 25. Am I right, guys? Guys, correct? Is that clear? Is that clear? Or in other words, I can take this to the numerator, bring this down to the denominator. Yes, correct. Can I say 1 plus KD to the power 25 is equal to 1 lakh divided by 2,500? Correct? Or in other words, 1 plus KD to the power 25 is equal to how much? 1 lakh by 2,500 gives you how much? 40. 40. Is that clear? Or in other words, now, what is the meaning of this? 1 rupee, right? If I'm compounding at some percentage for 25 years, becomes 40 rupees at the end of 25th year, which means what is the rate at which it compounds? We need to find out, right? Now, clearly, this we can find out in what? In our future value table. Guys, correct? Are you all able to understand this? Is that clear? Or another way of doing it is, I told you, a calculated trick. 1 plus KD to the whole power 25 is equal to 40. Or 1 plus KD is equal to 40 to the power 1 by 25. It goes the other side, becomes 1 by 25. 1 by 25, you compute a to the power b. With that you can do. But generally what they will do in exam, they will give you the tables. Now, can we try to do this in the table? Now, go to your appendix page. Appendix page. Now, for 25th year, look at the future value table. At 25th year, when, at what rate the future value becomes 40 rupees? Can we look at this? Guys, yes. Now here do you have 25th year? Yes, 25th year. This is future value only, yeah? This future value? Okay, fine. So first 10%, it's not happening. The 25 means only up to 10 it has come. Then look at this. We're talking about 25 years, right? 25 years. Look at this. Look at this. Now, 16% rate of interest. It's coming to how much? So at 16%, it is coming to 40.874. At 15%, it is coming to how much? 32.919. Now with these two rates, we can interpolate and find out at what rate it was exactly the value becomes 40. Can we do that? Guys, are you all able to understand? This is how it needs to be done in exam. This is how they will give it. Is that clear, guys? Write down, write down. Please write down. Please write down. Please write down. From future value table. From future value table. When R is equal to 15%, comma, now in that case, 1 plus 0.15 the whole power 25 is how much they have given? 32 point, how much was that? 32 point, yes, 919, guys, correct. So it's going to be 32.919. Now when R is equal to 16%, in that case compounding 1 plus 0.16 to the power 25 gives you how much? 40 point something. How much was the value? 40.874. Write down 40.874. Write down. It's going to be 40.874. Is that clear, guys? Is that clear? Any problem, any issues? So now clearly, what do we want, guys? What do we want? R 15%, 16%. Then what is the value that you get? The value you get is 32.919. Here you get 40.874. Or in other words, if I increase R by 1%, right? Now the future value increases by how much? 40.874 minus 32.919. How much by it increases by? How much, guys? It increases by how much? 7.955. Guys, correct? Increases by 7.955. But I want to find out at what percentage it is exactly equal to 40. Guys, correct? Which means I want my future value to increase only by how much? 40 minus 32.919. How much is that? 32.919. I want it to increase only by 7.081. Guys, correct? So which means for an increase in the future value to the extent of 7.081, right? By how much my R should be increased over and above 15%. This is the meaning of that, guys, correct? Or in other words, I can say R, or in this case KD, I find IRR is equal to the lower rate 15% plus what is the required amount? 7.081 increase I need to find out. However, currently for the change of how much? 7.955, right? So I will achieve this if my R increases by how much? 1%. Am I right, guys? Into 1%. Guys, correct? For an increase in 1%, the change in the future value is 7.955. How much? By how much should R be increased in order for me to get a change to the extent of 7.081? Is that clear for everyone? That is when you are computing NPV. Fine, if you want, you can also do it like that. Here I'm computing future value. Since it is a single cash flow, no, it is like this. Or if you want, you can also do it like this. IRR is a rate where NPV is equal to 0. Correct? Or in this case, what you can do. So here future value is how much? 32.919. From that you can say minus 40. Guys, inflow minus outflow. So this you will get negative. Here also you do minus 40. Here you will get positive. Guys, correct? Now you compute. Once again, you will get the same answer only. Nothing to worry about this. Here we are just computing the percentage changes and all. Are you all able to understand? Is that clear? See, this is nothing but I have directly used the compounding formula. Are you all able to understand this? If you want, you can also do it that way and arrive at the answer. Absolutely no problem. Is everyone able to understand this? Yes, clear? That's about it. So in this case, how much comes out to? 15% plus 7.081 by 7.955 into 1 gives you 0.89. Yes, 0.89%, which means IRR is going to be 15.89%. Are you all able to understand? This is going to be my KD. Guys, this is going to be my KD, am I right? Yes, so this is going to be my KD. Are you all able to understand? So KD is equal to 15.89%. Effectively, don't think it comes free of cost. Inbuilt, how much is the cost, or from the perspective of investor, how much is the return? It's going to be 15.89%, because look, 2,500 rupees invested becomes 1 lakh rupees at the end of 25 years, means on an average every year it has been compounding at a rate of how much? 15.89%. This is the meaning. Compound interest formula. That's what we did. Am I right, guys? Is everyone able to get this? So this is how you need to compute all these things. Are you all able to understand? If someone says, now this is sir, 2,500 rupees, sir, you just pay 2,500 rupees today. At the end of 25 years, I will pay you 1 lakh rupees. Guys, correct? Now what will you think? My money becomes 40 times. Right? Now, always remember, don't go by absolute number. Yes, no doubt your money becomes 40 times. In how many years? 25 years. So which means annualized rate of return per year on an average, what is the compound interest that you earn? It is only 15.89%. Are you all able to understand? Now you need to compare the percentage. Effectively, IRR needs to be compared with other investment option. Let us say there is another avenue, let's say equity share, that gives you 18% return. Now, though if I say 18%, it may not be attractive. This guy comes and says, sir, your money becomes 40 times, sir. Now, the way they present it, it becomes more attractive. Always remember, as finance students, what you should do. For any and every investment, compute IRR. Compute IRR. Compare this IRR with what? With the IRR of other investment products. Is that clear? So, in some areas, they call it as CAGR. IRR, CAGR, both are same. Is that clear, guys? So, IRR or CAGR. CAGR stands for Compounded Annual Growth Rate. Both are same. This needs to be compared. Is that clear? Some FDs, they give simple interest and all, right? Simple interest, they give it. Simple interest, compound interest are completely different. Guys, it can't be compared as such. Are you all able to understand? So effectively, when you are judging where to invest your money, you need to look at it from the perspective of IRR. Are you all able to understand? That is always the yardstick. In some cases, they would have given it as yield. They would have given it as yield. Is that clear, guys? Right? Now, you will not believe if I say this. Few months back, I, parked some amount as an FD with one of the top banks in India, SBI. This is not a made up story. Really, I invested. Okay. There's something called emergency funds, which I generally keep. In case of any immediate cash requirement, I generally keep. It is equal to 6 months of my monthly expenses. We keep it. That's a very good financial habit. As my personal finance, I did, and I just revamped it. I was earlier having it in liquid funds, mutual funds. I moved it to FDs in my SBI account. Now what happened? Now they gave me, and they said, sir, compound interest. They said the interest will compound quarterly. Is that clear? But when we are computing IRR, effectively, the underlying assumption is the amount compounds annually only. No, guys, compounds. Interest on interest will be computed annually. No, that's the basis reinvestment assumption we have for computing IRR, but there is an annual compounding. Is that clear? Which means inside every year, 4 times it will compound. Correct? So, which means based on this, I arrived at IRR. IRR will be slightly higher as compared to this. You know what? On the FDR, fixed deposit receipt, they had mentioned coupon rate. What is coupon rate? Interest. This is only relevant for the purpose of computing the amount of interest that needs to compound. Guys, correct? Coupon rate they mentioned. And they also mentioned annualized yield. Annualized yield is nothing but IRR. Because coupon rate compounds every quarter. Now, this annualized yield, why have they mentioned? It is not used for calculating interest. It is given so that you can compare this product with other investment products available in the market. Everything is annualized. Effective annual return, how much is it? You tell me. That is IRR. Correct? No? Right? If they give this, it is easier for you to compare with many products outside your SBI or anywhere. Correct? Even inside FBI, there are multiple varieties of FDs and all. Guys, are you all able to understand this? Right? So this annualized yield, IRR, is useful for you to take decisions as to whether I should buy this FD or not. You will not believe the annualized yield they calculated was wrong. SBI made this mistake. Now, I computed using Excel. Generally, I have this habit. So, I even compute my SB interest. Okay. SB interest is based on daily average, daily balance. So, end of the day balance. Based on that, only your SB interest gets computed. I have a model, right? Model na Excel model I have. Financial modeling, we call it. I have a way of computing it. Import the bank statement. It will hardly take 2 minutes. I have all these modelings I've prepared just so that I have, I compare all these things. I was shocked. Now, 99.9% of the population will definitely not see all these things. First of all, it's hard for us to, teach common public about the concept of compounding, IRR and all. Right? And even those people who know, they tend to, bank, they have given, how will they make a mistake? This mistake has been there in SBI. Now, I didn't go and tell them and all, because it will not affect your amount of interest payments. No. But it affects my decision of whether to open an FD with them. Definitely it affects. Who will do all these complicated calculations and check whether the IRR is correct? Now, IRR, they made a mistake. System only. Everything is system driven. Then there's a problem with the system itself. If one FD receipt is printed with the wrong yield, entire FD receipts across India will be printed with the wrong yield only. How can there be a mistake? I was surprised. I recalculated a couple of times. I checked whether my calculations are correct with respect to my spreadsheet formulas that I have done. Absolutely, there is a mistake. Now, understand this. Always do your own calculations. For you to do that, first you should be aware of what these formulas mean by. Then, yes, how to do it. Maybe you can use Google and other things. You can find out how to do it on an Excel spreadsheet and all. Once you do that, you always have the figures with you. I have my finances in order. That's how I always deal, right? Asset allocation, other personal finances I do. We even advise for our clients. But this is something very, very important that you all should know. Is that clear, guys? Now, a top banker in India, if they can commit this mistake, it's no joke, guys. It's absolutely no joke. That's why, knowledge is power. Knowledge is power. You can know whether this is a good investment or not. Because when I was investing in, this one, I told you there's something called as liquid funds. Yes, and there's something called liquid Bs and liquid funds, ETFs and mutual funds. When I was doing that, my effective annualized yield was coming close to about 7.1%. So I felt let's go to the bank and check. Anyways, for me it was a little higher because I did it through my parents' account, senior citizen. They got extra 0.5% and all. So slightly it was higher. I shifted, but still a mistake is a mistake. What if it influences my decision? It is definitely not correct. That's the reason I'm telling you. See, since it does not impact monetary amount, I think they have also left it. So again, I'm telling you, if SBI is not paying wrong interest amount, the yield calculation which is a deciding factor to park your money, that is alone wrong. That's what I'm saying. Be very, very clear. Don't then go around and say, sir has said SBI gives wrong interest. No, that's not what I say. That no bank will do. If they do, then they are not bankers then. Right? That is cheating. No, they will not do that. I'm talking about the yield calculation. Is that clear for everyone? Guys, clear with this? Perfect. So you guys have updated your library of adjustments? No, please go and update it. Write down. Zero coupon bond. ZCB-KD calculation. ZCB-KD calculation. Within bracket. Intrapolation. Within bracket. Intrapolation. Using FV table. What is FV table? Future value table. Intrapolation using FV table. Future value table. Is that clear, guys? Guys, is that clear? Fine. So with this, I am concluding this session. Please revise and practice all the sums we've covered till now, and I will see you all in the next one. Thank you all so much. Bye. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now, let's continue our discussion in this chapter, cost of capital. Now, let's go and look at one small concept. And this is one concept which generally many students overlook, meaning they think this is already covered and they skip and go. But there's one small concept, another method of computing KE, which generally students miss out. Now, let us learn that particular concept right now. Shall we get started? Yes, guys. Now, this is about question number 23. But before we get into this question, I will teach you this particular concept. With that concept, we will actually do one numerical problem. This is another method of calculating what? KE. Is that clear? KE, all the methods we did know. Guys, correct? What methods? Dividend price model, earnings price model, Gordon's growth model applied on dividend and earnings. We've seen. Then fourth, realized yield method from the investor's perspective. Finite life is given, with that you can do IRR calculation. Fifth one, CAPM model. We have seen. There is another model with the same name called realized yield approach, but this is not the realized yield that we computed earlier. IRR, no. This is a different method computed using something called as geometric mean. Right? What is it called as? Geometric mean. Is that clear? Right? Arithmetic mean, we use it for normal series. For GP, geometric progression series, we use something called as a geometric mean, and this is based out of a concept called geometric mean and HPR, holding period return. What is it? I will tell you. One small concept, but a 5-mark question can be built out of this, or for a 10-mark question, KE computation can be out of this method. If you do not know this method, the entire question will go for a toss. Is that clear, guys? One additional method. That's why I'm doing it towards the end. Is that clear? Now, sir, realized yield now means that IRR method, or does it mean this geometric mean method using something called as you said holding period return? How will we know? Clearly, you will know that based on the data given. right? How and all that I will tell you. Shall we get started? Yes, right? So this is called as, so this discussion is called as KE, please take the heading, KE calculation using realized yield approach, within bracket red ink, geometric mean technique. Geometric mean technique, please write it fully. GM and all you will not understand later. Right now I'm telling you, it is easier for you to remember, but later on you might forget. Write it fully. Geometric mean technique. Now, what is this particular concept of geometric mean technique? For that, first you need to know something called as holding period return. HPR stands for what, guys? Everybody, holding period return. Now, what is the meaning of this? Please catch up running notes. I will give you guys an example. Now, let us say I invested in a share. Okay, let us say I purchased shares of a company called Tata Motors. Okay, I purchased it today, Tata Motors share. Now, how much is the amount I invested? I invested 100 rupees. Is that clear? Now, what I did, now I held it, and during this period, I received a dividend of, let us say, 20 rupees. Is that clear? And after some time, what I did, I sold this share of Tata Motors for how much rupees? Let us say I sold it for 110 rupees after 1 year. Is that clear, guys? Is that clear? Now, can you guys tell me what is the effective return in percentage that I have made out of this particular transaction, out of this particular investment? Guys, can you tell me? Huh? How much, ma? Evlo? Huh? 30%. Guys, can I say clearly? Now, the overall return is made up of two components. One, I get one portion of return through dividend. The other portion of return is through capital appreciation, properly called as capital gains. Am I right? Now, can I say the total dividend return that I received was how much? Now, the dividend return was 20 divided by my investment value, 20%. Am I right, guys? Next, my capital gain return or my capital appreciation return as a percentage, if you see, it's nothing but 110 minus 100. It is 10 rupees divided by the base investment, 100. Overall, I would say I received a capital gain appreciation of how much? 10%. Overall, my holding period return means what? The return I generated for the time that I held was how much? 30%, guys. Correct? Or in other words, can I say holding period return is equal to, please write this formula. Holding period return is equal to, can I say P1 minus P0. What is P1 minus P0? The capital appreciation. Guys, correct? Plus dividend, right? Now, this will give me my entire total returns in amount. Am I right? Divided by my investment. What is my investment? Come on, very good. P0 into obviously 100%. Can I come up with this formula? Guys, every single formula I am deriving for you. Is that clear? Can I say this is nothing? Holding period return means what? It is nothing but P1 minus P0. In this case, 110 minus 100, 10 rupees. Plus, what is the dividend? 20 rupees. This is the overall return in money that you have made divided by how much you invested? 100 rupees. So this year's return was how much? It is going to be effectively 30%. Are you all clear with this? So can I say holding period return is equal to P1 minus P0 plus D, the whole by P0, that is the opening value, initial value, into 100%. Are you all able to understand? Literally, this is for year 1. Suppose if I continue to hold this for multiple years, now year-wise I can compute HPR, holding period return. Am I right, guys? Are you all able to understand? Is there any issue here? Is there any issue here? No. Now, this is for the first year we have computed. Am I right, guys? Now, similarly, year-wise I can compute. Let us say for 4 years data is available. Year-wise I can compute what? Holding period return. Guys, correct? That is, in this case for year 1, the HPR will be what? The price at the end of year 1, that is nothing but the price at the beginning of year 2, right? Guys, correct? Minus P0 plus whatever dividend I paid in this year divided by P0. Similarly, for the next year, year-end price minus the current year beginning price plus dividend divided by year beginning price. Like this, for 4 years data is available. For 4 years I can compute. So for 4 years I have holding period return. Guys, are you all able to understand? Is that clear? Now with this, what you can do, you can calculate KE. Now how can I calculate KE? Simple. KE is equal to, please write down, KE is equal to, if you want you can write it in a red ink also. Write down 1 plus HPR 1. HPR 1 means what? Holding period return for the first year into 1 plus HPR 2 into 1 plus HPR 3 into 1 plus HPR 4, right? Or dot dot dot. Ideally, it has to be to the power n number of years. For how many ever years it is given, guys? Correct? Guys, ideally, what you can do is you can put dot 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 and you can write finally into 1 plus HPR to the HPR for the nth year. Guys, correct? The whole power 1 divided by n minus 1. Now, what is this? Now, what is this? Have you guys written this down? The 1 plus first year HPR into 1 plus second year HPR into dot 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 into 1 plus HPR for the nth year, a whole to the power 1 by n minus 1. Is that clear, guys? This is your another formula for computing K. Now, what is this, sir? What have you mentioned? Simple. When you have a geometric progression, the formula for computing geometric mean, let us say I have 4 HPR 1, 2, 3, 4. Is that clear? When I have 4 figures, right? Now, how do I compute the geometric progression for geometric mean for 4 figures? Simple. It is nothing but the first figure into second figure into third figure into fourth figure, the whole power 1 by 4. Guys, correct? If it is an arithmetic mean, you simply divide it by 4. No. If it is geometric mean, you do to the power 1 by 4. So suppose 3 data is given. A, B, C, 3 data is given. How do you compute the geometric mean for 3 data? A into B into C, the whole power. How many figures are there? 3 to the power 1 by 3. 5 figures are there. Multiply all the figures to the power 1 by 5. Is that clear, guys? This is how you compute the geometric mean. Hence, what we do is 1 plus every year's return, right? You multiply everything to the power 1 by n, right? Minus 1 at the end. Why? Because the principal also gets compounded. Finally, this is the compounded value of principal plus your return. From that minus 1, if you do, you are removing the principal. Return alone comes into picture. Are you all able to understand this? Guys, is that clear? Is everyone able to understand this? Guys, I am explaining the derivation. This was a past exam question. Geometric mean for a particular thing. How will you compute whatever are the numbers there? 1 plus holding period return for respective year. Like that, multiply everything to the power 1 by n. If you do, you will get the compounded value. This is nothing but the compounded value has your principal plus the return. So minus 1 you do, right? You get the return component alone, that is equal to KE. Are you all able to understand? Once again, this is calculated from the perspective of investor, right? And this is based on the principle that investor's return is equal to cost of the company. Is that clear for everybody? Is that clear for everyone? Now, with this knowledge, shall we get started with the next particular question? Right? Now, let's go to the next question, number 23. Shall we get started, guys? Guys, please reciprocate, answer back. Right. Now, the cost of equity, calculate the KE from the following data using what? Realized yield approach. Now, sir, realized yield approach. I didn't give you this background. What will you think? IRR, sir. Someone purchased the market at this rate, sold after 5 years. Now, you will first prepare the cash flow equation. The rate that equates my present value of inflow with outflow, or in other words, the rate that makes my NPV equal to 0 is my IRR. That's nothing but in this case KE. So take 2 trials and use interpolation, arrive. That's what you will think. Now, correct. That's what everyone will think. But don't worry. Look at the data given. Year data they have given. Now, year-wise, dividend per share is given, and price of every share at the beginning of every year is also given. Is that clear? Which means year-wise dividend and price are given. Guys, year-wise price, is it relevant for you to compute IRR? No. You only need to know the price today and price at the end of 5th year or whatever it is. Year-wise data is given, then clearly understand this is based on holding period return formula. With that, you need to compute the geometric mean of holding period return. This is actually another method of realized yield approach. Is this clear, guys? Year-wise price given, then understand you need to use geometric mean. Year-wise price is not given, then do it under normal IRR method. Is everyone able to understand? So based on the wordings of the question, you can do it. Now in this question, how many holding period returns can you find out? How many holding period returns can you find out? Tell me. Every year you need to compute holding period return, no? How many holding period return can be found out? Huh? 5 or 4? Only 4 can be found out. Why? For the 5th year, this is the opening price. They have clearly mentioned. What is the closing price? 6th year data should have been given, which means you can only compute for how many years? 4 years. Are you all able to understand? Is everyone able to understand? Which means year 1, year 2, year 3, year 4 I can compute. Year 5, they have given all the prices are beginning prices. This is the P0 of year 5. P1 is how much? Then year 6 data should have been given. Is that clear, guys? Which means you can only compute for 4 years. Is that clear for everyone? Is that clear for everyone? Now it is easy to compute. Guys, year-wise compute what? Holding period return. Finally arrive at the geometric mean, and that is going to be your KE. Geometric mean minus 1 gives you your KE value. Shall we get started quickly? Let's do this question. Right on question number 23. Question number 23. Shall we begin? Write down. Write down. First, step 1. Calculation of HPR, holding period return, for how many years? Take a red ink and put it as 4 and normal ink years. Why? Because the moment you look at 5 figures, you think that you can compute for 5 years. No, you can only compute for 4 years. Guys, are you all able to understand? Be on your toes. Come on, guys. Now, let's do this. Write down. Write down. Formula for computing what? HPR. First, write down on the top. HPR is equal to, come on, formula. Logically think and answer. P1, price at the end of this year, minus P0, price at the beginning of the year, plus the dividend that you received, divided by the opening price, P0. Is this clear for everyone? Guys, is this clear for everyone? Now, based on this, can we compute HPR for 1, 2, 3, 4? 5th year you can't do. Guys, shall we do this? Write down first. HPR 1 is equal to, come on everyone, tell me, HPR 1, what is it? Yes, so whatever price is given at the beginning. So here, for year 1, 9 rupees is P0 opening. What is the closing price? The opening price of year 2 becomes the closing price of year 1. So I will say 9.75 minus 9. The capital appreciation is 0.75 plus dividend 1 divided by P0, 9. Am I right, guys? Is that clear for everyone? Write down. Write down. Rupees 9.75 minus rupees 9 plus rupees 1 divided by rupees 9. How much is that? Into 100, obviously. So 0.75 plus 1 divided by 9. 19.444 percentage. 19.44444 percentage. Is that clear? Now quickly, guys, HPR 2. Now I want you all to compute. Come on, tell me. Second year, how much is that? Now for the second year, so P1, next year's dividend, next year price, year end price, 11.5 minus 9.75 plus 1 divided by 9.75. Quickly do it. 11.50 minus 9.75 plus 1 divided by 9.75. 11.5 minus 9.75. Capital appreciation is 1.75 plus 1 divided by 9.75. How much you get? Yes, 28 point roughly 2%. Am I right, guys? Yes. Next one, holding period return of third year. Come on, figures. Come on, tell me. So third year, 11 minus 11.5. In this case, there is no appreciation. Ideally, there is a depreciation. Depreciation doesn't mean, you mean there is a fall in the value of share. Guys, correct? Opening value is 11.5. The closing value became 11. Negative is possible, no? Yes. Plus 1.2 by 11.5. Write down. So 11 minus 11.5 plus 1.2 divided by 11.5. How much is that? 1.2 minus 0.5 by 11.5 gives you 6.08 percentage. 6.08 percentage roughly. Next, HPR for the fourth year is going to be, come on, calculation. 10.6 minus 11 plus 1.25 by 11. Am I right? Write down. Are you all understanding? 10.6 minus 11 plus 1.25 divided by 11. How much is that? Hey, 15%. Calculation check, boss. How much is that? 7.72. 7.72 percentage roughly. 7.72 or 7.727 is 7.73. That's all. Now for the Fifth year, can you compute? No, if you want to compute for fifth year, you need to know the P1, which means 6 years beginning price. That is not available. Hence, you have to stop your calculations only with the 4 years. Are you all able to understand? That's the reason I asked you to update this alone in a reading. Is that clear? Now write down. Step 2. What is step 2? Calculation of KE within bracket, realized yield or geometric mean technique. Is that clear, guys? Are you all able to understand? A very, very unique sum. How will you know whether when realized yield method is actually referring to this geometric mean method? Year-wise price and dividend details are given. Alert. Be alert. Is that clear? Because you can't use Gordon's formula. No. Year-wise it is given properly. Guys, are you all able to understand? Right? Hence, you can't use Gordon's method. Gordon's method will have an assumption of constant growth rate and all. Share price. Whenever share price is given at the end of every year, we don't need in any other models, no? Whenever you are selling it, only that year's share price is required. Year on year, if it's given, then holding period return, arrive at geometric mean. So write down formula. Come on, KE is equal to, come on, you guys should tell me. 1 plus HPR first year into 1 plus HPR second year into 1 plus HPR third year into 1 plus HPR fourth year, the whole power 1 by 4 minus 1. Is that clear? Why minus 1 also? I told you. Principal you remove because we are effectively computing the return. KE is equal to, come on guys, tell me. First year, how much was that? 19.44. So 1 plus 19.44 is percentage is nothing but 1.1944. Am I right? Into second year, 28. So 0.282. So 1.282 into 6.08. Ideally it was 6.09, I think so. Anyways, 1.60608 9. Okay, 8. Okay, whatever it is. Then into, this was 1.0772. Yes, the whole power 1 by 4 minus 1. How much is the value? This can be done in calculator itself. Guys, 1 second. The power 1 by 4 means what? This is nothing but 1 by 2 into 1 by 2. Guys, or in other words, you multiply this number, right? And click on square root 2 times. One square root for first time, another square root, once again you do it. To the power 1 by 4 and all is very simple. Square root 2 times you will get it. 1 square root is equal to the power 1 by 2. Once again you do it. To the power 1 by 2 into 1 by 2 is 1 by 4. Are you all able to understand? So to the power 1 by 4 is given using calculator itself. You can do 1.1944 into 1.282 into 1.0608 into 1.0772 is equal to 3.81 something. Square root. How much you get? Earlier, where the 1 second. 1.1944 into 1.282 into 1.0608, 1.0772. How much you get? Square root. Yes, you get 1.15 something. It's going to be 1.1501. Okay, 1.15 minus 1. This is nothing but 0.15, or you get it as how much? 15% as KE. Is this clear, guys? This is the final answer. Are you all able to get this? Any problem, any issue here? Guys, any problem, any issue? This was one model available in your study material. I didn't want to miss that also. That's why clearly we have done it in the classroom. Is that clear, guys? A comprehensive coverage. We will not miss even a single concept, right? In this chapter, anything comes, you will be able to answer, right? That's about it. Quickly go and update your library of adjustments. We will finish off. Come on, this chapter, we are in the end of the chapter. Let's quickly close it off. Write down. KE using realized yield approach. KE using realized yield approach within bracket. Take a reading and write down. Within bracket, take a reading and write down. Geometric mean of holding period return. Geometric mean of holding period return. It's another variety of a numerical problem. Geometric mean of holding period return. Okay. So that's about this particular question. Now shall we move on to the next one? Okay, so 23rd is done and dusted. Okay, now let's move on to the next one. What is this? ABC company's equity share is quoted in the market at how much? 25 rupees per share currently. Current market price is how much? 25. The company pays a dividend of rupees 2 per share and the investors market expects a growth rate of how much? 6% every year. Now, you are required to, number one, calculate the company's cost of equity capital. You can computer. Using what method? Gordon's model. Perfect. Next. What do you need to do? If the company issues a 10% debentures of a face value 100 each and realizes rupees 96 per debenture, while these debentures are redeemable after 12 years at a premium of 12%, calculate the cost of debenture using YTM. Assume the tax rate to be 50%. Now guys, there is no new concept in this question. First, KE calculation using what model? Gordon's model. Formula D1 by P0 plus G. What is D1? Now it pays a dividend of 2 rupees. Unclear whether this can be taken as D1 or D0. What will you do? Anything you take it as anything, write a note, right? We can take it as D1 or D0. If you take it as D1, directly take 2. If you take it as D0, it has to be 2 into 1.06. That is 1 plus growth rate. Am I right? Is correct? Huh? So D1 by P0. How much is P0? 25 plus G is how much? 6%. You will arrive at what? K. Whatever is the calculation, you do it. Anything great here? No. Next, if the company issues a 10% debentures of face value 100 each, realizes 96, means what? Today the issue price is how much? 96 rupees. Perfect. While the debentures are redeemable after 12 years at a premium of 12%, means what? Redemption value is how much? 100 plus 12% on 100, which is going to be 112 rupees will be repaid. Calculate the cost of debentures using what method? YTM method, which means finite life is there. So you need to do what? You need to arrive at YTM IRR method. Basically in this case, take 2 trials, interpolation and all. Guys, correct? Assume the tax rate to be what? 50%. Simple. Every year what will be the cash outflow for the company? 10%. That is 10 rupees. Don't forget, into 1 minus tax rate. So every year it's going to be what? 5 rupees is going to be the outflow. Yes, sir. Present inflow, how much is it? 96 rupees. Outflow will be how much? This should be equal to 5 rupees into present value interest factor annuity for KD percentage that we need to find out for how many years? 12 years. Plus at the end of 12th year, I will pay them 112 rupees. So that is in future value, bring it to present value, into present value interest factor of KD percentage for 12 years. Am I right, guys? And the rate that equates the two is going to be called as IRR. Or you bring this to the other side and you say, so the NPV, the rate that makes my NPV equal to 0 is called as my IRR. We all know this. Guys, that's about the sum. That's the, I've just kept it in the end for this reason only. Simple. Cash flows. Initial, how much is it? 96, right? There's going to be an inflow. So, and every year you're going to pay how much? 5 rupees effective cost, post-tax cost. At the end, you will receive how much? 112. Now. 2 ways of doing, I told you. This is ideally, you take this as positive, these 2 as negatives. Or ulta, if you do also, you'll get the same answer. Why? Inflow minus outflow should be equal to 0. Or outflow minus inflow should also be equal to 0. Any which ways, at 0, the symbol does not change at all. Guys, correct? That is the reason why the figures will not change. You will get, so 5% and 10% they have taken. Generally, the tables will be given in the question. So one positive NPV, one negative NPV, and interpolation, they have arrived at KD. Is this clear for everybody? Right? Anything you want me to do this again? No, literally we have done multiple problems in this regard. Please go and update your library of adjustment. Write down. Question number 24. Write down. Calculation of KE within bracket Gordon's model, semicolon. Calculation of KE within bracket Gordon's model, semicolon. KD within bracket YTM. Calculation of KE within bracket Gordon's model, bracket close, semicolon. KD within bracket YTM or IRR. KE within bracket YTM or IRR, whichever it is, hyphen direct. Hyphen direct. Are we done? Are we done here? Guys, nothing great in this sum. Just update your library of adjustment. We have discussed the manner of doing this. Ideally, it should have been a sub question somewhere. So anyways, I have just given it towards the end. Now, question number 25. Mark this question as important. Mark this question as important. Now, shall we get started? Guys, the penultimate question means what? The last but one question, right? Penultimate question. Shall we get started? Yes. Right, okay, let me read the question, shall we? Okay. Today being 1st Jan 2019, Ram is considering to purchase an outstanding corporate bond having a face value of 1,000 that was issued on 1st Jan 2007, which has a 9.5% annual coupon and 20 years of original maturity, that is maturing on 31st of December 2027. Is that clear? Yes. The annual coupon and the 20 years, okay. Since the bond was issued, the interest rates have been on the downside, and it is now selling at a premium of 125.25 per bond. Is that clear? Determine the prevailing interest on similar type of bonds if it is held till maturity, which shall be at par. Present value factors 6%, 8% is given in the question. What should we do? What should we do? First of all, many students didn't understand the question. That is the general thing which I have noticed. Same thing goes here. Okay, what have they asked? Come on guys, tell me, what have they asked? Interest rate is 9.5%. Coupon rate, what have they asked? Determine the prevailing interest on the similar type of bonds if it is held till maturity, which shall be at par. What is the meaning of this? Prevailing rate of interest, or in other words, it means they are asking for the effective yield. Today we did one similar question where yield percentage was given, you remember, interest rate was given. With that we recomputed, and I said interest amount divided by yield percentage is going to give me my current market price. You guys remember that? You guys remember that? Yes, that yield they are asking, and yield is nothing but the effective return from the perspective of whom? From the perspective of the investor, and that will be equal to the cost from the perspective of company. Is that clear? Now, which means you need to arrive at IRR. Guys, effectively you need to arrive at IRR. Correct idea. Are you guys understanding this? Yes or no? Perfect. Now, IRR, what will you do? You will match the cash flows. Guys, IRR, how will you do this? You will match the cash flows. The present value of cash inflow should be equal to the present value of cash outflow, and the rate at which these two are equal is going to be called as IRR, or in other words, this brings the other side, right? The rate at which my NPV is equal to 0 is called as my IRR. Am I right, guys? Now, for this, first I need to know what is the tenure. What is the tenure? What is the life I need to take? What is the life I need to take? Huh? Tell me. Hello, 20 years is wrong. 20 years is wrong. Now, look at this. Why have they given this, ma? Today being 1st Jan 2019, Mr. Ram is considering to purchase an outstanding corporate bond having a face value of 1,000 that was issued on 1st Jan 2007, which has an annual coupon of 9.5% and 20 years of original maturity. That is, when is it maturing? 31st December 2027. Now, I am taking this decision when I am standing today. Today is what? Don't say today. Now, look at what the question is saying. 1st Jan. When was this issued? 1st Jan. This is 2019. This was issued in 2007. Now, Mr. Ram is deciding on purchasing this bond. Now, you tell me, this is already issued or today only they are going to issue? Already issued means clearly is going to the secondary market and buying this debenture or bond. I told you there's something called as a debt market. Guys, are you all understanding? This is the reason I gave the background. Introduction. I gave you a background. Is that clear? Which means it already got issued. Forget, I am an investor. Today I am going to deal in this security. For my perspective, from my calculation, from today onwards, I should look at how much is the maturity left. Are you guys able to understand? Now you tell me how many years are remaining for this debenture. How many years? 9 years. How did you arrive at 9 years? So it is going to mature on 2027 end, which means 2019 beginning I am there. So 2019, 20, 21, 22, 23, 24, 25, 26, 27. Some students made a mistake. They took it as 8. No, this is the beginning of 2019. Redemption is happening at the end of 2027, which means overall life for 20 years. No problem. Now, after 11 years of issue only, I'm even thinking about this bond. From today, I only have 9 years left. And today I purchase it. Not at face value. Today I will purchase it at what? So today I will purchase it at what price? I will purchase it at what price, everybody? Wrong. The price is not 125.75. It is quoting at a premium of 125.75, which means the price is going to be 1000 plus 125.75. So today if I buy, I'll have to pay how much? 1125.75. Is that clear, guys? Right. So today I will purchase. This is going to be my outflow. And every year I will receive how much? 9.5% on 1000 rupees. How much is that? 95 rupees for the next 9 years I will receive, and at the end of the 9th year I will also receive back my original principal of how much? 1000 rupees, which means for this cash flow equation, what is the effective return you need to compute, and the effective return from the perspective of the debenture holder is going to be the cost from the perspective of the company. Is that clear? Are you all able to understand? Look at the beauty of the question. Look at the beauty of the question. Two things they have done. Three things in fact. Number one, prevailing rate of interest means yield from the perspective of whom? The investor. Number one. Number two, the past life is irrelevant. From today, remaining life is only relevant. Number three, currently it is quoting at a premium of an amount. Students who took the first two figures correctly, that is the first two catches if you cross, some students took this as what? The price at which I purchased today, absolutely gone. Guys, are you all able to understand? Three catches in this question, a brilliant sum. Now, once you figure this out, calculation is not a big thing. You guys are experts in calculating IRR, correct? Right? But what are the figures you need to take? How do you compute is what is the biggest catch of this particular question. A brilliantly worded question. A brilliantly worded question. So today, if the company wants to raise money from the debenture market, at what effective cost can they raise? Is that clear, guys? So none of the, I don't think any tax rate is given. So simple, which means compute this from the perspective of investor and leave it. Is that clear, guys? Are you all able to understand? Look, and trials also they have given 6% and 8%. So first trial is 6%, second trial is 8%. Are you all able to understand? Which means what is going to be my cash flow equation from the perspective of investor? Today he pays how much? 1000 plus 125.75. So which means 1125.75. The present value of outflow should be equal to what? Some present value of cash inflows. What is the present value of cash inflow? Every year he receives 9.5% on 1000. How much is that? 95 rupees. So 95 into present value interest factor of annuity for KD% or X% for 9 years. Plus at the end of the 9th year he receives back the par, right? Redemption value 1000 into present value interest factor for X% for 9 years. Is that clear? First frame this cash flow equation. Are you all able to understand this? Or in other words, you can take this to the other side and also do this. So this figure minus 1125.75 should be equal to 0. So the rate that makes my NPV equal to 0 is called as IRR. Am I right, guys? Guys, are you all able to understand? So what will you do? Year 0. So this is the outflow. So 1 to 9 annual inflow. And at the end of year 9, so this is a one-time inflow, that is redemption value. Discount factors 6%, 8%. So you get one positive NPV, one negative NPV. Do interpolation, arrive at your effective rate of interest. Exactly, that's called as what? Prevailing rate of prevailing interest rate. That's nothing but your YTM, yield to maturity. Is that clear, guys? This is also called as what? YTM means what? Yield to maturity. That is, if I enter today and hold it till maturity, effectively, what is the return that I earn? Guys, this is nothing but your compound interest formula only, no? Guys, are you all able to understand effectively what is the compounded return, guys? Or that's why I said this is also called as CAGR, compounded annual growth rate. All those things you need not remember. This is IRR. Effective IRR means what? There is a reinvestment assumption, no? Guys, compound interest formula only we are using, no? So in a compound interest terminology, on an average every year I earn how much? 8%. That means my money grows the rate of 8% every year. Are you all able to understand? Guys, is this clear for everybody? Is this clear for everyone, right? So this is how you need to compute. Are you all able to understand? The most important thing here is what? Number one, prevailing interest means what? They are asking for yield, right? Next. So he wants to purchase an outstanding corporate bond. Means what? The company has already issued it. Now he is purchasing it from the secondary market. Are you clear with this, guys? Are you clear with this? Right? Then what other thing is there? Sorry. Yes, this other thing, it is selling at a premium. Means what? Face value plus premium is going to give you the market value. Is that clear, guys? Now you guys understood how to do the sum? Guys, any issues here? I just wanted to discuss this, an additional variety of problem. Now, can you please take it as a proper full-fledged homework and do it? Guys, literally there is nothing beyond this. The main issue in the sum is about interpreting the question and taking the correct data. Once you take that calculation, you guys are experts in that. I don't want to get into that and waste your classroom time for that. Is that clear? Will you do this? Guys, perfect. So now, go and update your library of adjustments. Write down. Write down. Question number 25. Write down. Calculation of prevailing interest rate. Calculation of prevailing interest rate within bracket yield, YIELD, percentage, within bracket yield percentage, calculation of prevailing interest rate within bracket yield percentage on an outstanding bond. On an outstanding bond. Outstanding means what? Already issued, right? Which means you are dealing in the secondary market. Already issued, right on within bracket. Outstanding bond means already issued bond. Semicolon, semicolon. Only remaining life to be considered. Write down. Only remaining life to be considered. Semicolon. 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 Market price is equal to FV plus premium. What is FV? Face value plus premium. Is that clear? Market price is equal to face value plus premium, and that's about this particular question. Mark this as important. Guys, today you will know all these things because I'm teaching you right now. Revision is a mandatory, and if you're having this library of adjustments, it's going to be an extremely easy thing for you to actually go and complete this chapter. Fine, guys, are we done? That's about this particular question number 25. Yes, that's about it. I think there's another question. A company issued 10,000 10% debentures, each of 100 at par on 1/4/2018 to be matured on 1/4/2028 at par. The company wants to know the cost of existing debt on 1/4/2023 when the market price of the debenture is how much? 80 rupees, which means what you need to do. It was already issued. Am I right, guys? This was already issued. When was it issued? So 1/4/18. Redemption 1/4/23. Now what has happened? Now suddenly today the company wants to do the calculation when? Sorry, 28. Sorry, ma. This is 28. Right? Now the company wants to do the calculation on 1/4/2023. Means what? So 18, 19, 20, 21, 22, 23. Exactly after 5 years. They are doing. On 1/4/23, they want to do the calculation, which means how many more years are there? 5 more years. So from today, the life is only 5 years. Am I right? And today, what happens, guys? The market price is how much? 80. It's quoting at a discount. Now redemption will happen at par 100. Am I right, guys? And every year, what is going to be the coupon? So 10% on 100. It's going to be 10 rupees. Wait, from the perspective of company, tax rate is given. Yes, guys. So it's going to be what? Into 1 minus tax rate, which means into 1 minus 0.35. Is that clear? Which means 6.5 rupees. So every year it's going to be 6.5. Am I right, guys? So every year it's going to be 6.5 rupees per annum. Are you all able to understand? Right? So which means you can do it either under. Yeah. Now in this case, you can either do it from today till the end of the life. So you need to do the KD calculation. It can be done either using YTM approach or it can be done using formula, shortcut method, whichever way you want. Now you can do. Once you get the figures, the remaining part of the question is easy. Are you all able to understand? Which means past is an irrelevant data for us. Are you all able to understand this, guys? This is what you are going to learn in this particular question. This is exactly what we did before also. Guys, that's why I've kept it as a sub question, right? It has come as a past exam question if I'm not wrong. So these variety of questions can come in your exam. That's why we are giving a comprehensive coverage. Guys, beyond this, you need not worry anything. Whatever we do in the classroom, please practice and also do the supplementary material, right? Recent past exam, RTP, MTP. Anyways, for regular batch students, I'll be doing it separately. Fine. If you have taken our exam oriented batch, please do it. And if you have any doubts, you can ask me. As simple as that. Is that clear, guys? Is that clear? That's about this question number 25. Go to your library of adjustments, write down question number 25A. 25A. Write down similar to question number 25. Now, please don't mark this as important. Why? If you do 25, ideally you can skip this question number 25A itself. Is that clear, guys? Okay. Okay. Done, done, done. Now, shall we move on to the last question? Shall we move on to the last question, number 26? Okay, guys, that's the last question of this particular chapter. Think so? Yes. All right, let's move on to the last question of this chapter. So, question number 26. Guys, last question. Go on, bring on that focus. This was a past MTV question. Shall we? Yes. Remember, no matter how you start, finish it like MS Dhoni. Okay, shall we begin? Okay, I can see smiles on your face. The first time you're reacting. Okay. So, question number 26. MS Dhoni fan? இல்ல அப்படி இருந்தாலும் சிரிக்கிறானா போய் பவர் ஆஃப் எம்எஸ் தோனி பேர் நீ ஃபேன் சொல்லியிருந்தாலும் அதே தான் சொல்லியிருப்பேன். Okay. RAM Limited evaluates all its capital projects using a discount rate of 16%. Okay. Which means, what is the meaning? Return illa. Okay. Let us see. Its capital structure consists of equity share capital, retained earnings, bank term loan, and debentures redeemable at par. Which means, how many sources of capital are there? Come on, come on, come on. Equity share capital. Then you have retained earnings. Then you have bank term loan. Then you have redeemable debentures. 4 sources are there, right? The rate of interest on bank loan is how much? 1.4 times that of debenture. Okay. Then the remaining tenure of debenture and the bank loan is 4 years, 6 years respectively. Debenture 4, bank loan 6. Is that clear? Yes. Book value of equity share capital and the retained earnings and the bank loan is given as follows. Book value of equity share capital, retained earnings, bank loan alone is given. Guys, how much is that? 20, 30, 20 lakhs respectively. Debenture are having a book value of 30 lakh. Debenture book value is also given, and currently it is trading at how much? 98 rupees per debenture. The ongoing PE multiple, price earning multiple to shares of the company stands at 4 times, right? What is it? I will tell you. Now, what do you need to do here? What do you need to do here? You are required to, number 1, calculate the rate of interest on the bank loan. Okay. And number 2, calculate the rate of interest on debenture. The tax rate applicable is how much? 30%. Now, guys, what have they given here? What have they given here? Now, please understand the most important aspect of the question. This is ideally a missing figure problem. Okay. Most important aspect of the question is the first line. You need to know what it is. RAM Limited evaluates all its capital projects. Means what? Investment decisions. For the purpose of capital projects means where to invest. Which project I need to invest. They use a discount rate of how much? 16%. Which means this 16% is what? Excellent. 16% stands for cost of capital. Why? We will see in our investment decisions chapter. All the cash flows are discounted at the minimum required rate of return. The minimum required rate of return should be equal to at least your cost, not actual return. Minimum required rate of return. Are you all able to understand? Hence, the discount rate for the purpose of our investment decisions is going to be our cost of capital. Look how beautifully they have worded this. Nowhere they have given the word cost of capital, but you should know the 16% stands for WACC. Are you all able to understand? Now, there are 4 sources of finance, and the average cost of all the components is going to be 16%. Now you understood? Now what they have given? Equity, retained earnings, term loan, and debentures are given. Rate of interest of bank loan is 1.4 times that of debenture. Rate of interest means not KD. Rate alone they have given. Which means into 1 minus tax rate you need to do. Is that clear? So interest on term loan is 1.4 times what? That of debenture. Remaining tenure is also given. Is that clear? Then book value of equity shares, retained earnings is also given here. Debentures are having a book value so much, and they are currently trading at 98 rupees of debenture. Which means in this question, now the relevant cost is what? KE, KR, you have KD, and you also have KT. Am I right, guys? And the average cost of capital, KO, is given as 16%. Now, interest rate of debenture and interest rate of term loan, we need to find out. And these two are interlinked. Term loans interest is 1.4 times of what? My debentures interest. Am I right, guys? Am I right, guys? Which means, let me keep this as X. Let me keep my interest on debenture as X. The interest rate itself, I will keep it as X. So the term loan rate will be 1.4X. Am I right, guys? These two will be written in terms of X. Correct? Now, KE and KR, what will I do? How will I find out? That is one issue here. Guys, correct? Now, this I need to multiply with the respective weights. Weights do I have? Yes, sir. All the components book value is given. With this, all the respective weights I can find out. The respective cost into respective weight should be equal to what? 16%. Now, these two can be expressed in terms of X. Now, if I calculate the value of K, K is equal to KR. So, I will get the first two values. The remaining two values are expressed in X. Multiply with the respective weights is equal to 16. You can arrive at an equation. And if you arrive at an equation, you can find the X value. Are you all able to understand? Now, for that first, KE, KR. K is equal to KR. Am I right, guys? Guys, correct? Right? Now, how will I compute KE and KR? Or how will I compute KE? Now, for this purpose only, they have given something called as what? PE multiple. Now, guys, very simple. I will tell you what do you mean by PE ratio. It's called as PE multiple, PE ratio. Now, what does this PE stand for? Price earnings ratio. Guys, clear with this? We will be seeing in an upcoming chapter. Right? It will be seeing ideally in the next chapter itself, we will be seeing some backgrounds. Ideally, this is covered in a chapter called ratio analysis. Now, guys, you can please write down here. PE ratio means what? Price earnings ratio. As the name suggests, what does it mean? Price upon earnings. Price we call it as MPS. Guys, correct? Divided by earnings we call it as EPS. Is that clear? For example, currently if the market price of the share is 100 rupees. Okay, and the earnings per share is, let us say, for example, 20 rupees. So 100 by 20, how much is it? 5 times 50, Lama, 5 times. What is the meaning of this? I'm saying that, look, currently the market price is 5 times of the earnings of the company. This is the meaning of that. Are you all able to understand? Guys, are you all able to understand? Is that clear? Is that clear? So if they say P ratio is 5 times, means what? It is 5 times. The market price is 5 times the earning of the company. Is that clear? Is everyone able to understand? Is everyone able to get this, guys? Is everyone able to get this? Right. Sir, with this, what can we find out, sir? Simple. Now, P ratio is equal to MPS divided by EPS. Guys, correct? Now, one second. Now, I will cross multiply this. I will take MPS, EPS to this side. Right? I will bring a P ratio here. And I will bring MPS to this side. Or in other words, can I say MPS, can I say EPS divided by MPS is going to be 1 divided by P ratio. Can I say this or not? Or in other words, EPS is what is EPS? In our example, I told you 20 rupees per share divided by MPS, nothing but P0, today's price 100. Can I say this is nothing but earnings price model? Earnings price model will come, no? What is earnings price model? Assume that earning is constant. The K is equal to what I pay by what I receive. Earnings divided by the current market price. Guys, correct? Or in other words, 1 by P ratio is another formula to compute K. Guys, are you all able to understand this? Are you all able to understand this? Yes, you guys are getting it. So this is how institute is testing. Are you all able to understand? Out of the box, guys, out of the box, this is the reason. Are you all able to understand? Guys, I'm proving it. Please write down somewhere. I'm not sure if you're understanding the importance of this. People keep struggling looking at this. The moment they've given P ratio out of the box, think, okay, 1 by P is KE. Another formula for KE. I told you, what is PE? PE, price by earnings. Ulta banna. Earnings by price gives you your earnings price model. Guys, correct? Are you all able to understand? And that's all. So earnings by price is expressed as a percentage. Price by earnings is expressed in times. Are you all able to understand? Guys, is this clear? Is this clear? So can I say, so please write down in a red ink somewhere, mark it as important. If you want, you can also write it in your concept decoder book also. Your concept decoder book, one more formula is there, no? There itself you write. Go to this page. What is this page number? 11. Earnings price approach is there. Guys, earnings price approach is there. Write down. This is nothing but KE is equal to 1 divided by PE ratio. Are you all able to understand? No. I will connect this dot somewhere. Will you guys be able to answer? Will you guys be able to answer? It requires some presence of mind. Will you guys apply your mind and answer? So another formula to compute KE, ideally it's not another formula. It is earning price model. Is what? 1 by PE ratio. Or in other words, it's nothing but 1 by PE means price by earnings. Is correct? Or if you do this, it comes the denominator of denominator becomes numerator. This is nothing but earnings by price. That's what you want now. Guys, are you all able to understand? Are you all able to understand? So this is another formula. Mark it down in your concept book itself. Write down, because one formula, you don't put it in other places. If I'm telling you something, put it here itself. Is this clear? Is this clear, guys? Are you all getting it? Are you all getting it? Any problem? Any issues? No. Now what we can do? Let's go to the sum. Now let's go to the sum. Now guys, now 1 second. How many components are there? Equity, share capital. Guys, look at this. Look at this. I will just give you guys the approach. Then you have what? Retained earnings. Then you have bank loan. Then you have yes, you have debentures. Am I right? Now, what is KE? Simple. 1 by PE ratio. 1 by 4. How much is that? Come on, guys. How much is that? 1 by 4 is 0.25 or 25%. Correct? And KE is equal to KR 25%. Now, guys, now you all tell me, what have they given here? The rate of interest on bank loan is 1.4 times that of debenture, which means if I assume the interest rate, not KD, interest rate of debenture to be X%, then can I say the interest rate of bank loan will be 1.4x? That's correct. So if this is X, this will be 1.4x. But don't say this is the final cost. This is not KT or KD. This is the interest rate, which means I can use a shortcut formula and apply it. Am I right, guys? Are you all able to understand? So that's what you need to do. Let the rate of interest on debenture be X. Therefore, the rate of interest on loan will be 1.4x. So KD on debentures will be I into 1 minus tax rate plus RB minus NP by N, the whole by RB plus NP by 2. Ideally, this is 2. Correct, guys? Correct, guys? Yes. Now, how much is the annual interest? Now, once again, I think this is okay. They have given it as 100x. Okay, guys, every debenture, what is the value of every debenture? 100 rupees, right? So 100 rupees into the interest rate gives you what? Gives you your coupon amount. Correct? You're looking as if you don't understand. You understood this? Let X be the percentage of your interest. So the interest amount will be what? 100 into X. This 5% na. 100 into 5% will give you what? 5 rupees. In other words, it's 100x. Guys, correct? X is itself a percentage. So 100x gives you the interest amount into 1 minus tax rate plus RV 100 minus NP. Is it given? Yes, currently trading at 98. So 98 divided by what is the tenure? So for debenture it's 4 years. So divided by 4, the whole by RB plus NP by 2. Is that clear? Now the answer will be in terms of X. So 100x into 1 minus 0.3 is 0.7. So 100 into 0.7 is 70. 70x plus 2 by 4 is 0.5. Divided by 100 plus 98 by 2 is 99. So this is what? KD. Am I right, guys? KD has to be written in terms of X. Correct? Yeah. Are you all understanding? Yes. Now, similarly, what is the bank loan? Ideally, you can put it as KT also. What is it going to be? Interest rate into 1 minus tax rate. What is the interest rate? It is 1.4x. So directly I've used X. Guys, clear with this? I'm not multiplying it on the principal and all, because on the rate itself I can apply into 1 minus tax rate. So 1.4 into 0.7 gives you how much? 0.98x. Are you all able to understand? This is KT. Guys, are you all able to get this? KE is equal to 0.25, which means KR is also 0.25. Is that clear? Is that clear? Now, how many sources of finance? Equity, reserves, debentures, and bank loan. Value is given. How much? Equity 20, retained 30, bank loan 20, and debenture 30. Simple. Put it up here. 20, 30, debenture 30, and bank loan 20. Is that clear? With this, you can compute the weights. 0.2, 0.3, 0.3, 0.2. Is correct? Respective cost. KE is equal to KR. 0.25, 0.25. Correct? KD. Look at this figure. 70x plus 0.5, the whole divided by 99. Correct? Then, how much is your bank loan? 0.98x. We are yet to find out. Guys, correct? Simple. Now, what you need to do? Weights into cost. The product we need to arrive. So, 0.2 into 0.25. How much is that? Come on, do it. Calculator. 0.05. You got the first figure. Second, 0.3 into 0.25. 0.075. Now, wait. Now, next, 0.3 into 70x plus 0.5, the whole divided by 99. We need to do, am I right? Correct? So, 0.3 into 70, how much is that? So, it's going to be 21x plus 0.3 into 0.5. 0.15, the whole divided by 99. Correct? Guys, is that clear? I multiplied. Next one, 0.2 into 0.98. How much is that? 0.196x. Guys, correct? Now, the sum total of all this should be equal to 16%. Am I right, guys? Guys, are you all understanding what we do? I am not getting into the calculation, but I am telling you the manner of computation. Calculation, you guys can do it by yourself. What is the big deal there? Is that clear? Now, this was tested in one MTP. That's why I'm not missing MTP also. If I feel a question is good, I'm doing it. Ideally, there is no concept here. Right? Honestly, guys, generally faculties will not discuss this in the classroom. But I want to give you guys a comprehensive coverage so that any kind of question you should be able to tackle. Is that clear? Done? So now what you need to do, you can just add up. These two figures can be added up. So 0.05 plus 0.075 gives you 0.125. Correct? Then plus 0.196x plus this figure 20x plus 0.15. This alone divided by 99. Am I right? So this is what I have mentioned. 0.125 plus 0.196x plus 21x plus 0.15 by 99 is equal to how much? 0.16. Is that clear? You can take an LCM here. Correct? You can take an LCM here, cross multiply, arrive at the x value. Roughly, you will get x as how much? 8.2%. X is nothing but the rate of interest of a debenture. So, which means the rate of interest of bank loan will be 1.4 times x, which is going to be 11.48%. Are you all able to understand? I'm just giving you guys approach this question. And one more thing that we have learned here, KE is equal to 1 by PE ratio. If PE ratio is given, 1 by PE ratio is equal to what? Your KE calculation. Is that clear for everybody? Is that clear for everyone? And that's about this particular question. I want you all to physically work it out, because solving the equation normal only, but I want you guys to get the confidence. So please, will you take this alone as homework, or you want me to do it now? Guys, this is very basic. You need to please get used to all these things, right? Additional question only I discussed here itself. Okay, fine. That's about this question. Mark this as important. Once again, it's a missing figure problem. Write down. Missing figures, write down. Calculation of KD and KT when KO is given. Calculation of KD and KT when KO is given. Calculation of missing figures hyphen. Calculation of KD and KT when KO is given, semicolon. Semicolon. Written, semicolon. Write down. KE is equal to 1 by PE ratio. 1 by PE. KE is equal to 1 by P. Take a red ink and write. If you have already written, take a red ink and put a box. K is equal to what? 1 by PE ratio. Is that clear, guys? Will you guys forget this formula? No. And that's about this particular question. Effectively, guys, including all the sub questions and all, literally, we have done 34 problems in this chapter alone. Now, this reason for me doing so many problems in the classroom itself is because of the variety of problems. We just started off with this KD, KP, KE, KR calculation and all. Then we went on to WACC. Then we did some different varieties of problem in WACC using this yield. So debenture yield was given. With that we computed redemption value and all. Guys, you remember the present value, that is net proceeds and all we did. Then we went on to see your levered form, unlevered form. You guys remember? In unlevered form, all equity. So KO is equal to KE. Guys, we saw that. Then short-term debt treatment we saw. Look at the library of adjustments, you will know how we proceeded the chapter, right? It should be ignored. Then we did marginal cost of capital. Then we did slab-wise calculation of what? Your, the slab-wise computation of KO. Guys, correct? Then we went on to see convertible debentures. Guys, correct? Then we also did one question where we need to decide whether to take a term loan or debenture. We had to compute the effective cost KD and compare. Guys, correct? Then we went on to see zero coupon bonds. Then K using realized yield approach, that is geometric mean of holding period return that we said, that we did. Correct? Right? And then one question, prevailing interest rate. Right? Ram, the remaining period and all we had to consider. That one question we did. And right now we did also a missing figure question. Is that clear, guys? Right? Such a comprehensive coverage. Every single thing in our concept decoder, we have covered it right now. I think that's about it. When MCC was covered, right? And look at this, some core theory topics. Significance of, cost of capital. In theory, guys, why do you need to compute cost of capital? I told you, number one, for evaluating investment options. Just now in the sum we did know. For the purpose of discounting my projects, the discount rate I use is what? Minimum required rate of return. That is nothing but what? Your KO, guys, correct? Next, financing decisions, we know. Fundraising activities and designing the credit policy and all is given. Now, guys, there's something, one second, I want to tell this to you. Risk classification under CAPM method. Now, guys, this is ideally something in detail I will teach you in CA Final Advanced Financial Management. What is it? I will tell you. Now, there are two types of risk. I told you beta is a measure of risk. I told you more the risk, more the return. Correct. There are two things. One is called as unsystematic risk. The other one is called as a systematic risk. Is that clear? Is that clear? Now, what they have given here is, guys, what they have given here is, now unsystematic risk means what? A risk which is attributable, associated only with the company. Systematic risk means a risk which is not specific to the company, the risk which is prevalent for the entire market. Example. Now, let us say there is COVID. COVID happened. Is it company specific or entire market specific? Market specific. When COVID happened, the market crashed. The market crashed, which means it impacts the entire market, not one company in specific. This is called as a systematic risk. It is a macroeconomic or a market specific risk under which a company operates. Can I eliminate the risk? No, the risk cannot be eliminated by diversification. Hence, it is non-diversifiable. Example, inflation, government policy, interest rates and all. Is that clear? Guys, clear with this? Right. Now, what they have given, unsystematic means what? A risk which is company specific. For example, Tata Motors. In this company, there is one strike happening because that production stopped. The entire market gets affected. No, it is my risk alone. Guys, correct? Unsystematic. Systematic means, it is pervasive throughout the market. Whereas unsystematic means company specific. Now, this is avoidable. This is eliminatable. Yes, I can avoid this risk. Is that clear? This is also called as company specific risk related with the company's performance. This can be reduced or eliminated by diversification of securities in the portfolio. It's also known as diversifiable. What is diversification? All we'll see later in final. It's not required at the intermediate level. Is that clear, guys? Now, as diversifiable risk can be eliminated by an investor through what? Diversification. The non-diversible risk is the risk which cannot be eliminated. Therefore, a business should be concerned as per CAPM method solely with what? Non-diversifiable risk means what? The non-diversifiable risk are associated in terms of a beta coefficient. Now, when I say beta refers to what? Systematic risk. Is that clear, guys? Beta refers to what? Systematic risk means what? The risk that is pervasive throughout the market. Is that clear? So beta indicates risk, I told you, more specifically, it indicates only systematic risk. Unsystematic risk is not covered in beta. Is that clear, guys? Overall risk of a firm, we will be seeing in final, it's denoted by something called a standard deviation. Is that clear? But all that is not required at the intermediate level. Beta stands for systematic risk. That alone you need to understand. And that is what your CAPM formula talks about. The non-diversifiable risk are assessed in terms of beta coefficient through fitting a regression equation between the return of a security and a return of portfolio. That is nothing but what? Your standard deviation and all I told you. What is it? We will see at the final level. Are you guys able to understand? Systematic, unsystematic risk. Are you guys able to understand? Simple theory if they ask. What should you say? Systematic is a company specific risk. Unsystematic is a company specific risk. Systematic means what? It's a market specific risk. That's about it, right? What is the shortcoming means disadvantage of CAPM? Beta estimation is based on historical data. I told you the beta calculation itself is there in your final. I'll be dealing it in detail right now. Understand, it's based on past data only. We do it using some regression analysis and all. We'll be seeing at the final level, right? And the market imperfections may lead investors to unsystematic risk. Basically, beta only captures what? Systematic risk, I told you. So it doesn't capture unsystematic risk. Now, what if unsystematic risks are there? That is not covered in CAPM equation. That is one drawback. Is that clear, guys? If at all this comes, even theory, you must be able to answer. Is that clear, guys? And with this, we have completed in detail the first and the most important chapter, official first chapter, called as what? Your cost of capital. Ideally speaking, with this, we have finished this entire chapter number 2. First chapter we did was time value of money, and then this cost of capital chapter is over. Is that clear, guys? Right? So with this, I am concluding this session. Please revise and practice all the sums we have covered till now. Also practice what? Your supplementary the supplementary booklet, right? Which I have issued. Look at the supplementary question bank, supplementary material to solve the question bank. Latest exam papers, RTP, MTP problems and all are there, right? With solutions, I have provided everything, right? Latest from Jan 25 onwards, whatever attempts it's been included here. So please do these questions, attempt it by yourself, right? Anyways, for regular students, I'll be discussing this as well. But anyways, you first practice. After you finish watching the lecture, you practice by yourself and then you can join the discussion. Is that clear, guys? Right? So with this, I'm concluding this session. Please revise and practice all the sums we've covered till now, and I will see you all in the next one. Thank you all so much.